The second day of talks in Berlin on a peace plan aimed at ending Russia's invasion. So do watch the likes of Renk, Hensoldt, Rheinmetall and Leonardo at the Open, Anna.
Yeah, we'll certainly keep those in focus with geopolitics and gradual movements towards some kind of peace deal in mind. So the start of the European equity market session then for this Monday morning nearly upon us, waiting to see some modest gains coming through across European equities. Will we see some negativity around the basic resources because of the China story, or is that all about retail and therefore not so much about China, about basic resources? Let's have a look and see if we get that coming through in London. The FTSE 100 for the moment up by 0.2%. The Stock 600 up by 0.1% then. So we are seeing these modest gains, as suggested by the futures picture, coming through for European equity markets this morning. And just waiting for others to open up. There we go. The IBEX in particular up by 0.8% over in Spain. The CAC 40 up by 0.2%. So that's the big overall mood of the markets, I suppose. A little bit of catch up for Friday, a little bit of positivity, Lizzie. What else do we see beneath the hood?
Yes, so if we look at the sectoral breakdown, Anna, we only have two sectors in negative territory this morning, and that's technology and healthcare. But at the top of the basket, we have energy up more than 1%, banks in second place up 0.9%, and basic resources up 0.9%. We were flagging the China story, but indeed basic resources actually in the green. Chloe Melly had told us to watch defence because, of course, we are monitoring the geopolitical situation with Ukraine. We have Rheinmetall down 1.2%, Leonardo down 1.5%, but other names in this sector actually managing to eke out gains. So Safran and Airbus are in the green.
Okay, so that's the defence story. And it is interesting to think about what link there might be between the defence names and any peace in Ukraine, because not as simple as a peace deal means no need to spend on defence, because obviously we know the national security plans out of the United States came as quite a shock, even if the messaging has been to somewhat consistent over recent months. There's still going to be a need for a lot of defence spending in Europe, so we'll keep that in mind as well. Back to the markets, and most sectors are actually in positive territory, aren't they? So in keeping with that overall move in equity markets, in indexes, we are higher across nearly every sector. As you say, healthcare is the only one that's negative, and I wonder if Argenx is one of the reasons for that. Yes, that particular biotech down by 7% on the back of one of the results that they posted to the markets, and energy and banks, the best performing sectors this morning.
Yeah, not perhaps as much relief for automakers as we had expected. We were talking about the softening of rules that would have banned new combustion engine vehicles from 2035. You are looking at Mercedes shares up 0.9%, Stellantis up 1.2%, but lesser gains for the likes of Volkswagen and Renault this morning. Should we dive into the broader themes of this market? John Bilton, head of global multi-asset strategy at JP Morgan Asset Management, joins us round the desk. Welcome, John. I want to start with AI, because we've had some gloomy narrative at the end of last week, lots of jitters around Broadcom and Oracle. You don't think that we need to be that jittery? Why?
No, I don't really, because at the end of the day, we're going out of our way to try and count out what is, we consider, the fourth major technology revolution that we've seen in our lifetimes. I mean, we had the mainframe era back in the 80s, we had the dot-com era, 90s and 2000s, mobile telephony during the early part of the 10s, and of course, this is the next big deal in our view. Huge amounts of investment going in, people trying to call the top in this, but remember, they're comparing it with the dot-com era. These are profitable companies. It has a huge footprint in terms of how it can be supported for the economy broadly. And if you look at CapEx ratios, we're at about 20, 25%, which is way below where we were at the dot-com era. It was about 35%. So, there's a lot of investment going in, and we're beginning to see some signs of this productivity lift.
So you're not worried about the bubble bursting. Do you buy dips? And if so, how big does a dip have to be to buy them?
Well, I think there's a couple of things going on right now. If you actually look at the year as a whole, we're right in the middle of December. People are probably squaring books, thinking about taking some money off the table. What's their big winners been, especially since April? It's been tech. No one got fired for taking profits. Let's be clear here. And if we look at what a 60-40 portfolio's done, 17% if you stayed the course this year. So, squaring books a little bit makes some sense. So, are we expecting a major dip down in tech? No, not really, because the earnings continue to accrue, the investments continue to be made, and a lot of the 2026 revenue is already basically booked because of the investment going in. So we think that there will be buyers not too far down. There's a lot of investment going on, to be clear, but the talk of the bubble might be slightly premature.
Okay. Good morning to you, John.
Good morning.
Let me ask about Europe then, either on that note or thinking more widely. So either because you like tech and you like something that Europe's doing on tech, or because of other things. You become more constructive on Europe. And I wonder what's going into that. Is that all fiscal stimulus, or is there something else?
So everyone's very clear on the fiscal stimulus. I mean, Germany have been talking about it now since February time. So, that's, to our mind, probably largely discounted. I think what folks have neglected is just how unhappy with the world the European consumer's been. Look at the savings rate, household savings rates, about 15.3, 15.4%. That's the highest it's been outside of COVID. Yet we've got record unemployment across the Eurozone. Record employment, across the Eurozone. So the result is what's going on. And I think we've come off the back of quite a lot of negative news in Europe. We've seen a slowdown in terms of the economy in Germany. Generally, we've had a lot of political news as well. We only need the consumer to begin to move sideways, stop adding to that savings rate, and we begin to get an uplift. And then look, of course, at where the PMIs are pointing. PMIs at the moment are running roughly in line with what would be a 1.6% GDP growth rate for next year. That's above trend growth. So we're positive on Europe from its ability to recover naturally, not just from fiscal stimulus.
So where does that shine a light on European stocks then? Is it about European retailers? Is it about a wider suite of products than just that? Where's the focus?
So there's a few things going on. So right now, our big emphasis is on the euro. Because, of course, we've got the Fed still cutting, we've got the ECB likely on hold, generally supportive of the euro, which is still undervalued in our view, probably by the tune of 7 to 10%. In terms of the stock market, the banking sector's had a great year this year, but we continue to see an uplift, not only in deal activity, but also in the credit impulse. And so generally that's supportive of the banks, who are in decent shape. Outside of that, we've obviously got some sectors which have been very geared to places such as China. Data there weak, obviously, as we know, overnight. But generally, we are a little bit more optimistic as we gradually move through the sort of quarters ahead. That potentially supports some of those consumer discretionary names as well, which have not had the greatest of times. So ultimately, when we look at the European index, we're moving away from some of those big defence moves that we saw early in the year and just thinking about the economy gradually sort of, sputtering back into gear.
So if you're positive, not that positive, but positive on Europe, John, does that mean that the ECB's next move's a hike?
So this is an interesting one. So the ECB, if we think where the outlook is for inflation, the ECB have pretty much done what they need to do. We've now got a symmetrical target. We've had that for some time now. We're running at around about the 2% kind of level, give or take change. Do we expect to see a massive early cycle reacceleration in Europe? No, this is not a world where we think that you're going to get Europe really sort of going off to the races here. This is talking 1-2 of a percentage point above trend growth, a gradual repair, a broadening out. But let's make no mistake. I mean, there's still a situation in Europe where we've got to deal with certain fiscal issues, places like France, for instance. Germany is only just beginning to see some of the impact of its improving economic outlook, and consumer sentiment remains weak. So I would say we're probably facing an ECB, firmly on hold for the next 6 to 12 months, in our view, at least.
Okay. Yeah. And what's you were keen to talk China a moment ago, and that puts me in mind of the China link with the ECB, the deflationary risk, I suppose, that there is for many places outside the United States from all of those Chinese exports that previously would have gone to the US now going elsewhere. I mean, how significant, how material is that going to be in 2026, do you think?
Well, I think it informs Chinese policymaking. That's the issue here. So if you've got a country which has been used to exporting, actually, interestingly enough, in the data overnight, the export data wasn't actually too bad. So generally that's holding up, even though it's domestic issues that are the problem. So the question mark is, if you've got a country which has potentially a disinflationary impulse and some overhang in terms of excess capacity, and this is a country with an ageing population, of course, what do? Do you go in and build masses of infrastructure? Probably not. Do you think more about the regulatory stimulus, supporting profitability of companies, some of the work they're doing around anti-involution, etc.? And then, of course, the People's Bank of China, what do they do with rates? So we think that there will be a target for around 5% growth next year, and we think that that will likely require some further easing of policy. So potentially, a relatively easy outlook for rates in China over the next 12 months.
Okay, so same target, but maybe a bit more policy needed to get there.
Indeed.
Just coming back to the US, though, because you started by saying how optimistic you are about AI. If we take it to the macro level, since you're relatively optimistic about the US economy, what justifies more cuts from the Fed other than the politics when you look at the economic case? Or should we be talking about Fed hikes?
Well, again, I think, look, monetary policy it's not a sort of spring that goes backwards and forwards. Policymakers like nothing more, in my humble opinion, than to be quite predictable and fairly boring, because that's what keeps economies going on. If they've got some stability and some certainty. So the idea that the Fed overcut and then suddenly overhike, that's really not the look they want to have. So we think there's maybe one more cut to go. And in our view, this wasn't the Fed suddenly responding to the need to massively cut rates much more than they'd previously planned to. They've brought them forward. So effectively, we didn't see the massive spike in inflation that some were concerned about at the end of this year. Inflation, it's above target, but we think that there's scope for it to gradually ease next year. The labour market's been a bit soggy, and that, I think, has given the Fed the ability to just do things sooner. We think maybe one more cut as we come into the first half of next year, and then probably data dependency. And what we're looking at in terms of growth, actually, from our point of view, is real terms growth. So we've got gradual pickup in investment, we've got a pickup in productivity that we're gradually beginning to see. That tends to be something that policymakers like to have on the books, as opposed to something which is being purely driven by nominal growth.
And John, so you think, are we already seeing, I think Chair Powell nodded towards this in the press conference, he thought we are already seeing some productivity gains from AI.
Yes.
Are we at the foothills of that, or do we have to wait a few years to really see what this can deliver?
Well, this is a multi-year phenomenon, let's make no mistake. Right now, we've got the big tech firms, the hyperscalers, who are really capturing the rewards of this. But bear in mind, the investment that's being made, that's something which will accrue to the wider economy. Go back to the mainframe era. It's some of the big tech names in the late 70s, early 80s were the biggest names in the index. But actually what powered the economy during the 80s was really reaping that return on investment. You're starting to use the mainframes as part of normal business practice. What's super interesting is that so far, in terms of AI, you've now got 40% of the world's population using AI day to day. That's taken 2 years. In the mainframe era, it took 13 years to do that. In the dot-com era, it took about 6 years before 40% of adults were using it. See where we're going? This is accelerating.
Yeah.
It's a big deal for the wider economy, and that's why we believe that the productivity upside is definitely there to be played for.
John, can I just finally ask you why you prefer gilts over bunts and treasuries? You're a rare specimen to do this. And I've just been looking at the bookies. They think that Starmer is going to be out of office next year. What's making you so confident that this Labour government can fulfil that fiscal consolidation that they've backloaded?
Well, I think there's a couple of things going on. I mean, first and foremost, you look at fair value on gilts relative to where we are in the UK from an inflation point of view, which is cooling gradually, and also a real growth point of view. Actually, we're a little bit we're trading a little bit cheap relative to where those things should be. We see a sort of low 4s percentage point level for the 10-year gilt. Turn around to Germany, and actually we know there's more issuance coming, there's a lot of spending about to take place, and generally Europe is re-accelerating. The growth picture here in the UK is a little bit sluggish, a little bit soggy. So I think when we actually look at fair values, it's a question of right-sizing it necessarily, rather than making some big call on fiscal consolidation.
Okay, John, thank you very much. Thanks for being with us. John Bilton, Head of Global Multi-Asset Strategy at JP Morgan Asset Management. Quick look at the core six then, as we wait to get a deeper dive into some of the stock moves this morning. Novo Nordisk on the back foot, down by just shy of 2%. In fact, some drug makers, biotechs in focus today. Rheinmetall in the defence space, that's in keeping with the rest of the sector. It is a negative day for defence names as we continue to watch those meetings ongoing between Ukraine and today it's going to be European leaders. LVMH moves higher, ASML a little bit of a retreat. We have Schneider Electric up by 1.4%. Let's get a deeper dive into some of the individual names, though, in focus. Chloe Melly has that for us. Chloe.
Good morning, Anna. We are seeing some modest gains for car makers in Europe this morning after the EU is expected to soften some of the rules around combustion engine vehicles. And so that would allow those companies here on the screen a little bit more time to transition to emission-free vehicles. So that's a big relief. And we are seeing some of those companies are moving higher today. As I said, quite modest gains, nothing major, but there's a little bit of relief going on there based on this. Moving on to defense, and we are seeing some weakness here as we monitor the progress of those peace talks that are now entering a second day. So the Ukraine President Zelensky has hinted that Ukraine could get some security guarantees from the US and Europe, and that could replace the long-term plan of joining NATO. And so this is signaling that there is progress on those peace talks. And as usual, when we get that optimism around peace talks, we are seeing some downward movements across that defense sector, and we are seeing Rheinmetall in particular down 1.8% this morning on the back of this. Moving on to Argenx, which is a biotech company that has discontinued studies for its flagship drug for thyroid eye disease, and it is down very majorly this morning, more than 8%, almost 9% this morning on the back of that setback that now is really interrupting a really impressive rally for that biotech company. And finally, miners are up this morning as metals prices are rising. Copper is rising because investors are expecting a tighter market next year, and gold is rising as investors are moving towards that safe haven and moving away from technology stocks because of fears around AI and spending. And therefore we are seeing in particular Fresnillo, the gold miner, up at 2.75% this morning, as well as Antofagasta and Glencore also clinching some gains as well on the back of those metals prices rising.
Okay, Chloe Melly from our equities team, we thank you so much. And we're going to dive into those themes Chloe was discussing, Ukraine and autos next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Welcome back to the opening trade. We are 19 minutes into Europe's session, and we've got European equity markets actually on the front foot, up by around 0.4%. A little bit of a rebound from some of the losses that we saw in Europe and in the United States on Friday. A lot of that was focused on the AI-related sell-off, but we do see Europe finding some space to rebound a little bit this morning. US futures pointing a touch higher, but only by 0.2% on E-minis, 1/10 on NASDAQ futures, and so not getting a sense that we're rebounding or recouping all of the losses of Friday, but certainly a little bit of a move higher. Let's talk about the autos sector here in Europe, because Europe's embattled automakers are set to get a breather as they struggle with the transition to emission-free driving, a critical moment that will shape the future of the continent's transport sector. Let's bring in Bloomberg's Elizabeth Behrman, who's been following the story. And we've had a deadline for the end of sales of new combustion engine cars for some time, Elizabeth, but is that being rethought? What are we expecting to hear this week?
We understand that the people are talking about taking this effective ban off the table, remain locked in talks. We're set to hear more about their decisions and plans tomorrow. It's fair to say that the industry is probably waiting with bated breath as to the exact details of what will be outlined there. We saw the shares of the respective car makers rising slightly, Volkswagen and Stellantis among them. The price reaction is fairly cautious, which would indicate that everybody is also worrying about the devil that usually resides in the details. But overall, I think we can be sure that this effective ban of combustion engine sales will be off the table for the deadline by 2035.
Yeah, Stellantis doing much better than, for example, Mercedes. Stellantis at 1.3%, Mercedes up 0.2%. Elizabeth, just talk us through really what's at stake here.
I think quite a few politicians have been on the front foot explaining that. Europe is home to a large and very important and a massive job center in terms of an automotive industry. And the bad news from the industry really has been piling up in the past few months. We've had a headline number from Bosch, the world's biggest supplier of auto components, shedding 13,000 jobs in their automotive unit as a result of a slower shift to EVs than expected. And that picture really is repeated elsewhere across the sector. The most pain for now is among the suppliers, especially in Germany. We've had mounting statistics of companies going out of business, closing plants, and that's obviously a big worry. On the other side of the spectrum, it's fair to say that if you slow down in the EV transition too much, you really risk remaining in a holding pattern while other companies, namely from China, are overtaking us in the technology transformation, because one thing is clear, that we are going to move away from the combustion engine, and losing too much time in that race is going to be just basically postpone the pain for later on.
Okay. Bloomberg's Elizabeth Behrman out of Munich. Thank you so much for that look. At the autos sector this morning, we are seeing it really in the middle this morning. We are seeing it really in the middle of the basket, up 0.5%. But it's a miserable day for the defence names. The moves coming after the Ukrainian President Volodymyr Zelensky signalled that Kyiv could accept security guarantees from the US and Europe in place of its long-term goal of joining NATO. So the likes of Rheinmetall down about 2% as things stand. Joining us for more is Bloomberg's Oliver Crook, our chief Europe correspondent. Morning, Ollie. Just walk us through the latest comments from Volodymyr Zelensky.
So those comments, they follow the meetings that were held yesterday in Berlin that were attended by President Zelensky. Friedrich Merz, who was obviously sort of overseeing the meeting, who was hosting it there in Berlin, with Jared Kushner and Steve Witkoff. And it was a sort of encouraging sign that the U.S. delegation showed up at all, because on Friday and last week, Trump administration, Donald Trump himself, said that basically he wasn't sure he was going to send any envoys to those meetings. He would only send them if he felt that meaningful progress could be made in the negotiations in trying to achieve a peace plan between Russia and Ukraine. He did, in fact, send his delegation. They spent 5 hours speaking with Zelensky. According to the White House and the U.S. side of things, that a lot of progress was made. And one of the things that Zelensky's put on the table is basically withdrawing, in some sense, his ambition for Ukraine to join NATO. This is seen as sort of giving something up from the Ukrainian side. Obviously, you're surrendering some degree of sovereignty when you agree to not freely associate yourself with any kind of particular association. From the Russian side, though, of course, the Ukrainians want an Article 5-like guarantee. The problem is, within this paradox, is the closer you get to an Article 5 guarantee, the more likely the Ukrainians are to sign on to it, and the less likely the Russians are to sign on to it. We should say we haven't heard a great deal from the Russians in terms of reacting to the 20-point plan as it currently stands. We understand it was sent on Wednesday of last week from the European side to the American side, so we don't really know how much traction this has. But again, encouraging that these talks keep going on yesterday and will continue again today in Berlin with a number of other European leaders.
Yes, and let's go there next then, Ollie, because we have other European leaders joining the wider conversations then today. What are we expecting? Who's going to be there, and what are we expecting them to make progress on?
So there are going to be 10 or so European leaders that will be in attendance, including there will also be the Secretary of NATO, Mark Rutte, as well as Ursula von der Leyen attending there, and a sort of the usual cast of suspects, whether it's the President of Finland, Alexander Stubb, Macron, Starmer, Merz, of course, who is hosting the meeting, and a number of other sort of devoted leaders to the Ukrainian cause, all to be discussing. But I think, Anna, really where the sort of importance comes is at the end of the week for these European leaders. We keep taking one step forward with the Russian assets and one step back. On Friday, the emergency powers of the EU were enlisted in order to circumvent Hungary and Slovakia. And over the weekend, we understand that the Italians have now joined a sort of letter suggesting that the European Union should look at alternative ways of funding Ukraine that don't rely on the Russian assets. Now, we should say the Italians are not saying that they're necessarily opposed to this idea, but they are saying that they'd like to hear some other options. Unfortunately for them, I think the only other option that the Europeans have come up with is joint debt. And as we know how sort of contentious an issue that is going to be a very difficult thing to progress across the European Union. So that being said, at the end of this week, we will know finally whether or not the Europeans will make forward progress on that EU loan that will be backed by the Russian assets, 90 billion euros. That is what would fund the Ukrainian war effort and the Ukrainian economy for basically 2/3 of the next 2 years. Whether or not they're going to get it over the line, I have to say, as of Monday, is fairly in doubt.
Okay, Ollie, thanks very much. Bloomberg's Oliver Crook joining us there from Brussels, and Oliver's going to have a really busy week. Plenty of guests coming your way from Brussels. Today, we'll be speaking to the European Commissioner for Trade and Economic Security, that's Maroš Šefčovič. Tomorrow, the Commissioner for Enlargement will be with the team. And then, finally, on Thursday, we speak to the EU High Representative for Foreign Affairs. That is, of course, Kaja Kallas.
Well, coming up on the programme, a personal appeal to Warner Brothers shareholders as Paramount tries to get the edge in the bidding war. Details next. This is Bloomberg.
climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back, everybody. This is the opening trade, 30 minutes into Monday's session, and the picture looks pretty positive across European stocks. Certainly the CAC 40, the FTSE 100, the Spanish market getting some decent gains this morning. A bit of optimism makes a change from Friday, when everyone seemed to be caught once again in a doomy mindset surrounding AI, and certainly that weighed on the US session. We saw that weakness coming through, certainly in the early part of the US session. Then there was a bit of a rebound. We catch up with that a little bit this morning, going a bit higher. Energy stocks, one of the best performing this morning, but broadly, Lizzie, we've got nearly all sectors in positive territory. This is a pretty broad-based, small bounce for European stocks this Monday morning.
Yeah, reflecting that green across the screen, across the geographies of Europe. We do have more stock 600 members higher than lower, 411 in the green this morning, Anna. But when it comes to volume, we have said that it is the final full trading week of 2025. And as you might expect, we've got volume lower this morning than usual. Flip the board over and we can take a look at the leaders in the stock 600 this morning. You've got Santander and Schneider Electric up, SAP up 0.9% as well. Flip over and we can look at the laggards as well this morning, and we are looking at Argenx. We'd flagged this down 8.2% as things stand. Bad news when it comes to that clinical study, and bad news for Sanofi from the FDA as well, so down 5.2% on that. Novo also in the red. What else we need to know, Anna?
Let's have a look at some of the other stories we're keeping an eye on then this morning. Australia is considering tougher gun laws after 15 people were killed in a terror attack on Bondi Beach. One of the gunmen was also killed. A father and son have been identified as the attackers, who targeted members of the Jewish community as they celebrated the start of Hanukkah on Sunday evening. It's the worst terrorist attack in Australia's history. France is seeking to delay this week's EU vote on a free trade agreement with South America. The proposed accord with Mercosur has been 25 years in the making, but the French Prime Minister, Sébastien Lecornu, says measures to protect EU farmers and consumers are so far insufficient. Sources say the deal could collapse if it is not signed by the end of this year. And China's investments slumped further, and retail sales expanded at their weakest pace since the crash caused by COVID, in another month of lopsided growth for the country. The Chinese inability to revive consumer spending, or the country's inability to do that, is exposing the economy to risks abroad after it relied on foreign demand to propel growth for much of this year, despite the tariff war unleashed by President Trump. And that Chinese data, really fascinating, Lizzie, just underscoring, I suppose, some of the criticisms that the US and Europe make about China, the imbalanced nature of the economy there, and it doesn't look as if it's moving very quickly towards, trying to rebalance the Chinese economy.
Yeah, factory output not that weak, but retail sales the worst ever outside of the pandemic. That 5% growth target actually looking to be okay for this year. That's what we're hearing from economists, but it's 2026 that is the issue here, and how much fiscal and monetary stimulus are you going to need in order to reach that 5% target, if indeed that's what they choose to set again, when you've got this stress potentially continuing. So the government's saying that it's planning more financial support for consumption, but Xi talking about needing it to not just be superficial, and he wants real growth. So he's thinking long-term and holistically here.
Yes, exactly. And so then we spoke to Phoenix Kalin earlier on, didn't we, with the emerging market beat in mind, and China's such a big part of that, of course, about whether there's going to be a substantial shift in Chinese policy in 2026 then, a slightly different complexion on their GDP targets perhaps, or further stimulus for the retail side of things to try and get a more balanced economy. She didn't seem to be all that hopeful that there would be a sort of major policy rethink in China, just sort of more of the same perhaps coming through there. But just to underscore what you were saying about some of the weakness in the data, the retail sales then, Lizzie, the weakest since COVID, and actually if you take out COVID, this is the weakest since data has been collected on Chinese retail sales. And then fixed asset investment set for the first full year drop since 1998. So that's the extent to which we're seeing those areas of weakness. And yes, industrial output holding up okay because of the ability to find new export markets, but that still raises worrying questions, I suppose, for the rest of the world about deflation, about the extent to which China continues to export that deflation.
Yeah, and indeed we already saw losses in the Chinese session. The CSI 300 down 0.6% earlier. The broader MSCI Asia Pacific Index down about the same amount. But let's go to corporate news. The battle to buy Warner Brothers expected to take months to play out, and to get an edge, David Ellison, the chairman and CEO, of course, of Paramount Skydance, is forcing the firm's board to reconsider his offer by appealing directly to the company's shareholders, some describing it as a hostile bid. Well, we're joined now for analysis by Ben Barringer, Global Head of Technology Research and Investment Strategist at Quilter Cheviot. Really good to have you with us, Ben. We're both dying to talk to you about this exciting corporate drama. But let me start by asking you, why does Netflix want Warner Brothers Discovery? Do you see it as a diversification play, and would it be the end of cinema if it wins?
Look, I think this is a really interesting opportunistic bid, actually, by Netflix. They've got a really unique opportunity and timing to buy a high-quality asset, both in terms of the content library, but also in terms of the production. So the key asset, of course, is HBO, but you also get the Warner Studios in as well. So I think it's very much about opportunistic. The other thing that's really important, and remember the Netflix business model is all about driving engagement, and obviously HBO and Warner would give them more engagement, and engagement naturally turns into pricing power, and so that's what we've seen. As engagement has grown, Netflix has been able to increase its pricing, and along with subscribers, that's led to good revenue growth at Netflix. So I see it as opportunistic from Netflix side.
But of course, who's fighting whom depends on who wins, because Paramount wants to fight Netflix, but Netflix says it wants to fight YouTube. Do you think that actually the US Justice Department will buy that argument that Netflix is using this deal to fight YouTube?
Well, I mean, this is all about regulators' definitions of the market and market power. So Netflix were talking last week, and they were saying that this would take their market share from 8% to 9.2%. And to your point, that's still well below YouTube at sort of 13%. And actually, they were sort of counter-arguing to the Paramount offer and saying that actually Warner Brothers Paramount would take their share up to 13.8%. Right. So I think it's again how the regulators are going to break it down in terms of market definition. Those are the TV market shares. It's slightly different in film.
Yeah, it's really interesting, isn't it? How you define the market. Is it just TV? Is it just TV? Is it film as well? Is it both together? If you're including YouTube, are you starting to think about gaming businesses as well? It's all competition for eyeballs, you know, that kind of thing. But I want to ask you specifically about something I found really interesting in the last couple of weeks, Ben, was when Paramount made their offer, the share price really jumped on the day it made the offer. And sometimes that happens in M&A, but often it doesn't. When you see companies willing to spend large amounts of money, there's risk involved. It doesn't always deliver and create shareholder value. So does that tell us something important about what the market thinks will be created if Paramount gets its hands on Warner Brothers?
Well, that's exactly right. I mean, Warner Brothers and Paramount together create a credible number two, or even potentially, as I say, bigger than Netflix and Disney. And so there is a huge amount of value accretion. You know, the other side of this, though, is that, you know, Sky, Paramount, needs this deal a lot more than Netflix needs it. You know, you need to be able to merge these two businesses together, one in terms of creating scale, but also in terms of the synergies. And because there's a lot of overlap in the Paramount and Warner Brothers businesses, there's that much more synergy. And so, yes, it's much more imperative that the Sky deal goes through compared to the Netflix one. Yeah.
Yeah. Yeah, I mean, there are many different stakeholders here, and in terms of the wider community in Hollywood, are they pushing back? Are they much more nervous about a Paramount Warner Brothers tie-up because of those quote-unquote synergies, which everybody knows will mean some cost-cutting? Are they much more nervous about that?
I think that's right. Exactly. If you look at the two plans, there's a lot more cost cutting potentially from the Paramount offer. You know, Netflix, although it has exposure in Hollywood, you know, is a lot more diversified geographically. But yes, their offer is still they're going to create more jobs than they're going to cut in terms of that. But yeah, let's see in terms of the offers which one plays through. Personally, I think it's a bit more of a distraction for Netflix, and they've classically been builders, not buyers. So I think the Paramount deal is structured so that, you know, they really do need to win this one.
Ben, what about the stakeholder in the White House? I wonder how much President Trump's vote will be a deciding factor, or whether actually his role's being overblown here. We know that the Ellisons are pro-Trump.
Yeah, so his issue really is around CNN, and it's a little complicated, this, because under the Paramount deal, CNN will be owned by that entity, whereas under the Netflix deal, there'll actually be a spin-out of the CNN and the legacy TV assets. So it's not certain that there'll be a new owner for CNN under the Netflix deal. And so what Trump wants is a new owner for CNN, and so he tends to favour the Paramount deal in some of his commentary. But let's see whether Netflix can work out a way of getting a new owner for CNN, which is ultimately what Trump is interested in. He hasn't opined too much on the sort of regulatory and market definition piece that we were talking about earlier.
And when it comes to CNN, if Paramount's offer's backed by Gulf money, how much of an issue would it be that CNN and CBS News would be part-owned by Gulf monarchies, and also, of course, the president's son-in-law? How squeamish would that make Warner?
Well, look, I think, you know, all of this ownership of news media is very difficult for me to opine on. Look, it's not a good look, but you know, there's plenty of interests in news networks around the world.
Is this going to take months and months, Ben? I mean, it seemed to all happen very quickly, and then we're waiting. Is this going to take months and months, do you think? Are we going to have further offers coming through?
Yeah, I think there will be further offers. I mean, there was a report in the New York Post that that Paramount potentially are going to raise their offer to 33. In terms of the timelines, yeah, the Netflix deal would actually take longer, potentially, you know, up to a year, maybe longer, simply because you've got to spin out some of the old legacy TV assets. But even with the Paramount deal, it's going to take, you know, certainly quarters rather than weeks for this to be concluded. So I think we're very much at the early innings rather than the late innings of this game.
Okay, Ben, thank you very much. Thanks for joining us. Ben Marriger, Global Head of Technology Research and Investment Strategist at Quilter Cheviot, with that really interesting story. I mean, it does, someone will have to make a film about this one day, won't they? A movie. It's got movie potential.
Well, it's got TV drama potential. Seasons 1, 2 and 3 just writing themselves for us.
Where are we now, then?
I feel like we're in 2.
Okay.
Okay. But yeah, no, let's see who wins out of this. Because so much, political consequence of this as well. If, as Ben was saying, it ends up being a paramount deal, and we have to see what happens in the news world as well.
Yes, absolutely. It's interesting how that legacy media, to some degree, not very highly valued and of least interest to the bidders, but it's having an outsized impact on the conversation around what it's worth and where this ends up sitting, this asset. Coming up on the programme, we'll get back to some of the macro agenda this week. The UK is set for a barrage of data and an all-important Bank of England decision this week. We will preview all of that UK action next. This is Bloomberg.
Estava sitiada.
Isso, ao começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. 46 minutes into Monday's session, and we have green on the screen across European equity markets. In fact, a little more than maybe we'd anticipated, up by 0.6% over, on the Stoxx 600, the wider market. In particular, the more peripheral markets, the FTSE MIB, for example, up by 1%. And US futures actually improving over the last 15 minutes or so. E-minis now up by 0.3%. It is going to be a busy week. We have new US non-farm payrolls, two prints on US non-farm payrolls coming tomorrow. Will either of them shed any light on the jobs situation in the States sufficient to change the debate around the Fed next week? We'll also get some global PMIs. We've got UK CPI on Wednesday, more data coming out from the UK as we go through the week, and a Bank of England rate decision. Then we get US CPI on Thursday and the BOJ, keeping us busy all the way into Friday, Lizzie.
Well, let's focus in on the UK. That widely anticipated rate cut from the Bank of England this week could force policymakers to confront whether the easing easing cycle's nearing its end, almost 1.5 years after it started. Let's bring Bloomberg Economics Chief UK economist Dan Hansen for a preview. Dan, it looks like it's going to be on a knife edge, all resting on the governor. They've said that they're moving gradually but not carefully, whatever that means. When do the cuts end, in your view, at this point?
So we think they'll end in the first half of next year. So we think they'll cut this week, data permitting. I think you'll probably need to see some pretty big surprises for them not to cut this week.
Do you have a number in mind of what would stop a cut?
I knew you'd say that. So we think, I think the CPI would have to be a blowout CPI, basically, and that's the one, I think, because if you look at the jobs data, it's the way the data is measured and the like, it's quite difficult for it not to be a 5% handle on the unemployment rate. It's pretty hard for pay growth to not fall, I should say, beneath 4%, just arithmetically the way it works. So I think CPI would be the one that would need to surprise, and particularly measures of underlying inflation that the bank looks at, things like services inflation. As I say, I think the surprise would have to be pretty big, particularly given what's happened in the budget. Given what's happening in the economy, we had a big surprise. Anna and I spoke about it on Friday. We had a big surprise in the GDP numbers. The economy could contract in the final quarter. The bank was expecting 0.3 growth. So that's a massive difference. So all else equal, even if the inflation data is surprising a little bit to the upside, you could dress this up as an insurance cut and send a message that we're not in any rush to cut again, because you are a little bit worried on the other side of things about inflation.
So that's the new thing we do, isn't it? We do insurance cuts if there's a sort of stagflation light narrative out there that the economy is weak, but inflation is also a bit of a worry. You call it an insurance cut, and then people don't freak out that you ignored entirely the inflation story. Tell us more about that growth story, Dan, because as it settled in, I mean, this is quite a lot of. Usually the 1 month GDP, it doesn't move the needle too much, but it was pretty weak. I mean, there were specifics around one particular car factory, weren't there? But there seemed to always be specifics about why the UK GDP number has come in weak.
Yeah, you're right. There's always, every month we have a one-off and we have a reason why it was weak. But as we were talking on Friday, there were issues in the run-up in that print, things like the budget, the uncertainty around the budget, things about car production. But actually, if you look on an underlying basis, the big story, and Phil Aldrich had a nice story over the weekend about it, is about consumers and about whether consumers will be willing to spend a little bit more going into 2026. Because the story so far has been one of sort of pretty significant caution. And if you have 60% of the economy, which is what consumption is, not spending, it's quite hard to have economic growth. So that's. If you're thinking about the risks, we're maybe talking about an upside inflation surprise, but on the other side, you have moving into 2026 this risk, which is what the governor has said he's more worried about, I should say, which is weak growth driven by weak consumption.
Well, the split on the MPC seems to be, do you care more about the labour market or inflation, and where is neutral? And no one wants to say except for Alan Taylor. But how weak is the labour market? Like, we've had some private data out this morning. In your view, when you look at things, how weak actually is it? I think
there was a point over the summer where we thought it might be bottoming out in terms of the speed at which the labour market was loosening. I mean, the labour market is operating beneath full employment, so there's slack, as economists call it, in the labour market. I think the latest set of data has sort of poured cold water on that. We've had some continuing of the loosening in the labour market. I think the question is, was that similar to the GDP data, a similar driver, the uncertainty about the budget? Was it around that? And now firms are going to be, now that we know what was in the budget, because that was what it was about, like what was coming, will the labour market begin to stabilise somewhat? I think the risk with the labour market, and it's always the risk, is that it moves in a non-linear fashion. So you get to, this is why the SARM rule is a thing in the US. You move to a certain level, and all of a sudden the unemployment rate goes very quickly in the wrong direction for a central bank. So that's the risk they want to guard against, and that's the risk, I think, for the Bank of England, is they just don't want to be, they want to be restrictive because of inflation, but they don't want to be too restrictive because of the labour market.
And that non-linearity in mind. Thank you very much, Dan. Good to get your perspective. Bloomberg Economics Chief UK economist Dan Hansen. Probably much more from Dan this week, as we have plenty of UK data and, of course, the Bank of England. Now, for the other major decisions in terms of central banks and the data points, Bloomberg's Valerie Teitel is with us. So we also have, Valerie, the ECB to look ahead to, the BOJ on Friday, and lots of US data. I mean, where do we think the big surprise comes from?
Well, as Dan was mentioning, you know, the weakening of the labor market, I think, is a key focus, not only in the UK, but also in the US, especially after Powell in the press conference last week said out loud that he expects unemployment only to tick up 1 or 2 more tenths in this cycle. So it puts a lot of focus on the unemployment rate. If we do perhaps get an unexpected rise, it's currently at 4.4%, but it has been ticking higher 3 straight months up until the shutdown, and we obviously are not going to get an unemployment rate for the month of the shutdown. But if we do see a decent tick higher, it might start to doubt the Fed's confidence that the labor market is not, I guess, accelerating its weakness in the U.S. That one is a key focus, but also these central bank decisions, I think, are also, likely to throw maybe a monkey wrench into the market calm this week.
Yeah, unless we paint the ECB as the boring one, actually the forecast could be quite interesting from the ECB.
No, I actually think the ECB could be really interesting because at the same time, it can be very awkward, I think, for Lagarde to answer questions on why we had all this hawkish language. Meanwhile, in your forecast, you're still undershooting on inflation in 2026 and 2027. The market actually thinks that she could downgrade 2027 core inflation even further from where it is right now at 1.9%. So undershooting on inflation and talking about rate hikes doesn't necessarily add up to the market's minds. Remember, we had the more hawkish side of the governing council, Isabel Schnabel, talk about how she's comfortable with the market pricing in a rate hikes, and that really did upset the bond market in the month of December. Essentially, globally, we've had a sell-off in the belly of these 5-year yields. The market really now starting to doubt any rate hikes or any rate cuts, I guess, from most central banks out there, emerging markets included.
Yeah, I mean, it seems like the market wants to pivot to a new hiking narrative, doesn't it?
Except for the Fed, thankfully. So
right, except for the Fed, although there were questions about that. The media attempting to make that pivot, I suppose, but Jerome Powell pushing back on that. I guess that takes us to the BOJ, where we do have expectations that we get a hike. So I can't work out if they're behind or ahead of the curve, but they're certainly going their own way.
Yeah, so there's been a lot of messaging from Bank of Japan officials of late, almost trying to set up the market for hawkish guidance at this meeting. So let's see how the market actually takes the announcement, but we are expecting a hike from the Bank of Japan, and what we've been led to believe is that they might leave the table open for more hikes next year. The question is, to what extent? Are we talking about 2 or 3 or just 1 more from the Bank of Japan? We also had reporting overnight that they are looking to begin selling their ETF holdings in January. This is something they signaled back in September. They gave us, the pace at which they wanted to do it, but didn't necessarily declare when they would start selling those into the market. So again, another hawkish angle from the Bank of Japan that they'd be selling these ETF holdings, winding down their balance sheet, essentially, is another thing that they've been trying to do. We've not heard how they're going to be doing that with their bond purchases yet. They've obviously been quiet alongside the huge adjustment to JGB yields we've seen this year.
Well, it was interesting because we were speaking to Sri Kochgovindan earlier, and she was saying actually it's the fiscal story that you need to mind more than the monetary story when it comes to Japan.
That's also very interesting. We have new leadership in Japan, and we know the Bank of Japan isn't always as independent as some think. So we have seen Sanae Takaichi, the new prime minister, almost give permission for the Bank of Japan to be hiking at the moment. She has kind of toned down her language ever since she became prime minister a few months ago, but big questions on her fiscal spend, what kind of bond issuance that entails for a market like JGBs, which honestly you can blame for a lot of the steepening of the curve this year. The long end of the JGB curve has had a humongous readjustment, and the fact is it might not be over. It might still bleed into 2026.
Okay, Valerie, thank you very much. Bloomberg's Valerie Seidel with the latest on what we're watching ahead this week. And Lizzie, I can't work out whether the US data is going to be really exciting and a huge market event because of the flaws in it and the things that aren't there. Will we just end up with a situation where people are able to tell all kinds of stories they want to tell about that US data?
I think we're just happy to finally have a bit of data, even if it isn't complete
even
and it's
imperfect.
Not perfect, exactly. But yeah, can we answer that question of whether the Fed's done? Probably not, according to our economists. Anyway, we've got futures pointing higher still stateside. S&P evening up 0.4%, and we're doing well on the Stock 600, up 0.6%. That does it for the opening trade. The pulse is up next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Australia's Prime Minister says the country will seek to strengthen gun laws after 16 people were killed in a terror attack targeting members of the Jewish community on Bondi Beach. Ukraine and the U.S. are due to hold a second day of talks in Berlin on a plan aimed at ending Russia's war. This, as President Zelensky is set to meet European leaders today for a major summit. And a big week for investors in the last full trading week of the year with key central bank decisions and inflation and jobs data from the U.S. So happy Monday, everyone. There's quite a lot going on. We look at geopolitics. We, of course, look at the world of corporate news and try to figure out what happens with the Fed in the next couple of, well, not cycles, but cycles that we talk about. Look, U.S. equity futures edging a little bit higher at the start of the last trading week, full trading week of 2025, 6,912 points for the S&P futures. Look, the other thing we look at is, of course, gold. It's usually a good barometer of some of the risk or not out there. Gold at 4,349, and global risk appetite in general, I would say, has ebbed on doubts that tech stocks have propelled global benchmarks record highs, still warrant their lofty valuations. Euro dollar 117.32, and this, of course, is also all playing out on European equities that seem a little bit stronger than in the U.S. today. But, of course, in a much longer term, their still valuations are cheaper than what we're seeing abroad. Look, the FTSE and the CAC 40 gaining some 0.5%. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Australia's Prime Minister, Anthony Albanese, has set out options for strengthening gun laws following the country's worst-ever terrorist attack. 16 people, including one shooter, were killed after a gunman opened fire during a Hanukkah celebration on Sydney's iconic Bondi Beach. Let's bring in Bloomberg's Swati Pandey in Sydney. Swati, bring us up to date with the latest developments and what the Prime Minister is actually proposing to do to strengthen these gun laws.
Good morning to you, Francine. So Prime Minister Anthony Albanese held an emergency meeting with the state and national leaders, and they have agreed to strengthen gun laws in the country. And remember, Australian gun laws are already really strong, and it's really difficult to acquire firearms in this country, but they are going a step ahead, and the cabinet has tasked police ministers and attorney general to explore options, including caps on the number of firearms that people can hold, limits on open-ended licenses as well, because one of the shooters has had licenses for almost a decade. And Albanese pointed out during one of the press conferences earlier in the day that circumstances could change, people could get radicalized over a period of time or have any other issues which could prompt them to become violent, and so there should be a limit on open-ended licenses. And then there are also stricter rules on the types of guns and modifications, as well as a requirement that license holders should be Australian citizens. So these are being considered at the moment, and it looks like it will have the support of all parties necessary to get through as well.
Swati, a bystander is also being hailed a hero after tackling one of the gunmen. What more do we know?
Yes, that is being celebrated across the country, and the gunman is being seen as the bystander has been seen as a hero. He is identified as this 43-year-old man who owns a tobacco shop named Ahmad Al-Ahmad, and it was really heroic. And the Premier of New South Wales State, home of Sydney, he said without this man there would have been more lives lost. Unfortunately, he took 2 gun wounds as well, and he's in the hospital at the moment. Earlier, Donald Trump, US President, he mentioned this man as well, and hailed his heroism. Billionaire Bill Ackman mentioned how there should be rewards given to community heroes like this, and he in fact donated $99,000 to a GoFundMe page for crowdfunding, and the money would go to Ahmad. And last when I checked, that FundMe page had more than $775,000 that was raised. So yes, it is seen as one bright spot in this really dark moment, and it's really unfortunate that something like this has happened at this time of the year when people are thinking about holidaying, spending time with their family, and so it was really courageous that this man came before the police arrived and prevented some of the damage at least.
Swati, thank you. Swati Pandey there. And as Swati was reporting, there were 2 gunmen involved in the attack, a father and a son. Now, in the U.S., police have released a person of interest after a shooting at Brown University in which 2 people were killed and 9 were wounded. All students have been sent home and final exams have been called off. The shooting took place in a classroom in the engineering building at the Providence, Rhode Island campus on Saturday. Now to other matters, and of course we continue looking at the markets, where this week we'll see a flurry of U.S. data, including CPI, non-farm payrolls, and retail sales numbers. Those come along with decisions from the Bank of England, the ECB, and the Bank of Japan. With us now, Laura Cooper, global investment strategist and head of macro credit at Nuveen, and David Power of Bloomberg Economics. It's the last stretch of course, 2025, the only full week, but there's absolutely 100% a lot going on. Thank you both for joining us. Laura, what are you looking out for this week? I mean, we have a number of central banks, but it's also really trying to guess what happens in 2026 with the Fed.
And I think really the central banks will likely take the attention this week. I mean, my focus is on the Bank of Japan in particular. We have seen the significant rates repricing across G10. Japan has really been a key kind of driver of that. And even though we're seeing that rate hike already priced in, I think guidance will be crucial. Are they going to assess that they no longer need to take that gradual stance? And what does that mean? Is that a quarterly pace of hikes from here? I think that's probably going to draw the most attention relative to the BOE and the ECB. And I think the Fed, the data is a bit more of that backwards-looking gauge at this stage.
Yeah, and David, when you look at the Bank of Japan, I mean, there was just a lot there in the last couple of weeks, right? A little bit of anxiousness as there were leaks that then had to be, I guess, confirmed by the Bank of Japan.
Yeah, there's lots been going on, but as we've just heard, they in all likelihood will hike this week, given the strength of inflation there, and also the ease and uncertainty related to trade, the trade stance with the United States at the moment, and they're really kind of bucking the trend globally. There's very few other central banks are hiking right now. Most of them will be easing in 2026, but there's a different story in Japan.
Yeah, I mean, this is a concern, right? That actually it's really difficult going against the grain.
Well, I think the really interesting dynamic we've seen in markets is just the extent we've seen from easing expectations for 2026 now towards tightening expectations. If we look at kind of Australia, Canada, if we look at the ECB, markets are starting to position not just for the end of those easing cycles, but the resumption of those hiking cycles. Now, some of that is warranted based on fundamentals. I would argue Australia certainly, and even the ECB, we've been a bit of an outlier in expecting a rate hike in the latter part of next year. But again, I think there's just so much uncertainty. Some of that is year-end liquidity issues. I think that's going to drive some more volatility.
Okay, more volatility to come. What can we expect from the BOE? I know they hate talking about the terminal rate, David.
Well, what we can expect is a rate cut. That's our call this week, and then we can expect probably one more next year, which would basically bring the terminal rate to 3.5, which is kind of broadly seen as a neutral rate for the BOE. So we've got a bit more easing there, unlike the ECB, where they're probably close to the end already, or if not at the end, actually. And markets, as we just heard, are toying with the idea of hikes, particularly after some very hawkish words from the executive board member, Isabel Schnabel, last week, which encouraged a lot of dialogue and market pricing in that direction.
Laura, when you look at the Bank of England, I mean, again, it does seem to be, I guess, a more complex situation because some of the domestic pressures, but also there's just a sticky inflation, and the votes are so close that you kind of wonder what 2026 brings.
Yeah, and I mean, our view is that we expect they're going to have to take a more aggressive easing stance, and that's largely predicated on, yes, services inflation still remains sticky, but it is coming down. We're seeing some signs of labor market deterioration. Just looking at that vacancy to unemployment rate is deteriorating. That suggests we're going to see some softness in wages that can spill into services. And I think overall, yes, the budget was kind of this risk-clearing event, but we still have a fiscal drag of about 1.5 percentage points over the next 2 years. So all of that together suggests, we could have about 3 Bank of England rate cuts until the end of the cycle. And we do expect Governor Bailey will be firmly in that rate cutting camp, shifting towards maybe a 5-4 vote this time. So still quite divisive, but I think overall we're leaning towards that. And I think that does open attractive opportunities in gilts as well.
I was going to ask you about gilts. So first of all, you see the terminal rate at 3.25.
Yes.
I mean, we've tried to ask any really Bank of England MPC member where they see it going. Why 3.25, and what does it mean for gilts?
Well, I think, ultimately at this stage, we have seen gilts caught up in the global rate sell-off. So it's been a very difficult trade to extend duration in the UK. But I think the fundamentals still justify a lower 10-year yield. But we're positioning now more in towards the belly of the curve. I think the risk-reward profile is better in terms of, scope for more easing to be priced in, but as well not getting caught up in some of that global rates repricing, particularly looking at bonds and treasuries, which we think will be much more volatile and stickier at higher yield levels next year.
And then the ECB, I mean, Isabel Schnabel kind of, gave Bloomberg an interview saying there's 3 words. And the market is kind of like, no way, we don't know when a hike will happen. What do you see it happening, David? Is it kind of steady as she goes until the last quarter of next year for the European Central Bank?
We don't think the ECB will be hiking at all next year. I think they'll remain on hold for the foreseeable future. In fact, we actually see downside risks for more easing next year. That's not our core scenario, but we think that's how the risks are skewed, because the full impact of the rise in U.S. tariffs will only be felt with time in the euro area, and the ECB will probably struggle to meet its inflation target. We'll be getting updated forecasts from the ECB staff economists this week, and we already know from September that those projections showed inflation below the 2% target for the next couple of years, and we'll probably see that again. And the rise in U.S. tariffs, the lower demand for European exports will only make that problem worse. So we're firmly in the camp of no hikes for the ECB in next year, despite Isabel Schnapp's warnings. And by the way, she didn't give a time. She didn't say she looks for it next year.
Or the next move is a hike, which could be long into the future.
Yeah, if you look at what's being priced in the market, there's a little bit, a few basis points priced in for next year, but not even a full 25 basis points. So the market's not really expecting that. What she was referring to in that interview that she gave to Bloomberg and Market Expectations, if you look further out on the curve, there are hikes being priced in kind of over a 2-3 year horizon.
Laura, what does it mean for where you want to be invested in Europe? Bonds, I guess, look less attractive than other European bonds.
I think that we're seeing a structural shift in terms of European assets because of the fiscal stimulus dynamics that is underpinning our constructive view for Europe next year. So we think that German 10-year should be trading above 3%. I mean, we are seeing more of that seasonal factors driving the underperformance this quarter. I mean, 8 out of the past 10 Decembers, we've seen bonds underperform. And then we also have that very strong January technical headwind around supply. So we struggle to see opportunities in extending duration, certainly in German bonds. I think the periphery is much more attractive from a carry perspective. And then looking at European investment grade credit, I think, is really where you're seeing better risk return rather than taking that government debt exposure.
Laura, how much of 2026 will just be focused on AI valuations and whether they're too lofty?
I think it's going to continue to be that key question. Are we seeing the bakings of that AI bubble persist? I think at this juncture, we're still leaning into U.S. large cap stocks. The earnings are quite robust. U.S. equity performance is all about U.S. earnings. We look at expectations for earnings about 10 to 12%. That's not necessarily a significantly high bar, I think, to surpass, so still remain constructive. And if we think about the U.S., we're going to have ample fiscal stimulus come through. We're going to have that AI tech investment. AI investment has already added 1/5 to the U.S. economy this year. And then if we think about the resiliency of consumption, we have tax rebates coming through. We have likely tariff clarity that's going to boost real wages. This is really a dynamic next year where I struggle to be kind of bearish on the U.S. equity market, even though there are certainly pockets of risk.
So interesting. Thank you both for joining us. David Powell, Senior Euro Area Economist at Bloomberg Economics, and Laura Cooper, Global Investment Strategist at Nuveen. He's been very generous with her time, actually, so we hope we see even more of you in 2026. Coming up, Ukraine and the U.S. are holding a second day of talks in Berlin on a plan to end the war with Russia. More on that story next with Amundi Investment Institute's Anna Rosenberg. This is Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Are holding talks in Berlin on a peace plan to end Russia's invasion. The Ukrainian President Volodymyr Zelensky has signaled Kyiv could accept security guarantees from the U.S. and Europe in place of its long-term goal of joining NATO. Well, with us now is Oliver Crook, Bloomberg's chief Europe correspondent. Ollie, so walk us through the latest comments by Zelensky that seem like a big deal, which come ahead of more talks today.
That's right, and they come around the talks that happened yesterday in Berlin, which were attended by Jared Kushner, Steve Witkoff, and Volodymyr Zelensky, speaking in Berlin yesterday for 5 hours. We should say that it was a significant and I think meaningful fact that there was a U.S. delegation actually attending those meetings yesterday and today. You'll remember going into the weekend, President Trump suggested that really he would only send a U.S. delegation if he thought that any forward progress could be made concretely. Those talks yesterday lasted about 5 hours, and the U.S. said that they were very pleased with it. They said that a lot of progress had been made. The comments that we're focusing on today are the ones of Volodymyr Zelensky, suggesting that basically they could very openly basically withdraw their ambition in some way, scale it back, of joining NATO, which of course for the Ukrainian perspective is seen as one of the only ways to secure no further invasion or a future invasion by the Russians at Article 5, with an Article 5-like guarantee from the United States and the Europeans. That being said, anything that approaches Article 5 is going to be a problem from the Russian perspective, and we have not yet heard their perspective on some of the latest proposals that we've been hearing from this 20-point plan as it evolves. We should say that now the conversation will evolve today in Berlin, where you have 10 European leaders. You'll have Mark Rutte, the Secretary General of NATO. You'll have Ursula von der Leyen there as well today to have those discussions. But really, Francine, I think the most significant thing out of Europe this week is that EU leaders meeting that begins on Thursday. And I have to say, as of Monday, as of today, looking 3 or 4 days ahead of this meeting, I still find it very difficult to see whether or not the European leaders will move on those Russian assets, which is absolutely key in terms of funding the war in Ukraine for the next couple of years. That is, I think, still an open question, something that Kaja Kallas, the High Representative, going into a meeting today said it's getting more difficult to see if there is actually consensus there.
Ollie, thanks so much. Oliver Crook there, Bloomberg's chief Europe correspondent now. Let's also bring Anna Rosenberg, head of geopolitics at the Amundi Investment Institute. Anna, thank you for joining us. And of course, Russia is not present at the Berlin talks, and Vladimir Putin seems also to be showing no signs of pulling back from his maximalist demands in Ukraine, including on territory. So what are the chances of these negotiations actually, leading to something meaningful?
So I think what we're seeing right now is Europe trying to reinsert themselves into this equation more strongly, to the degree that they are trying to put the European position, the Ukrainian position on paper much more strongly than what we saw in the original plan. That's what we're seeing. The other thing that we're seeing is Ukraine being very open to try and achieve a ceasefire, to keep the US happy. So that's what's going on right now. I don't think we're really talking about the end of the war yet. We're seeing a realignment of positions and Ukraine trying not to lose the US. And this is what's going to dominate the week. I think it's early to say that this is going to lead to a breakthrough. The ultimate sticking points are the same. The security guarantees are critical for Ukraine, are a problem for Russia. Russia wants to see the capitulation of Ukraine as a sovereign state, and I think it's quite unlikely that they will agree to anything that prevents that from happening in the future. So,
and do you think that can there be elections in Ukraine? Like proper elections?
There could be elections once they agree on it, but you need preparation time. It's going to take a couple of months. You need security, and that is an opportunity to gain time for Zelensky as well, and to get security guarantees through the back door, and to actually achieve a ceasefire through the back door too. So we have seen Zelensky giving a lot, giving up on NATO membership, which was never realistic in the first place. Now floating a referendum or elections to try and buy time, really, and to show that to the US, we're serious about this. Stay on our side.
What do you think the U.S. will be happy with at the moment? I mean, this feels like actually placating the U.S. president so that he continues giving his support to Ukraine.
I think the U.S. wants to see territorial concessions. They want to see movement on the Ukrainian side. They want to see that things are progressing into the direction of the ceasefire. The issue is not the U.S., it's not the Europeans, it's not Ukraine. The issue remains Russia. They are holding the card. So I think what's happening at the moment is that we're seeing unity around the US, Ukrainian, European position emerging. And that in essence brings us closer, because then there is a common ground for talks that the West, if you will, represent. The question is, what does Russia do next? And for Russia, this is going very well, because what Russia wants to see is a divided West. Russia wants to see Ukraine giving up already on its key demands without doing very much, without compromising. So we're likely going to get to a point where Russia says, okay, this is good, but it's not good enough. I need to see more. And then we could see another pivot where the US says, okay, Russia, we've given you what you wanted. You are not doing this. I'm afraid we have to ratchet up sanctions again. So this is still early, and as of now, I think a ceasefire is not the base case.
Despite what happens in Ukraine in the shorter term, how do you think this war will have changed Europe?
Well, it's changed Europe quite a lot. For one, it's become clear that Europe doesn't really have a lot of geopolitical power in this world, because in this kind of multipolar world, what counts is that you have military might, ideally in the form of nuclear weapons, that you have natural resources that someone else depends on, food, energy, rare earths, for example, and that you have a lot of partnerships. That's something that Europeans have. We have seen Germany, ironically, once again being the country that is creating a massive military muscle. You know, history is ironic sometimes, where the rest of the European countries don't have the finances to spend on defense. This is going to change Europe quite significantly, where Germany is once again becoming a more important player. There's a realization that they need to emancipate themselves from the US military umbrella as well. This is going to take time, but it's likely going to accelerate from here. So Europe has to move from an economic union towards a more geopolitical union. Yeah. I think that despite the divisions, we have seen a lot of coherence, very little divisions actually, in managing Trump. So far, the European nation states have realized that they need each other in this geopolitical divided world.
And is there actually recognition when European leaders listen to the White House say that it's a decaying continent with decaying leaders, that they need to step up?
I think there is a recognition. It's not news, right? We have seen the Draghi report, etc., about the challenges that Europe faces. The problem is that leaders are facing a lot of political constraints, and they're not moving fast enough, and they're not being bold enough and creative enough. And oftentimes you see that the political debate is dominated by very local issues, and that there is not a lot of honesty with the public, and that is overall holding the continent back in being bolder and more innovative. They get that. But as usual with the European Union, it takes time to get there. And the political constraint is an issue. Yeah.
Do you worry about these political constraints into 2026?
Yes, I worry about it. I think that there is a lot to worry about, but overall we shouldn't underestimate what has already happened. And what has already happened is that the EU has stayed remarkably consistent and united. They've managed to manage Trump. We're talking a lot about the US national security strategy, but actually the important sentence in that strategy has been that Europe remains a very important strategic ally for the US. They can't afford to drop Europe. So they've moved last week on freezing the assets for good. Mm-hmm. That is a big issue. And there has been quite a lot of consistency. So I think that overall there has been positive progress too. We are now talking more seriously about the capital markets union again in Germany. Again, difficult, we all know that. But I think we shouldn't underestimate the kind of progress that has been made.
We also saw in the last couple of weeks, which I thought was very striking, actually Vladimir Putin being embraced by certain leaders across the world. Was that unexpected?
Not really. I mean, now we are in a multipolar world where everyone is trying to get the most out of it for themselves. And many countries realize that the more relationships they have with more powerful countries, that the stronger their own position is. And that is, in essence, the effect of multipolarity. So I'm not surprised by this. And if there is a ceasefire, Russia will likely be reintegrated into the global economy to a certain degree. And that is realpolitik.
Anna, thank you so much, as always, for joining us. Anna Rosenberg with some really smart thoughts on the future of Europe and, of course, what's going on between Ukraine and Russia. She is head of geopolitics at the Amundi Investment Institute. Coming up, private credit and potential bankruptcies. We discuss the outlook for financial distress and restructuring with David Morris from FTI Consulting. This is Bloomberg.
key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London, and these are your top stories. Australia's Prime Minister says the country will seek to strengthen gun laws after 16 people were killed in a terror attack targeting members of the Jewish community on Bondi Beach. Ukraine and the U.S. are due to hold a second day of talks in Berlin on a plan aimed at ending Russia's war. This as President Zelensky is set to meet European leaders today for a major summit. And a big week for investors in the last full trading week of the year with key central bank decisions and inflation and jobs data from the U.S. Now, we've spoken a lot recently about potential cracks in the private credit markets as debt-laden companies such as First Brands and Tricolor have declared bankruptcy. But what happens after a company declares bankruptcy as investors scramble to salvage what's left? Well, with us now is David Morris. He's head of UK restructuring at FTI Consulting. David, thank you so much for being with us. We're seeing a lot of distress in highly cyclical industries. Chemical companies in Europe seem to be particularly vulnerable to U.S. tariffs. What are you worried about?
Yeah, well, look, we've certainly seen a pickup in restructuring activity and financial underperformance during 2025, particularly in the second half. So I am concerned that we're going to see a continuation of that trend as we go into 26. And look, you've touched on a couple of sectors there. We're seeing it across a broad range of sectors. So industrials, particularly chemicals, Western Europe, with the demand and the global supply dynamics, business services as people look to cut costs, and also consumer businesses as real disposable income has been really hit over the last few years.
But what is the concern? Is it U.S. tariffs? Is it also China cheap imports? And again, how are companies just reacting to some of these issues?
Well, look, I think the concern is, really a softness of demand whilst costs are increasing from inflation pressures. And that softness of demand, yes, there is something about supply and demand turmoil due to tariffs, but there's also geopolitical instability. The market's been volatile. In the UK more recently, people have been worried about the budget. So there's a whole combination of compounding factors. Now, what are companies doing about it? Well, look, there's been a practice of maybe trying to prolong the restructuring activity and trying to buy time. So we've seen a lot of businesses embark on liability management exercises, LMEs. We've seen people seek amendments in their debt documents, raising sort of emergency turnaround capital, and managing their businesses for cash. And they have all been designed to move the event to a better future. And that better future hasn't necessarily come. Demand is still soft, interest rates are still high.
David, when you look at UK retail, hospitality, and care and catering, it's just been a really tough business.
Yes.
Leon recently went bust, despite it being full, as far as I can tell,
Yeah.
all the time around here. Are things going to get worse before they get better?
Look, I mean, we're in the golden quarter right now for many of those businesses in terms of consumer-facing businesses, retail, hospitality. But what is certain is the consumer is really stretched at the moment in the UK. Cost of living is expensive. People are spending less. They're being more discretionary where they make that spend. So unfortunately, I do think as we come out of the seasonal period, we will see some more stress and some more failures or financial restructurings in that space.
In that space and others, or are there specific, if not company, like really specific sectors or bits of businesses that you worry about?
Well, I think any big-ticket discretionary items is obviously more vulnerable. Hospitality, non-essential spend is really where we're going to see the pain. And look, as in terms of our business, people talk about the K-shaped economy. If you apply that concept to the markets, we're dealing with the businesses at the intersection of the legs on the K and the downward leg. So we're looking at the bottom half, the lower quartile of businesses. So there will be winners, but those more challenging businesses are facing a lot of headwinds at the moment.
Any other sectors that we should worry about?
Look, I mentioned business services. So one of the things we're seeing at the moment, as businesses realise that there's probably not going to be near-term growth, they're starting to take action. They're starting to take cost out. A lot of those costs within a corporate B2B environment are business services. So we're starting to see business services, post flat or even lower revenue as demand comes off.
If you look at private credit, it's facing its first, big down cycle.
Yeah.
Again, what happens there? Because it's inevitable that things are going to go into distress or that there's going to be a restructuring situation. But how's the industry preparing for it?
Yeah, well, look, I think it's interesting. You're already seeing private credit having to get involved in restructuring activity. Now, the advantage, if you like, of private credit is a very flexible source of lending, so they can amend their banking documentation, they can capitalise their interest, they can even step in and provide new money and take over control of companies and step into the shoes of the sponsors. And we've certainly seen that happening. And we're also seeing some of the bigger credit funds either build or augment specific in-house restructuring capability, and that's either because of the volume of restructuring they're dealing with or the anticipated volume. Look, it's not a sector of the market which is going to be immune to these economic headwinds, and arguably you could say that their borrowers are slightly more challenged because they tend to be in the high yield, higher leverage space.
And so how are private credit funds dealing with the fact that, for example, private equity holding periods are now longer?
Yeah. So look, when you look at, if you like, the private equity deals of 2018 to 2021, if you like, those stuck deals where it's more difficult for private equity to exit. Look, private credit are being supportive where they can if the credit metrics still stand up. But they're going to expect those private equity funds to continue to support their investments and provide follow-on capital. And if they're not going to provide follow-on capital, then the credit funds need to decide whether or not they step in or whether there's a valuation event.
And are they doing a good job of that, of trying to preempt and decide ahead of an event happening?
Yeah, look, I mean, they are being paid to take risk and to manage that risk. From what I see, they manage it at the origination stage. They obviously manage it through the portfolio life. As I've talked about, they're building up their capabilities. They're pretty flexible. They can be quite patient. I think what we have seen in the last few years is one or two private credit funds step into situations, probably hoping that the market would have been more buoyant and actually it would have been a shorter hold period. But now they've stepped in, they're probably looking at hold periods of 4 to 5 years. So it's not easy.
But it's not easy, but it's okay. I mean, this is like, what's the level of anxiousness out there? I guess is how I would, what I would ask you.
Well, look, it's if you look at, I would say, when I talk to my private credit fund clients, they seem pretty confident that they're managing that risk. And if you look at the larger, more established funds, they're obviously got a massive advantage because of their diversification through scale. However, they're not going to be completely immune, and I should expect that they're looking at their current portfolio, they're looking at what 2026 may bring. I suspect they're not anticipating too much growth, and so they probably are expecting that they're going to have to roll up their sleeves, is and really invest some time managing through that portfolio.
Do you think 2026 will be harder than 2025 overall, or will it be much of the same?
Look, personally, I think it's going to get harder. So in our business, where we advise companies in financial distress, we're already seeing an uptick in momentum towards activity, and we're seeing companies preparing to go to market, go to their creditors and look to raise capital and restructure in Q1, Q2 next year. And there's a lot of businesses we've been looking at now for a number of years, thinking, how are they surviving with this huge level of indebtedness, this huge level of leverage? Why have they not restructured their balance sheets already? And that's starting to the tipping point, I think, is here. So look, I don't want to be doom and gloom, but I do think we're going to see more restructuring activity in 26 than we have in 25.
David, thank you so much for joining us. David Morris, they're head of UK restructuring at FTI Consulting. Now, China's investment slumped further and retail sales expanded at their weakest pace outside the pandemic in November. It's another month of lopsided growth that's inflaming trade tensions with the rest of the world. Well, we're now joined by Balazs Pens, our senior desk editor in Hong Kong. Balazs, thank you for joining us. So in terms of the data, what do these numbers actually tell us about the Chinese economy?
Well, they don't paint a very positive picture of the economy. As we heard, investments shrank, housing prices fell further. Even industrial output, which has been bolstered by China's very strong export performance, hasn't done as well as expected. But the big one, the main number that everybody is focusing on right now, is the very, very disappointment retail sales growth, which was the weakest outside of the pandemic ever on record. And that really is what the whole Chinese economic picture boils down to. Is there a way to get the Chinese consumers to spend? This is something that we've been talking about, seems like for half a decade now. Are there any set of measures that can pierce this reluctance by the Chinese consumers to spend? And the answer for now seems like there isn't, and that is a really worrying, a very concerning sign for the economy going forward. This year, we already know growth is going to be around 5%, but there are real concerns about what this might look like next year when the domestic side, the domestic leg of the Chinese economy might be missing.
Quite strong comments, Balazs, also from President Xi about cracking down on what he calls reckless projects in the future.
Yeah, that's right. And it's important to kind of look at the context in which he said this. He was talking about this issue during the Central Economic Work Conference, which is a major gathering of economic policy planning. And his message to these kind of overlords of the Chinese economy is stop what you've been doing until now. Because until now, some of these people have been rewarded by sort of manufacturing growth numbers that Beijing was looking for through some of these conspicuous spending projects, these big exhibition halls and other infrastructure projects. And what she is telling them now, stop doing that. Don't do that anymore. Focus on the long term. Focus on structural, more sustainable growth. Focus on projects that will benefit the Chinese people in the longer term. So it does suggest that there is a recognition that a pivot is necessary, and they need to focus on things that improves people's lives more than kind of contribute to very impressive headline growth numbers. So it does look like a change in philosophy for China there.
Balazs, thank you so much. Balazs Pens there in Hong Kong with the very latest on China. Now, the company that revolutionized robot vacuum cleaners in the early 2000s is its Roomba model has filed for bankruptcy. According to a press release, iRobot will be taken over by its main Chinese supplier. Now, the Massachusetts-based company enjoyed initial success with the Roomba when it debuted in 2002, but earnings at the firm, which has sold more than 40 million home robots, began to decline in the post-COVID era. Now, the former Hong Kong media mogul Jimmy Lai has been found guilty of endangering national security in a landmark trial. It's a verdict that could fuel tensions between China and the U.S. Bloomberg's Min Min Lo was sent this report from outside the court.
A marathon trial lasting 156 days has concluded, and the former media mogul Jimmy Lai has been convicted guilty of all charges, including 1 count of publishing seditious materials and 2 counts of colluding to conspire with foreign forces. The total verdict is over 850 pages long. The judges read a small portion of it, pointing to WhatsApp messages as evidence of his intent to collude with foreign forces to call for sanctions to be imposed on Hong Kong and China. They also found him guilty of using the now defunct newspaper Apple Daily as a platform to embark on this campaign to undermine the legitimacy or authority of Hong Kong and Beijing. Now, this is a closely watched trial. Scores of supporters queuing up overnight to enter the courthouse this morning. President Trump saying he raised the issue of Jimmy Lai's release with President Xi when the two men met at the sidelines of the APEC summit in South Korea in October, and White's group calling for his release on medical grounds as well. Jimmy Lai is 78 years old as he awaits his fate. The sentencing will be handed down on a later date, and he could face up to life in prison. Min Min Lo, Bloomberg News, Hong Kong.
Now to some other stories making news, and new data shows wage growth for the lowest paid workers in the UK is starting to slow. This comes as worsening jobs market undercuts the bargaining power of a section of the workforce that has proved resistant to the Bank of England's inflation-fighting efforts. Now, according to figures from job search site Indeed, advertised salaries for low-wage roles rose by 5.9% in the year to October, down from a 7-month high of 6.6% in the previous month. Now, staying with the UK, and according to Bloomberg analysis of official earnings and property data, average London apartment prices are now below 9 times annual earnings. That's the most affordable they've been in 12 years. A series of factors, from Brexit to tax hikes, have reined in a market once seen as overvalued, with flats in the capital now 22% cheaper in real terms than a decade ago. And France is seeking to delay this week's EU vote on a free trade agreement with South America. The proposed accord with Mercosur has been 25 years in the making, but the French Prime Minister, Sébastien Lecornu, says measures to protect EU farmers and consumers are insufficient. Sources say the deal could collapse if it is not signed by the end of the year. Coming up, new studies suggest the latest AI models are getting even better at persuading people at the expense of the truth. We discuss that next with Parmi Olsen from Bloomberg Opinion. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, tech valuations and bubble fears continue to dominate Wall Street. But what about AI and its impact on democracy? You know, that small thing. Supporters say artificial intelligence can help to address conspiracy theories, but there could also be a dangerous flip side. The latest AI models are getting even better at persuading people at the expense of the truth. That's the view of Parmi Olsen, tech columnist from Bloomberg Opinion and author of Supremacy, AI, ChatGPT, and the Race That Will Change the World. Parmi joins me now. So, Parmi, thank you for joining us. What are these AI models doing exactly?
Right. So there were 2 studies that just came out recently, and both basically showed that chatbots are incredibly persuasive. Yeah. And it's not just AI that generates a 200-word blurb about a certain political candidate. It's when people get into a conversation with an AI system that their views can actually be quite susceptible to being changed on all number of sort of policy issues. And so that was the first finding, that these things are much more persuasive than traditional TV ads or political campaign ads. And secondly, when they use the most persuasive tactics, which we can talk about what those tactics are, they're more likely to actually hallucinate and give incorrect information, mistruths.
So what are those tactics?
Well, the tactic is basically to bombard a person with as much information as possible. So in a 10-minute conversation with a person, if a chatbot gets in 25 different facts, that person is much more likely to sort of start to sway their view than if it's 10 different points that they're making in the conversation. And actually, this kind of, it might not be surprising to people, because a very popular debating tactic now, particularly on YouTube, is this rapid fire, just kind of flooding the zone with all sorts of facts, and making it quite difficult for your opponent, if you're in a debating situation, to kind of unpick and analyze what you're saying. So this is this actually has a term, gish galloping, comes from the creationist Dwayne Gish, but it essentially means just bombarding a debate with lots of facts, and that actually really works when it's AI doing it.
So in this age of social media and these rapid fire kind of debates, will AI, automatically make things worse?
It could. We don't know yet. The good news is that this is something that was shown in a study where people were paid to participate. But actually getting someone to talk to you could call it a propaganda bot, is quite difficult. Yes, many people are using ChatGPT, about 900 million a week. But it's not ChatGPT that is doing this. It would be, let's say, a campaign group. They buy access to the model, then they fine-tune it, and then they put it on a website. And somehow you have to attract people to come and talk to it, like a customer service bot. So the good news is it's actually might be quite difficult to get people to talk to these AIs. But another tactic might be to just DM them on WhatsApp or on Facebook Messenger as a bot. And then, if you're a campaign group or whatever, an activist group, that might be one way to use that persuasive tactic.
Are bad actors already using this technique?
I don't know. I haven't seen any evidence that they are. But, there's a lot of open source AI models out there, which make it, relatively cheap for anyone to do this. And this is why the scientists at Oxford University and the London School of Economics and Science and Nature journals published this report, just to kind of show how easy and cheap it is. We're talking, a few tens of thousands of dollars to actually set up an operation like this, particularly with open source models like Llama or Quen from Alibaba, which are very easy to kind of make bespoke and build this kind of ultra persuasive tool. It's out there, it's available.
But so at the moment, there's no regulation, right? So you're kind of relying on the common sense of people to understand who they're interacting with.
Yes, but you can arm people with more common sense by sort of telling them these bots are out there and just to be aware of them.
Yeah, for like a specific reason.
Perhaps,
guess, right?
Yes, perhaps.
Parmi, thank you so much as always. Parmi Olsen there from Bloomberg Opinion, our go-to person for anything ethics and democracy and AI. Now, it's a big week of risk events for investors, central bank decisions due from the Bank of England, European Central Bank, and Bank of Japan. We also get a lot of U.S. data, October's partial CPI report and November's full one, 2 non-farm payroll releases, and November's unemployment rate. Now, for more, let's bring in Ven Ram, cross-asset strategist for Bloomberg MLive. Ven, so good to speak to you. So which of the central banks do you think will be most interesting this week?
Morning, Francine. A pleasure to be talking to you. I think that, there are at least 4 central banks in Europe meeting, and not to mention the Bank of Japan in Asia. But I think the one that's going to be the most interesting is going to be the Bank of England, because the markets are pricing in at least 25 basis points of rate cuts from the Bank of England, even though this is a no press conference meeting. So I think that, how reactive is the Bank of England going to be to the budget is the key question here. And are they going to pivot dovish? 1 month ago, the markets were not even pricing in a rate cut in December. Now they've brought forward the rate cut to December. So that shows how the market views the BOE's reaction function is going to be. And I think if the Bank of England shows that it is capable of going much further, I think that the pound will sell off, and I think that the BOE's reaction function is going to be in focus. As far as the ECB is concerned, it'll be the updated macroeconomic forecast that will be in focus, even though nobody expects them to cut rates anytime soon.
On the Bank of England, how are you thinking about the pound, Ven?
I think the pound has bounced off, has made a tentative rebound in the aftermath of the budget, because the risk premium that had been embedded into markets, UK assets, has unwound partially. But those gains are at stake if the Bank of England is going to say, look what, the markets are pricing in a terminal rate of 3.5%, which the Bank of England governor Andrew Bailey has alluded to as being the right ballpark. But if he suggests that the Bank of England is willing to go further than that, then I think that the markets and the pound will sell off, because that's far more dovish than the markets have priced in.
How's the Treasury market likely to react to the jobs data and CPI reports, Ven?
Well, I think that, the markets are very interestingly set up ahead of the November non-farm payrolls. I think, if we get an expansion, the question will be, when is the next rate cut from the Fed due? And if you look at the 2-year yield, it's done a very interesting plot on the charts. It's refused to go down below 350 meaningfully for any period of time, even though we are almost flush with the Fed funds rate at the current level. So the markets are kind of, turning somewhat skeptical at all these Fed rate cuts, saying, your core PCEs are hovering around 3%. The economy is doing well. In fact, we just heard from the Fed that they expect the economy to grow 2.3% next year, which was a huge revision upward. So I think that the markets are beginning to question that, look, do you need further rate cuts from here? And that's the reaction that I'll be looking out for from the front end.
Ven, overall, what do you think will be the main driver for 2026? I know there's going to be a lot of concerns about valuation in AI, Fed. It feels like it's going to be the similar themes, unless there's something else we should watch out for.
Well, I think AI, the bubble in the making, is a big deal to watch out for. Fiscal expansion in Germany and Europe is a big theme as well. And I think that, increasingly the markets are going to be looking at the credit metrics as well, which is little watched. And I think one more area where I would be looking at with great interest is what the SNB does with its policy rate. I know last week that they said that they're not inclined to take rates below 0. But I think that, but they also lowered the inflation forecast. But if they continue to see inflation going down to deflationary territory, I think that, they will pull the string on the one more rate cut. And even though they're reluctant to do it, that's a tail risk that the markets are not thinking about just yet.
Ven, thank you so much. Ven Ram there from Bloomberg MLive. Now, this is a picture across the board for markets. Again, as Ven was saying, it's just a big week, the last full week of Fed trading days before the end of the year, and U.S. futures pointing to a slightly higher start. You can see S&P futures gaining 0.4%. Up next, it's Bloomberg Brief, and this is Bloomberg.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It is 5 a.m. in New York City. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. Australia calls for tougher gun laws after gunmen opened fire and killed at least 15 people at a Jewish community gathering to celebrate Hanukkah. Ukraine and the U.S. are set to hold a second day of peace talks in Berlin to end the war with Russia, and a busy week ahead. Delayed November jobs data and rate decisions from the ECB, the BOJ, and the BOE, all on deck. Let's get a look at what's going on in futures here in the U.S. after a brutal close on Friday. S&P futures recovering a little bit of that, up about a 0.5% right now. NASDAQ futures also gaining 0.5%, and small caps gaining a little bit more. In terms of some of the stocks we want to watch this morning, let's get out to Valerie Teitel in London. She's got your details. Valerie?
Good morning, Matt. Let's start with a check on the main the stock that led some of those declines in Friday's session. NVIDIA climbing back some of those losses from Friday is up 1.2%. NVIDIA was one of the main drags on the NASDAQ on Friday after Broadcom. It was down some 3%, so still down on a two-day basis, but it does look like the tech trade is on a firmer footing today. Speaking of the tech trade, let's have a check on Intel. On Friday, it was reported that they are nearing a deal to acquire Samba Nova, an AI chip startup, for $1.6 billion. An acquisition like this would really help Intel widen its AI product offerings. We're seeing shares of Intel up over 1% in pre-market trade. Lastly, keeping with the tech theme, but in a different manner, iRobot. This is the company that is the maker of Roomba. The robot vacuum is going bust, filed for Chapter 11 bankruptcy, and will be taken over by its main Chinese supplier. iRobot has really struggled in the post-COVID era, battling not only tougher competitions, but still issues with supply chains. We're seeing shares of iRobot down 83% after it files for Chapter 11 bankruptcy. Matt?
All right, Valerie, thanks very much for that. Coming up this hour, we're going to speak with Jane Foley of Rabobank on the foreign exchange market, and don't miss our exclusive conversation with the EU Trade Commissioner on the negotiations with the U.S. Now let's get, though, to our top story. Australia experienced the deadliest terrorist attack in its history on Sunday when two gunmen opened fire on a celebration of the first day of Hanukkah at Bondi Beach in Sydney. The Australian Prime Minister spoke earlier.
What we saw yesterday was an act of pure evil, an act of anti-Semitism, an act of terrorism on our shores in an iconic Australian location, Bondi Beach, that is associated with joy, associated with families gathering, associated with celebrations. And it is forever tarnished by what has occurred last evening.
Joining us now is Bloomberg's Roz Matheson. Roz, what do we know about the motivations? I mean, clearly anti-Semitic, but what drove these two killers to carry out such a gruesome act?
Well, we don't know directly from them what drove them to carry out this attack, but as the Prime Minister has said, this was deliberately targeted at the Australian Jewish community. Two people, apparently the shooters, are father and son. The father is dead and the son is in critical condition in hospital. The father came to Australia decades ago on a student visa. We don't know from what country he came. His son was an Australian-born citizen. His son, however, did come on the radar of the intelligence community in Australia back in 2019, apparently for something to do potentially with Islamic State. But the exact motivation, what made them decide to go to the iconic beach of Bondi and open fire on a very peaceful celebration for the Jewish community is unclear. But obviously, like other countries, Australia's been experiencing issues around rising anti-Semitic incidents, a big debate in Australian society about the war in Gaza, Australia choosing obviously to recognise a Palestinian state. So it's been very much in the ether in Australia as a political issue.
How does this look set to change the political landscape in Australia, Roz?
Well, it's going to open a debate again very much around things like immigration. Australia, like other countries, has these rising far-right parties that have been pushing the debate around immigration. It's been a long-running political topic in Australia and no doubt, again, will come to the fore in terms of the debate. There'll also be a fresh debate around gun control. I mean, Australia has some of the most stringent gun control laws on the planet. They were enacted after a massacre in Tasmania decades ago, so banning automatic, most semi-automatic weapons. But gun ownership has been on the rise again in the decades in between, so those laws do need revisiting. The Australian government has said they're going to look again at how people can get their hands on guns in Australia. So there'll be a lot of conversation around immigration, around the rising anti-Semitic incidents that we've seen in Australia, and also around gun control.
All right, Roz, thanks very much. Roz Matheson there talking to us about the tragedy in Australia. Over in Berlin, meanwhile, Ukraine and the U.S. are preparing for a second day of talks on a plan to end the war with Russia. President Zelensky has signaled that Kiev could step back from its long-term goal of joining NATO if it reached bilateral security agreements with the U.S., Europe, and other states. Joining us now is Bloomberg's Oliver Crook. Oliver, walk us through these latest comments by Zelensky.
Yeah, they came as he met with Steve Witkoff and Jared Kushner yesterday in Berlin. We understand those talks will extend to today and be joined by a number of European leaders, about 10 of them, including the Secretary General of NATO, Mark Rutte, and Ursula von der Leyen, the European Commission President, all in Berlin today. But really, the sort of discussions yesterday was sort of an encouraging sign that the U.S. delegation even arrived. You'll remember going into the weekend, President Trump said he was only going to send a delegation if he thought meaningful progress could be made on the negotiations. We understand they met for about 5 hours yesterday, and that the United States said that there was a lot of progress that was made. We understand also from Zelensky that as a sort of olive branch, he might be able to and be willing to basically move back from this idea of Ukraine joining NATO, that is surrendering to some degree Ukrainian sovereignty in terms of deciding who they can associate with in the interest of trying to advance the peace negotiations. The problem is, Matt, when you talk about the Article 5 guarantees, the closer you get to those guarantees, the more difficult it is going to be for the Russians to accept it. And we've just heard from Dmitry Peskov, who's one of the spokesmen from the the Kremlin, I'll just quote there, saying that he's basically saying that a legally binding document preventing Ukraine from joining NATO is the cornerstone of negotiations. So, of course, the optics of NATO are critically important. It seems there is willingness to move on it. But that being said, Matt, we haven't really heard the Russian reaction to the 20-point plan as it stands today, and we still need to get that in order to realize if there is any actual meaningful progress being made here on these peace negotiations.
Oliver, there's been a lot of criticism of the European structure, not just from politicians here in the U.S., but also from Jamie Dimon recently. Who's taking the lead in terms of the European negotiations? Is Friedrich Merz stepping up for that role?
To a degree, but I think that there are the ways in which Friedrich Merz, who comes into this sort of office in Germany, the biggest economy in Europe, has sort of been a bit of a disappointment for a sort of continent that has really been looking for leadership for a long time. As you know, Matt, I think Macron really would like to have been that leader for many, many years. He obviously has far too many problems domestically to sort of embody that. I think part of the problem here in Europe is that there is not that sort of leadership. There is not that sort of momentum going forward. And Matt, really the key event for European leaders is to figure out how to fund Ukraine into the future. There's been this debate for weeks, for months, really for years, about whether or not to touch those frozen Russian assets to get that so-called reparation loans to the Ukrainian. 90 billion euros is the amount of money they're talking about. That would be 2/3 of funding for Ukraine for the next 2 years, not just for their military, but for their budget. And I've got to tell you, Matt, as of Monday, this summit is on Thursday, I think it's very difficult to see which way it's going to go, whether or not they're going to make the progress and they're actually going to get this agreement over the line. Every time they take a step forward, they seem to take 2 steps back, and that is going to be kind of one of the final potentially humiliations for European leaders who have been talking about years supporting Ukraine. When it comes to putting their money where their mouth is, I don't know if they're going to get it over the line this week, and that'll just show kind of more European impotence on the geopolitical stage, which there's been no shortage of this whole year.
All right, Oliver, thanks very much for joining us. Oliver Crook there from Europe with the latest. Now let's get to our top stories trending this morning. China's economy shows further softness in November. It posted the weakest retail sales growth since COVID. Investment and factory output also missed the mark, while housing prices continue to slump. iRobot, as Valerie mentioned, that company that revolutionized robot vacuum cleaners in the early 2000s with Roomba, has filed for bankruptcy. It will be taken over by its main Chinese supplier. iRobot's earnings began to decline in the post-COVID era due to supply chain issues and much cheaper competitors, despite having sold more than 40 million home robots. And National Economic Council head and the frontrunner in the race to be the next Fed chair, Kevin Hassett, has said that President Trump can offer Fed advice, but will not set its action.
I think he has very strong and well-founded views about what we ought to do. But in the end, the job of the Fed is to be independent and to work with the group of people that are on the Board of Governors at the FOMC to drive a group consensus on where interest rates should be. And to do so, basically with the guidance of the Fed chair. But in the end, it's a committee that votes.
Coming up, we'll look ahead to the week full of economic data and rate decisions with Jane Foley of Rabobank. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute news
news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
It's Jobs Day, and Bloomberg has the report under surveillance.
How do we understand whether inflation is the bigger problem or whether it's the labor market?
That is a key question, and it's going to be challenging.
Tuesday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We've actually seen the most layoff announcements since 2009.
The weakening is happening, but the overall structure is pretty sound.
The November Jobs Report, Tuesday on Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in New York for Vonnie Quinn. A busy week ahead in markets with the delayed payrolls data coming on Tuesday, then rate decisions from the ECB and the BOE, plus U.S. CPI on Thursday, and then the BOJ decision on Friday. So a ton of central bank news this week. Joining us now is Jane Foley. She's head of FX strategy at Rabobank. Jane, where do you put your focus? I mean, the U.S. data doesn't seem to be as important since the Fed already met and cut last week. Which of the other central banks are you looking at as the key decision maker this week?
Well, I suppose it's got to be the Bank of England and the Bank of Japan, although we've got to remember there's also the Norges Bank, there's a Riksbank too, and they will be important in their own way, not because the market is expecting any change in policy, this time around, a bit like the ECB, but there is the speculation that they could go during 2026. And the Norges Bank is just one of those three central banks now, the Fed, the Bank of England, and the Norges Bank, that the market's expecting to cut rates again. But, everybody else, all of the other G10 central banks, according to market pricing, could be hiking in 2026. And that's what makes central banks, right now, really very interesting.
Here in the U.S., Jane, the labor market seems to be the bigger worry, even though inflation is still 50% above the Fed's target. It doesn't seem to matter as much. Is that not a concern for the rest of the world? Are labor markets not an issue elsewhere?
Well, I mean, they are. I mean, for instance, you could look at the UK, and certainly there is a decline in employment in the UK too, and that is a concern. But, there is a structural versus cyclical element to this, both in the UK and in the US. And yes, there is a cyclical downturn here, and the data, really do prove that. But if we stand back and look at the demographics and maybe, in the US, the immigration impact too, the demographics suggest that, in the next few years, we are going to have less labor supply because of the aging population. And we've got to look at that in the context too. So, a cyclical slowdown, when you've got the structural issues going on, will have slightly different ramifications on inflation than if it was otherwise the case. So that gives us some context as well.
What do you expect from rates? I read a Bloomberg opinion piece by Edward Harrison last week in which he argued that all of these other central banks raising rates and raising their benchmark rates and Treasury rates around the world rising would drag the U.S. 10-year higher as well. And we haven't seen it come down even as the Fed has cut 125 basis points.
Yeah, I think that this is going to be a theme going into the new year, really fiscal issues more generally. So, for instance, if we look at some of the best performing G10 currencies this year, we see, the Swiss, we see the Swedish krona, right up there. The Norwegian krona is pretty high up there too. And, these are central banks, or these are countries, I should say, that have pretty well managed fiscal situations, low levels of debt, for instance, really good levels of budget deficits. And, it does make you wonder whether or not, some investors are diversifying into currencies that have strong fiscal positions, and whether or not that's going to become more of a trend next year, and whether or not that will impact, for instance, the US, but also Japan, because whilst the yen is generally a safe haven currency, that is a currency that hasn't done at all well this year, despite that safe haven reputation, and that's probably related to its poor fiscal position.
If I look at the on WCRS, the world currency ranker on the Bloomberg terminal, all of the majors, you mentioned the krona or the multiple kronen, they've all done better than the dollar. All of the majors have outperformed the dollar this year to date. And even if I expand that, only Argentina, Turkey, and India have done worse. So does this dollar weakness look set to continue?
Well, that is the consensus, but there is a slightly different perspective here, because if you put in half year to date into that page on Bloomberg, the dollar's actually been performing relatively well. I mean, it's not the best performer right now, but it has been in recent weeks. It has been at the top of that table. So from that point of view, we have got a slightly different impact coming through from the dollar since the summer. All of that decline really was registered in the first part of the year, and that's pretty interesting, because obviously, we've seen the AI trade again gain momentum in the second half of the year, really since June. That's perhaps helped give the dollar, a better poise, but also the fact that, whilst there has been disruption from Trump's tariff policies, not as much as the market feared at the start of the year. So from that point of view, the dollar really has settled down, and you could take that and argue that, actually, all of these market consensus for a weaker dollar in 2026, maybe that should be moderated if, again, we get perhaps a U.S. economy maybe even outperforming market expectations.
Jane, getting away from the U.S. dollar, what are the most important? What are the other most important pairs that you're watching?
Well, I mean, clearly, euro dollar, dollar yen. I mean, cable's been interesting. It's been really sticky. The pound has sort of held up above that 130 level really quite well. But, I do think that for 2026, the dollar yen could be perhaps the most exciting currency pair out there. The yen is extremely, extremely cheap. And it's quite possible that with other central banks potentially hiking interest rates by the end of next year, maybe the Bank of Japan has to accelerate the pace of its interest rate hike. So an interesting currency pair indeed.
All right, Jane, great to get some time with you. Thanks so much for joining us. Jane Foley there of Rabobank talking us through some of the currency action and, of course, so much coming up this week in terms of economic data here in the U.S., but also central bank decisions around the world after a week that was dominated by the Fed. We'll be focused in on the Bank of England and the Bank of Japan, among others. In terms of what's going on today in futures, we're seeing a little bit of a rebound from the brutal close that we had here on Friday. We were down on the S&P 500 on Friday, more than 1% to 68.27. Of course, we had just hit an all-time high, closing high of more than 6,900 last week. Looks like we're going to recover a little bit of what we lost on Friday. You can see the dollar right now at 12.05, so just down 0.1%. As Jane mentioned, it was really the first half of the year that the dollar had its real weakness. And then the 10-year yield right now at 416.65. And this is fascinating because over the last year and a couple of months, the Fed has cut 125 basis points, and yet the 10-year yield remains exactly where it was from that time in, say, October of 2024. Coming up, the Australian Prime Minister vows to strengthen gun laws following the Bondi Beach mass shooting. That and a look at what else is making your headlines in front page news next. This is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
This is Bloomberg Brief. I'm Matt Miller in New York City, in for Vonnie Quinn. Time for your front page news. First up on the New York Times, Australian police say they plan to charge the surviving suspect in the shooting on Bondi Beach that killed at least 15 people at a Hanukkah celebration. It's the worst terrorist attack in Australia's history. Next up on the Washington Post, in the U.S., police have released a person of interest after a shooting at Brown University. At least 2 people were killed and 9 were wounded. All students have been sent home and final exams have been called off. The shooting took place in a classroom in the engineering building at the Providence, Rhode Island campus on Saturday. And on the Wall Street Journal, famed Hollywood director and actor Rob Reiner and his wife, Michelle Singer Reiner, have been found dead in their Los Angeles home. Authorities are investigating the incident as a homicide after police and firefighters were called to the couple's house on a Sunday afternoon.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. Australia calls for tougher gun laws after gunmen opened fire and killed at least 15 people at a Jewish community gathering to celebrate Hanukkah. A busy week ahead here in the U.S. Delayed November jobs data and rate decisions around the world from the ECB, the BOJ, and the BOE, among others. And don't miss our exclusive interview with EU Trade Commissioner Maros Sefcovic. In terms of what's going on in the U.S. markets after a drop of more than 1% to close Friday's trade, S&P futures are back up about 0.5%, NASDAQ futures as well. The small caps gaining even more. For a look at some of the individual stocks to watch, let's get over to Valerie Teitel in London. Valerie?
Good morning, Matt. Let's start with a check on the Mag 7. NVIDIA leading the gains this morning as tech is on a more solid footing to start this Monday session. NVIDIA up over 1%. It was one of the biggest drags on the NASDAQ on Friday. It was down over 3%. So still a lot of room to be made up to catch up to Friday's weakness. But we do feel like we're on a firmer footing with the wider Mag 7s this morning. Staying with the tech trade, let's have a check on Intel. After Friday, it was reported that they are looking at an acquisition of SambaNova, an AI chip startup based out in Silicon Valley, for around $1.6 billion. Matt, we're seeing shares of Intel rise on the back of this news, up 1.2%. This acquisition of SambaNova really helped Intel increase and widen its AI product offerings. And lastly, let's check on the Roomba maker iRobot filing for Chapter 11 bankruptcy. The share is down 82% in pre-market trade. This is the company that's revolutionized the robot vacuum, but they have hit a lot of problems since COVID, that being of supply chain issues and steeper competition. It will be taken private by its main Chinese supplier. So iRobot down 82% after declaring Chapter 11 bankruptcy. Matt?
All right, Valerie, thanks very much for that. Now, a week packed with data and rate decisions, starting with the delayed November payrolls report on Tuesday, U.S. CPI and rate decisions from the ECB and the BOE on Wednesday. Then we get the Bank of Japan on Friday. Joining us now is Bloomberg's Enda Curran to talk about, I guess, everything. And let's start with the labor numbers here in the U.S. First of all, what do we expect, and how important are these numbers considering the fact that the Fed has already cut?
So, yes, we're getting official jobs data for the first time in some time, Matt. As you mentioned, we will get November jobs data this week. We're expecting a gain of around 50,000 in the month. The unemployment rate creeping up to 4.5%. We're also going to get an estimate for October, not the unemployment rate, but an estimate for the payroll side of things there. So on paper, it suggests, yes, we're going to get official employment data again. That's a very good thing to give us an indication as where the economy is at. But this data, of course, because of the government shutdown, is expected to continue to have some survey and quality issues that will take many months to be ironed out. And the Fed chair, Jerome Powell himself, made that point last week. So the best we can take out of tomorrow's data will be some indication as to which direction the labour data is headed in. And it's expected to be a confirmation that it's not falling off a cliff, but has been softening, Matt.
Well, I wonder what the Fed thinks about inflation, which has not been softening. It remains 50% above the target that they have failed to hit. Will they continue to cut regardless?
Well, we also get inflation data this week on Thursday. Again, that's going to be partial. There won't be month-on-month comparisons because of the shutdown that really impacted October in particular. But nonetheless, it will give us some suggestion as to what's going on with headline CPI. And we've had core PCE again remaining above target, like you mentioned. The Fed's own forecast last week suggests that they see PCE coming back to target in the years ahead. That's certainly what they are clinging to. But there's no doubt, I think the real pressure point on the inflation story will come in early next year in the US. But it's either going to be somewhat of a benign path, tariffs are a one-off price impact, as the Fed and others suggest, that we start to see a decrease in shelter costs, in rental costs, for example, and we see inflation heading in the correct direction towards target. Or if not, in the first half of next year, we'll soon start to get warnings. Maybe tariffs aren't a one-off. Maybe there are other pockets of prices like services that are sticky. So the inflation story has not yet gone away, and it feels like we're at a critical junction now in terms of what exactly is happening in the jobs market, what is going on with inflation. I think the months ahead are going to start to show some clarity on that.
We have so many central bank decisions coming out this week. And Jane Foley from Rabobank earlier was saying, at a few, maybe the BOE, we could see a cut. But at others, we could start seeing central banks raising rates. And we haven't really had, a dip in longer treasuries. I mean, we're still at 420 essentially. What do you expect from these other central banks? And could we see, the treasury rate continue to get pulled up with other global interest rates?
Well, the Bank of Japan is at least expected to hike in some quarters. I mean, they've been battling the inflation story. Some would argue they're behind the curve. So they seem to be in a different space. Everybody else, I think, it was interesting last week, Matt, seeing pricing around the world for advanced central banks, so your ECBs and Bank of England and so on. There's markets are now, and Australia's RBA, markets are nudging towards the next move could be a hike for some of these. Now, remember, that doesn't say when the next move might happen, just that perhaps they've finished their easing cycle or about to finish their easing cycle in the case of some, and then go on hold for a while, and then perhaps the next move might be up. But that's a long way away for now. We do know that Fed Chair Jerome Powell was asked last week what's his view on that, and he said that right here, right now, no one's base case at the Fed is for tightening. And again, it goes back to what we discussed a bit earlier, Matt. So much depends on where the inflation story heads next year. And if we see the inflation story coming off the ball, central banks have plenty of room. If not, then it might be a different policy story in the middle towards second half of next year.
And I got to ask you about the Chinese economy. You spent so many years studying that market. A shocking chart on the terminal this morning as retail sales hit the lowest level since COVID. And even going back previously, we haven't seen retail sales growth this week, at least, in this time period. What do you make of that?
I think a lot of it still reflects the real estate slowdown, Matt. It hasn't turned around. That's being weighed on confidence. And we know that, the real estate sector accounted for 25% of the economy. And until that's fixed, a lot of people will tell you consumers aren't meeting their potential in China. But, let's not forget that's one part of the economy. We did have data last week saying China's export surplus breached the $1 trillion mark. And we know that the manufacturing and export sector in China is going gangbusters, along with the tech sector. So you have some analysts making the point that there are, there's a multi-speed Chinese economy going on right now. You can look at whichever part that you want. Consumers may be subdued, not meeting potential. Real estate sector continuing to be sluggish. house prices under pressure, but manufacturing and exports and EVs and quantum and high tech and those other sectors are growing gangbusters, and that's where the activity and the excitement and energy is in China's economy right now.
Yeah, that's fascinating because it comes despite the Trump tariffs as we get closer to the end of the year. And how do you see those tariffs playing out in terms of the manufacturing distribution? Because the president, I think, wanted to reduce the amount of exports we buy from China and bring manufacturing back to these U.S. shores. Is that happening?
Well, it's tricky to gauge. Number one, we're very early in this process in terms of this trade shock, so to speak. But a lot of manufacturers will tell you, Matt, it's not as simple as moving up sticks overnight, pulling out of China and bringing back to the US. It's more expensive here. Clearly, there are investment commitments on the table. The White House touts them every other week. My own colleagues did an analysis on just exactly how much investment commitments are on the table. Clearly, that number falls far short of what the president is saying. But we know some things near term. We know that both importers and customers are complaining that prices are going higher, and that's linked to tariffs. We know that supply lines around the world are shifting, but it's not all necessarily pulling out of China, because right here, right now, some of that tariff differential play just makes it easier to stay in China, because why would you move to other countries given tariffs have also gone up there as well? So it's not a binary story, Matt. It's not a simple story. There are changes afoot, but it will take several years for it to become clearer to see just exactly these tariffs have impacted manufacturing and where it is located.
Got it. Really appreciate you joining us this early, and Bloomberg's Enda Curran joining us there out of Washington, D.C. Now to the other top stories trending on the Bloomberg terminal this morning. Ukraine and the U.S. are due to hold a second day of talks in Berlin on a plan aimed at ending Russia's war. Allied security guarantees for Kiev is a central focus of the negotiations. About 10 European leaders are also expected to attend a summit on Monday, together with NATO Secretary General Mark Rutte and European Commission President Ursula von der Leyen. iRobot, the company that revolutionized robot vacuum cleaners in the early 2000s with the Roomba, has filed for bankruptcy. It will be taken over by its main Chinese supplier. iRobot's earnings began to flag in the post-COVID era due to supply chain issues and cheaper competition, despite having sold more than 40 million home robots. And Alphabet is set to book another sizable paper gain after SpaceX completes a tender offer that effectively values the closely held company at about $800 billion. SpaceX's insider share sale was priced at $421 a share, which would mark a sharp jump in valuation from earlier secondary transactions. That is likely to lift the carrying value of Google's longstanding investment in Elon Musk's rocket and satellite company. Coming up, an exclusive interview with the EU Trade Commissioner as talks continue with the U.S. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself and a way, having yourself hit the home run.
Erica Ayers-Badant.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersecci. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in for Vonnie Quinn in New York City. Let's get right to our exclusive interview with the EU Trade Commissioner as talks with the U.S. continue. Bloomberg's Oliver Crook joins us now from Brussels. Ollie?
Yeah, that's right, Matt. Thanks so much. Yeah, we're here joined by Maro Sefcovic, who is the Trade Commissioner for the European Union. We have so much to talk about the relationship with the United States, China, Mercosur, this Latin American trade deal that's supposed to be signed this week, and we'll see if we get to that. Commissioner, thank you so much for joining us here. I'd like to begin with the negotiations with the United States, because I think a lot of people are not very clear on where we are, particularly on the negotiations for steel and aluminum, those 50% tariffs. What progress has been made? Where are we right now?
I was very pleased with the outcome of the visit of my two principal counterparts, Secretary Latnik and Ambassador Greer, and I think we kind of reconfirm also in front of our industry, because we had a meeting with CEOs, that if it comes to steel and steel products, we are not each other problem, because we export to each other really minimum amounts. But what unites us is that we really need to take care of overcapacities which are destroying the steel production in US, but also in the EU. And I explain again that we adopted these very far-reaching safeguards if it comes to the imports of steel from the third countries to the EU, which are kind of very much reflecting the measures which US has undertaken several months ago. And therefore, I suggested again, let's go back to the idea where we can kind of build this ring of friends, where we would trade on MFN, or zero levels, and we would have the same, let's say, measures to take on the global overcapacities. The situation as it stays right now is that I sent to Secretary Latnik the list of the codes where we believe that we can definitely lower the tariffs. I understand there is some interest, especially from the machinery sector, but we didn't proceed or haven't proceeded yet to the very concrete negotiations on this type. So we're talking on the level of teams. We are almost, I would say, in permanent contact with my counterparts, and I think this would be good for both sides, because if America wants to reindustrialize, they need machines. We produce the machines. We are ready to send them the machines, but of course we need to find a solution on the derivatives.
And when Secretary Latnik was here, we caught up with him. He came on Bloomberg Television, and he said that basically in order to make progress on steel and aluminum, there needs to be movement on regulations for digital industries. So basically stuff that's outside of trade that the United States considers non-trade barriers or non-tariff barriers within. Is that something that is on the table in terms of the negotiation? Could that be part of a framework? And is there any other avenue to get those tariffs down other than basically diminishing European tech regulation?
I think that our tech regulation is adopted democratically by us through very thorough legislative process, and therefore we are, of course, going to protect our tech sovereignty. What I heard from Secretary Latnik and Ambassador Greer was that they wanted to be treated fairly. So we had a lot of discussions. Are we aiming only at the US companies? Clear answer is no. Just look at the companies which we are investigating or eventually finding. And are we kind of, favoring the European companies in this case? Again, no. And I was just providing my both counterparts with the fact that a lot of these investigations are actually prompted by the complaints which are coming from American companies, which are also located here in the EU. They want to make sure that US companies are treated fairly, in non-discriminatory manner, when we would use more I would say, the possibility of the settlement than fines. And all these things been also discussed with American partners, also by my colleagues who are responsible for these sectors.
And speaking of sort of rare earth minerals, this obviously has been thrust into the sort of the conversation in a very sort of obvious way now by China. Are we getting closer? Is Europe getting closer to getting a general license from China as the United States has?
Yes, I think that there I can say that we are in very close contacts with Foreign Trade Minister Wang Wentao and also his team, so we are communicating on different levels. We had here the team from China specializing on export controls like a couple of weeks ago, and I think we are getting initial reports from our industry that they are getting these general licenses, but we need to have a little bit more granular information to evaluate the whole process. But the fact that this idea was favorably received, that it seems that we are getting first general licenses, and also that the Chinese side was receptive to our arguments that the process as it was set up in April required too much of I would say, very intrusive information, too many photographs, too much detail about the supply chains, and I think that the general licensing could be one of the solutions how to address this issue.
Does that mean that there's going to be a regime that governs this sort of issue between the EU and China, or is it still just kind of being hopeful that things don't change, basically?
I think that we kind of set up I would say kind of hotline with the Minister Wang Wentao for, I would say, priority cases. So we are talking on our level quite regularly, but especially our teams are in permanent contacts, because indeed we had moments over the last year where on my table I saw that pile of the letters from the worried CEOs of different new companies about the lack of permanent magnets, lack of legacy chips, and so on and so forth. Was really growing quite rapidly, and we needed to address it. So now I think that we set up the good channels on working level and political level to address this issue. But it's a challenge. It brings additional instability into how the global supply chain has been working, and therefore my message to the European industry is you have to be prepared to pay security premium. We have to stockpile, we have to diversify, because we learned the hard way how the dependencies are costly, and therefore we included it into this new communication on economic security, because we just simply have to be much better in managing these emergencies.
And one of the costs of imbalance and the sort of dependencies is sort of evident in the trade balance with China, and something that Emmanuel Macron has been very critical of, particularly in the last week or so after his visit to Beijing, saying that there should be a more aggressive approach to dealing with the oversupply that is going into Europe. Do you think there is appetite to deal more aggressively with this question from China? And do you think that the trade deficit with China specifically should be targeted by the EU, and that is something that they should be looking to close?
Clearly, I would say the deficit of 300 billion is way too high. This was the topic which was raised by me with my counterparts from the moment one when I first time came for the visit to China. And I think that there's also a very clear message from our side that we'll fight tooth and nail for European jobs and European companies, and to have the deficit of 300 billion on permanent basis is unsustainable. Yeah. So we are looking at different possibilities how to address this issue. Maybe one interesting information for you would be that we set up such as import surveillance task force, which are monitoring, I would say, the inflows of the goods on bi-weekly basis, and this is what constitutes, I would say, the basis for our next steps.
And if 350 billion is too high, what for you is a more reasonable figure? What is a kind of goal, since we can talk concretely about kind of what we should be aiming for? And is the anti-coercion device, for example, something that is on the table in trying to achieve that goal?
I think that before we went to, I would say, the most, I would say, to the strongest instrument in our arsenal. What would be very important for us would be to see the tendencies. Are the European companies in China treated fairly? Do we have access, to some of the programs and public procurement, how the issue of the handling of overcapacity is happening, and if the investments are done in the EU, are they really investment? Are we talking about the IPR transfer? Are we talking about creating real value added in Europe? Are we talking about creation of the real job? So what would be very important is the tendency, and I would say engagement with us to address these, I would say, issues which we are raising with our Chinese counterparts really already for quite some time.
And it seemed going into sort of at the end of last week or in the middle of last week that Mercosur was more or less a done deal. There now appears to be some question about that. What do you think are the chances that Mercosur goes into effect, that it is signed this weekend?
We are going to use every minute of this week to get it done, because I think to end this turbulent year from the perspective of such a global trader like European Union, with the biggest free trade agreement ever signed, I think would be a positive conclusion to this year. That's a big deal with lots of opportunities for not only European exporters, but also in the field of critical raw minerals accessibility, and I'm sure that in the end it will be a very positive deal also for our agri-food industry, which is paying very high tariffs if they try to export anything to Mercosur. So we really very diligently listen to our farmers community, and I believe that we found the responses to every single concern they have. I just hope that they will look at it carefully. We are ready to explain it. We are discussing it with our member states in the parliament, and I hope that we'll end up on the positive note.
And just very quickly, after 25 years of negotiation, which is how long this has sort of been going place, if we do not get it over the line in these next couple of weeks, can we consider this sort of initiative to be dead?
Let's think positive, and I would never accept such a good deal like we negotiated between Mercosur and European Union is dead, because it's just simply too good for our citizens and too good for our businesses.
Omar Sefcovic, thank you so much for your time. And on that note, I'll bring it back to you, Matt, in New York.
All right, Oliver, thanks very much. Oliver Crook there with that exclusive interview out of Brussels. Let's get a look now at what's ahead this week in the U.S. The November jobs report will be released on Tuesday after being delayed due to government shutdown. Around the world, the ECB and the BOE will announce their rate decisions on Thursday. And then in Japan, the BOJ comes out on Friday. In terms of individual movers that we're watching today, Intel said to be near a $1.6 billion deal for Samba Nova, a chip firm that it works closely with already. ServiceNow is said to near up to a $7 billion deal for Armis, and Texas Instruments has been cut to sell over at Goldman Sachs. The price target there, $156. In terms of what's going on with futures, after a more than 1% drop at the end of the session on Friday, we look to kick off Monday's session with gains, 0.5% rise on S&P and NASDAQ futures, about 0.75% gain for the small caps. In terms of treasuries right now, we're looking at a 10-year yield at 4.1665. All yields there coming down just about 1 or 2 basis points. That's it for Bloomberg Brief. Bloomberg Surveillance is up next. Have a fantastic Monday morning. This is Bloomberg.
Court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
The market doesn't like uncertainty, it loves it.
The acronym of the year is AI.
I think the AI story is growing.
Next year, I think, is really going to be the year of the AI adopter. There is a lot going on into next year. We're positive, but I think there may be some volatilities.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Ending the year with a bang. The last full trading week of 2025 stacked with economic data and rate decisions. The headline number coming tomorrow. Non-farm payrolls finally being released. Follow up later in the week by CPI. Traders, meanwhile, playing narrative roulette into next year, weighing Fed rate cuts against weak growth and AI skepticism. David Gura, once again, pulling the short straw here with us here.
Glad to be here.
We're so glad to have you here in studio. It seems like people are trying to get a Santa rally at a time with this sort of dueling narrative of, are we going to get Fed rate cuts? Are we going to get a weakening economy? And does the AI story really turn?
Yeah, it really been called into question. So we get this long-delayed deluge of data this week. That'll be interesting. We'll see sort of how that casts a different shadow, perhaps, than what the Fed chair said at that press conference last week, his assessment of the economy, his and the other policymakers as well. But right, we saw that pivot in real time away from the enthusiasm about that rate cut and the prospects of what's going to happen next year. Shift almost immediately as soon as we got those Oracle results, then Broadcom. You're right, the dueling, the narrative roulette. It's a great term.
Well, that's what it feels like. Mike Wilson of Morgan Stanley coming out over the weekend in a note saying we are now firmly back in a good is bad, bad is good regime. Stuart Kaiser over at Citigroup is rolling his eyes and throwing things at the screen. But this is a sort of key question. Is there sort of a sweet spot where the data is just weak enough to justify another rate cut even as soon as January, but not so weak that it really undermines the idea that there will be some sort of economic recovery to start the year?
And we went into that meeting last week knowing that there was a deficit of data, that the Fed was operating somewhat blindly as it made its decision. There was that question, should they just wait until January? Was the insurance cut needed then? Yes, the good news, bad news thing I think is going to persist here going forward, but a fascinating thing for us to continue to watch and talk about.
Right now, we're trying to climb back after ending the week on a pretty soggy note for both stocks and bonds. Right now, we're seeing a tilt upward in futures, up about 0.5% on the S&P. We're looking right now at 10-year yields that are lower, taking out some of the heat after a sell-off that led the yield curve to steepen to the most going back to 2022. Right now, 4.17% rounded up in gold. Heading back toward all-time highs, the precious metal now at $4,338 an ounce, raising this question of how much more this haven bid has to go. We were talking about the week ahead, and really we have to talk about the fact we get non-farm payrolls tomorrow. On Thursday, we get CPI. We get a host of different Fed speak. Coming up this hour, we get Cameron Dawson of New Edge Wealth with stocks looking to bounce back, Sarah Kunst of Clio Capital on mounting AI skepticism, and Kathy Bastancic of Nationwide looking ahead to that key week of data. We begin this hour with stocks slightly higher to kick off the last full trading week of the year. Cameron Dawson of New Edge Wealth writing, the biggest question for 2026 is whether or not everything else can strike back and deliver the earnings growth that is necessary to unseat the narrow Mag 7 leadership. Cameron, I am so pleased to say, joins us here in studio. Cameron, great to see you. Thank you for being here.
Thank you for having me.
So this is the whole broadening out narrative. Yeah. Is it actually going to work this time?
Well, that is the really great point, is that this time of year, you always are seeing this notion that broadening out is going to be the hope trade for the next year. But the reality is that it really does depend on earnings. We looked over the last 3 years, and the Mag 7 has delivered earnings growth of 200%. You compare that to the equal weight S&P 500, it's been a whopping 16% over the last 3 years. So in order for this to actually be a sustainable broadening out of this market, where leadership is not just in this narrow cohort of names, you have to see the earnings really start to deliver. What's fascinating is that if you look at earnings estimates for 2026, you can see that Mag 7 is expected to see deceleration in its revenue growth from about 22% to 17%, but equal weight is expected to accelerate from 1.5% to 5%. So there's a lot of hopes and dreams weighing on this broadening out.
Do you think that it really is predicated on the idea that the economic data is just weak enough for the Federal Reserve to cut more? I mean, really going to Mike Wilson's point of Morgan Stanley, is good news bad news, or sort of little too good, kind of bad, and a little bad, really great?
We have had the ultimate combo for risk assets in these last 2 periods where the Fed has been cutting rates. What you've seen is that as the Fed has delivered rate cuts, you've actually been raising GDP forecasts. Delivering cuts, you're seeing forecast gets ratcheted up. That's why risk assets are so happy, because when you're raising forecasts and you're getting easier policy and liquidity, of course you're celebrating. However, if you start to get data that challenges current growth forecasts, and you have 2% growth that's expected for not too high of a bar, but if data starts to challenge that growth forecast, then you're in an environment where the Fed is cutting because it should, not just because it can, and risk assets typically don't like that.
Are you of the mind that what we've seen in recent days with Broadcom, with Oracle, has kind of eroded the narrative that's buffeted the Magnificent Seven here over the last year plus? I mean, are we at a moment where there's kind of a seismic change underway, or are you kind of still looking kind of narrowly at those results and more optimistic about its continued persistence?
I think that there is now a broader questioning of how much of this supernormal growth can continue. If you look at the Mag 7 over the last 3 years, just as they delivered that 200% earnings growth, they've also expanded operating margins by a full 10 percentage points. Not 10 basis points, but 10 percentage points. And I think the question is how sustainable is that in a world where not only A, are they starting to spend a lot more money, but B, they're facing a lot more competition. Because as we're seeing all these AI narratives, whether it's TPUs versus GPUs, or it's Google's model versus OpenAI's model, all of these suggest that competition is heating up, which means that they're having to spend more money for their businesses that had been near monopolies, and that suggests that this huge run in multiple or margin expansion could come to an end.
There's supernormal growth, if I can steal your modifier there, and then there's supernormal expectations as well.
Yeah.
Is this a moment when we kind of rethink the way that we expect these companies to perform?
I think that is a fascinating question, and when we hear about this idea that 2026 is going to be the year of the AI adopter, that effectively is a veiled call for a broadening out. Because we've long been arguing that the build out of AI infrastructure is going to be a very different subset of winners than the actual application of the technology. And I think the big question is we know that AI CapEx build out will remain robust in 2026 based on current guidance, but it is going to slow down, meaning the second derivative is slowing down. And usually markets trade on second derivatives. So we could be in an environment where we look back at 25 and say maybe that was peak valuations, maybe not peak earnings, but peak valuations.
Which really goes to this sort of anxiety. What is priced in? We don't really know what is getting priced in. There was this Teneo survey over the weekend that I thought was really interesting. 400 institutional investors, 53% believe that AI initiatives are going to start paying off within the next 6 months. Then they interviewed CEOs. 84% of CEOs of large companies expect it to take significantly longer than 6 months to monetize it. There is a gap in perceptions here about the length of time, the delta between some of these investments and when you actually start to get money. Is that skepticism being priced in, or are people just closing their ears and going, la, 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 la?
Well, the thing is, what's being priced in today is not the application. It really is just this build out. And I think the big question is, can the application help fund the build out? I think it's interesting, Merriam-Webster just published their word of the year for 2026, and it's slop, which refers to the AI slop. And I think that that's interesting in a time where we're looking at OpenAI and they have their code red, and they're saying that Sora is going to be the big source of growth, a video app, and yet people are saying it's just full of AI slop. So the question is, can we see the kind of revenue generation that's needed to continue this infrastructure build out? And if the answer is it's going to take longer than expected, do we see infrastructure build out CapEx forecasts start to come down? And that suggests then again that maybe some of this supernormal growth we've seen in the earnings starts to level off.
We'll have Mickey now with his hat cleaning out some of that slop Fantasia style, I guess, in Sora. But as it broadens out, as just the prospect of it broadening out, where are you looking? Where do you see potential for that happening?
So we think that there's a lot of room to find opportunity outside of just the largest large cap growth names, meaning that you can look within things like small cap and international and value, as well as mid cap. But that's an area where we think active selection really can add a lot of value. Those indices tend to be far less concentrated. There tends to be a lot more dispersion between winners and losers. So if you're looking for a place for active management fee budgeting, that's probably the place to go.
That's fascinating to me. And we've talked a lot about small caps as well on the heels of that Fed meeting and over the course of last week, continuing to see somewhat of an upward trajectory there, continued upward trajectory. What are you thinking when you look at small caps, too?
Well, the challenge with small caps is that you've seen this continuous death by 1,000 cuts when it comes to earnings revisions. And this year is a great example of that. You came into the year expecting 40% EPS growth, and the small cap Russell 2000 index is only able to deliver 6%. So when you look at the 53% expected growth for 2026, I think it doesn't necessarily deserve the benefit of the doubt. But the big point is that small caps also had a lot of extreme outflows from positioning over the course of the summer, and you're still just about 1/5 of the size of inflows that you saw at prior peaks, such as post the election during 2021. So we think that there's still room for a chase within small caps, mostly if you're in this special environment where you're expecting an easier Fed and you're getting resilient growth, because remember, small caps need a strong economy and lower interest rates in order to outperform.
I'm still thinking about slop being the word of the year, and that sounds about right. Cameron Dawson, you're going to be sticking with us through this entire hour, which we're very happy to say. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. Australia's government says it will consider toughening gun laws after a father and son killed 15 people in the deadliest terror attack in the country's history. The mass shooting at a Jewish community celebration of Hanukkah on Sydney's Bondi Beach also left dozens injured. Australian Prime Minister Anthony Albanese described the attack as an act of evil anti-Semitism. We'll be watching that story throughout the morning. Meanwhile, a Hong Kong media tycoon, Jimmy Lai, has been found guilty of 2 counts of conspiring to collude with foreign forces after a 3rd count of sedition. Lai, a British citizen, founded and ran the now-defunct Apple Daily newspaper, one of the only Chinese-language outlets in Hong Kong that was critical of Beijing. Governments around the world have been calling for Mr. Lai's release, including President Trump. And a JetBlue flight halted its climb to avoid colliding with a U.S. Air Force tanker on Friday. According to air traffic control recordings, a pilot flying from Curacao to New York's JFK blamed the military's craft for crossing its flight path. The Air Force did not immediately respond for comment. And that is your Bloomberg Brief. Up next, maintaining Fed independence.
I think I certainly should have a role in talking to whoever the head of the Fed is.
He would have no weight. It's just his opinion matters if it's good.
Bloomberg's Tyler Kendall joins us now. And next for more. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Trying to get the last full trading week of the year with some possible gains, maybe reprising the Santa Claus rally right now, getting an early start on that, seeing an inflection higher across the board led by the Russell 2000. So that rotation tilt, that broadening out seems to be in effect, up 0.3% on Russell 2000 futures. You got the S&P futures up 0.5%. When you take a look at the bond space, this is the why behind this. Hopes for rate cuts, hopes for that biggest global easing cycle going back to 2020, going back to the financial crisis. Looking at building on that with some rate decisions. Right now, you're building on the rally in the bond space, 3.51% on the 2-year, down a basis point. Even on the long end, although hanging in there, 30-year yield still at that 4.83%. This idea of a yield curve steepening that has steepened out to the widest going back to 2022. The real question here is the Fed in 2026, and who is going to lead it? Under surveillance this morning, maintaining Fed independence.
I think I certainly should have a role in talking to whoever the head of the Fed is. I think my voice should be heard, but I'm not going to make the decision based on that. I'll be making a decision over the next few weeks.
Would the president's voice have equal weighting to the voting members?
No, he would have no weight. It's just his opinion matters if it's good.
Here's the latest. President Trump reportedly leaning toward former Fed Governor Kevin Warsh or NEC Director Kevin Hassett, pictured there, to be the next Fed chair. Bloomberg's Tyler Kendall joins us now. Tyler, just curious to hear from your perspective how much Kevin Hassett's been trying to separate himself from the president and how the president is really navigating this race that continues forever.
Yeah, hey Lisa, good morning. Well, it appears evident that at the moment the process does remain in flux. As you mentioned, President Trump indicated in an interview with the Wall Street Journal on Friday that the two Kevins are the top two contenders. This despite the president repeatedly saying that he already has an idea of who he's going to pick. But then the president reiterated what you heard, that he would like to be consulted on the path of monetary policy. And to your question, I think it's fair to say that really in recent weeks we've heard from the NEC Chair Kevin Hassett, the presumed frontrunner on this, try to emphasize the idea of central bank independence amid concerns that he's too close to the president or could cut rates too aggressively. Now, he went on in that television interview, Kevin Hassett did, to say that President Trump's voice would be one of many consulted by policymakers, but that any rate decision is going to be data dependent. He said he himself is, of course, looking forward to the delayed data that we're getting this week when it comes to jobs and inflation. But interestingly enough, he did also go on to say that he would be willing to speak to President Trump on a daily basis if he ultimately was chosen to be the Fed chair. Of course, Hassett is one of those contenders, the contender that is closest to this administration and has worked for President Trump the longest. Now, it's our understanding that Kevin Warsh had a meeting with President Trump on Wednesday, and it's not clear at this point if President Trump is going to meet with any of those other contenders. But Lisa, as you well know, this administration is really putting lower borrowing costs at the forefront at the moment of its economic agenda, as it is trying to re-emphasize this idea of affordability, navigate that issue as we head into the midterms. It's worth mentioning in that Wall Street Journal interview, President Trump said that he was not sure if his economic policies were ultimately going to resonate in wins for Republicans next November.
Yeah, Tyler, just to pick up on that point, it was a really interesting one, saying that some of the money from the One Big Beautiful Bill and other stimulus plans wouldn't make their way through the economy. So his economic plan hadn't taken effect and might not before the midterm elections. Can you talk a little bit about that and kind of how he's setting up into 2026 when it really comes to policy and potential affordability issues?
Right, exactly, Lisa. It was so interesting to hear him talk about this potential delayed in money. It seemed like he was talking about the one big beautiful bill. He also touted the idea that some of the investments that he's been able to get from foreign investors might not make their way into the economy soon enough, as well as tariff revenue, something that the president has really focused on. We know that this White House is trying to go on the offensive now. They're trying to put President Trump out on the trail. We had that last week in Pennsylvania, and we are expecting, according to senior administration officials, that President Trump is going to continue to hit the trail with domestic policy updates. But at the same time, the upshot here is that there is really slim margins in the House of Representatives. The numbers could change, but at the moment, Democrats only need to net 3 seats, which means that as we see these consumer sentiment numbers, which the NEC chair did say in his interview over the weekend, the administration isn't happy with where those are. So we see polling showing that Americans are frustrated right now with the economy. The issue that really sent President Trump to the White House, it is clear that this White House needs to make up some ground with American voters as we head into November.
Bloomberg's Tyler Kendall, thank you so much. As always, Cameron Dawson, a CIO of New Edge Wealth, still with us. Cameron, how does this sort of affect what you expect for early next year if President Trump is already talking about how the money might not get to people soon enough? Is he saying something that we're not in the economic data?
Well, I think the other thing that this could throw into question is what happens with healthcare insurance premiums, which are set to jump pretty substantially. It seems like we're at an impasse as to finding resolution to keep those from jumping, which of course would further exacerbate the issues with affordability. And it doesn't seem like any of these issues are necessarily getting better. Cutting tariffs on things like coffee and bananas or beef doesn't necessarily move the needle for families that are continuing to get their belts tightened. The challenge you have is that it just doesn't show up in the aggregate data because the largest cohort of consumers just carry such a higher weight versus the weak consumers that carry a very low weight. So on the surface, things look okay, but clearly there has been distinct pain for quite some time for a lot of consumers.
You're following the ups and downs of this personnel search, as we all are, and I'm actually just genuinely curious how much you think it matters. So there have been moments when Kevin Warsh seems out, he's in, Hassett's out, he's in. Hassett saying over the course of the weekend the president wants to be consulted. Well, he talks all the time about this. It's not like the president doesn't have a forum to make his opinions on monetary policy known. When you think it through, how much does it matter if it is Kevin Hassett or Kevin Warsh? What's this going to mean in the context of committee? Because we did hear from Kevin Hassett as well, him saying what is so rightly true, that this is a vote by a committee. One person isn't going to make a whole amount of difference.
And I think that that is the exact key point, which is maybe there's this calculus going on that having somebody who has Fed experience, who has been an insider at the Fed, might have more luck getting to bend the will of the entire committee. Because it's fascinating, even as you had Hassett's name getting floated around as being the likely nominee, you weren't necessarily seeing an upward lift in yields because there seemed to be this assumption that, sure, he might want lower rates, sure, he might want to please the president by cutting rates, but that doesn't mean that everybody will vote for it. And so you didn't see yields move up. Now you're starting to see somebody like Warsh enter the picture who has been an insider at the Fed, suggesting maybe that there could be a little bit more success in bending that will.
Going back to the fog of data, the lack of data that we've had, delayed data that we've had, how much does the data that we get this week matter? Having the decision made already last week, the Fed are talking about the prospects for the economy, talking about productivity increasingly. How much do the CPI and the jobs data this week matter to you?
I think it matters a lot, mostly for the short end of the curve. If you look, the bond market only has about a 24% chance of a cut in January. So if you were to see an unemployment rate, let's say that is in the high 4.5%, that could push up that pricing for an expected cut in January, meaning that those 2 cuts that are priced in for next year happen sooner rather than later. But then we'll also have to contend with, on the other side, CPI. If you look at current consensus, you have headline consensus that's still expected at 3.1%. So how much of that will push the Feds back into a corner where effectively they could still be dealing with this environment where there's upside risk to prices and downside risk to growth?
We see bad news, good news.
Yeah, exactly. This is the whole thing. No, but truly, this is actually the reason why people are watching this and saying if there's a little bit of softness, that might be a good thing. I just wonder, are we missing the plot when it comes to the timing of the next Fed rate cut? We have not seen a global easing cycle of this nature outside of a recession for decades. For the Federal Reserve, it's the 1980s. For the ECB, it's never. We get rate decisions this week from the ECB, from the Bank of England. We get a potential rate hike from the Bank of Japan on Friday. How much are we looking for the same and going to get something different based on the fact that the global easing cycle is over?
Yeah, I think that we are far closer to the end than we are to the beginning of this easing cycle. And you're starting to see it in short-term rates on a global basis. No surprise that Japanese short-term rates are moving up, but if you look at German short-term rates moving up as well, and that's creating an interesting dynamic within currency markets, and likely one of the reasons why you've seen renewed downward pressure on the dollar. The dollar tried to break out in November above its 200-day and has faded. And if it breaks below 97, I think we could be talking about a DXY in the low 90s. That's important because that could have big influence on what we see as far as market leadership. Remember, you saw all the outperformance for non-US stocks at the beginning of this year in the first 3 months of the year when you saw an 11% decline in the dollar. If you see renewed dollar weakness, then we could be talking about non-US leadership again over a short period of time.
Is this kind of what you're anticipating as we talk about these differentials?
I think that this is another great reason as to why having a balanced equity portfolio makes a lot of sense and not being overly concentrated in one trend, one market. And of course, if we go back to that first quarter of 2025, that was the first time in a long time we got to be able to say, you're welcome for being diversified in portfolios. Because over the last few years, really the only thing that you wanted to do was just own the Qs, own NASDAQ, own tech stocks. And for a short period of time, we got this breath of, oh, it makes sense to be diversified. And if we see renewed dollar weakness, we probably see that narrative come back.
Cameron Dawson of New Edge Wealth sticking with us for the hour. David, we are getting some information from Netflix saying that they are going to continue with their position for the Warner Brothers Discovery deal, talking about how the Paramount hostile bid was entirely expected. You're seeing Netflix shares up 0.8%. They said that they've got a solid deal in place and they don't expect anything to change.
Yeah, they're pretty resolute about it. And I think what we're seeing here is them drawing a really strong distinction between these two deals, or the deal that the Paramount would like to have. And I think what Netflix has said all along is there wouldn't be the need for the kind of cost-cutting redundancy that you would see if Paramount were to win out over them going forward here. That obviously Netflix doesn't have a studio. There's kind of a complementarity there that you wouldn't have if Paramount were to go through with this. So again, looking at just the Q&As that we're seeing here today, our stance then and now is the same. We see this as a win for the entertainment industry, not the end of it. The deal is about growth. Warner Brothers brings businesses and capabilities we don't have.
Yeah, and talking about how they are committed to the theater business. So AMC, maybe a breath of relief, because this is something that certainly Hollywood was very concerned about. We'll get you more updates on that throughout the morning. Coming up next, Tara Kunst of Clio Capital's Oracle's AI delays reflect growing unease. You're seeing that unease in the share price as well. Plus, Yahira Anand with your morning movers. iRobot, the Roomba, it's bankrupt. This is Bloomberg.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
It may feel over, but it's not. It's winding to an end. This is the last full week of 2025, and right now we have a stacked deck ahead, given the fact that we get non-farm payrolls, that we get CPI. Right now, people are anticipating a strong finish, 0.5% gain on the S&P. You are seeing that sort of 117 level on the euro dollar just stay around there. It really has been quiet in the FX space, and you do see a slight rally into the long end of the yield curve. Watch this space after that yield curve steepening that we saw last week, 416 on the 10-year. Gold going back toward an all-time high, up almost 1%. Really, this has been a stalwart. What's gold saying? That's what a lot of people are going to say. What's Yahaira Anand saying? 3 hours away from the cash open. Here are your morning movers with Yahaira. Yahaira.
Hi, Lisa. Well, tech is starting the week on a better note, and NVIDIA is leading the charge. We are seeing shares up 1.2% after a more than 3% drop on Friday when doubts around the AI trade started to swirl, partly due to that Oracle story that we reported that it was delaying some of its data centers for OpenAI, and of course Broadcom's results failing to impress investors. Meanwhile, we move on to some M&A chatter with Intel. Sources telling us that Intel is in advanced talks to buy AI chip startup Samba Nova for $1.6 billion, well below the $5 billion valuation it was given back in 2021. Investors are reacting positively to the deal, not just because it is a bargain, but also because it provides a platform for Intel to compete with NVIDIA's AI chips. Sources telling us that a deal could close as soon as next month. And we end on the Roomba maker. As you said, iRobot plunging more than 80% after it filed for Chapter 11 bankruptcy, with plans to go private after it hands over the reins to its main Chinese supplier. Of course, its autonomous vacuum cleaners were all the rage at one point, but it's failed to keep up as cheaper alternatives have hit the market. Lisa?
Thank you so much, Yahaira. I just want to point back to Netflix and Warner Brothers. Netflix coming out with a filing earlier this morning, just moments ago, saying that their bid for Warner Brothers has not changed in any way, saying that the bid from Paramount was entirely expected, but they have a solid deal in place. They continue to reiterate the benefits for the consumer, and those shares up 0.7%.
Fascinating to watch. I mean, this is going to be a saga that's going to last a long time. I know we're up against this deadline when Warner Brothers has to decide whether or not to take the the Netflix offer. But I think that we're going to see this back and forth, and that was kind of indicated before this deal was announced. You saw Paramount sending a letter from its legal team to Warner Brothers saying it didn't feel like it had a fair shake in the introductory part of this. But I think this is going to be a story that plays out over many months. And again, I think that distinction between these two deals will come kind of in starker relief as it goes along. But we'll keep looking for more filings like this one.
Yeah, and it comes as global transaction volumes has risen 40% so far this year from the prior year. On our radar this morning, NEC Director Kevin Hassett saying he would listen to President Donald Trump's advice if he made a Fed chair. However, Hassett stressing that the Fed's interest rate decisions will remain independent. Meanwhile, Ukraine President Volodymyr Zelensky considering security guarantees from the United States and Europe in place of its long-term goal of joining NATO. Ukraine has sought membership for years, but has altered its rhetoric as Washington presses for the war to end. trend. And this story catching our eye, China's economic recovery hitting a wall, retail sales rising at the slowest pace on record outside of the COVID-19 pandemic. And fixed asset investment is on track for its first annual drop since 1998. Cameron Dawson, to me, this sort of raises this issue of, are we seeing a reacceleration of China that some people were talking about and betting on? Or is this something different?
I think that this could challenge the broader pro-cyclical narrative that has taken over markets over the last couple of months. You've seen a lot of movement in things like industrial commodities, which we typically see are very related to the Chinese market, given that it's been very infrastructure-focused economy. And so you've seen some perkiness in those prices. However, if you start to see China not deliver on growth, does that suggest that you see more weakness kind of start to set in? The real big question, though, is that if there is a lot of weakness within the Chinese economy, that usually causes people to say, ooh, we're going to get more stimulus, and thus we can be bullish after all.
Well, this has sort of been the story for a long time, but right now it seems like for investors, they're looking at whether Chinese tech can really beat out the United States. And that is the big bet right now in China, because ultimately, as we see in the United States, the actual economy can fall off a cliff, but you can still see tech sort of fill in the blanks.
Yeah, and Chinese tech on the Golden Dragon Index peaked back at the beginning of October and has been trading pretty heavy ever since, not keeping up with U.S. tech shares. So the trend doesn't look all too inspiring. We'd watch the technicals really closely for a sign that this breakout could actually be sustained.
Let's stick with tech. NASDAQ futures bouncing back after Oracle announced plans to delay AI data centers, and that led to a pretty huge sell-off in the prior week. Joining us now is Matt Bloxham of Bloomberg Intelligence. Matt, just how serious are some of these delays, and how different is the likes of Oracle and OpenAI from the behemoths of NVIDIA and Microsoft?
Yeah, you know, I mean, they're obviously significant, but I think in terms of their ability to kind of honor near-term commitments, that there's no risk there, and I think they made that clear in some of their statements. But, you know, I think what it does go to show there are huge bottlenecks in the development of these big new data centers needed to kind of support the demand for AI and more broadly cloud computing. And, you know, we've heard comments like this from the likes of Microsoft, who said, you know, that they would be recognizing more revenue if they could. They just can't bring enough capacity on stream quick enough. And I think what we're seeing here with Oracle is essentially reprioritizing their finances, but also the resources and raw materials they can get hold of into the data centers that they need to bring on stream sooner to kind of deliver on those commitments, mainly to OpenAI. You know, there's so many people building data centers that the kind of the human manpower you need to build them and design them, the power, all of the electrical components that go into creating these data centers is in really short supply.
Matt, Oracle is certainly having its day or week in the sun here. I'm curious how much you look at it as a proxy. So Lisa mentioning some of those other names, but when you look at the kind of bottleneck you're describing, is it something widely shared by its competitors, or does it stand kind of alone in that regard?
No, it's very much an issue we see shared across competitors. As I mentioned, Microsoft in particular has kind of called out the challenges they face in bringing enough capacity on stream. So it's an industry-wide issue. That's not to say that we aren't seeing huge construction take place. We really are, but it's taking place across so many big players with big budgets that this is really stretching the capacity of the data center ecosystem beyond anything that we've seen before ever.
Matt Bloxham of Bloomberg Intelligence, thank you so much for those insights. Sarah Kunst of Clio Capital writing, Oracle's core business just isn't going to grow as fast or as cheaply as people wish. Oracle is a solid cloud company. It's much less clear that it's an AI data center darling. Sarah joins us now as we parse through expectations versus reality. Sarah, so thank you so much for being with us. I want to just start there. I mean, how much of the froth has already come out of the likes of Oracle with a 40% decline in that name since its peak this year?
Absolutely. I think that the reality is that they jumped into this trend a little bit late. They saw a massive spike up, and now people are realizing that the financials don't quite work as well as we had hoped. And so I think that there is some sort of locking in gains and saying maybe this isn't going to go to the moon.
Well, this raises a question. Who is actually doing a good job right now of managing expectations while continuing to be the darling of the data center and AI world? On one hand, you could say NVIDIA. On the other hand, you could say they had a $5 trillion valuation. There are questions about competition. Is it Meta? Is it Microsoft? Is it, for example, what we see with Amazon and some of the new chips? Where is your eye sort of set?
So I have been saying this from the very beginning. I think it's Alphabet. When you look at what sort of catalyzed this AI trend, it was OpenAI. But the researchers at OpenAI were all mostly Google alums who had been there writing that initial paper. I think it's called Attention is All You Need, that really kickstarted this sort of generative AI boom. And most of them have left OpenAI, but Google certainly has an insane amount of talent with its DeepMind team. Gemini's baked in. There's clear revenue streams there. They can make money on the advertising. They have the capacity around data centers. They can do interesting things with chips. We know that because of their work with stuff like Waymo. I think that Google's the winner here. I've been saying that forever while everybody else on the street was saying, Google's missing the boat on AI. And the reality is, I think that they are so far out ahead of the current.
Sarah, if we continue to see some weakness in some of the Mag 7 names like Meta, do you expect that we could see them start to turn to a little bit more discipline in their spending, kind of akin to what we saw back in 2022, where if the share prices continue to come under pressure, they may not be able to spend quite as much?
Oh my God, you have to be so mean to Zuck to get him to rein in his spending. You really, really, really have to make that man look at the stock price quarter over quarter over quarter before he starts to say, maybe they don't like what I'm doing. And I think the difference this time with that sort of legless metaverse thing that he was on a few years ago before that year of austerity is that the market does like AI. The market cooled on the metaverse very quickly. It's not going to cool on AI in the same way. And so I think that you will continue to see Meta spend. I think the question is who they spend it on. Is it a good idea to let Jan LeCun go? Is it a good idea to have Alexander Wang in that role instead? We know that there's a lot of tension inside of those teams. How much work are they really getting done while they're getting paid up to $1 billion a year? So those, I think, are the kinds of questions that are going to be top of mind for Zuck much faster than should I give up AI altogether?
In fairness, we did see Mark Zuckerberg have some rethinking of the metaverse. It seems like at his Hawaiian retreat when he decided to make some cuts to Meta over the course of Meta staff over the course of the last few weeks. Bearing that in mind, I'm curious what level of introspection you think is happening in this sector broadly. So we've talked a lot about kind of the capital investments, how much of that is being paid for by debt now. Are we at a moment in this story where there is kind of a more general re-examination of the way all of this is proceeding?
Look, they're all still the richest men in the world. I don't think that losing like 2 pieces of gold on your Scrooge McDuck pile makes you fundamentally rethink your life's work. I do think, though, that there are real questions about the cost of doing AI. When you look at things like OpenAI, Sora, I've seen estimates that say that it can cost up to $5 to make a 15-second video clip that they are giving to people largely for free. Where do you get the ROI on that? And that's true across the category, across the sector. So there's so much money being moved around everywhere except from customers' wallets to these companies. And I do think that next year, the big question is going to be, could we get somebody to pay us for this, please?
Sarah, just real quickly here, how much are you seeing upstarts really come with great ideas that you think could be successful in this environment? Or are some of the largest companies really consolidating talent and market share in a way that really prohibits some of these smaller companies from getting in?
I think it's a little bit of both. Smaller is a funny question to ask when you have people like the AI team, like Ilya, leaving and immediately being able to raise at multi-billion-dollar valuations with multi-hundred-million-dollar seed rounds. That's the new small. But we certainly see a lot of that. There's a tremendous amount of talent globally in the AI space. And so I do think that we will see, I have names like Grok with a Q, the Elon Musk one, that have done incredibly, incredibly well. So, I think that there are good startups here. It's just a question of, is the private market going to continue to be interested in funding them before we really see the revenue come online across any of these?
Sarah Kunst of Clio Capital, thank you so much for being with us this morning. Cameron, what do you make of that, this idea that really it is Google, the others kind of, Zuck, you have to just be really mean to in order for him to do anything like ratchet back his spending?
Yeah, I remember the hoopla when all of a sudden he goes, there's pants in the metaverse. We now have pants. This all comes down to the returns that they're going to see on all of this spending, and I think it'll be fascinating on Sarah's last point as to what happens if we start to see them push into public markets. Could we see an IPO of one of these AI darlings in 2026? I know it's not AI, but SpaceX is talking about potentially doing an IPO. You've seen a little bit of a heavier trading activity in the IPO ETF, which is a great barometer for how the market is willing to accept new issuance. So let's see if we can get one of these mega deals out onto the street in public markets, and if that could open the door for more capital raises from public markets for AI companies.
Yeah, David, what was it, $800 billion, I think, for SpaceX?
That's what I saw, yeah. But picking up on this point that she was making about who's going to pay for all of this, I do think this distinction between who's working on enterprise AI versus consumer-facing AI is going to be fascinating to watch going forward here as well. Obviously, OpenAI is doing both, but kind of betting on the consumer-facing side, but you have Anthropic and others, Google certainly among them, really making the case that that's where all of this is really going to manifest itself in progress and improvements in our day-to-day lives. If it can be used for medical research or making our jobs more efficient, I think that'll be a very fascinating thing to watch going forward here.
How much will you pay to ask ChatGPT, why does my elbow hurt? I mean, that will be the sort of key question. Right now, let's discuss less of that, more of this. An update on stories elsewhere this morning. Here is your Bloomberg Brief. President Trump is suggesting the U.S. will do, quote, big damage to militants behind a deadly attack on American forces in Syria. 2 soldiers and an interpreter were killed over the weekend during counterterrorism operations. Trump is blaming the assault on the Islamic State terror group. Meanwhile, Brown University has sent students home and called off final exams for the fall semester after a shooting killed 2 students and injured 9. The shooting occurred on Saturday in an engineering building, prompting a shelter-in-place order that was later lifted in the day. A day later, a person of interest was detained yesterday, but he was later released. And Hollywood director and actor Rob Reiner and his wife were both found dead inside their Los Angeles home this weekend. The couple reportedly died from stab wounds. Reiner, a well-known activist who contributed to liberal and democratic causes, was 78. His wife, Michelle, a singer, was 68. And he was, of course, the director of movies like The Princess Bride, as well as When Harry Met Sally. And that is your Bloomberg Brief. Up next, watching for cracks in the data.
We might be starting to get the data that really starts confirming, whoa, something's not quite working. Now we're at that proof is in the pudding, and I'm a little bit nervous that the jobs data is going to show this is not working the way we hoped it would be.
Kathy Bostancic of Nationwide joins next from New York. This is Bloomberg Surveillance.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1, this is putting the between the rice air. Then make the 4 fingers curl, make sushi shape. Then touch this. 2, then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3, then, I mean, looks like pushing, not pushing. 3, 4,
2, same way, 5, and 6. So this is 1 through 6.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
We're trying this again to end the year, possibly getting that Santa rally and potentially building on gains that we've seen earlier this month. Right now, you are seeing about a 0.5% lift to S&P futures. You see sort of a somnolent kind of move in the currency space. Honestly, it has been almost entirely flat between 116 and 117 on the euro-dollar cross, and 10-year yields now in a complete 2 basis points at 4.16%. Gold. Watch this space as the precious metal climbs back toward all-time highs. People saying maybe it got over its skis. Well, maybe it's getting back there after a rip-roaring rally this year. Under surveillance this morning, watching for cracks in the data.
We might be starting to get the data that really starts confirming, whoa, something's not quite working. Now we're at that proof is in the pudding, and I'm a little bit nervous that the jobs data is going to show this is not working the way we hoped it would be. People aren't comfortable leaving their jobs. That tells you everyone knows the job market's a little bit sketchier than maybe the data shows. There's a risk that this data comes in much weaker than we're expecting. I'm definitely not quite sanguine about the economy. I think there are some risks there.
Here's the latest. Traders bracing for the final data points of the year and looking for clues on the Fed's path forward. Kathy Bostancic of Nationwide writing this: we expect a long pause until June, allowing time for inflation to peak and start trending lower and coinciding with the end of Chair Powell's term. Kathy joins us now. Kathy, before we get into the discussion around the Fed, let's talk about the actual economy. How weak is weak when we get non-farm payrolls tomorrow?
Well, good morning, Lisa. So we're expecting, a soft reading, up 25,000 overall. Now that's for the month of November. We will get October, November, but I think the focus really goes to November. And for, the household survey, which gives us the unemployment rate, Chair Powell's already warned us that it's going to probably be distorted. They really didn't have the normal time and process to collect data. So I think you pay a little bit of grain of salt to the household survey, the unemployment rate. But payrolls we think are weak, and we think the risk is on the downside, especially since government workers are going to be rolling off severance. That could really drive the number even to a lower level.
Peter, you're talking about the sketchiness of the jobs market. Let me ask you more about the sketchiness of these data. So you're getting at what I'm very curious about, which is low-quality data coming out of this government shutdown, the challenge of sort of getting a good read on the labor market, given what Chair Powell said at that press conference about how accurate this data might be, what might be counted, what might not be. Talk a bit about that, the veracity of this data, the importance of this data, given what we know are kind of deficits of it.
Yeah, no, all concerns and great question. My sense is the payroll data will be more reliable, really. They can reach out to establishments, companies, get that data. It's not as difficult of a task. In fact, you can make the argument maybe it's even a bit more accurate because they had more time. Remember, a lot of the companies are slow to respond in the first, when they survey for the month, and then the revisions catch a bigger swath of the data. The household survey is a different story because you actually have people calling, households and asking them, are they looking for a job? Are they employed? And things like that. That wasn't really done completely. And I think that's where, Chair Powell's warning us, don't pay too much attention to the unemployment rate. I think once we get the December data, we'll get a better reading. But I think the payroll data has such a wealth of information. We'll get wages, hours worked, breakdown of where employment is. I think that is enough to kind of satisfy us for now, especially since we've had such a drought of data.
You heard Peter say that he's not sanguine about the course of the economy. I'm curious how you reacted to the tone and tenor of what the Fed chair said on Wednesday of last week. I won't say that he had a rosy outlook for the economy. When it came to growth, for instance, he did seem to be more positive than he had been in the past. What did you make of that, the way that he engaged with the prospects for growth, the way that he talked about productivity, for instance, just the way that he's approaching this U.S. economy in the tail end of his tenure?
Yeah, I do think he was, rather optimistic. One, he's coming to the end of his term, so he wants, as he said, his legacy is he wants to hand off a good economy, solid economy, and lower inflation. And that's essentially what the Fed's forecasts are. They do line up with ours, too. I would say that we are, on the optimistic side that growth will improve, we'll get more balanced growth next year. But some of that is coming from fiscal policy. We're going to get quite a bit of stimulus starting in the first quarter. Tax refunds could be, $50 billion, and then additional business incentives that are baked into the One Big Beautiful Bill. Plus, the Fed has eased rates. That starts to work through the system a bit as well. And I think we get past this peak uncertainty, right? We know that not just the tariffs, the immigration changes, but the uncertainty around that really weighed on economic activity. I think we get past that next year and things start to loosen up. The risk is the labor market, though. So there you could see a little bit of weakness persisting. But I think those refund checks do help to boost consumer spending.
Kathy, how do you expect inflation to progress in 2026 as we think about things like wages and rents? Do you think that there could be a downside surprise potential to inflation as we move through the year?
Well, good morning, Cameron. Great question. So, yes, we do see housing inflation, so that's rents, to continue to trend lower. And we think other services, inflation is on a downward path. We do look for goods prices to continue to edge a bit higher. The tariff impact, I think, is still going to feed through. But we see that peaking, somewhere around, the start of the second quarter. So again, not too different from what the Fed and Chair Powell painted. We think it peaks and starts to trend lower. We just think overall the tariff impact has been more moderate. And you do get that disinflation for the service side, which is really, if you think about it, that comprises the largest share of measured prices.
Kathy Bostancic of Nationwide, thank you so much for being with us. Cameron, I turn this to you. Do you think that right now the CPI report or non-farm payrolls is more important this week?
Well, I think non-farm payrolls is far more important for the Fed because they have told us that they will look through any kind of stickiness within CPI on the good side of things because of tariffs being considered not transitory, but a one-time impact.
Transitory.
Transitory, yeah. So, but I think the important thing on inflation is that if we look at those big components, as Kathy was mentioning, you're still seeing wages look like they're pointing lower. Look at the quits rate that typically leads wages. You have continued downward pressure in observable rents, which suggests that shelter component is moving lower. So certainly that could help.
Cameron Dawson of New Edge Wealth, thank you so much, as always, for being with us. Coming up next to hour, Sarah Hunt of Alpine Saxon Woods, Henrietta Trays of Veda Partners, Jayati Bharadwaj of TD Securities, and Russ Kostrich of BlackRock as we see markets melt up to close the last full trading week of 2025. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The Fed is not going to solve the labor market.
This concern that the Fed has about the weakness in the labor market, I think it's a bit overdone.
The Fed is well aware of the fact that inflation remains a very sizable problem.
There's certainly a risk here that you could see inflation that's a bit more sticky.
Economic surprises keeps us in this scenario.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. A busy end to the year with traders preparing for a stacked week of economic data and policy decisions, with markets searching for that holiday melt-up as investors shake off AI skepticism and growth fears. The focus now turning very much to the delayed non-farm payrolls report out tomorrow. David Gura here alongside me, and there really is this question. Are we looking at a labor market that's softening just enough to keep the Fed in play, to keep that bullish spirit going?
What's good is bad, what's bad is good, to quote Mike Wilson, or to borrow a phrase from him going forward here. No, I think it's a fascinating thing to watch. We get this data. It's been long delayed. Tomorrow, CPI data coming this week as well. We'll talk about the relative quality of that, but I think it'll be interesting. We'll put that Fed meeting in a new relief once it happens.
Yeah, and watch that unemployment rate that we get tomorrow as well. We also get CPI that comes out on Thursday. We also get a smattering of Fed speak, whether it's Chris Waller, whether it's John Williams, whether it's Bostic. We get some earnings, and then of course we get all of these policy decisions from the ECB, from the Bank of England, from the Riksbank, from the Norges Bank, and it raises the question: have we seen the end of the global easing cycle? And are we entering something different as the Bank of Japan potentially on deck to hike rates?
There's that. There's the AI story, of course. You say investors are shaking it off. I candidly wonder if maybe they're postponing sort of the apprehension or pessimism they might have to the new year. Want to end this week, this full trading week, with a bang going into the holiday season. Again, I do think we're at this kind of very fascinating moment here, perhaps more fascinating than a lot of investors thought. The tail end of December going into January.
Well, you know, this year has been one of roller coasters, has been one of narrative roulette, has been one of tosses.
Pick your metaphor.
Pick your metaphor. It has been it. It has been a long year, and we are entering the final stretch. And we're entering it with a positive tone. Right now, you're seeing S&P futures up about 0.5% as people look to possibly a brighter future, as you were talking about. We also get some earnings from Lennar and Nike and FedEx. We also have currency space. Watch this sort of dollar weakening trend that we had been seeing that seems to be reasserting itself slowly as the euro climbs just a bit against the dollar, 117.50. 10-year yields actually getting a bit of a bid, and now in through 416, 4.1587%. And gold, after more than a 65% rally on gold, you are seeing an inflection higher of more than 1%. in early trading. Coming up this hour, Sarah Hunt of Alpine Saxon Woods as Wall Street shakes off some AI alarm. Henrietta Trays of Veda Partners as President Trump's approval rating slides. And Russ Kostrich of BlackRock as bond investors eye key economic data. We begin this hour with stocks trading near record highs once again after Friday's AI pullback. Sarah Hunt of Alpine Saxon Woods writing, "We think this illustrates a level of concern from investors that there is too much spending on the horizon and not enough cash flow to fund it." Sarah joins us now for more. Sarah, wonderful to see you. Thank you for being here.
Good morning. It's great to be here.
So is it enough fear? Is it enough skepticism to make you actually interested in AI once again, or does it need to go a little bit further?
Well, it certainly seemed like enough last week. I mean, there were some big moves last week, and I don't think the market, I mean, you look at Broadcom's earnings and the numbers themselves were very good. It's back to the expectations problem and the second derivative problem, which Cameron just mentioned, which is what happens when you're still spending a lot of money, but you're not spending it quite as fast as you were. And the more you spend, the bigger that the problem of large numbers comes in. And can I go 10% on every 10% or 20% every year? And I think that's an issue. And now people are starting to question, where's that money coming from? And it wasn't, that question didn't happen in the beginning. And you've got some real issues with companies that used to be cash rich now getting more asset heavy. And I think that that's a little bit of an absorption issue for investors right now.
But have we gone a little too far with this, with the idea that Microsoft and Google really are going to face some sort of insolvency risk or some sort of serious existential question because they're borrowing a bit from the bond market, right? I mean, have we sort of thrown the baby out with the bathwater, to use John Solfis's term, given the fact that people seem skeptical more broadly of the promise that they embraced 2 weeks ago?
I think that that is just indicative of what we've been living with for the last several years out of the pandemic, which is narrative shifts every day. And yes, the pessimism gets wildly bad and then it gets wildly fantastic again. And this is why I wouldn't say that this is a moment where you have to go, oh my goodness, we have to change everything. But you have to think about who else might benefit and how that's going to go. And I actually think that even the story about the CDS for Oracle, I think that's much more about hedging the stock than it is about actually thinking that Oracle's not going to pay its bonds back in the end. So I think a lot of this is the mechanics of how that spend is going to come about. And I don't think it's really challenging the fact that money is going to get spent.
I don't want to say that groupthink is great, but I want to pick up on what you just said there, which is we have all of these narrative shifts, dueling narratives. What does that say to you just about conviction, investors' conviction in this, not just this trade, but in the prospects of AI generally?
It is difficult to have because it's hard. I mean, the conviction that AI is going to be a big thing, it's going to make a lot of changes, I think hasn't changed. What those changes are going to be, who is going to benefit from those changes, and how fast they're going to be implemented seems to be a big part of the current concern. It was easier to say at the beginning of the year, we see a ton of spending on infrastructure. There's still going to be a ton of spending on infrastructure, but now that that's getting questioned, is that the peak of infrastructure spend discussion? Now do we have to look at use cases and who's using it and how they're using it, and is this going to improve margins? Because in the end, that's what it all comes down to, is it going to make people more money? Because if it isn't, then it isn't going to raise earnings, then it's less exciting than if it is going to raise earnings.
It's December. I'm in a retrospective mood. Perhaps you are as well. You mentioned that question wasn't being asked at the beginning, which was how is all this going to be paid for? Is it going to be cash? Is it going to be debt? What do you make of that in hindsight now, the fact that people weren't wrestling with those questions to begin with?
I think with every big investing enthusiasm, there is a willingness to suspend belief about whether or not and how things have to happen to get to the point where everyone's excited about. And I think that it doesn't mean that we won't suspend that disbelief again, right? So there's going to be some technological changes. I don't see how you get the molecules and the electrons to as many data centers as we have. So I think that there will be changes, and those changes are going to occur in ways that are right now difficult to parse. So you don't know who's going to win and who's going to lose there. I think it was very clear at the infrastructure beginning who was the winners, and now it's like, okay, who's going to win now? And are the winners really over, or is that just something that isn't going to grow as fast?
Yeah, the conversation over the weekend was you almost need bubbles to fuel technological advancement. I mean, I know that sounds really strange and perverse, but there is a sort of element of you need that enthusiasm to finance absolutely everything. Is there sort of this feeling that you would need to see the broadening out in the trade, the idea that other companies benefit from AI to keep the AI machine chugging, right? That in order for people to justify valuations where they are in the big tech giants, you need to see participation on a broader scale.
I think you absolutely need to see that participation. And I think that that was a question even earlier in this year, in the beginning, at the end of last year, which was who's going to use this? And then Walmart came out and said a few things about how it was helpful for margins. And other companies came out and said, yes, we can use it this way, and it's going to be, and that sort of solved the short-term problem. But longer term, that has to broaden out. And that has to be, and this is also the question about small caps. Can they use this to make some margin improvements? Because the small cap earnings revolution was supposed to happen 2 years ago, and then last year, and then this year. And is that really going to come through? And I think all of those things are very important as we go forward, and where valuations are right now, it's even more important.
This is where the economy starts to matter again. This is where all of a sudden, when we were talking about how anything related to AI could be in its own universe and the economy could keep sort of dragging along and basically being in a recession if it weren't for that AI investment, at what point can you see this expansion, this broadening out, unless you see economic data like what we're going to be getting this week really pick up?
It's interesting because I think that the government shutdown has not only made the data that's current difficult to see what happened just recently, but it also may have shifted some activity into next year. So it's going to be interesting to see that. You do have to see an economy that keeps chugging along. If it doesn't, you're going to have a problem. There's no question that that's going to be an issue. That's an issue for earnings. Earnings lead to valuations, and that's the circle that investors are looking at.
Speaking of circles, let's talk about circular investment and your sort of thoughts on that right now. I mean, we can't have this conversation about AI without going back to that, and I'm curious how worrisome that is to you. Have you been have your worries been significantly or sufficiently assuaged by these companies saying that it's not a big deal?
I'm not sure that I can say one way or the other it's definitely not a big deal or it's a huge big deal. I know that in 2000 there were a lot of issues with vendor financing. It was quite simple, right? The companies were selling stuff and they were financing.
Can we say circular deals and vendor financing are the same thing?
I don't think that you can, because I think that there are some of the players in that circle have much more cash than they did before. So last time it was vendors financing who didn't have the cash to companies who didn't have the cash. Now there is cash in the mix, and there's quite a bit of cash, and that's where you're seeing the have and have-nots on the tech side of who's cash rich and who's not, and who are people concerned about whether or not they're going to raise money or not. Again, I don't think that Oracle, anyone's concerned that it's going to go bankrupt, but I think that there are concerns about overburdening balance sheets right now.
Lisa brought us to the economy. Let me go back to that. Sorry to pull us away from that there just for a moment. But I'm curious, how do you think about growth in the year ahead? Are you, to borrow a phrase from Peter Schiff, not sanguine about it, or are you feeling like prospects are good, things are going in the right direction?
I think it's tough because the K-shaped economy is a real thing. That people who are spending the most money are the people who have the most money. The lower end consumer is not doing well. A lot of the companies that track that are not doing well. And I think it's going to be, that's really a question now, how much have we overstated jobs, right? So in Powell's conference, he talked about some of those overstatements, and maybe instead of generating jobs, we're losing jobs every month. How much is that really occurring? What can we see? And what do wages look like? Because all of those things matter. It's great that the high end can spend, but you really need, for the full economy to chug along, you need broader participation.
Yeah, which is the reason why everyone's watching and hoping for this broader participation in the equity space. Sarah Hunt of Alpine Saxon Woods is with us for the hour, I'm so pleased to say. And honestly, this is part of the reason why people are saying you're seeing mergers and acquisitions and things of that nature, because there is this broadening out. We just saw a 40% increase in transactions and announcements for global M&A, and people expect it only to continue.
And we were talking a little bit about with Cameron in the last hour, just that sense that this might be a moment for IPOs that we haven't had in a while. So yes, M&As and I think public offerings as well.
Yeah, meanwhile, right now, let's get you an update on stories elsewhere. Here is your Bloomberg brief. National Economic Council head Kevin Hassett saying he'd consider President Donald Trump's policy opinions if picked to lead the Federal Reserve. Hassett was responding to questions about Trump's comment on Friday that he should be able to make recommendations on rates set by the Fed. Hassett is one of the frontrunners to replace Jay Powell as Fed chair next year. Elsewhere, talking about IPOs, SpaceX starting the process of selecting bankers for its IPO. The Wall Street Journal is reporting that investment banks are scheduled to make their initial pitches this coming week in what is known as a bake-off. SpaceX's CFO reportedly told staff that whether a listing will happen and when it might take place remain highly uncertain. An $800 billion bake-off. Meanwhile, Zootopia 2 is officially the highest-grossing Hollywood release of the year. Disney's animal-packed animated sequel made $1.13 billion globally after 20 days in the theater, overtaking the haul of Disney's live-action Lilo & Stitch. It is the 7th biggest animated film in history and may, I'm just suggesting, may have gotten a boost from the fact that it was really cold out. I mean, I'm just saying.
Have you seen it? You haven't seen it.
I haven't seen it. Have you seen it?
No, I haven't.
I mean, but like,
sure
you think about it. I mean, if the kids were a little bit younger, I mean, I think that you'd be looking for activities. I think it would be great. Meanwhile, up next, the conflicted consumer.
Consumer sentiment right now is lower than anyone would like. People look at their wallets and see they're doing better, which is why we have the biggest Black Friday ever and so on. The sentiment will catch up with the reality.
Henrietta Trace of Veda Partners joins next. This is Bloomberg Surveillance.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
A reprisal, perhaps, of that rotation that we had been seeing in the past couple of weeks. Today, the Russell 2000 is the outperformance, although off some of the earlier highs, up almost 0.7% on the futures. Right now, S&P futures up a little less than 0.5%. Similar kind of move on the NASDAQ. The why behind this potentially is the everything melt-up rally that includes the participation of the bond space. 2s, 10s, and 30s. You are seeing yields lower as people look to economic data throughout the week. The potential for the Fed to cut maybe even as soon as January. 3.5% on the 2-year. You have seen that steady drip with expectations for Fed rate cuts high. On the long end, less so. Yes, you are seeing about a 2 basis point decline, but that yield curve steepening very much reasserting itself with 30-year yields back at 4.83%. Meanwhile, gold, check this out, climbing back to all-time highs so far this year. More than a 65% rally in the precious metal and continuing to climb back toward all-time highs. Is this because of dollar debasement? Is this because of haven fears in the face of growth concerns? Something to debate for the ongoing future. And frankly, under surveillance this morning, it is the conflicted consumer.
Consumer sentiment right now is lower than anyone would like. But, you know, we find that that very often happens during a government shutdown. People look at their wallets and see they're doing better, which is why we have the biggest Black Friday ever and so on. The sentiment will catch up with the reality. The money that we're talking about is like real money. So for groceries, it went from $400 a month to $525 a month under Biden. So that's like an extra more than $1,000 a year you have to spend on groceries.
Here's the latest. President Trump telling the Wall Street Journal he's unsure his economic policies will lead to midterm wins. An NBC News poll showing the president's approval rating down to 42% as economic concerns weigh on Americans. Bloomberg's Tyler Kendall joins us now for more. Tyler, can you talk a little bit about the evolution of President Trump's approach when it comes to talking about affordability?
Yeah, hey, Lisa, good morning. Well, we have to keep in mind that it was really a slew of election losses for Republicans in November that put this White House on the defense when it comes to higher costs of living, as the polling and the data has repeatedly shown that these concerns are really resonating with voters. And we've seen President Trump sort of evolve on the issue. At first, he was calling affordability a Democratic hoax, and he has been touting his policy proposals. But now he's saying that it's going to take a little bit more time for them to work through the economy. As we've heard, some of his advisors mirror these same sentiment points as well. You heard the NEC director, Kevin Hassett, there talk about consumer sentiment, which, yes, while slightly improved, is still hovering near record lows, as some consumers have pulled back, while others, particularly higher income households, continue to power the economy. I also think it's worth mentioning in that NBC poll, we're seeing President Trump's support erode among Republicans, too. This is a bipartisan issue, and the White House is really going to start to feel the pressure even more when it comes to the issue of health care, because it appears very likely that we are going over the so-called Obamacare cliff. Lisa, the House of Representatives is set to vote on a health care package this week after the Senate failed to advance any legislation last week, but it does not address those expiring Affordable Care Act premium tax subsidies that could see millions of Americans face higher premiums. And at this point, even if that does pass the House, it doesn't seem likely that it's going to pass the Senate, because there is only 1 week left in the legislative session for this year. And then lawmakers are heading out of town for the holidays, and they're not expected back here in Washington until at least January 5th.
Tyler, what is the president's plan, or the plan for the president, maybe is a better way of putting it? We saw him go to Pennsylvania last week, deliver this big speech, talk about affordability among other economic issues. Are we going to see more events like that? Is he comfortable talking about this? Is he under pressure to talk about it more? How does he engage with this issue of affordability in the economy running up to the midterms?
Well, he's definitely under pressure to talk about it more. In fact, we heard from President Trump, David, on the campaign trail in Pennsylvania last week, saying that his chief of staff, Susie Wiles, has told him that he's going to be making a lot more of these appearances. We know that he's very comfortable on the campaign trail, but while that speech last week, our understanding was expected to be focused solely on the economy, we also heard him veer into some of those other topics that do well with his base, including immigration. We spoke last week about him talking about the auto pen and potentially even looking into how that impacts Federal Reserve nominees. So it's going to be a issue for this administration that's going to keep coming up, as his policy officials want to keep him on topic when it comes to the economy and urge voters to have some more patience when it comes to their policies. And David, I'll quickly mention that we continue to hear this White House put out new policy proposals. For example, last week, President Trump touting new investigations into the food supply chain, aid for farmers, and of course, one of those big ones that he keeps touting but would need Congress's approval, the potential for any tariff rebate revenue checks.
Tyler Kendall, thank you so much, as always, for that. Henrietta Trays of Veda Partners joins us now for more. Henrietta, how do you sort of view this interview in the Wall Street Journal in particular with President Trump, where he's saying that people just haven't felt the ramifications or the benefits from some of his policies? Will that actually make any headway early 2026?
Yeah, that's absolutely true. The One Big Beautiful Bill went into effect immediately for corporations. Indeed, we've seen that corporate tax revenue has dropped by about 1/3 into federal coffers this year. That's because of the tax preferences that went out very quickly after they passed that bill on the corporate side. But the individual side is back-end loaded and starts in the new year when the tax filing season starts. So when you think about the odds of a reconciliation bill 2.0, for example, or the $2,000 tariff rebate checks, for example, that requires another act of Congress. And as far as the White House is thinking about it, and indeed when I talk to Republican staff on the House and Senate side, they're saying, you know, we already did the individual tax cuts, you just haven't seen them yet. So when Kevin Hassett comes out and says 2026 is going to be a boon year for the consumer and individuals, it's because the tax preferences that hit the individual side of the docket really start in the new year. So if you are, really looking forward to the SALT deduction, that's coming for you. There's a really small segment of the economy that's on the no taxes on tips, no taxes on overtime piece. That all starts in the new year, and they're hoping that that's going to be enough to overcome the continued hit of tariffs, the continued negative narrative around affordability, and the high cost of living, housing, healthcare going up by $1,000, et cetera. We'll see.
Henrietta, as you talk to staffers on the Hill, I'm curious what they want this president to be doing. So you lay out very clearly sort of the benefits that'll be very evident, I imagine, to the American public here come in the new year. What do they make of his emphasis on immigration, on foreign policy, him not talking about affordability? What would they like him to be doing more, and what's the reaction to him not doing more on that front?
It's a real mixed bag with the same answer. Get President Trump on the campaign trail. And for Republicans, they really want to see that because the majority of the new voter turnout of the last decade of sort of the MAGA base, they're here for President Trump. They're not here for your average run-of-the-mill rank-and-file Republican. So those members really want President Trump to come to their district, come on the campaign trail. They would have liked to see him more in Tennessee, for example, a couple weeks ago, to boost the numbers because he is a turnout-generating machine. And there's a lot of anxiety on the Republican side about going into a midterm election cycle where the president himself, who is highly popular with the Republican base and MAGA voters, is not on the docket. Those voters tend to not show up in a midterm, which is why you saw such a shellacking for the Republican conference in 2018. They don't want to see a repeat of that, so they really want Trump to get on the campaign trail, come rally their voters, and get the turnout machine. Unfortunately, that's what Democrats also want because they know that Republican voters that are supportive of President Trump are more likely to stay home. And the majority of Americans now have a negative view of the Republican Party's handling of the state of the economy, inflation, prices, housing, and healthcare. And those are the top 5 issues of voters going into the midterm cycle. So Democrats similarly want President Trump to be front and center. So it's really a tough row to hoe for the Republican conference and for President Trump in particular. He's got to get out there. He's got to talk about affordability, but the more he talks about it, the more it helps Democrats. So it's sort of a catch-22.
Good morning, Henrietta. So what of all those things that you mentioned, it seems to me that one of the most important things to try to nail down right now is healthcare, because you can't really change a rise in price levels. Whenever you do about further height doesn't matter as much as changing what's going to happen now with those subsidies. And this is a train wreck that's been coming and pushed off and pushed off and pushed off. Is there do you think that they can get something done in a time frame that's going to be meaningful? And do you think that there's enough bipartisan anything? Because everybody is going to be affected by this. How does that look in your opinion?
Yeah, I'm not shy about making projections. There's no chance that they fix Obamacare before the end of the year. So we're going off the cliff. To put it into perspective, that's 22 million people that are going to be hit. 4 million people will lose their insurance. If you're 60 years and older, your premiums are going up by almost $1,000 in the new year. That's going to happen. There is this period of time between January 5th and January 30th, where they could find a solution. Our odds are pretty slim. My colleague Spencer Perlman is our healthcare expert, and he's now down to 25% that we get any 2-year, 1-year extension of the ACA subsidies. And you can hear it from Republicans in the United States Senate who saw this train wreck coming, as you rightly point out, and consider this, a subsidy that needs to expire. We have a $38 trillion debt load in the United States. Let's cut this and make sure that it is not extended. Unfortunately, when American consumers look at Republicans speak to the healthcare issue, we're now on year 16 of not having an alternative to Obamacare. So that leads to an erosion of trust within voters of Democrats and Republicans alike around the entire concept of healthcare for the Republican conference. Former Speaker Boehner had the best quote the other day, where he basically said, I've been in all these meetings with Republicans for a decade now, and we've never all been on the same page. And so as long as that's the case, you're not going to see a fix, and we'll go into the new year without one.
Henrietta Trades of Veda Partners, wonderful to hear from you as always. Thank you so much. And Sarah, this raises a question about how much stimulus some of the tax cuts will actually be if they're offset by increases in healthcare premiums.
It is one of the biggest issues, I think, that we face as a country is the fact that you have this very opaque healthcare system. It's very difficult to understand how everything is priced, how everything gets paid for. And I think that, to Henrietta's point, the trust is gone in people getting it fixed by the government. And the problems that we have only gotten worse. They have not gotten any better. And I think the assumptions behind Obamacare did not work out. And instead of coping with that as they happened, they've just been pushed and pushed and pushed.
And it's going to lead to potentially another January fight that could end up with a January shutdown. Coming up, we're going to be speaking with Jayati Bharadwaj of TD Securities as we await 3 big central bank decisions this week. Plus, Yahira Anand with your Morning Movers. This is Bloomberg Surveillance. Good morning.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
A massive week to end 2025, the full trading week of this year. Really, it's the last one, and we get, of course, non-farm payrolls, we get CPI, we get some earnings, we get some rate decisions. Right now, people taking it all in stride, although reducing some of the enthusiasm from earlier in the session. S&P futures up 0.4%. You are seeing that dollar weakness continue to pervade the FX cross, euro dollar at 117.54, and that bid into bonds does continue. 10-year yields down by almost 3 basis points, 4.1587, rounded to the fourth decimal point. Take a look at gold, rising back to all-time highs, 1.1% gain right now, climbing there after more than a 65% rally so far this year. 2 hours away from the cash open, here are your morning movers with Yahira on it. Yahira.
Hi, Lisa. We are seeing Micron shares rising nearly 2% in the pre-market on some sell-side action ahead of earnings this Wednesday. Wedbush raising their price target from $220 to $300, maintaining their outperform rating. And what they're saying is that stronger memory market conditions have set up Micron to benefit from higher average selling prices than anticipated. I will also note Micron shares are up some 180% year to date, so quite the run there. Meanwhile, ServiceNow not having the same luck. Shares are falling 4.4%. Honor reporting that it is in talks to buy the cybersecurity startup Armis in a deal that could be valued at as much as $7 billion, a price tag that Bloomberg Intelligence says seems expensive. It is also seeing some pressure due to some sell-side action, with KeyBank cutting its rating on ServiceNow to underweight. And we end on the Roomba maker. It has gone bankrupt, so shares are plummeting, down more than 70% in the pre-market. It plans to go private after handing over the reins to its main Chinese supplier. Its vacuum cleaners, autonomous vacuum cleaners, were all the rage at one point, but it has struggled to keep up amid heightened competition due to cheaper alternatives hitting the market. Lisa?
Thank you so much, Yahira. David, didn't Roomba used to do all the airports? Wasn't that what happened?
I've seen that before.
Yeah, they would go around. What happened to that?
The novelties, too many people stepping on them.
I bet the kids.
Crushing them, yes. Mine would have been all over them.
I mean, come on, chase them, the dogs and the kids. Meanwhile, on our radar this morning, President Trump saying he should be able to make recommendations on the Fed's interest rate decisions.
The old days, it used to happen. Nowadays, it's sort of, they think it shouldn't happen, but I've done great. I've made a lot of money. I've been very successful. I think my voice should be heard.
The president is set to announce his nominee for Fed chair in the coming weeks. In an interview with the Wall Street Journal, President Trump saying Kevin Hassett and Kevin Warsh are his top choices. Meanwhile, Alphabet is set to book another sizable paper gain after SpaceX completes a tender offer that effectively values the company at $800 billion. SpaceX's insider share sale sitting at $421 a share, marking a sharp jump in valuation. David, the numbers get bigger and bigger. This, to me, just highlights how much fervor there is in the private markets and how big some of these companies are getting before they have an initial public offering.
Completely agree. Here as we look ahead to 2026, since I read our colleague Ed Ludlow's piece about this over the course of the weekend, struck by this line that the IPO would be for funding an insane flight rate, that's a quote, for its developmental Starship rocket, artificial intelligence data centers in space, and a base on the moon. So I think it's, it's emblematic also of the gamble or bet one is making on Elon Musk's vision and ideas.
Yeah, and the idea that we're all going to go to Mars and potentially find our new
Surveillance on Mars.
I think that, let me tell you, it will be hot on many levels. I wonder, Sarah, from your perspective, what this means about private markets and just how much froth has been building in the private space and not necessarily the public one, given the fact that there are huge companies that would be some of the biggest companies in the S&P 500 that are private that are yet to actually come to the market and are less transparent.
Well, I think that you've had such a window of the ability of those private markets to raise money. I mean, it used to be that the IPO was the cash out, and now it's almost, I mean, I wonder if part of the reason the IPO market is so stuck is because the public market isn't willing to accept some of the valuations that are happening in the private market, right? So I think that there is a tension there, and it will be interesting to see how the SpaceX progresses. That is one of those companies like you're talking about that's had this huge growth and these huge valuations, and yet there's no sort of mark to market on the public side. I think that there is a lot of money that's been chasing both private credit and private equity, and there is a mismatch in some cases, I think, between the valuations.
And this is something that has been the reason behind some of the private equity firms and the lack of some of the exits that we've seen because of this mismatch in valuations. Meanwhile, the Wall Street Journal reporting 68% of CEOs plan to spend even more on artificial intelligence in 2026, despite no meaningful investment returns. An annual survey of more than 350 public company CEOs finds a majority believe AI will increase their entry level and senior leadership headcounts. The survey also highlighted, and Sarah, I'd love your thoughts on this, the fact that investors expect it to take less than 6 months for you to really start seeing much more profitability from the AI investments. CEOs saying it will take much longer than 6 months to see profitability from some of these investments. So how do we understand that?
So on the CEO side, you can certainly say maybe that's part of the under-promise and over-deliver. On the other hand, you can also say that investors are always expecting things to happen much faster than they actually have. And I think that that's part of the problem with some of the valuations is that they run up so fast, and if you don't start to see something, then you get that pullback and that narrative shift. And I think that that's one of those big tensions around AI that we're all waiting for. But even small incremental positive coming out of industry that says, yes, this is working, I think people will just extrapolate and they won't worry about the timing. But you need to see some of that happen, because if there's nothing to extrapolate from, then I think you have a problem.
It has to be more than
I keep going back to like the plasticity of the promise of AI, that companies say something's going to change or happen, but we don't know what that is in tangible terms. And we had some fun last week with this Disney announcement and the fact that, maybe the great promise here is that we get a 15-second video with Mickey Mouse. I don't know if that's going to hold water going forward. So I think that's what it's going to take now, is sort of a broader rethinking of what exactly the promise is going to be here.
Yeah, an entire energy plant devoted to making Mickey Mouse.
This is what we've worked so hard for.
Speak your name in 15-second sound bites. Turning to currencies, the dollar facing 4 straight weeks of losses ahead of a busy slate of data and 3 central bank decisions. Jayati Bharadwaj of TD Securities writing, we expect euro-dollar to head toward 118 by the end of the year on a turn in dollar sentiment and weak payrolls reports. We're almost there now. Jayati joins us now for more. Jayati, thank you so much for being with us. This is sort of the big question heading into the first 3 months of next year. Do we see the same kind of dollar weakening that we saw to start 2025 on the heels of a kind of similar dynamic?
Thank you so much for having me. I think that's a very important question. In fact, we are off consensus and calling another 5 to 6% weaker move in the dollar by middle of next year. And I think that also hinges on the fact that, there's been a lot of talk of AI capex. We were just on that, conversation a second ago, but there have been no tangible results, like you said. What that means is that the Fed's mandate is not what headline GDP is doing because of all of the capex investment we're seeing. The Fed's mandate is the labor market, which is not being propelled up. The majority of the sectors outside of tech are not seeing any gains, any tangible gains yet from all of this. The Fed's mandate at the end of the day is labor market. They will have to keep cutting interest rates if we don't see any strength. We have payrolls tomorrow, which is going to be a very important release. In fact, we expect the October payroll to show a contraction of 60K, which then rebounds into November, but that does not paint a very good picture of the labor market.
So this is the difficulty right now for me to understand the FX market, which has been highly confusing and basically stagnant for a while because everybody's equally confused.
Is it ever not? I don't know.
Honestly, yeah, it's fascinating. There has been some really interesting interest rate-driven differentials, but there is this issue now. Are we talking about growth differentials? Are we talking about interest rate differentials? Are we talking about a Fed that's cutting rates? Or are we talking about a U.S. economy that still is growing faster than in Europe or in elsewhere? So how much does the growth rate supersede the interest rate cycle?
You're absolutely right. Currencies are fascinating. They're the most macro asset class there. They move on any and everything on any single day. It's both frustrating, but also exciting at the same time. I think it's about both. But it's all about relative to what our market expectations. The US, in terms of nominal GDP, will still be stronger than the rest of the world. But in the first half of next year, we still have the US growing below potential. So obviously, in terms of nominal GDP, the US is the largest economy in the world. There's no good alternative to US stocks. But it's all about relative to expectations. Is the US growing at the pace it was in the last 3 years when we had this US exceptionalism trade and narrative? Definitely not. And on the interest rate channel, which is becoming increasingly more important, the Fed is the only central bank out there where risks are more to cuts on the downside, whereas we're now talking about hikes at other places. That is also going to keep that downward pressure on the dollar in at least the next 6 months to come.
Lisa's pointed this out already, but I'll ask you just, this is not a quiet week. There's so much central bank news this week, and I saw Goldman Sachs noting central banks in the Euro area, the UK, Norway, Sweden, Japan, Mexico, Indonesia, Hungary, and Czech Republic, Russia, Taiwan, Thailand, Colombia, and Chile, all scheduled to meet this week.
Yeah.
How do you look at them holistically, and what's the lesson we can take away from the decisions that are going to be made this week?
I think definitely very exciting. I think the two big focus points, which could be market moving in our purview, are the BOJ and the Bank of England, both in opposite directions, actually. We expect the Bank of Japan to hike after a very long time, which should provide some relief to the Japanese yen. We've all been waiting for that. It's been stuck in very weak ranges ever since the political turmoil started. But at least if let's say the payroll reports tomorrow come on the weaker side, which leads markets to price in more Fed cuts, paired with the BOJ hiking, I think interest rate differentials can really push dollar yen back towards 150, provided some reprieve. And the other interesting one is the BOE, because they are still on the cutting path. In line with the Fed, definitely not as aggressively as the Fed. In fact, I think they will try to signal a very hawkish signaling because they're not ready to cut at consecutive meetings. In fact, I think they will signal that we're done, but don't expect us to keep cutting from here onward. So those are the two ones which we have our eyes on.
You didn't mention the ECB. Is it proudly uninteresting? So they've just done a great job of telegraphing sort of what they're doing.
They're done. I think for the euro, what matters is if they can get the peace deal. And I think that's the main focus point. ECB is done. They're not going to talk about either cutting or hiking. The next move by them is more likely than not going to be a hike, which we think is definitely more a second half of the next year story. But they're very comfortable for now. I think the main point is what happens with the Russia-Ukraine peace deal. I think that's going to be very important for the euro.
So you mentioned the yen, and this is one of those currencies that's been used in a lot of ways that weren't just about the Japanese currency. What happens? Are they going to have to hike because rates are going up anyway? I mean, what do you see going on there, and how do you see that playing out over the next 12 months?
I think hikes have become inevitable for them at this point. There's a lot of domestic macro momentum on the growth, inflation, and the wages side, which we saw overnight. And also now, we've had a new politician in power who is going to be fiscally expansive, which is not something that the currency or the bond market is liking. So in order to stem currency weakness, and outside of the MOF intervention, I think the only best chance for you is to show credible policy action through a rate hike. Imagine if the MOF starts intervening massively here. That's not going to send a good signal, even to the US, who have become very watchful of Japan's activities. And we know Besant has been commenting on BOJ and MOF's decisions a lot recently. So it doesn't look well for them. I think the only best chance they have is to hike interest rates.
Well, all currencies seem to have lost value versus the precious metal of gold so far this year. And I want to finish there, especially with gold prices surging back to all-time highs. Does this raise more concerns for the currency space, that there is this sort of broader devaluation of fiat currency that's happening at a time when, we're talking about relative values, but there is this bigger shift that could be durable?
I think we've spoken about the de-dollarization narrative for the last decade, but the only thing is it's happened at a glacial pace. What changed this year was the perception of the US dollar as a safe haven, which is what also has led to this bid in gold as the alternate safe haven, let's say, which can also shield you from a lot of the exogenous shocks we are dealing with right now. Obviously, the longer this extends, the uncertainty of policy in the US with Trump in power, with so many risk events, Supreme Court decisions still pending, I think that will likely keep a bid on gold and also a downward pressure on the dollar. That is definitely that de-dollarization or hedge dollar trade, which we're seeing play out.
Jayati, wonderful to have you here. Let's do it again sometime. Great to have you. Jayati Bharadwaj of TD Securities here in New York. Meanwhile, a tough weekend that's left us all reeling. We're talking a lot about markets and the economy because that's what we do. But our thoughts are squarely with the Jewish community in Australia and the student community at Brown University. These shootings shake all of us around the world, so we do want to get you an update on stories elsewhere. Here is your Bloomberg brief. Australia's government says it will consider toughening gun laws after a father and son killed 15 people in the deadliest terror attack in the country's history. The mass shooting at a Jewish community celebration of Hanukkah on Sydney's Bondi Beach also left dozens injured. Australian Prime Minister Anthony Albanese described the attack as an act of evil anti-Semitism. Brown University sent students home and called off final exams for the fall semester after a shooting killed 2 students and injured 9. The shooting occurred on Saturday in an engineering building, prompting a shelter-in-place order that was later lifted a day later. A person of interest was detained yesterday, but he was later released. Meanwhile, Volkswagen gearing up for its first production closure in Germany. In its 88-year history, the closure comes as Europe's largest auto manufacturer is under pressure due to weak China sales and demand in Europe, as well as U.S. tariffs weighing on sales in America. And that is your Bloomberg Brief. Up next, balancing the Fed's dual mandate.
To me, right now, we've got policy that's right around neutral. It's in that range of neutral. And when we've got challenges on both sides of our mandate, being close to neutral is probably the right place to be.
Russ Kostrich of BlackRock joins us next. From New York, this is Bloomberg Surveillance.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest. And this is Bloomberg.
Seeing a lift to markets as we kick off the last full trading week of 2025. We are seeing that lift to futures as people look back to last week and say, let's try to shake off some of those AI concerns. 0.5% gain on the S&P. Dollar weakening, taking hold, 117.55 on the euro-dollar cross. 10-year yields lower by about 2 basis points to 4.16, and gold surging back toward all-time highs, up about 1%. Under surveillance this morning, balancing the Fed's dual mandate.
To me, right now, we've got policy that's right around neutral. It's in that range of neutral. And when we've got challenges on both sides of our mandate, being close to neutral is probably the right place to be. I would prefer to be on a slightly more restrictive stance to help continue to put pressure on that inflation side of our mandate.
Here's the latest. U.S. Treasury yields inching lower as traders await key data for guidance on the state of the economy. Russ Kostrich of BlackRock writing, while the Fed is likely to temporarily pause in its cutting cycle, financial conditions remain supportive for risky assets. Russ joins us now for more. Russ, great to have you. Thank you so much for being with us. So let's just start there. This idea that does it matter if the Fed cuts rates? Are people putting too much emphasis on this idea of the Fed needing to ease policy and need to focus a little bit more on the actual economic backdrop?
Good morning, Lisa. I think that's correct. We have an environment where whether the Fed cuts once or twice next year, we can debate that. We have a very accommodative environment when it comes to financial conditions. You have an economy that's likely to accelerate in the first half of the year based on tax refunds, capital spending. You have an economy that appears to be benefiting from a productivity standpoint from AI. You've got a corporate sector that continues to produce incredibly strong earnings and cash flow. So to have everything hinge on whether the Fed's going to cut 1 or 2 times next year, I think that sort of misses the point.
Russ, I want to ask you about the place of bonds in portfolios today, sort of how you think about that. And I saw a piece in The Economist a few days ago indicating the bond market is quiet, perhaps too quiet. We haven't seen a lot of volatility therein.
Yep.
What's the role as you see it here as we round the corner into 2026?
See, this is a really interesting question for a couple of reasons. First of all, we're still in an environment where really for the first time since the late 2000s, you can build a high quality bond portfolio, lean into credit and spread, and get a 6.5% yield, something you were not able to do for most of last decade. So as a source of income, as a source of carry, bonds make more sense. The other thing that's happening, which I think is a little bit of a departure from what we saw in 2022 and 23 and 24, is that you're beginning to see some indications that bonds are once again acting as a bit of a hedge. In other words, more of a likelihood of bonds going up when stocks are going down. I think the reason for that, or one of the reasons, is that while inflation is still somewhat above the Fed's target, we have seen is that it's become much less volatile than it was in 21 and 22 and 23. And that drop in the volatility of inflation, giving investors a bit more confidence. So you can start to have the conversation again about whether bonds are likely to act as somewhat of a hedge as we go into 2026.
Are clients eager, willing to have that conversation now? How has the kind of attitude toward fixed income changed here in recent months?
Well, it's interesting. Certainly a lot of people were hurt in 22, one of the worst years for the bond market in record. So there's still a little bit of reluctance. But I do think that the ability to generate yield in a portfolio, the fact that we're still looking at an economy that is strong and a recession is very unlikely, it argues for having that portion of your portfolio in bonds that can provide carry. And again, if it can also add a little bit of safety along with other asset classes such as gold, all in all, in our view, that leads to a more robust multi-asset portfolio.
When you have discussions with clients, do you often talk about the fact that they are going to want to hold those bonds until maturity and not watch the fluctuations on the pricing? Because that's one of the things that gets people more worried. But in the end, if you can get that yield, you just have to stick around and take that and not get too worried about the price fluctuations when you get those interest rate shifts.
I think that's exactly right. And, to be clear, we think of benefit in a lot of our portfolios. Much of the fixed income exposure, particularly on the credit side, we're able to buy that several years ago when spreads were much wider. And really what we've been doing is we've been holding that credit, holding those bonds in the portfolio, getting that carry, getting that tailwind. Another point, again, we've had 3 phenomenal years for equity returns. We may not quite get to 20% on the S&P this year, but the reality is this has been the best 3-year stretch since the late 90s. We do think stocks are going to head higher next year. We think earnings are going to power that. It may not be another year of 20% gains. If you can get 6-7% in the bond portion of your portfolio and do that with a lot less volatility, we do think that's going to be attractive for clients.
Would you rather be exposed to the AI story through credit or through equities right now?
I think it's still an equity play. The reality is you think about where do you want the convexity in your portfolio, it's on the equity side. And we continue to see, even with some of the recent pullback in AI names, a phenomenal year for tech, phenomenal year for a lot of those themes. There's likely to be more volatility. I think 26 is going to be more of a year where you're going to have to really think about stock selection, the industries you're in, pay attention to valuation. But by and large, we continue to believe this is a multi-year, probably a multi-decade theme. Having that exposure in the equities in your portfolio, it gives you that long-term convexity, gives you that long-term growth.
At this point, are you seeing concern build in credit space, in credit markets, about some of the exposure to artificial intelligence, given some of the circular financing, given some of the higher degrees of leverage in the likes of OpenAI and related to Oracle?
I think there's definitely concern in general. Obviously, what we've seen this year is a continued growth in the capital spending. When you started the year, I think the expectation for the 4 hyperscalers was they were going to spend around $350 billion in CapEx. That number's only gone up for the year. It goes up further for 2026. So both on the credit side, but also on the equity side, you're getting this reasonable concern. If these companies are going to spend what could easily be $500 billion on capital spending, what does the return look like? What does the timing of that return look like? So I do think that's a reasonable concern. We're not overly worried about credit markets. We think in general these companies are producing very healthy amounts of cash flow. But I said a moment ago, 2026 is likely to look different, both in credit and equities, that it's going to be more of a year of differentiation, not simply you buy AI and go to sleep, but more really thinking about what parts of that space, what names you want that exposure to.
Russ Kosterich of BlackRock, thank you so much for being with us. Sarah, has there ever been a time where you could buy something and go to sleep?
In retrospect.
Sure. Is there anything right now heading
going
into next
forward,
year?
it's very difficult. I mean, I just put out a piece on 2026 and looking forward. It was very difficult to write because it's very difficult right now to look at what's going on and say, I know what's going to happen in 2026. There are so many variables. There are so many things that people are excited about, but then pull back on. People are looking for, and then you think about how much dark fiber was laid, how long it took to absorb that. Are we overbuilding data centers? We don't know. Are we underbuilding them? We don't know. There are a lot of things that we don't know, and some of the, again, it's always in retrospect. You look back and you go, well, of course the AI spend was going to continue, so of course you needed to own all those names in big size. What's going to happen from here is a little bit trickier, and I think that all of us have to think about that for our clients and for ourselves and for the market itself. There is a lot of question. You've had a big change since 2008 in the financial crisis. And all of that is just different now than it was before.
Sarah Hunt, wonderful to have you here, as always. Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods. Coming up in the next hour, Keith Lerner of Truist, Sucharita Kodali of Forrester, Pooja Sriram of Barclays, and Alessio DeLongis of Invesco as we head toward a really busy last full trading week of 2025. This is Bloomberg Surveillance.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view of Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for VVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
The market doesn't like uncertainty, it loves it.
The acronym of the is AI.
I think the AI story is growing.
Next year, I think, is really going to be the year of the AI adopter.
There is a lot going on into next year. We're positive, but I think there may be some volatilities.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, a busy end of the year with traders preparing for a stacked week of economic data and policy decisions. Markets searching for that holiday melt-up as investors shake off AI skepticism and growth fears. The focus now turning very much to delayed non-farm payrolls report out tomorrow. We get November CPI on Thursday, a slew of earnings, Nike as FedEx, and of course we get University of Michigan sentiment survey on Friday. David Gura, honestly, in this third hour of surveillance, it seems like people really gearing up to try to understand the Fed and the Fed versus AI.
Yeah, we get the opportunity to hear from some Fed policymakers this week as well. Stephen Myron's going to be speaking here in New York. So again, kind of getting a fuller sense, a more holistic sense of what the Fed did last week, and people will carry that into the new year. I think this kind of conversation about AI continues as well.
Well, it's sort of this push-pull where you have the economy that hasn't been doing fantastically, but it's been supported by the AI narrative. And there's a feeling, at least in the first 2 hours, where people were saying you have to start to see the economy catch up on some level in order for the AI promises to really have come to fruition, just because how are you profitable in a society that doesn't have the money to pay for it?
Yeah, show me something, show me what those promises are in actual effect. And then I think going back to what the Fed chair said last week, you detect an interest in policymakers here, I think, in kind of wrestling with what AI is going to actually mean for this economy going forward.
Yeah, and is it going to be the Oracle story, or is it going to be the Google story? Two very different sides of possibly the same coin. Right now in markets, you do see a lift across the board throughout indexes, but you do see that broadening out that people have been hoping for to end the year. 0.8% gain on Russell futures. S&P futures up about 0.5%. Similar move on the NASDAQ. You do see a bid into bonds. This is going to be important, especially heading into a 20-year auction later this week. It is coming across the board, but in particular at the middle of the curve. The 10-year yield lower by almost 2 basis points at 4.16, although pulling back from some of the earlier lows. You are seeing this expectation of a Fed Fed cutting rates. You did see that yield curve steepening, 30-year yields 4.83%, steepest yield curve going back to 2022. Coming up in this hour, we've got Keith Lerner of Truist, with stocks rising to start the last full trading week of 2025. Sucharita Kadali of Forrester looking ahead to fresh retail data this week. And Pooja Sriram of Barclays as investors await the November payrolls report. We begin this hour. Stocks are higher as Wall Street aims to bounce back from Friday's losses. Keith Lerner of Truist writing, we are still positive tech longer term, but in the near term, there is a lack of a catalyst for the sector, so investors will need to be patient. Investors known for their patience. Keith joins us now. Keith, thank you so much for being with us. I just want to start there. I mean, do you think that this sell-off that we've seen, or underperformance, I should say, probably putting it more fairly, in the tech sector is something that can persist for a longer period of time, or is it just sort of like an end-of-the-year melt-off, given how much it's been outperforming?
Yeah, well, first, great to be with you. I didn't realize it was actually the last full trading week of the year, so that's exciting in some ways. So to your point specifically, Lisa, listen, I still think tech is long-term leadership, but to your point, we went up off the lows about 70% versus 35% for the S&P 500, and now you're getting all these different questions as well. So I just think it's a point where, you know, that we have to kind of rebuild that wall of worry, which we're doing. But at the end of the day, the earnings momentum for the tech sector is still the strongest one out there. So I think in the near term, I think the challenge is, what is the catalyst to move this up? Because, you know, we just went through earnings season. People are focused on, obviously, Oracle. NVIDIA comes out with some news about some more chips selling to China. It's not moving it. So I think it's just maybe a digestion phase. And I think, you know, next year at some point, maybe that's 3 months or 6 months from now, we'll see money rotate back into it. And when we look historically at bull markets, maybe my final point here is, the leadership of a bull market tends to endure towards the end, notwithstanding periodic, you know, pullbacks and rotations. We're seeing one of those rotations right now in this kind of broadening theme, and I think that broadening theme, at least near term, has a bit more to go.
You sound somewhat skeptical of it long term. Is that correct, Keith, that this broadening theme maybe is a short-term blip, but not necessarily a 2026 full-year trend?
No, I think, you know, at least if we were here a year ago, I think the theme was very similar about this broadening theme. It didn't work out. But no, I do think next year there's more of a reason that we could see more broadening. So I think a lot of times people think about it's tech or X. And in our view, it can be both, especially as we have these sharp rotations. But, you know, the good news, I think, as we think about the equal weight index, we came into this year around the 17 multiple. We're ending the year around the 17 multiple, and it's been mostly earnings growth. The key for next year is profit margin. And do we see the adoption and the profit margin start to expand for these 493? But I think, listen, in near term, we are seeing some positive action. We had industrials break out last week. The equal weight index just made a 52-week high. Here's an interesting stat, guys. You know, the equal weight index is only up about 4% since the November peak right after the election. So almost more than a year, we're only up 4%. So no, I think it has further to go. I just think it's both, not either or.
There's a tendency to have this kind of monomaniacal focus on the big tech names, the Magnificent Seven and the like. Do you foresee, as you look into your crystal ball, more eagerness to look overseas in the year ahead? Of course, markets overseas have done extremely well this year in many cases. Are you looking more to Europe, for instance, in 2026?
I don't know that we're looking more, but it's kind of a similar story. When we look around the globe, I just checked this morning, 98% of the markets we track, more than 40 countries around the globe, they're in uptrends defined as above their 200-day moving averages. So it's kind of that similar story we just had. It's like either or, no, both. We still have a tilt toward the U.S. because that's where the innovation and earnings are there. And let's, you know, if we think about the last year, the U.S. underperformed, but that was after, you know, in the prior year, the U.S. had outperformed by the most since the 90s in 2024. So we had a bit of mean reversion, and almost all the increase in international was PE valuation, not earnings, and the currency side. So I think as we move into next year, we had a bit of a revaluation. Currency has come down to the U.S. dollar. So I think both will do well. We're still tilting towards the U.S. on the margin.
We've been kind of threading this needle over the course of the 3 hours this morning. Mike Wilson's note, Mike Wilson and Morgan Stanley write about how we're now firmly back in a good is bad, bad is good regime. As you look ahead to this week and the data that we're going to get, how are you thinking? Are you in agreement with Mr. Wilson?
I think the market likes Goldilocks. I think we want an economy that is still, you know, kind of chugging along. We expect a modest uptick into next year with inflation that doesn't get out of control, which we don't think it will, and interest rates that remain, you know, kind of in this range that it's been overall. So I would say on the margin, solid news is good news. I don't think we want either extreme. If it's something that's really much stronger to the upside for the economy, that probably means rates go up, and that will hit maybe valuations. If we see a real weakening in the labor market continues, and this divergence between GDP data and labor market, I think that's problematic as well. So I think, we're using an analogy for our outlook, the seventh hand stretch. I think we want something kind of in the middle between those two extremes.
Do you think, Keith, that this market's fully wrapped its heads around the idea that we have seen the end of one of the biggest global easing cycles ever outside of some sort of recession?
It's an interesting question because it hasn't really come up a whole lot in conversations as I speak with investors. So I think that is, potentially a risk. And I think the other thing, all things come back, or all roads lead back to the 10-year Treasury. As we think about next year, we still are positive. We think the uptrend deserves the benefit of the doubt. But going to your point about central banks, I think the key tell for next year and the risk factor we'll be watching is the 10-year, which, again, seems relatively contained at this point. But that is a shift. And I think just like this past year, I think earnings will be the key. Again, we expect solid earnings, and we do expect those earnings to burn out as we move through 2026.
When you talk about earnings, this kind of leaves us in the same place of, yes, bonds may offer a hedge, but maybe you don't want that hedge in 2026. Maybe you want to be exposed to the equity space and then on the short end of the yield curve at a time of yield curve steepening. How do you look at that kind of interplay, given the fact that people are expecting enough growth, an accommodative Fed despite that ongoing growth, and this yield curve steepening that we have seen really start to reassert itself?
Yeah, so overall, heading into the year, we do have a modest tilt towards equity relative to fixed income and cash. We're still overweight gold as well, which we've been overweight all year long. And then on the fixed income side, again, going back to the analogy around baseball, we still look at fixed income as that consistent hitter, kind of collecting that coupon. All in all, over this last year, where the equity markets have done pretty well, we are having a solid year in fixed income with high quality returning 6-7%. And I think as we think about next year, we talked about there's a lot of cross currents. There's a midterm election year, and there's a scenario where the economy is stronger than expectations, or there's a scenario where the labor market weakens further. In the latter one, you would actually want bonds. So I think going back to diversification, the kind of the simple diversification aspect, you still want to have bonds. Are they at a modestly lower weight? Yes, but I still think it makes sense. But we are pairing that with some exposure to gold still into the new year.
Let's stick with diversification. So there's this market masonry building the wall of worry. As you look beyond tech, if you look beyond big tech, telecommunications as well, where do you see opportunities sector-wise here in the year ahead that might have been neglected in 2025?
Sure. So where we were overweight tech and communications for most of this past year, and we still are, again, we're still positive long term. What we've been doing is making incremental changes based on this broadening theme. So, over the recent months, we added healthcare. Healthcare is a sector where just, a little bit of good news can go a long way. I know it's done better recently, but it's underperformed the S&P by over 50% over the last 3 years, and that's a historic extreme. So you just get a little good news that can go a long way, and we're seeing valuations attractive and some better fundamentals there as well. And then just last week, we upgraded industrials. Industrials was a hot sector early in the year. Since July, it kind of moved sideways, only up about 2%. It just broke to the upside of a five-month trading range. And as we think about this economic uptick that we envision and some of the benefits from the One Big Beautiful Bill, like accelerated depreciation, we think that's an area that should benefit as well. So again, tech, communications now paired with healthcare and industrials, and something else we're looking closely at, not quite there to upgrade. Financials with that steeper curve that Lisa mentioned earlier are acting very well.
Keith Lerner of Truist, thank you so much for being with us. Have a wonderful holiday season. Right now, let's get you an update on stories elsewhere this morning. Here are your Bloomberg briefs. NVIDIA has told Chinese clients it's evaluating adding production capacity for its H200 chips after orders exceeded its current output level. This, according to Reuters. The move comes after President Trump announced the U.S. government would allow NVIDIA to export H200 processors, its second fastest AI chips, to China last week. Alphabet set to book another sizable paper gain after SpaceX completed a tender offer that effectively values the closely held company at about $800 billion. SpaceX's insider share sale was priced at $421 a share, which would mark a sharp jump in valuation from earlier secondary transactions. That is likely to lift the carrying value of Google's longstanding investment in Elon Musk's rocket and satellite company. Meanwhile, spare a thought for Roomba. Roomba maker iRobot is expected to go private after filing for bankruptcy. The company, founded by MIT engineers in 1990, is looking to hand over control to its main Chinese supplier. iRobot sold more than 40 million home devices, but saw a post-COVID decline due to supply chain issues and cheaper competition. Wasn't expecting to see lots of Roombas this morning. But over the weekend, that was very much front and focus. That is your Bloomberg Brief. Did you ever use Roombas?
Never had a Roomba, but I had friends who had them, and I was admiring of them, but I somehow knew, I didn't know that it would end this way.
Yeah.
Not to say it's ending, I should say, but no, I never went all in and go.
I actually love the idea, but I never got one also. But I do think that it would be great, especially if you could do other things, like bring you things.
Yeah, like put the coffee on top of it,
exactly.
and have it move around. Yeah.
Have a little baby that's
maybe that's the future. Maybe this
yeah,
Chinese company will
make it.
Take that in from me. I don't know.
Up next, the morning calls. Plus, Sucharita Kudali of Forrester looking ahead to fresh retail data this week. That's coming up next from New York. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
We are, excited that growth will improve. We'll get more balanced growth next year. We're going to get quite a bit of stimulus starting in the first quarter. Tax refunds could be, $50 billion. I think those refund checks do help to boost consumer spending.
That was Kathy Bostancic of Nationwide. What's ahead for the consumer as we get retail sales tomorrow alongside non-farm payrolls, and on Thursday we get, of course, CPI from November, a check across the broad economy ahead of the January Fed meeting. Right now, the check on markets is broadly positive, up about 0.5% on the S&P. Dollar weakness. Watch the space. The euro gaining about 0.1%, 117.55 on the euro-dollar cross, and yields lower, but not as much lower as they were earlier this morning. The bid driving 10-year yields down to 4.17%, rounded up. Gold on a tear, pulling back a little bit, but still back toward those all-time highs. Time now for the morning calls. First up, Morgan Stanley upgrading Hershey to overweight from equal weight. The firm saying the stock offers rare visibility into significant earnings growth within staples. Those shares up 1.5% in pre-market trading. Up next, JP Morgan upgrading Dollar General to overweight from neutral with a price target of $166. The firm seeing upside, saying Dollar General is back on offense. Those shares up 2.6% in pre-market trading. And finally, Roth Capital Partners downgrading Costco to sell from neutral, a rare sell rating from the sell side, citing concerning underlying metrics and intensifying competitions. Those shares lower by about 0.8%. Sticking with retail, October retail sales data set to provide another look at the state of the consumer tomorrow. Sucharita Kadali of Forrester writing, retail sales have been more positive than consumer sentiment suggests, but much of that may be biased by mass and essential merchants. Sucharita joins us now. Sucharita, that's a great way of framing it because we've been trying to understand the retail sales data that we have been getting, as well as the earnings. Is this inflation? Is this staples? Is this an issue of the higher income individuals padding out some of the totals? What's your first read on just how good retail sales have been?
Well, I think that the big story is really this K-shaped economy expression that we're hearing a lot of now. Ultimately, where we definitely see strength is certainly with the affluent consumers. And you see that reflected not only in the stock valuations, which of course are certainly padding the net wealths of a lot of consumers and empowering them to purchase everything from essential goods to certainly some of the more discretionary items as well, whether it's in sectors like automotive or home. But what we also are seeing is really, really low shopper sentiment as well, consumer sentiment, and that's largely dragged down by some of the lower income consumers, the demographics that are not in the top 10%.
That's right where I want to go, and I keep harping on this, but there's something really funny about that we've seen strong retail sales still yet. Maybe again we'll see them tomorrow. But all the while there is this negative sentiment. And I wonder if you look for like historical analogs, are there any that come to mind? Is this a kind of unique new phenomenon? And what does it tell you about maybe the prospects for consumer spending, retail spending going forward?
Well, this is unusual because typically consumer sentiment and overall spend are correlated. So every time we have seen recessions in the past, you typically will have negative consumer sentiment. But all of the indicators are that the economy right now is still doing relatively strongly. GDP has been positive. You have unemployment being relatively low, wages on average being relatively high. So all of those key macro indicators are very, very strong, but yet you have very, very low consumer sentiment. And there are some reasons that have been speculated about. It's everything from the advent of AI, leaving a lot of people uncertain about the future. You have other issues related to just even inflation and consumers feeling that they may not be getting as much value for their money. We certainly see this with a lot of consumer packaged goods and a lot of essential goods that consumers are purchasing, where not only are the unit prices going up, but the amount of value that the shopper is seeing in a number of those goods is actually going down. And that could be one of the reasons that we're also seeing that negative consumer sentiment in spite of wages being higher.
As I think about the K-shape here, and I wonder sort of what this part of the K can do. Can it pull up sentiment? Can it pull up? Can it kind of give consumer spending, retail spending more broadly a lot of juice, or do you need that like lower half of the K to be working as well?
Well, for the higher income consumers to pull everybody up, that is essentially the argument of trickle down economics, right? And unfortunately, that hasn't always proven to be the best economic approach. What we saw during the pandemic was when we gave enormous government stimulus to the broad economy, and it was a fantastic experiment in how being able to provide stimulus to the masses really supported economic growth, because we saw some of the fastest growth rates that we had seen in a long, long time. And what that ended up doing is it overheated the economy to the point that we saw the inflation numbers that we're now continuing to try to bring down. So I think that it is somewhat difficult to say that the top end of the consumer demographic is going to single-handedly pull up the rest of the economy. We definitely need more broad sentiments of economic well-being in the economy, I think, in order to get those sentiment numbers up. But then there's also the other argument that maybe we shouldn't even be looking at consumer sentiment as a factor at all, because if it's not correlated to spend, we should be looking at other things like maybe housing starts or joblessness as better indicators.
Or maybe fiscal stimulus, which is what some people are expecting early next year. You were talking about some of the cash infusions under some of the post-COVID relief plans. Next year, a lot of people are saying that what you're going to get is a huge tax break, and it's going to leave people with a lot of cash. How are retailers shaping up to take advantage of that? Clearly, they're paying attention, and there must be some expectation.
Well, retailers try to take advantage of the cash refunds every year, so that's not necessarily a new strategy. The challenge is that Q1 tends to be a softer time in general for retailers. There are fewer sales. There are some exceptions in some seasonal categories, like maybe jewelry in February. But for the most part, Q1 isn't a terribly great time. You have a lot of returns that you're processing and a lot of just exchanges that retailers are seeing rather than the purchase of new goods. We really don't see much more of that higher year-over-year growth until later in the year.
Sucharita Kodali of Forrester, thank you so much for being with us. We really appreciate it. Have a wonderful holiday season. Let's turn to the economy. We've got a key week of data on deck. Bloomberg's Michael McKee joins us now. Not just data, we also have a lot of Fed speak. A real focus, though, here, how much does some of the data matter other than non-farm payrolls, or really is it all about the unemployment rate?
Well, it's mostly all about the unemployment rate, but we aren't going to get one for October, so it makes it more difficult to interpret these numbers. We were just talking about it in the green room here. Exactly what is it going to mean? The one number we're going to get this week that will be easy to interpret, but probably the least meaningful, is going to be retail sales tomorrow, because retail sales, we got the September numbers, and these are the October numbers, so we'll actually have a month-to-month comparison. And in September, the numbers weren't pretty good, just 0.2% overall, and the control series was down 0.1%. Now, both of those are expected to rebound in October, but it's not going to tell us what happened in November and give us an idea of what was happening for the holiday season. So it's going to be the more complete number, but it's going to be one that it helps us a lot figure out where the economy is.
Mike, stay close. I know that you're going to be with us in just a few minutes, and we are going to be getting a little bit of data earlier this morning. We're going to get Empire manufacturing data coming out in about 5 minutes' time. A real question here, David, as we look out about what to trust, given the fact that the numbers have been messy, they have been inconsistent, and we just heard this idea from Kodali talking about how maybe we should ignore sentiment data, given the fact that it hasn't been reliable.
And we don't have the continuity of the series as well, which is another facet to this too. No, I think it's a fascinating thing to bear watching. And again, we've kind of been through this period where there's been a lack of data, there's been delayed data. We're beginning to get something toward normalcy here, but we've seen the Fed proceed, soldier through all of this, wondering sort of how policymakers will proceed now. We've had this kind of coloring the decision that they made last week.
Well, if you're curious about what they think, we have a number of speakers on deck, including John Williams, of course, Chris Waller, we have Stephen Myron, we have Raphael Bostic, we have a host of other speakers who can give you a sense of just how they feel. Coming up, Pooja Sriram of Barclays will be joining us as investors await the November payrolls, plus Yahira Anand with your morning movers. Shares of ServiceNow falling as they're nearing a $7 billion deal to acquire Armis. Those shares lower by about 5.4%. You're watching Bloomberg Surveillance. Good morning.
Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
A lift the last final trading week of 2025. We are seeing stocks broadly higher, led by the small caps, up now about 0.8% on Russell 2000 futures. S&P futures up by 0.5%. Similar on the NASDAQ, a bit into bonds pretty much across the board, although it's fading as the session grows older, an eye towards some of the economic data we get throughout the week. At the long end, it's almost completely flat at this point. So really a question about that yield curve steepening continues with that 30-year yield at 4.84% when you round it up, and you've got a similar kind of move. 10-year yield almost back at 4.17. 2-year yield just pinned there at 3.50. 1 hour away from the cash open. Here are your morning movers. Yahaira, Anna, and Yahaira.
Hi, Lisa. We start with Intel. Shares are rising 1.3% on some M&A's chatter. We are reporting that Intel is in advanced talks to buy AI chip startup SambaNova in a deal that could be valued at $1.6 billion, well below its valuation back in 2021 of $5 billion. So investors are reacting positively, not just because it would be a bargain, but also because it gives Intel a platform to compete with NVIDIA's AI chips. Meanwhile, also moving on some potential M&A action is ServiceNow. Shares are moving in the opposite direction, down 5.25%. Honor reporting that it is in advanced talks to buy cybersecurity firm Armis in a deal that could be worth up to $7 billion, a price tag that Bloomberg Intelligence says seems expensive. We are also seeing some weakness due to some sell-side action with KeyBank cutting its rating to underweight of ServiceNow. And we end on IMAX, also some sell-side action there. Shares are rising 3.5% after JP Morgan upgraded the stock to overweight. The analyst has had a change of heart and now sees IMAX as more than just a theater chain. Rather, he says it's a premium live experience brand benefiting from a strong slate of upcoming films. So he is raising his price target to $47, which is about 20% upside from here. Lisa?
Thank you so much, Yahaira. I love that. We're not a movie business. We are an experience business, which is very much, I think, what everyone is trying to be. Turning to the economy ahead of tomorrow's payroll data, Bloomberg's Michael McKee back with us. And Mike, I know you're going to look ahead to everything that we're going to get this week. I would love your thoughts, though, on Empire Manufacturing from New York, given that it really was quite negative.
Yeah, negative 3.9, down from 18.7, and pretty much all of the underlying aspects, shipments, production, and orders are down significantly. The only things up a little bit were employment and a bit of a decline in the prices paid and prices received indexes. But this is contemporaneous data. This is December, some of the newest stuff we've got, so it does matter a little bit. Now, tomorrow, jobs. In our last episode, I feel like one of those shows that has to catch you up on what happened the last time in case you missed it.
Preview.
September payrolls, we got that in November, 119,000, and unemployment was 4.4%. The forecast for October, we don't have one because there's no October data that we can build on there. But for November, the forecast for jobs is 50,000, which would continue a trend of very, very slow job growth. The big unknown in this is how many federal workers workers were furloughed and not counted, and how many were doged when you were laid off? Your payments ended at the end of September, so that could be a big drag on October. We do expect the healthcare segment to keep hiring. The one number to rule them all, of course, is going to be unemployment. It is forecast to tick up to 4.5% in November, but we won't really have a comparison because there's no October household survey, so no October unemployment rate. We will be watching labor force growth. There's a big question about what's happening, of course, with the deportations. And then don't touch that dial, because tomorrow, of course, we also get the retail sales numbers we just talked about. And Wednesday, we'll have Waller, Williams, and Bostic, and they can comment on all those things. We have Waller today, along with Myron, but the data aren't really there for them to talk about yet. Thursday, CPI, that'll be big. The forecast that we have now is for 3.1%. We only get year over year. There's not going to be a month over month because there's no October CPI. Jobless claims, and Friday, existing home sales. Everybody's watching those to see if mortgages are going to make a difference. So far, they haven't. So this is perhaps the biggest week we've had for the economy in months, and I'm just trying to remember how to do it all.
Michael McKee, you're doing a great job. Stay tuned as Michael McKee unravels who stole the knife. Thank you so much, Michael McKee. Pooja Sriram of Barclays writing, we expect non-farm payroll and employment flat in October and up 50K in November, providing further evidence that the labor market is slowing but not breaking. Pooja Sriram of Barclays joining us now. Pooja, great to see you. Thank you so much for being with us.
Thanks.
So just looking at slowing but not breaking, what's the difference between the two? How narrow is the gap between slow and between broken?
Yeah, I think that's a great question. I think we're getting close to the point where people, ourselves included, are seeing risks clearly to the downside. But in terms of breaking, that is a world where you expect labor market slack to shoot up. Pick up very rapidly, and that's not something we're seeing either in the official data or in some of the other statistics, like, think about job openings and the separations rate there, or jobless claims data. So it is a labor market which for a while now has been stuck. We're not hiring, but we're not firing as much, so there's very little dynamism. Risks are to the downside, but we still think we're not at that point where we're ready to fall off the cliff.
Well, I guess I'm wondering if we're at an inflection point of sorts, or maybe we've been grinding along, we could be heading toward an inflection point. Why wouldn't it be to the upside? Because we have seen smaller businesses really pull back in hiring. The hiring has been concentrated in the larger companies. If they get some stimulus, if there is these rate cuts that kind of start percolating through the economy, why wouldn't we see a pickup in hiring rather than sort of the other way around?
That's a great question. And I think that's a very feasible scenario to keep in mind, just given, we are quite constructive about growth into 2026. We're seeing a lot of positive impulses that could keep the economy highly supported. And in that world, yes, you could have a labor market that actually stabilizes. In fact, our own forecast, official forecast, has the labor market looking quite resilient in 2026, and we have the unemployment rate coming down. So I think we really subscribe to that view that there is a world where the labor market stabilizes and eventually starts to look better. But given where we are now, I think it's reasonable to also see that risks could very well be to the downside. It would take very little to push the labor market in the opposite direction.
I'm curious how you think about the legacy of what we have been through here with this government shutdown, the delay of data that we hadn't seen before, and all the while there was this conversation about what might be a decent substitute for the data that we weren't getting from the Labor Department. How could we get as good a sense as we could about the state of the labor market in light of not having that data? Now that we're beyond it, I'm curious sort of what we've learned about how good a sense we have of the jobs market in this country. We heard from the Fed chair suggesting perhaps there are more fundamental problems with the way that these job numbers are collected and counted. How are you thinking about what we've been through?
Absolutely. So I would say this, that the government shutdown basically brought to the forefront the fact that we are highly, highly reliant on official statistics. And there's a good reason why. We have very talented statisticians who've been doing it the right way for a very long time. But at the same time, I think it also expose the vulnerabilities of suddenly not having these data, or now we're in a scenario where the data could be clouded in some sense, right? To answer your question, we have looked at a dashboard of indicators which are quite useful and are reasonable alternatives to get a gauge of where the economy is headed. And these come in different shapes and forms. You've got job openings data, you've got job postings, some of them about hiring. So it gives you a decent picture of where things are, but we still don't think those are enough to substitute the official statistics.
I suspect Lisa's going to ask about inflation in a moment. Before we get there, let me just ask you about the Fed speak that Mike was, I'm sorry. that Mike was mentioning, all that we're going to hear from. And I'm curious, what are you listening for in specific? We've talked a lot about the silent dissents, the quiet dissents that happened at that meeting. What are we likely to learn from the kind of panoply of speakers who are going to be giving remarks and interviews over the course of the week?
Yeah, I think the one thing that stood out in the December FOMC meeting is just how divergent views are within the committee. I mean, if you just look at even the dot plot, for example, in 2026, 7 participants felt that it's appropriate to hold rates steady where they are now. So I think going into this week and also just, beyond this week, we want to get a sense of who's thinking how. For example, we did hear from Goolsbee that his dissent was to some part tied to the fact that he didn't have enough data to go by, right? And so that gives you some insight into, I guess, what he's looking for. And, we're likely to get similar insights from others. And I'm sure, like a lot of other Fed watchers, we're trying to place them on the Dove Hawk lineup to see exactly where their minds are at. And to give us a sense, really, of what the reaction function is for each of these participants.
Over the weekend, San Francisco Fed President Mary Daly put out a blog post, and she was talking about why she supported cutting rates at the last meeting. And she talked about how, yes, it was a very difficult decision because there is this dual mandate that's very much in conflict. She was talking about inflation. Yes, I always got to talk about it. And how it has been really punitive for these families. But she said, how you get down to 2% matters, because if you get there too quickly, you break the labor market, and then you've got families grappling with both above average inflation and potential job losses. Do you think that there is this theory right now presiding over the Fed to run the economy a bit hot, especially at a time of technological transition, with artificial intelligence posing some existential questions around the labor market, in order to avoid some sort of labor market scarring at the expense of inflation not getting down to 2% anytime in the near future?
Well, this is what I think stood out to me in the December presser. There seems to be this view in the Fed that inflation is really not a problem right now. In fact, Chair Powell's own comments on inflation is he's quite sanguine about it. I think in some part of the presser, he did think that inflation, you strip it out of all the tariff effects, is somewhere in the low 2s. Then he mentioned something about productivity, also likely to support the economy. So if you sort of put all those views together, I think there is this view out there among the Fed participants that inflation is perhaps not a problem to be concerned about, and what they need to be concerned about right now is the labor market. That's perhaps what Mary Daly is also subscribing to in some sense. My own take is I think it's a little too premature to think that inflation is going to take care of itself. We at Barclays have been saying for a while that we are yet to see the full effects of tariffs on the inflation data. And sure, while it may be a one-time price shock, I think it's a little too early to declare victory on inflation yet.
Pooja Sriram, thank you so much for being with us. Really wonderful to get your thoughts, and have a wonderful holiday. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Briefs. Ukrainian President Volodymyr Zelensky has signaled Kyiv could accept security guarantees from the United States and Europe in place of its long-term goal of joining NATO. Zelensky met with a U.S. delegation in Berlin on Sunday. Ukraine has sought NATO membership for years, but has altered its rhetoric as Washington presses for the war to end. A JetBlue flight halted its climb to avoid colliding with a U.S. Air Force tanker on Friday. According to air traffic control recordings, the pilot flying from Curacao to New York's JFK blamed the military craft for crossing its flight path. The incident comes alongside increased military presence near Venezuela. The Air Force did not immediately respond for comment. And in sports, the LA Rams clinching a playoff spot with a win over the Detroit Lions. Michael Barr will be very happy. Meanwhile, the Bills came back to beat the Patriots, and the Ravens shut out the Bengals. However, the biggest news from the NFL Sunday, Chiefs quarterback Patrick Mahomes and Packers defender Micah Parsons both suffering season-ending knee injuries. That is your Bloomberg Brief. Up next, setting you up for the day ahead, plus Alessio DeLongis of Invesco as he was remaining overweight equities heading into the new year. From New York, you're watching Bloomberg Surveillance. Good morning.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
I think non-farm payrolls is far more important for the Fed because they have told us that they will look through any kind of stickiness within CPI on the good side of things because of tariffs being considered not transitory, but a one-time impact. I think the important thing on inflation is that if we look at those big components, as Kathy was mentioning, you're still seeing wages look like they're pointing lower.
That was Cameron Dawson of New Edge Wealth earlier this morning ahead of what is going to be one of the busiest economic data weeks of the year. Right now, markets really increasing, gaining steam throughout the morning, up 0.5% on S&P futures. Seeing that dollar weakness, 117.57 on the euro-dollar cross, and yields down on the 10-year, almost 3 basis points now to 415.87. Sticking with central banks, Treasury yields edging up ahead of this week's data releases after the Fed outlined plans for a new round of bond purchases that Ira Jersey and the rates team at Bloomberg Intelligence is called Quantitative easing light. Ira joins us now for more on what this means. Ira, don't call it quantitative easing. This was sort of the announcement that tried to sound like paint drying. It did not work that way in markets. How is this like quantitative easing, even if not quite?
Yeah, so if the Federal Reserve was just doing $5 to $10 billion a month in these reserve management purchases, I could make the argument that it's not quantitative easing. But the fact that the Fed has decided that it's going to be doing $40 billion a month for at least a few months and up until tax day, you have to. There's going to be a similar reaction in risk asset markets in particular to quantitative easing. Now, it's not going to be sustained, and I think that that's an important aspect of this, is that you are talking about a 3 or 4 month purchase program of around $40 billion. It's also not designed to get long-term yields lower, because they're only going to be buying T-bills and very short-term coupon debt, so things like 1 year to maturity debt. So that's not going to have the effect of like getting mortgage rates down very, very much at all. So it does have a much different both effect but also purpose than quantitative easing did back in 2020 or in 2008 to 2014 as well.
So Ira, is it fair to say this will support risk assets in a broader sense, with a signal that the Fed is going to backstop and expand its balance sheet to manage liquidity at a time where liquidity has changed based on how big the deficit is in the United States?
Well, it's not only the deficit. You know, the big change here is like, look, I know that there's some people who are saying, well, look, before 2007, we didn't have any excess reserves and we had very small balance sheet. But the fact is that one of the reasons why you have this bump in liquidity here, or need a bump in liquidity here, is because reserve balances are now used for a lot of the Basel regulations by the large banks. And so the thing is, you need these reserves in the system in order just to keep the plumbing working. So the Fed went too far. This is an acknowledgement by the Fed that it went too far in shrinking its balance sheet, and now it has to, make up for that little bit, because, this idea that Jay Powell has said, like, look, we want an ample reserve regime. Reserves are either ample or they're not. So you really need to have a buffer above this tipping point of reserves, which, we've now proven is somewhere around $2.9 trillion in reserve balances at the moment. And then naturally, those are going to have to grow as the economy grows, because that's just the way it works. And keep in mind, and this is something that I think a lot of people who have only been in the markets for the last 15 or 20 years forget. Prior to 2007, the Fed expanded its balance sheet almost every single month from 1973 until 2008. And so this would not be that unusual. Again, if they were doing small amounts, $5, $10 billion, $40 billion has to be called QE light in my book.
Ira Jersey of Bloomberg Intelligence, thank you so much for that. Turning back to markets, more broadly, futures gaining ahead of the year's last full trading week. Alessio DeLongis of Invesco eyeing broader opportunities in 2026, writing, a recent shift towards value and small and mid caps and broad diversification between U.S. and non-U.S. equities should provide better downside protection. Alessio joins us now. Alessio, thank you so much for being here. It's great to see you. So how has the concept of diversification changed over the past couple of years? It was once bonds and stocks 60-40. Then it was a question of whether you have ex-US or US. Where are we right now?
International markets are now moving into positive territory and catching up with what was previously a divergence between US equities and non-US equities. So the expectations around fundamentals are also supporting that broadening market participation. And just the last data point, AI, Mag 7, tech, earnings growth expectations, 18%, the lowest in the last 4 years, still very strong, but the lowest in the last 4 years, and not too much ahead of the overall S&P 500. So that convergence is really happening. Diversification should begin to pay off again.
Let's play this out a bit more. We're going to be using this phrase Magnificent Seven in 2026, or I know a lot of people think we should be using it now, would be keen to retire it, but what does the conversation look like in the year ahead when it comes to these kind of hyperscalers and big tech?
I think from a fundamental perspective, the terminology Magnificent Seven and U.S. exceptionalism, from a fundamental perspective, is untouched. Right? We're talking about behemoths. We're talking about champions that in financial markets we have never seen before in terms of fundamental strength and nearly monopolistic conditions. But while the narrative will most likely play out, the price changes, right? It's all about expectations. These high growth stocks don't need to see negative earnings forecast or negative growth for them to sell off or to see underperformance relative to the other parts of the market. High growth stocks can simply see a still positive but lower growth rate to trigger that rotation into other sectors. Again, we're not calling for a sell-off, but we think that the proverbial unwind of the tech trade is more a rotation into other segments of the market rather than a crash in the tech trade.
So that recalibration of expectations, does it give you more confidence when you see results like we saw last week from Oracle or Broadcom, that that's kind of a necessary evolution or growth that's taking place in terms of the way that we think about expectations?
That's very well put. I think the names that you're referring to and some of the developments, the headlines from last week, is that evolution. What do I mean by that? We spent the last 3 years where anything AI, anything tech-related was a tailwind. There was a structural shift. Now, with substantial investment, substantial spending, we're entering now the phase where we will begin to see winners and losers. I am not in a position to say which one those winners and losers are from a single name perspective, but that's the evolution you're beginning to see. You're seeing two orbits now, the OpenAI orbit and the Alphabet orbit. And all of the companies that service and are exposed and have deals on the financing side or the contracting side with those two orbits. This large CapEx that we continue to see from a macro standpoint, some will see zero return on assets, return on investment. Some will see very large payouts. And that's where the valuations will come down, because valuations coming down will be a reflection of a wider range, wider uncertainty, wider range of outcomes, rather than previously was, and the expectation was for a much narrower range of outcomes.
Yeah, the show me moment for a lot of these AI names. Alessio de Longas, wonderful to see you. Thank you so much for being with us here. Alessio de Longas of Invesco. And David Gura, thank you so much for being with us. Truly awesome to have you as we look toward a really busy week and potentially the last real week of 2025. I shouldn't say that because a lot is going to happen, but a lot of people are going off. But we are going to be getting a host of economic data, Fed speak, as well as central bank decisions coming up tomorrow. Paul Canisi of JP Morgan, Stephanie Roth of Wolfe Research, Monica Guerra of Morgan Stanley, and Francis Donald of RBC Capital Markets as we count you down to non-farm payrolls for November. We finally get the data as well as retail sales. Thank you so much for being with us. That was Bloomberg Surveillance. Good morning.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in in improving.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good Monday morning. 30 minutes till the start of the cash trade. I'm Matt Miller. Danny Berger is on assignment. Bloomberg Open Interest starts right now. Coming up, big moves are brewing in tech M&A. ServiceNow eyes cybersecurity startup Armis for $7 billion. Intel circles AI chip maker Samba Nova for a big discount. And McKinsey is looking to get leaner with plans to cut thousands of its own jobs. Plus, a new playbook for the new year. Wall Street says the Mag 7 won't run the show in 2026. Let's take a look at some of the big stocks that we're watching in terms of deals. ServiceNow right now down about 6% in the pre-market. Intel, on the other hand, gaining 1 1/3% as it looks to pick up potentially Samba Nova for $1.6 billion. That company was valued at $5 billion in 2021. In terms of talking to someone at Bloomberg Intelligence about this, we have him on the desk here. Mandeep Singh, he's the head of technology research for BI. And Mandeep, this is, to me, fascinating because Intel's CEO, Lip-Bu Tan, is also one of the early investors in Samba Nova through his venture capital firm, and he's the chairman of the board at Samba Nova. So is that why he's getting such a sweet deal?
I mean, right now, the moves that he has made, whether it's the cash infusion from NVIDIA or the government taking a stake in Intel, seem to be headed in the right direction. And look, Intel doesn't have a great track record with acquisitions. We know that. And so he's trying to change that. And I think $1.6 billion is not a big amount. So like you said, it's a big drawdown from their prior valuation. And I'm honestly surprised, given a company that's exposed to, AI accelerator chips with a decent revenue and a good exposure to sovereign play. I mean, the thing about Samba Nova, and they were at our conference, is they really specialize in the Middle East. And they have a big partnership with the Saudi sovereigns in terms of deploying AI there. And it sounds like a pretty sweet deal for Intel in terms of valuation.
Yeah, right. We should stress, this is according to people familiar. It hasn't been confirmed, so the value could change. But I just think it's fascinating that Samba Nova was valued at $5 billion in 2021. And since then, the SOX index has tripled in value. I actually spoke to the CEO on this program last month. Let's listen to what he said.
We've been getting a lot of interest over the last few months around investing in the company. But look, every scenario we consider is about growing our footprint, accelerating our roadmap, driving a product into the market faster. We see quarter over quarter doubling of our business in multiple quarters in a row now. And so we're excited about that. And so we're just really excited about figuring out how to actually accelerate that into the market and growing faster.
So I did ask him as well about Lip-Bu Tan being the chairman. It's interesting that they have done so well, and yet they would sell for relatively so little.
Yeah, and even, Cerebras, Grok, all these companies were looking to compete with NVIDIA by specializing on certain aspects of inferencing or training. And in this Sam Badova's case, they did make a pivot from training to inferencing, but it sounds like he was quite excited about the opportunities in the Middle East. And to my mind, Intel, will benefit in the sense like they need somebody on the AI accelerator side to really come in and manufacture their chips on Intel fabs. They really need to get that going to draw, someone like AMD or one of the bigger players to come in and make use of their fabs. And I think by acquiring Sam Badowa, which is an AI accelerator company, hopefully pivoting them to, use their own Intel fabs as opposed to manufacturing their chips on TSMC would be part of the strategic vision that Intel may have with the Sam Badowa purchase.
All right, I want to finally ask you about the ServiceNow, the potential deal there. Also, according to people familiar with the matter who declined to be identified, they could be picking up Armis for as much as $7 billion. This is what, like an Israeli intelligence company that tracks threats on devices?
Yeah, and look, Google still has that pending acquisition of Wiz for $32 billion. So clearly security is a hot sector when it comes to M&A play. And, it makes a lot of sense. I mean, the world is changing in terms of how enterprises are thinking about upgrading their systems. There will be a lot of API activity. We know in the world of agents, the UIs will change. And so to prevent, prompt injection and all these sort of new attacks, you need to beef up your cybersecurity, which is why ServiceNow, an application software company, seems to be delving into cybersecurity through M&A and paying up. I mean, this is more than 20 times, sales for an asset, which is a private company. And look, it does make
20 times sales.
Yeah. I mean,
wow.
That's how the cybersecurity multiples are right now.
Yeah, they have $300 million in annual recurring revenue, but up from $200 million just the year before. So what a really cool sector you cover, Mandeep. And we're grateful to you for coming on our program so much. Mandeep Singh runs tech coverage for us at Bloomberg Intelligence. Now, partners at consulting giant McKinsey are discussing job cuts at their own firm, and it could be in the number of thousands of employees. Leadership could cut staff as much as 10% across non-client facing departments over the next 2 years as revenue growth flatlines. Bloomberg's Wall Street chief correspondent Sridhar Natarajan reported on this and joins us now. So McKinsey, typically the one to say you should cut jobs at your firm, now looking to slim down itself.
It's a window into the challenging period that the consulting industry overall is facing. This is not a McKinsey-only issue. And you have to be mindful of the fact that in the prior decade, McKinsey had really grown its headcount quite a bit. However, we've seen a little bit of flatlining in their revenue over the last 5 years, and that is why, despite the bravado in front of the partners, where their global managing partner, Bob Sternfels, was just recently talking about this idea that they're ready to kick some ass, that those who believe in this mission will see good times ahead, that there is a more pragmatic message percolating through the entire firm, and that is, it is time to get leaner. And they rightly point out, one of their spokesmen actually tells us that much as they advise their own clients, they realize there is a need for some efficiency, especially in their support functions.
I saw in your story from 2012 to 2022, they'd gone from 17,000 at one point to 45,000 employees. So beefing up massively at the same time, well now, as a lot of consultancies, a lot of law firms, a lot of banks are saying, we don't necessarily need to hire as many first-year employees because AI can do all of this work for them.
And it is notable that they themselves, in their own statement, flick at the idea that AI is having profound impacts on business and society. And yes, that is why, even in the last 2 years, you've seen McKinsey's headcount go from 45,000 to 40,000. So it will be interesting to see where the headcount actually ends up in 5 years. These things never move in a straight line. The last time around, they had a big round of job cuts. They called it Project Magnolia internally. They said about 1,400 jobs will be lost. That would be 2 years ago. But when we hear 2025, end of 2025, the headcount reduction, actually, the net reduction is down 5,000. So that could well be tapping some consultants on the shoulders and saying, time to get out, not hiring as many. So because of all the changes ahead of us, challenges faced by the consulting industry, and rightly what you point out, when they look at their clients and whether the changes you're seeing at law firms, even banks at the initial stages, at the junior stages, how will the consulting firms react to that? And how does McKinsey, the flag bearer of that industry, react to that? It will matter quite a bit.
All right, fascinating story, one of our most read today. Sri, thanks so much for joining us. Bloomberg Sridhar Natarajan covers Wall Street for us. Now, after years of the Magnificent Seven driving market gains, Wall Street strategists see great sector rotation into underperformers like financials and consumer discretionary stocks in 2026. Bloomberg's Alexandra Semenova reported on this, and I just saw that the financials hit another record high on Friday, even as the rest of the market cratered.
Yeah, and that's likely to continue going into next year. The resounding message from Wall Street is if you want to keep capitalizing on this bull market, you have to take your money out of the big tech high flyers that have been doing very well over the last few years and put it into some of the ho-hum old economy sectors like financials, industrials, energy. Part of this thesis is, of course, that the Mag 7 have run up some 300% since this bull market began in October 2022. So the bar is very high when you think about valuations and monetization of AI. But the other more optimistic part of the argument is that people expect the economy to reaccelerate in 2026 thanks to Fed easing and Trump's tax bill. So that is going to bode well for sectors like transportation and manufacturing. At Bank of America, Michael Hartnett calls this the rotation out of Wall Street and into Main Street. And if you look at some of the price action in recent weeks, we're already seeing it happen. If you look at the near-term low on November 20th, since then, the Russell 2000 is up about 11%, and the Mag 7 about half that advance.
So what's the expectation for earnings? Because we saw this year, kind of a head fake. We expected the S&P 493 to start growing earnings more, and we do obviously see the Mag 7 slowing down because they had grown at such a fast clip.
Right, so we're once again on track for double-digit earnings growth in 2026, and that is going to obviously help gains at the index level, why strategists are so optimistic going into next year. But as you mentioned, Matt, that gap between the 493 and the Mag 7 is expected to narrow. If you look at the first quarter, the Mag 7 are expected to post year-over-year growth of 15%, and the rest of the index 11%. So that catch-up is really going to materialize.
All right, Alex, thanks so much for joining us. Alexandra Semenova writing on sectors that could benefit next year other than the big tech sector. Now, check on what's going on in futures after the market closed down more than 1% as measured by the S&P on Friday. You can see right now we have S&P futures up 0.6%, NASDAQ futures gaining 0.75%. In terms of the individual movers on our radar, Roomba parent company iRobot filed for bankruptcy and proposed handing over control of the business to its main Chinese supplier. As a result, this already small company gets even smaller in market cap terms. Netflix said its position on its deal for Warner Brothers Discovery has not changed since the hostile takeover bid from Paramount. Netflix shares up 1% this morning in an up market. Paramount shares also gaining in the pre-market. Warner Brothers, little change. Logistics firm GXO says Brad Jacobs will step down as non-executive chairman of the board at the end of the year. Brad says he's going to focus on QXO, one of the many three-letter businesses that he has been running. Coming up, President Donald Trump names his top choices to be the next Fed head. We'll take a look next at who it could be and what that will mean for rates. This is Bloomberg Open Interest.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It appears the race for the next Fed chair is down to 2. While talking to the Wall Street Journal, the president named Kevin Hassett and Kevin Warsh as his top 2 choices. Polymarket odds had Hassett as the clear frontrunner, but Warsh is closing the gap considerably. Here with me now is Michael McKee, Bloomberg International Economics and Policy Correspondent, and I know mystery is a big part of the strategy of this administration. But previously, the president said he knew who he was choosing. He had his pick.
Yeah, well, do I have to remind you, this president is Donald Trump, and he never does anything in a straight line, shall we put it that way. He did tell the Journal that he is thinking of both Kevins, and he did interview Kevin Warsh again last week. But that doesn't mean he's not going to be interviewing other people, as far as we know. There was some talk of a whole second round of interviews, and he has given us conflicting data on when he intends to name a choice. Now the question is, between the two of them, what is the difference, or does it really matter? Kevin Warsh is probably more hawkish. Kevin Hassett has a reputation perhaps as being in the president's pocket, but they both will come to a Fed that already has a lot of people in place who may not want to do what they want to do. You look at who was appointed. Hassett or Warsh would be appointed by Trump, along with Mickey Bowman, vice chair, and the Governor Chris Waller, if he's not chosen as chair. But the rest of them all were appointed by other presidents, and I left Powell in there because we don't know if he's going to quit yet. And so how much influence is the new chair going to really have, at least in the short run? He will have some opportunities. Jay Powell has 3 more rate meetings before he leaves, but the new chair will have 5. So it is going to be June 17th that everybody's going to be focused on once we get the name and they get in place. June 17th, the first Fed meeting with that person as chair.
And that's why the odds jump considerably of a rate cut in June. If you look at the WIRP function on the terminal, all of a sudden it goes from like 20 to 50. I wonder what you make of Scott Bessent has talked about having regional Fed presidents, you know, actually live in that district and have a 3-year period of residency there. That could change the makeup of the regional Fed presidents, although he says it would take an act of Congress. How much further can President Trump, can this administration shake up the Fed?
Well, that's going to depend on the court case before the Supreme Court on Lisa Cook, because if the president's given permission to fire at will, then he could get rid of other governors and appoint new people, and he could also get rid of members of the boards of directors of the local regional Fed banks and their presidents and try to influence it that way. But it isn't clear that that would get very far under the law. We got to wait for the Supreme Court to decide. And then, as you say, the idea of putting residency requirements or any other requirements in would require Congress to modify the Federal Reserve Act.
All right. Mike McKee, thanks very much for your coverage. I'm sure we'll check back in with you quite a bit this week as we get non-farm payrolls, delayed non-farm payrolls, as well as CPI and other economic data. Let's get to high interest now and look at what's making headlines around the world, and it is grim, as you can imagine, after the past couple of days. Australia pledged tougher gun laws after a father and his son killed 15 people at a Hanukkah celebration on Bondi Beach. One of the shooters was killed. Officials are labeling it a terrorist attack targeting Jewish Australians. The incident has ignited fierce debate over anti-Semitism, gun laws, and national security. Brown University canceled finals and sent students home after a campus shooting killed 2 and injured 9 over the weekend. Thousands sheltered in place for hours as police searched for a suspect. Students say they're shaken, many fleeing campus early, while leaders urge mourning and recovery as the investigation continues. Tributes are pouring in for celebrated director and actor Rob Reiner and his wife Michelle Singer Reiner after the couple was found dead in their Los Angeles home on Sunday. U.S. news outlets reported both appeared to have died from stab wounds. Police are investigating the case with no suspect identified yet. Reiner, 78, was beloved for classics like The Princess Bride and When Harry Met Sally, and for his decades of political activism.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
A weak payrolls report tomorrow could increase the probability of more rate cuts, and that could be a boon for stocks. Morgan Stanley's Mike Wilson says we are now firmly back in a good is bad, bad is good regime. This implies that moderate labor market weakness is likely to be viewed in a bullish context by the equity markets. He says the equity return to interest rate correlation is falling deeper into negative territory. Let's bring in Citi Wealth Chief Investment Officer Kate Moore. And Kate, it's always kind of depressing when bad news is good news, but we've seen this movie before. What do you think about this this prediction from Wilson?
Look, I think there's something to it, Matt, which is that
we're in an environment where people have had a good risk-on year, and they're starting to get a little bit antsy about their overall positions. I would classify sentiment as kind of tepid at the moment, and you've seen this in terms of some of the rotations happening in the market in this final month of the trading year. But what I would say is we're actually seeing plenty of good reasons to think that nominal growth is going to be strong in 2026. And, if we end up getting a solid payrolls number, it's kind of hard to predict. There's obviously a lot of noise, but most of the labor market data we've been looking at has actually suggested that there's been decent labor market strength. One of the things we've been anchoring to is the tax receipts, which are consistent with people having money and companies having money and individuals having money and not actually facing job losses. So we're going to take the payrolls tomorrow as part of our overall data picture for the labor markets. And we would say the economy looks like it's in solid shape and likely will be strong in the first part of next year. If that scares people because they've been positioning in secular winners instead of thinking about beneficiaries of economic growth, so be it. But we have a positive outlook for the next couple quarters.
I mean, do we need more rate cuts from the Fed? We've already cut 125 basis points since October, November of last year. And in that time, by the way, the 10-year yield has remained at the same level, still around 4.10, 4.20. Is it really helping if the Fed cuts rates?
We always know that monetary policy works with long and variable lags anyway. So these cuts that we've had in the very recent past would take some time to feed into the overall economy to begin with. Secondly, we're actually seeing plenty of signs of stability. And while it is fair for us to talk about, weakness in the lower end consumer, that's been persistent for 4 to 6 quarters here. So that's not a new feature. And we've also seen a significant amount of dissent and discussion amongst the Fed presidents, not all of them voters. And we think they are also seeing some regional areas of strength as well. So it's not a slam dunk for us that the Fed cuts at every one of the next couple meetings over the course of the first quarter of 2026. And as I said before, we are very firmly in the view that nominal growth is going to look strong in the beginning part of next year, supported by, kind of a broadening of the consumer and what we're seeing support from the tax bill as well.
If I look over the year-to-date, Kate, at the sectors that have done well, communication services, these big hyperscalers and IT are the top 2 winners. Really, every year-to-date, every one of the GICS sectors has done well. But at the bottom of the pack, real estate, consumer staples, energy, consumer discretionary. Do you see any of the underperformers picking up in 2026, the kind of dogs of the Dow theory?
Yeah, so we've done a bunch of work on this, Matt, and what we will say is, some of the stuff that has underperformed this year just has incredibly weak fundamentals relative to the tech and tech-enabled companies that have been outperforming. And we don't want to rotate for rotation's sake. There's a lot of people who are calling for rotation in the first part of next year simply because they like this kind of dogs of the Dow theory, or they want to kind of get out of the momentum trade and they want something to say. But we're really, really grounded in fundamentals. And we're looking at where the strongest earnings growth is and is expected to be in the next couple quarters.
All right, Kate, stick with us. We're going to go to a break. Then we come back with the opening bell, and we'll be back with more Kate Moore from Citi.
cidade estava sitiada,
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures rally this morning after a drop on the S&P of a little more than 1% on Friday. Of course, we did have a record high on the indexes last week as well. So coming off of that a little, but now we're gaining into the Monday open. The NASDAQ doing even better, up 0.75% and small caps gaining about 2/3 of 1%. You look at the New York Stock Exchange, Ron Barron ringing the opening bell there with his colleagues at Barron Capital, celebrating a couple of their active ETFs. That has been really the flavor of ETFs this year. You'll know if you watch ETF IQ, which, by the way, is on today again at 12 noon with an extra special guest. Tractor Supply ringing the bell down at the NASDAQ market site, and Beyond Ready. Looks like they have some Girl Scouts down there, maybe. This is a company, sorry, it's a 4-H thing. I should have noticed by the clovers. This is a company, a stock that has kept pace with and actually outperformed the S&P, just barely. If you include reinvested dividends, it's up 99% and change over the last 5 years. The S&P up 98% and change. Take a look at a couple of the companies involved in deal news this morning. ServiceNow is one that we're watching. It's in advanced talks to buy the cybersecurity startup Armis in a deal that may be valued as much as $7 billion. This, according to People Familiar. The same is true of Intel. It's in a deal, in deal speculation, I should say. People Familiar say it's looking to acquire AI chip startup Samba Nova for about $1.6 billion, including debt. Let's bring in Citi Wealth Chief Investment Officer Kate Moore. And Kate, just to talk about the animal spirits in this market, deals, IPOs, everything seems to be back on track. Does that hold into 2026 with the tailwinds that you're talking about economically? Sorry, did you mute yourself?
I must have muted myself. I'm sorry about that.
I'm just
so
glad we still
excited.
have you.
Yeah, I'm so excited while you were giving your market update a moment ago that I had to turn off my my audio. What I'm thinking is that for 2026, we'll have a continuation of a bunch of this capital markets activity. And I just want to point out, Matt, that there's a bit of a disconnect here between what has been solid capital markets activity, where we're seeing actually a significant amount of interest across a variety of different asset classes, and people's concerns that there are weakness in parts of the economy and that the Fed should continue to cut rates. These two things are not really that consistent. In an environment where the economy is weakening, the labor market's weakening, where we have to be sort of worried about the forward growth trajectory, companies are not going to be coming to market and acquisitions and targeted events will not likely happen. So we're of the view that capital markets activity will pick up again in 2026, and that it will be an opportune time for high quality companies to offer shares to investors.
So do we need rate cuts? This is kind of the question I was trying to get at before the break. Do we need rate cuts in order for companies to post double-digit earnings, for stocks to continue to climb? I mean, can't things do well on a markets and economic level without the Fed cutting rates?
Yeah, I think that the economy and the markets can do well without additional rate cuts. But look, no one's asking me to be an FOMC voter at this point. We have been talking about this, though, since the beginning of October, that it wasn't a slam dunk that the Fed would cut rates, at the October and December meetings, and that we were likely going to see actually some economic data and some behavior on the part of consumers and businesses that was more supportive of a growth environment. The one thing we've also been talking about, Matt, which I think is a little bit different than others, is that inflation may stay a little bit warmer. I've called it spicy, but a little bit warmer than some people are expecting. The ideal environment for a lot of people's positioning into next year is that, you see inflation coming down meaningfully close to 2, or the lower parts of 2, and economic growth being strong. But we actually think that prices are going to remain relatively elevated, closer to that kind of 3% level, and that also makes the Fed decision a little bit harder. So I don't think the Fed needs to continue to cut rates. Our assessment of the economy and of prices and inflation would suggest that they can pause and wait to see what the impacts of some of these rate cuts have been, and that we're likely to see strong activity from some of the fiscal tailwinds, as well as some of the secular trends as well in the beginning part of the year.
We've seen inflation in commodities for sure. I mean, gold, again, near a record high, but many of the other commodities in the Bloomberg Commodities Index have rallied to highs. That's, I guess, emblematic of the inflation that we've seen, but will it continue?
Yeah, we think it will. In fact, we added a little bit more gold to the portfolio last week, and you could say, Kate, why are you guys doing that when gold is up, kind of 65% year to date? And the truth of the matter is that we're looking at gold as a portfolio ballast, not just looking for price appreciation. And even though I have a constructive view on the overall economy and we think markets will move higher over the course of next year, we still want to build resilience in portfolios. I think there are a lot of allocators like myself that are making this consideration and are having these discussions with our committees. So it's not just wealth organizations. It's also pension funds, other institutional investors, sovereign wealth funds who are looking to add a little bit more gold and build that resiliency into portfolios, particularly if long duration may not play the part it has historically in terms of providing equity ballast. So that's part one. On the second thing you were mentioning in terms of commodities, we've also been constructive of commodities and actually see some of the upstream plays in the AI and tech side as being an interesting way to broaden out on that specific theme. That's been a favorite topic of ours over the last couple months, and I think we'll see more and more people get excited, both from the growth side as well as the supply-demand features of many of these commodities, industrial metals in particular, as we go into the continued tech build-out.
So are these companies, is this economy doing well enough, strong enough to overcome higher commodity prices that may continue to rise, higher rates that may continue to rise?
I think so. And look, we're going to have to be on watch for, data points that shake this narrative, that shake our conviction. But we are super data focused on our team, and everything that we're seeing right now suggests that higher commodity prices and even this slightly higher inflation than many people are expecting can be absorbed and dealt with in this economy. So at this point, we see no cracks in the story. Yet I do want to recognize that many people are kind of positioned for solid nominal growth next year. And that's always a risk when you have consensus. You know this very well, Matt, when consensus is very crowded around a specific view.
Absolutely. I want to ask also about, regional investing, because for so many years, we thought maybe Europe would outperform the U.S., and it never happened. And now it finally has, to a pretty serious degree. I mean, even without currency, I look at the gains in Madrid of 46%, the gains in Frankfurt of 22%. Those are both better than the S&P gains. Does that continue? I mean, around the world, do you see places that are maybe even more interesting to invest in than America?
Yeah, it's been really notable to see the very significant outperformance or the very significant performance of some non-US markets this year. Actually, even more than Europe, which I think was a lot about multiple expansion and not really about fundamentals driving it. And again, we're very fundamentally driven in terms of how we allocate our equity risk. You know, we've been really focused on the significant outperformance in terms of emerging markets, and particularly emerging Asia. We're lucky enough to have been, you know, very well positioned and overweight in this area, and we've had a very strong position in China. That's been a great portfolio adder over the course of 2025. We still see the opportunity for these areas, and particularly EM Asia and China, to outperform. But again, that's driven by fundamentals, what we think are like solid earnings trajectories, rather than the more multiple expansion and kind of the value rotation that some people engaged in that led to sort of Europe doing well. So I think there are amazing high quality companies in Europe. Many of them already are, you know, kind of priced on par with their US peers. They're not like trading at a discount. And we want to be really kind of focused on taking more active risk in Europe rather than saying, hey, we're betting on further multiple expansion when we think the US has the strongest and most consistent earnings trajectory.
Kate, great to get some time with you. Thanks so much for joining us. Citi Wealth's Kate Moore talking to us about these markets and this economy. Let's get a check right now on what the major indexes are doing. 10 minutes into the session, we're still looking at gains here, about 0.3%, so the S&P adding 20 points. If you take a look at the winners and losers, we're looking at 350 roughly gainers, 150 losers, so pretty decent breadth. If you look at who's adding the most, Tesla adding even more than NVIDIA, so that's interesting. Tesla right now at more than 4%, NVIDIA gaining 0.75%, and then you see some non-tech firms, Lilly, JP Morgan, KLA. On the downside, Broadcom is once again off today, off about 2% right now, taking 4 points off of the S&P 500. Apple is down only 0.6%, but that's good for 3 points loss. And then ServiceNow, we've been talking about the potential deal there, down 8% and change. If you take a look at some of the sectors that we're watching very closely, we showed you year to date earlier. This is on the day. Almost every sector is gaining, only energy and communication services. These are the hyperscalers not doing a lot this morning, but we do have consumer discretionary gaining. We have healthcare gaining, financials and industrial. So this could be a little bit of a defensive play in terms of what's bringing us up here. When we come back, we're going to focus in on Fannie and Freddie. It's long been talked about. They've quietly boosted their investment portfolios in recent months. This adds to the speculation around an even more public offering for these shares that you can already trade. This is Bloomberg Open Interest.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Used to be one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Time now for our top call. Some of the analyst action and focus this morning. First up, B of A Global is upgrading Bristol Myers to a buy, arguing the company is heading into a stretch of pipeline milestones that could reset expectations and reignite growth. The firm calls Bristol Myers a catalyst-rich story heading into next year, and those shares are up almost 3%. Next up, Goldman Sachs upgrading Teradyne to a buy, arguing that AI-fueled demand will reignite its chip testing business. Longer term, Goldman says expanding chip sizes and stricter quality requirements should keep pushing Teradyne's revenue higher. That stock also up by 3% in the early trade. Finally, KeyBank is cutting Adobe to a sell as part of its 2026 software outlook, arguing that competition is heating up. KeyBank prefers smaller software names over large caps heading into next year, framing Adobe as less attractive in that shift, and those shares taking a little bit of a hit. Now, Fannie Mae and Freddie Mac have added billions of dollars of mortgage-backed securities and home loans to their balance sheets in recent months. That's adding to speculation they're trying to lower lending rates and boost profitability ahead of a potential secondary offering. Bloomberg's Scott Carpenter covers credit and joins us here on set. Scott, great to have you on the program. This is a story that has been persistent because Bill Ackman often tweets about Fannie and Freddie. The president and those around him talk about it a lot. But for many people, what these companies do, these government-related entities, is kind of nebulous. So step back and explain exactly what the story is.
Yeah, absolutely. So Fannie and Freddie are enormous government-sponsored companies. They're designed to support the market for home loans and ultimately make it easier to take out mortgages. They underwrite something like more than half of all mortgages in America, so they're enormous, right? The main thing they do is they provide a financial guarantee on mortgage bonds. That's how most of these home loans get financed. That's the main thing they do. They also, and this is the part that's not talked about quite as much, they also buy some of those mortgage bonds and home loans themselves. By doing that, they can support the market and also earn revenue for themselves. They get money from providing the financial guarantee. They charge money on that. They also get money when they buy the mortgage bonds. So it's sort of like, for them, it's called their investment portfolio or their retained portfolios. This is in addition today to their main business of providing the financial guarantee. And what's been happening and what we wrote about is that since June, between June and October, they've increased that investment portfolio by about 25%. It's now roughly $233 billion. That's a lot. The agency mortgage bond market is enormous. It's about $9 trillion. So it's still, it's not the whole thing by any stretch, but it's growing. And what people are talking about, what all strategists, a lot of investors I talk to are talking about, is that it's on a trajectory to continue growing into next year. Citigroup is expecting them to add $100 billion. There's a wide range. Nobody knows exactly what they're going to do because Fannie and Freddie and their regulator, the FHFA, have been tight-lipped about this.
So, but let me ask, clearly if they buy mortgage bonds, that'll push the rate down, right? Price up, yield down.
Yeah.
But why would they want to keep lending costs down and grow their portfolio as a precursor to what's being called an IPO? Although, obviously, it's not an initial public offering since the shares are already pretty public.
Right. To do an IPO, which is what the Trump administration is clear they would like to do, the GSEs, Fannie and Freddie, need to have really good earnings. If you're going to invest in an IPO, if you're going to buy shares of a company that are being offered publicly, you want that company, or in this case companies, to be very profitable. So you want them to be quite profitable, right? And this, by increasing the investment portfolios, you're increasing the earnings, although it depends on what your funding costs are and so on. But that could be what's going on here. They have the IPO in mind as well as other possible objectives like lowering mortgage rates, and they're thinking, how do we make this possible? One way to do that could be buying more mortgage bonds, mortgage loans, increasing their earnings, presenting better profitability, so that when it comes time to do an offering, investors like what they see.
All right, this is something that I think we're going to be talking about a lot more over the next year, Scott, so I hope we can get you back on. And fantastic coverage, great story today. I hope a lot of people read it on the Bloomberg or on Bloomberg.com. Scott Carpenter writes about credit for us. Coming up, gold climbs to, well, near fresh records again, given a boost by the Fed's latest rate cut. We'll look at the year ahead for the precious metal. That's next. This is Bloomberg Open Interest.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Vernon in Florence, Italy, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Get a quick check on stocks with the Chicklets. Right now, almost a half hour into the session, the S&P 500 is gaining, but less than 0.2% so far. The NASDAQ up also about 0.2%. Remember, we had a big drop in these indexes on Friday. The S&P ended up closing down 1.1%, and the tech stocks were really the drag on that. Taking a look at the biggest stocks here, NVIDIA actually up 1 1/3%, so that's going to help lift the index. We saw just moments ago that Tesla and NVIDIA were the biggest gainers on the S&P. Oracle on the downside, Oracle and Broadcom both weighing on this index, this market. iRobot is the Roomba maker that's filing for Chapter 11 protection from creditors, so that's down 70%. ServiceNow is down 10%. Wow, really decimated on reports that it's going to buy Armis for a $7 billion valuation. And then we have gold and silver. We've seen new record highs. Well, silver has seen a new record, and gold is getting back close to the record that it recently hit. So we do see commodities continuing, at least in terms of precious metals, on the upside. For more on gold, we're joined by Bloomberg macro strategist Simon White. And Simon, we just spoke with Kate Moore of Citi Wealth. She said she's adding to her portfolio, even at these lofty levels as well. Can this rally be sustained?
Well, I think you have to kind of stand back and look at the bigger picture. You know, the rally that we saw, for instance, in the late 70s and the early 80s was something that was, you know, remarkable at the time. But if you look at today's rally in comparison, you know, it's still barely a scratch on that. I'm not obviously saying that necessarily it's going to go to the same extremes. We're already ahead of it in nominal terms. But in terms of when it's a regime shift, which is what I think we're in today, you have to keep an open mind. So, you know, I think it could be a slightly more tougher year for gold next year. Like, it could be more volatile. There could be a pullback on the way there. But the fundamental reasons, I think, for the bull market remain intact.
So what is driving this? What are those fundamental reasons? Why are we seeing gold at well over $4,300 a troy ounce?
Yeah, I think, look, there's quite a few things going on. I mean, the initial driver of the rally this cycle was emerging market central banks started buying. I think they started to feel, especially after the financial crisis, but more so after the Russia-Ukraine war, that their risk of their assets, dollar assets, being seized was something that they wanted to or didn't want to live with. So they started to diversify. Gold is obviously the natural thing for central banks to buy, but that has widened to retail traders. Retail traders are now starting to buy more and more gold out of Asia as well, I might add, and in Europe and the US. They were a little bit slow off the mark, but they certainly are participating right now as well. So you've got this rally that's kind of broadening, but what I think people are really worried about really is gold is a tail hedge. It's not only is it an inflation hedge, when I say inflation, I mean extreme inflation, it's also a deflation hedge as well. So the two tails of inflation is when gold tends to do best. It's not an overall inflation hedge, because when inflation's kind of petering around the middle, you know, gold's not necessarily going to be the thing that's going to salvage your portfolio. But at extremes, it's something that is beneficial for portfolio. People think Bitcoin might be an alternative, but you know, in this environment, I think it's untested. You know, Bitcoin may end up well pulling through the next kind of crisis that we have, whether it's governments debasing their currencies or there's some sort of private credit event and there's debt deflation. But at the end of the day, you know, if you want to take insurance, you probably want to go for something that you know has worked in the past, and that applies to gold.
Simon, great to have you on the program. Look forward to reading more of your reporting. Bloomberg's Simon White. You can check out the stuff he does by typing MLIVGO on your Bloomberg terminal. By the way, we're going to talk more about gold as well as diamonds, both real and lab-grown diamonds, with Ankur Daga, Angara co-founder and CEO, in the next hour as we approach this holiday season. Coming up in the next hour, Monetta's Ethan Devitt says the huge gains in gold and silver don't support their characteristics as diversifiers and inflation hedges. We'll get that take next. This is Bloomberg Open Interest.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Deborah Rodriguez. Hollywood is reeling after the deaths of legendary director Rob Reiner and his wife Michelle. Jerry O'Connell starred in Reiner's movie Stand By Me. The actor tells CBS Mornings.
Just really surreal and still in shock, to be honest. Just still in shock. Rob was like a father to me.
Correspondent Jonathan Vigliotti is outside the Reiner's mansion in the Brentwood neighborhood.
Investigators have not yet immediately released details on the circumstances surrounding Reiner's and his wife's deaths. But multiple outlets, including the Los Angeles Times, are reporting a family member is being interviewed in connection with the deaths.
Can you confirm that? And is that family member being cooperative?
There are going to be many family members interviewed. I'm not going to confirm whether someone's being interviewed at this time or not.
Rob and Michelle Reiner married in 1989. They have 3 children. Police in Rhode Island say a new manhunt is underway after they released a person of interest in Saturday's mass shooting at Brown University that killed 2 students and wounded 9 during a study session on campus. CBS's Tom Hansen has more from Providence.
7 remain in the hospital in stable condition. 1 is in critical condition, and a 9th person has been released. Meanwhile, the university has canceled all remaining finals and classes.
Charges are expected against the surviving suspect in the Hanukkah shooting in Sydney, Australia, that killed 15 people and injured dozens.
After Australian police confirmed one of the Bondi Beach gunmen owned 6 registered firearms, Prime Minister Anthony Albanese promised speedy action.
Included in that is the need for tougher gun laws.
The Pope praying for the victims, but in Britain.
This is clearly not an isolated incident.
Prime Minister Keir Starmer recalling October's Yom Kippur massacre here.
These incidents are chillingly focused on some of the holiest days in the Jewish calendar.
Noting the danger to Jewish communities stretches beyond Australia's borders. Vicky Barker, CBS News, London.
A trial begins in federal court in Milwaukee today for Judge Hannah Dugan. She's accused of helping an undocumented man hide from ICE agents. Loyola Law's Lori Levinson.
Judges are not usually put on trial, and it's quite unusual until recently for ICE to go into courthouses, let alone into courtrooms, to seize individuals.
That high-risk trip from Venezuela to Norway proved painful for opposition leader Maria Corina Machado. A spokesperson for the Nobel Peace Prize winner says she fractured her vertebra on the first leg of her journey in a small wooden fishing boat that took her to the island of Curacao. She flew on from there in a private plane to Oslo. Dow futures up 59. This is CBS News. One of the big stories from NFL Sunday, the grandfather who suited up for the Indianapolis Colts.
44-year-old Phillip Rivers played in his first NFL game in 5 years.
Rivers, and he's got a man, touchdown! That's Josh Downs, and that's Phillip Rivers with a touchdown pass.
Rivers had the Indianapolis Colts on the brink of an upset on CBS, leading Seattle late before a field goal won it for the Seahawks.
It was a blast, but obviously the emotions now are disappointment.
Rivers, who watched last weekend's action on his couch, had a week to learn the Colts offense.
As the game just got going, I was just thankful, grateful that I was out there.
Steve Kathan, CBS News.
Wouldn't this help with holiday shopping? The Powerball jackpot for tonight's drawing up to $1.1 billion after no one chose the lucky number Saturday night. The cash value, more than $500 million. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well. So you head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Scarlett Fu and Paul Sweeney, we are live. This is the Bloomberg Intelligence Program. Coming up, we're going to check in with Michael McKee, Bloomberg International Economics and Policy Correspondent. Why? Because we've got a ton of economic data coming this week, starting tomorrow with the jobs numbers. We'll get a little preview there, see what's happening. Roz Matheson, Bloomberg News Chief Asia Correspondent. She's based in Singapore. She is going to give us the latest reporting coming out of Australia. Walter Todd, President, Chief Investment Officer, Managing Director at Greenwood Capital, give us his thoughts on these markets. And then the person I really want to talk to about this Warner Brothers Discovery deal, if there's going to be a big media transaction, is will the regulators allow it? Jen Reed, Bloomberg Intelligence Senior Litigation Analyst. She covers all the antitrust stuff for Bloomberg Intelligence. She'll have the informed opinion, so we'll touch base with her. Right now, let's go to Lisa Mateo and get a Bloomberg Business Flash. Lisa.
And this Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around the clock. Well, traders are looking to delay jobs inflation data this week. They want to have them build a better picture on the economy, also interest rates. You have Citigroup, who gave an upbeat outlook for U.S. stocks next year. Morgan Stanley, they predict tomorrow's non-farm payrolls numbers could give the market a boost. Economists, well, they project a 50,000 increase in non-farm payrolls and a 4.5% unemployment rate. We'll see tomorrow. Over to stocks, we have the NASDAQ. Right now, deteriorating down about 0.1%, 37 points. The Dow and the S&P 500, both little changed. Treasury yields dropping on bets the Fed's going to lower rates twice next year. We have the 2-year yield 3.49%, down 2 basis points, and the yield on the 10-year 4.15%, and that's down 2 basis points. The Bloomberg Dollar Spot Index weakening by about 0.2%. Dollar slide giving a lift to gold and silver. We have spot gold at $4,322 an ounce. Over to company news. Roomba maker iRobot filed for bankruptcy. Also proposed handing over controls to its main Chinese supplier. Its shares were halted. Now they're down about 69%. McKinsey preparing to cut 10% of its jobs in some departments, and that's a move that could affect thousands of roles. Coca-Cola held last-ditch talks with TDR Capital. The Financial Times is reporting its proposed sale of Costa Coffee. Well, that risks collapse. And finally, looks like SpaceX moving forward with an insider share sale values it at about $800 billion. The Wall Street Journal said the company is sounding out to banks for that IPO. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here with you in a Bloomberg Interactive Broker Studio, streaming live on YouTube as well. We got you back in studio.
Yeah, I was in sunny California
over
the weekend, and then I came back to a 5-inch snowstorm.
That's exactly right. I mean, how sunny was it in California?
It was 80 degrees every day.
Perfect.
So, yeah.
Perfect.
Can't complain.
Yeah, my son's out there in LA. I don't think he's ever coming back, you know. So that's how it rolls here. All right, let's take a look at some of the stocks on the move today. I'm Paul Sweeney. I'm alongside Scarlett Fu. We're joined by Bloomberg's Christina Aquino. Christine, what are you looking at today?
Well, we got to take a look at ServiceNow, Paul, because it's M&A Monday. So that's right. Bloomberg News exclusively reporting the company is in advanced talks to buy Armis, which is a cybersecurity startup. And those shares now down, though. So ticker NOW shares are down more than 10% now, so extending some of those opening declines. And so from our reporting, people are saying, who are familiar with the discussions, they're saying that the discussions are advanced. Of course, they may still fall apart if another potential bidder emerges. And so Bloomberg Intelligence has weighed in on this. They're saying that, you know, for now, or ServiceNow, this would help its ID asset management practice. But they're just questioning that deal price, $7 billion to gain $300 million in annualized recurring revenue, which to them seems expensive. What do you think, Paul?
I don't know the multiples here, but I mean, it's a fast-growing business, and you know, you got to put this capital to work somewhere. I don't have a problem with it. Let's go. But that's a big drop in the stock. It's something that just tells you that their shareholders weren't like expecting this at all.
Exactly, and clearly not happy with it.
Yes, exactly. All right, what else we got?
Let's take a look at Franklin Resources, so ticker BEN. Those shares are up today just slightly, 1.5%. So that was up slightly more earlier. So just bearing some of those opening gains. But we did get news from the company itself. They said that the U.S. Department of Justice is preparing to resolve an investigation into its fixed income unit, Western Asset Management Company, without criminal charges. So clearly that's buoying the stock a little bit this morning. Apparently the Justice Department told the company on the 13th of December that it is preparing to resolve the investigation through a disposition. The department just needs more time. So we know that this company has been through a lot of turmoil. We've seen clients pull more than $100 billion from Western Asset specifically since the middle of last year. That was when Franklin disclosed that Ken Leach, which was WAMCO's former co-chief investment officer, was under investigation. So it seems like they're eager to put this behind them.
Yeah, I always go back to the ticker, which I love, BEN,
that's
for
right.
Franklin Resources. Okay, you're also taking a look at iRobot.
We got to talk about iRobot. It was very iconic at one point in the early 2000s. No more. So those shares, ticker IRBT, those are now down more than 60% after being halted earlier for volatility. And that's because, yeah, they have filed for bankruptcy. So it's an end of an era for the maker of the Roomba. And so the company is saying that it will be taken over by its main Chinese supplier, which is Shenzhen PICA Robotics, as well as a subsidiary of that firm. And then the common stock for iRobot will be wiped out under the proposed Chapter 11 plan. You know, in 2022, they actually had an opportunity to be bought out by Amazon, but then the deal collapsed because they clashed with EU competition authorities. So that would imagine their fortunes if they.
Do you own a Roomba?
I own. I used to own one, and then my cat broke it.
Ah.
Pets and Roombas.
Roombas.
That's a dangerous combination.
Exactly.
It's this moving thing, invading their space.
We have a Roomba, and I've been told it works. I don't know. I kind of think it's a scam.
You haven't seen it in action.
I have, but I'm just like, really? Is that? I mean, I don't know.
It's just it's just sweeping around the house.
In the middle of the night when Paul's not, there to monitor it.
Yeah, exactly. All right, Christina Aquino, thank you so much. We appreciate that. Christina Aquino from Bloomberg News. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. You type in ECO GO. The economists are going to be busy this week. There's a lot of stuff coming out, so let's get a little preview
Not to
here.
mention Fed speak as well.
Fed speak as well, absolutely. Michael McKee, international economics and policy correspondent for Bloomberg News, joins us live here in our Bloomberg Interactive Broker Studio. I guess the big one is tomorrow, Mike, change in non-farm payrolls. Is that a big one?
There's two big ones this week, the change in non-farm payrolls, and then on Thursday we get CPI. These are all old ones that are being finally released. I do want to note that in terms of the Roomba, the one value that it had was YouTube videos of people putting their babies on the Roomba and riding around.
It was a good public service thing.
That was a good public service. But the jobs numbers tomorrow are going to get a lot of attention, but they're going to be really hard to interpret, and they probably won't mean that much in the long run because we don't have half of the October report, and these are delayed reports, and we don't even know what is it's gonna tell us about the overall economy because of the parts that may be missing. In September, we had 119,000 jobs created. Unemployment was 4.4%. We don't have a forecast for October, and November is just 50,000. But the unknown is our federal workers who were furloughed and those who were doged, who were fired, did they fall off the payrolls in October and create a big negative? So there's a lot of things we don't know about that. I think that in terms of the Fed, they're probably going to pay more attention to the December numbers, this month's numbers, which we get on January 9th, because there'll be a full set, and they can then be compared with November to see which direction we're going.
True, but the bond market needs something to key off of, and they've been putting a lot of expectations on this one, especially when they're pricing 2 rate cuts in 2026. Mike, what is the setup going into this jobs report based on what Jay Powell told us last week?
Well, the Fed, as Powell told us, realizes that these numbers are going to be revised. He kind of overstated that in a sense, but once a year, you remember in January, the Bureau of Labor Statistics recalculates the numbers using tax data and things like that. And they have found the last 2 years, which statisticians are saying is probably more a coincidence than anything, that they have been significantly overstated. Now, they've been, the preliminary number is 911,000 too high, but that's through March, not the rest of the year. And when they get much of the rest of the year, it's going to go down to 700,000 or so, which will make Powell's estimate too high. But that doesn't even come into play until January when they redo the numbers. So it's kind of irrelevant that the Fed is looking at that, in the sense that by the time they get to their next meeting, it won't make a difference.
How high is the bar right now for the Fed to cut rates in January?
Well, it's pretty high, the way they phrased it, and they went back to the old statement about in considering the timing and extent of any future rate cuts, which was what they said just before they paused last year in December. So it does look like they are planning to pause. They're planning to wait and see where we are. Now, we'll get an interesting report on Thursday with the Consumer Price Index, which is going to be only year-over-year numbers. People don't realize that because there isn't an October number. They didn't collect the data. So we will see, and the forecast is we're going to go up a tick to 3.1% in the headline. So with the absence of specific CPI data and with the absence of really good October and November payroll data, the Fed is still working at a disadvantage, even though some of these numbers are coming out now.
When will the data be clean again?
Good
I
question.
think the December data will be pretty clean. It'll be a little harder than normal to interpret because we'll get revisions as we usually do to these numbers, and it's going to be hard to know exactly what those are going to be because of the missing data. But by the time you get to January data in February, we should be pretty much back to normal.
All right, the change in non-farm payrolls consensus is 50,050. The whisper number, WHIS, is the terminal function, 15,000, 15,000. So we'll keep it.
Yeah, that's a hard one to figure out how they're going to do that.
Yes.
How you get a whisper number out of it.
Yeah, exactly. We just call a couple of your friends. Michael McKee, thank you so much. We appreciate it. Michael McKee, international economics and policy correspondent for Bloomberg News, joining us live here in our Bloomberg Interactive Broker studio. Coming up, we're going to check in with Roz Matheson. She's Bloomberg News Chief Asia Correspondent. She's based in Singapore. She is Australian. And she is in our London bureau this week. But we'll check in with her, get the latest reporting coming out of Australia. We'll bring that to you. S&P is down 7 points. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Bloomberg Interactive Broker Studio. I'm Lisa Mateo. We've got a little bit of shift in the markets with red on the screen now. The NASDAQ down about 0.3%, 76 points. We have the Dow and the S&P 500 both down about 0.1%. So let's take a deeper dive, a look into the 11 industry groups. The biggest drag coming from energy. We click through its oil and gas exploration and production. This is in the IMAP feature of your terminal. And at the top, we have ConocoPhillips. Their shares down more than 1.5%. To the yield space, the 2-year 3.49%. That's down 2 basis points. The yield on the 10-year 4.15%, and that's down 2 basis points. Checking out shares of NVIDIA, whose stock has fallen more than 6% over the past month. Its shares now up nearly 1%. And looking at the Mag 7 overall, Tesla shares, they're up more than 3.5%. One stock on the move. Want to point out shares in Italian football club Juventus. They're jumping more than 14% in Milan. That's after crypto firm Tether Holdings. They made an all-cash proposal to buy a majority stake in the team, but Juventus is majority owner. They did reject that bid. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right. Thank you so much, Lisa Mateo. This is Bloomberg Intelligence. We are live from our Bloomberg Interactive Broker Studio here in Midtown Manhattan and streaming live on YouTube. Paul Sweeney and Scarlett Fu here with you. We want to head now over to overseas for the latest developments there because, of course, we had this terrorist attack in Australia over the weekend where 2 gunmen killed 15 people during a Hanukkah event on Sydney's Bondi Beach. I want to bring in Roz Matheson. She is Bloomberg News Chief Asia Correspondent for the latest. Roz, I know you're based in London, you're Australian, and you cover our Asia region for Bloomberg News. What is the latest?
Well, the latest is that they've identified 2 gunmen, a father and a son, that they say worked in concert to kill people who were gathered on the foreshore of Bondi Beach, the iconic beach in Sydney, Australia, for the first evening of Hanukkah. The father has been shot dead. The son is in hospital with gunshot wounds. The question, of course, is what prompted them to take this action. Obviously, the Australian government, as I say, it was a targeted attack against the Australian Jewish community, but what prompted them to decide to do this and what is Australia's worst terrorist attack in its history is prompting a lot of questions and a lot yet we don't know about this. But obviously, it's come against the backdrop of months of rising anti-Semitic incidents in Australia, bound up in a very complex conversation within Australia about the conflict that we've seen in recent years in the Middle East.
That's kind of where I wanted to go, Roz. I guess most Americans, we probably don't think of we do think of Australia as kind of a melting pot like the United States, welcoming to lots of different people. Talk to us about the anti-Semitic, I guess, discussion or argument that's going on in Australia.
Well, what's happened in the Middle East has been felt quite strongly also in countries as far away as Australia. You had a lot of horror at the Hamas attack on Israel, an outpouring of sympathy for Israel, but also a large community that's been concerned about the humanitarian situation as it's gone on in Gaza, and very big pro-Palestine protests that you've seen occurring in cities around Australia. And bound up in that, you have seen incidents increasing of anti-Semitic commentary and behaviour. And the question is, did the government recognise that enough and do enough to try and stamp it out? Did the intelligence officials spot any specific threats that were coming from that? But it's really been quite a complex situation for Australia, and it kind of stretches back into years of quite fraught conversations around immigration in general, the risk of what people, you know, who are critics on the far right say of radicalisation from Islamic groups and so on. So Australia might be on the other side of the world and far away from many of these issues, but is still experiencing them and still going through fundamental debates itself around them.
Yeah, no doubt there will be some national soul searching here after the events of this weekend. Roz, also give us a sense of how leaders are moving forward. The Prime Minister is talking about strengthening gun laws, and this has happened in the past. There's been a precedent for doing something like this.
That's right. There was a massacre back in 1996, a lone gunman at a place called Port Arthur who killed 35 people, which was the worst killing in modern Australian history. In the aftermath of that, Australia, the government enacted some of the most stringent gun control laws on the planet, banning automatic weapons, most semi-automatic weapons, quite stringent rules around getting a license to own a firearm. But some of those laws have not been completely enacted or followed up over the years. Perhaps they've not kept pace with some of the threats that Australia might experience, and perhaps even a sense of complacency because those laws exist, that therefore Australians are safe. And so now there's a real calibration going on about whether those gun laws need to be updated. Gun use is on the rise in Australia. More people own more guns. The gunman, owned 6 guns. He had a permit to do so. So there's a lot of conversation in Australia about, do those laws need to be updated? Can the federal government work with the states to do so and tighten some of those loopholes that are now become apparent, have been existing for some years?
All right, Ross, thanks so much for joining us. Really appreciate your reporting. Ross Matheson, she's the Chief Asia Correspondent for Bloomberg News, joining us from our London bureau. Let's get back to these markets. Well, we do have a little bit of selling here today. We've got the S&P off 20 points. That's about a third of 1%, and the NASDAQ's off about 150 points. That's 0.6%. Again, we're getting a lot of economic data this week, and as Michael McKee just mentioned to us, the 2 most important ones are the jobs data tomorrow, and then later in the week we'll get some CPI data, both of which will be important for the markets and for this Federal Reserve. Walter Todd joins us. He's the President and Chief Investment Officer, Managing Director at Greenwood Capital, joining us via Zoom from Greenwood, South Carolina. Walter, you look back on 2025, and boy, investors enjoyed 15% returns in the S&P, 20% returns in NASDAQ, high single-digit returns across most of fixed income. That begs the question, now what do we do in 2026? What are the conversations you're having with your clients about that?
Yeah, well, good morning. Don't forget 30+% overseas equities as well. So yeah, it's been a really strong year. Certainly better than we would have thought going back to the events of April with the tariff announcement. So I think the conversations we're having with clients as we move into 2026 is to take advantage of some of the strength. If you've got a target of 60-40, you're probably at 70-30 at this point, given the performance in equities. Let's rebalance some of that and move it back into fixed income or some other areas of the market. So it's really just kind of being disciplined in your approach and taking advantage of the strength that we've seen.
So how are you thinking about fixed income then? Because there's a debate clearly on what's going to happen with the Fed in 2026. And a lot of that is riding on the jobs report that we're going to get tomorrow and, of course, in early January.
Yeah, so that definitely could be market moving as we get that data. But I think maybe the bigger thing for fixed income in 2026 is going to be who the new Fed chair is, and we'll get that announcement after the turn of the year. It looks like it may be swinging a little bit more towards Warsh, which I think the market is digesting well. I think rates may be backed up in anticipation of Hassett getting the nod there, so we're seeing a little drawdown in rates. So we think kind of the 3 to 4 duration target is good. A balance of corporates and treasuries makes sense in a fixed income portfolio. And we still think you can get solid 4 to 5% type returns in that market in 2026.
Walter, what screens well for you guys these days, whether it be a sector or a factor? Because this has been an equity market, at least, that's really been driven by technology, principally AI. What else are you guys looking at?
Yeah, it's a great question. I mean, we really saw a fundamental shift in the market. If you go back to NVIDIA's earnings report on November 19th, the next day, the 20th, the market had sold off. Then we got Williams coming out that Friday morning and changing the dynamic for the December Fed meeting. And since that move, we've kind of traded back to the highs in the S&P, but the way we've gotten there is very different than how we got there the first time in late October. So we've seen a broadening out away from some of those momentum-driven AI trades. We're seeing that again today, for example. And the beneficiaries of that rotation have really been the likes of healthcare, industrials, even materials and energy have participated there. So it's kind of been the revenge of the real economy versus the digital economy on this rebound that we've seen. So as we look into 2026, we want to stay diversified across different sectors, not just be concentrated in those names, have some exposure to those technology and AI names, but have a much more diversified outlook. We like healthcare heading into 2026 as an example. We like energy as well.
Makes a lot of sense. I wonder, though, Walter, how you're thinking about depreciation expenses when it comes to those hyperscalers. Bloomberg has some reporting that shows in the fourth quarter of 2023, Alphabet, Microsoft, and Meta had a combined $10 billion in depreciation costs. And that number is seen reaching $30 billion for the same time this year. So it's quite a huge jump.
Absolutely. There's been a lot of discussion about the useful life of all of these equipment being purchased and them extending that out to stretch out that depreciation expense. But you make a great point. These companies have gone from cash generating companies to cash using companies. Oracle's probably the most extreme example of that. But I do think that's going to be a headwind as you look in 2026 for the earnings of the overall S&P and certainly for those individual names.
So, Walter, how important is it for the Fed to continue cutting rates for this market, do you think? Because it seems like the market, I don't know, it's only pricing in 1 or 2 cuts. It doesn't seem to be as big a story maybe as originally thought.
Yeah, I think it really depends on how the back end behaves relative to what the Fed does and what the economic data is, and importantly, who the next Fed chair is. So if 10-year rates can remain kind of range bound around, let's say 4 to 4.25, maybe 4.3 at the high end, I think that's a good backdrop for equities. However, if the back end of the curve starts to move towards that 4.5% or beyond, I think that becomes a real challenge for equities. And the final thing I'll say, just in general for 2026, it's a midterm election year. Those tend to be a little more volatile, particularly on the front end of the year as you head into that election. So something to keep in mind.
Walter, what is the biggest risk you see for 2026?
Probably a couple of things. One is earnings disappointments, or maybe continued earnings disappointments from some of these big drivers of performance in 2025. So back to the AI story, if we continue to kind of see questions arise around the return on investment from all this spending, I think that could be a challenge just because of the weights those names represent in the marketplace. But also this concept of being a midterm election year, some volatility around that, and of course we got a bunch of unfortunately geopolitical situations going on as well that are still out there. So the market is kind of discounting very few risks in a world that seems to be proliferating with them. So that I just think that's a risk in 2026 and something to be mindful of.
Washington and Lee University, awesome school, beautiful town of Lynchburg, Virginia. But dude, it is in the middle of nowhere. Yep. What did you guys do for fun in Lynchburg?
Lexington, Virginia. Yeah. Population of about 2,000 without the students there. But it is a very historic area, and we had a lot of fun.
Yeah,
as well as worked hard.
I spent a lot of weekends there driving up from Richmond to see my buddies.
Wait, 2,000 without the student body? The
students are only like 1,600 students at Washington Lee University.
Really?
So the town, in full enrollment is probably about 5,000 in total.
Yeah, it's a beautiful town and a lot of history there, and a lot of history at the Washington Lee University. Great school. A lot of my buddies went there. But when I was in college, it was all boys, but now it's co-ed. Walter Todd, President, Chief Investment Officer, and Managing Director at Greenwood Capital. And we came from an all-boys boarding school. And then my dudes, they went to Washington and Lee. I'm like, are you nuts?
You were like, I'm going the other way.
Yeah, exactly. I went to the University of Richmond, and that was a night and day. So some good stuff there from Walter Todd. He's down there in Greenwood, South Carolina. We're going to have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, after starting off the trading day higher, stocks, well, they're falling in the run-up to the jobs report tomorrow. We did have some more Fed speak. The Fed's John Williams said monetary policy well-positioned for next year following last week's interest rate reduction. Let's get right to it. We'll start with the NASDAQ, down about 0.5%, 137 points. The S&P 500 and the Dow Jones falling about 0.2%. The two-year yield, 3.49%. That's down 2 basis points. The yield on the 10-year, 4.16%, and that's down 2 basis points. Gold rising for a fifth day. Goldman Sachs analysts expect gold prices to lift to $4,900 by the end of 2026. We take a look at COMEX gold, $4,349 an ounce. The Bloomberg Dollar Spot Index weakening by about 0.1%, and Bitcoin down about 2% at just above 86,000. Over to company news. The CEO of Netflix, well, they're making their case for Warner Brothers acquisition. It was in a letter to employees. You have Greg Peters and Ted Sarandos saying they are committed to releasing Warner Brothers movies in theaters. They also addressed some concerns about job losses, saying that they promised no overlap or studio closures. Now, meanwhile, deal makers heading into the final weeks of 2025. Bloomberg data shows global transaction values, well, they've risen about 40% to about $4.5 trillion this year. That is the second highest tally on record. And more Wall Street investors, they're backing the parent company of the Texas Stock Exchange, Goldman Sachs. Bank of America headlining a group putting about $20 million into TXSE Group. That's bringing the capital raise to $270 million. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right. Thank you so much, Lisa Mateo, for that Bloomberg Business Flash. We appreciate it. It is Monday morning here, and as Lisa mentioned, we are monitoring the latest on Netflix's bid for Warner Brothers Discovery. I think we're in week 2 or week 3. Where are we at?
Yeah, I know. It's just been out there for a long time, and I think it's going to take a long time to
Absolutely. So, I mean, they were thinking 12 to 18 months, could be longer. Of course, we need to bring in Jennifer Reed, Bloomberg Intelligence Senior Litigation Analyst, who's been on top of all the regulatory concerns. And Jen, you heard what Lisa was saying about this letter that the co-CEOs Greg Peters and Ted Sarandos have released. Did we learn anything new from that letter that helps clarify and clear up the regulatory murkiness?
I mean, I think not. I think what they said in the letter is what they had to say. You know, right now they are trying to convince the shareholders of Warner Brothers that they're going to be a better buyer than Paramount. They're in a fight for the assets. And they've heard what the concerns are, that it's going to kill the movie theater experience and kill movie theaters, that people will lose jobs. People who create content will lose jobs because it's one fewer buyer of content. And so they're just trying to assuage these people that won't be the case if Netflix ends up actually being the buyer of Warner Brothers down the road.
Red headline crossing the Bloomberg terminal. Nick Reiner arrested by LAPD. Bail set at $4 million. That's according to Bloomberg News. We'll have some more reporting on that going forward. If you were advising the Warner Brothers Discovery Board, which deal would you recommend from a regulatory standpoint? Which has the least amount of risk?
Oh, I think from an antitrust perspective, it would be Paramount. Yeah, and the reason is because there are overlaps. Both companies have risk. Both companies raise antitrust issues, but I think the issues that are raised by the Paramount bid may be more easily defensible or more easily fixed than the issues that come up with Netflix. And then you also have, you know, what we've seen in the news, that it seems that the owners, the people who are behind Paramount are allies with the administration. And this administration has said that they will be involved in this. And that obviously gives them a leg up with respect to that situation.
Jen, you noted in your research that there's a consumer lawsuit filed against Netflix's bid for Warner Brothers. And it's a proposed class action suit as well. Does that matter? Does that make a difference to what we're seeing right now?
You know, it does. I'll say that these consumer lawsuits seeking to block a deal, it's sort of aligned alongside any kind of federal or state scrutiny that would occur, they are rarely successful. And this is usually because the Department of Justice or the FTC, whoever the reviewer is at the time, is really considered the expert in antitrust, right? And a judge would prefer to sit back and let that play out and see what happens there than to be the one to decide to block a deal, because that's what the consumers are looking for. It's not, you know, money, which is what you usually see in a class action, but to enjoin the closing of the deal. But it adds risk no matter what. It's yet another piece of opposition that you never know could turn into something, along with states right, that could get involved, that could align with this consumer action or align with the federal agency, the Department of Justice, that could end up going after a deal. So yes, it adds risk. I would say it's a limited risk, but it does.
So if Paramount wins, there's going to be, just from my understanding of the media business, a lot more job losses. Because for every set designer, every writer that Warner Brothers has, Paramount has one as well.
That's right.
And I would argue the synergies, and I've seen research that the synergies, i.e. job cuts, are 2x Paramount versus Netflix. Does that factor into what the regulators look at?
It does. You know, it didn't as much in the past, but this has been a trend in the last 10 years. They will look at the impact on workers. This is what we call in the antitrust world a monopsony issue. Too few buyers of a service. And the Department of Justice is coming off success with that theory of harm. They were able to block Simon & Schuster from acquiring Penguin Random House, and it was all about fewer bidders for top-selling authors. And similar, right? Fewer bidders for content, for writers, for creatives. And so they won that in court recently, and so it is a theory that they could pursue, and it's a viable antitrust theory of harm.
My other question for you, and I guess this should have been the first question I asked you, is Netflix has promised all kinds of things. They're going to continue to release Warner Brothers movies and theaters. They promise no overlap or studio closures. Netflix has a habit, a tendency of going back on their word. They, reverse course on advertising. They reverse course on live sports. So how much can we really trust legally any of what they're saying?
Nothing. You really can't. And honestly, sometimes there are consent orders, settlements entered with the government where these kinds of promises are memorialized in writing. And even in that case, what antitrust practitioners would tell you is that it often fails, right? That and the companies would say, look, we're publicly traded companies. We have a fiduciary duty to our shareholders. Economic conditions change, things change. And so that had to change our strategy. So really what they say today doesn't have a lot of meaning. Now, if it were memorialized in a consent order, maybe it has a little bit more clout because then somebody could go after it in court if they fail to abide by those promises. But even in those cases, this doesn't mean very much.
Do we know which regulatory body, the Department of Justice or the Federal Trade Commission, which one's going to review this deal? Do we care?
It'll very likely be the Department of Justice because they have experience in this area. That's how these deals are cleared to one or the other.
So do I hire like DOJ counsel just to argue my case, or do the dudes at Simpson Thatcher or whoever, do they have those people? Do I hire a specialist law firm to do this?
I will tell you, you hire a big antitrust firm where many of the partners probably came from, the Department of Justice or Federal Trade Commission.
That revolving door.
Yes.
Final question to you, Jen. Is the burden all on Netflix to prove that this is not an antitrust breaking deal, or does Warner Brothers Discovery have a role to play here? They've been fairly quiet.
Well, the burden, if they have a deal and it goes before the Department of Justice, the burden is on the Department of Justice, actually, to prove that the deal raises antitrust concerns. I think they have a fairly easy burden because right off with the overlapping streaming assets.
Is the burden on Netflix to defend against that, or is it on Warner Brothers Discovery?
Once there's an agreement signed, it will be up to both of them. Mostly Netflix as the buyer, but the seller also has to be a participant and cooperate in defending the deal.
What does Warner Brothers do in the meantime?
Right now, I think they should just be sitting quietly because it might be there's a battle for the assets, and it might be there are yet higher bids coming, which would be a benefit to them. So it seems to me that I think they've been fairly quiet. Seems to me that's probably a good strategy for them.
Boy, I'm looking at this. The Paramount acquisition. They've got on the lawyers Cleary. They've got Cravath.
Yes.
They got Latham. I
there
mean,
you go.
Three of the monster firms.
Yes,
now,
they're serious.
Each of those firms, and including the firms representing Netflix, they probably had to say, proceed with this deal. We think it will pass muster. Right?
Well, what they say is we think we can defend this. I don't think any lawyer would say, for sure, we're clearing this deal for you. They would say, look, we think we have defenses, and that if those defenses don't work before the Department of Justice, you have yet another shot before a judge, because it isn't really, at the end of the day, up to the Department of Justice. It's up to a federal judge. You have to go to court, and you can win. Merging companies can win these deals in court.
All right, very good. Jen Reed, thanks so much. We appreciate it. Jen Reed, Senior Litigation Analyst for Bloomberg Intelligence. Again, the red headline crossing the Bloomberg terminal. Nick Reiner arrested by LAPD. The bail set at $4 million. We'll have more reporting on that story. Sam Fazeli is going to join us here, Bloomberg Intelligence Senior Healthcare Analyst. Give us the latest in the world of healthcare. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in chilly Midtown Manhattan. We're also streaming live on the YouTube as well. So check us out there. Go over to Bloomberg. Let's go to, yeah, you can go to Bloomberg.com. You can go to all that kind of stuff and YouTube.com and search Bloomberg Podcast, and that's where you'll find us. Sam Fazeli joins us. He's the Director of Research for Global Industries and a Senior Pharmaceuticals Analyst for Bloomberg Intelligence. Sam, what is myeloma and why is that kind of in the news? Where are we in terms of treating myeloma?
Yeah, so if you remember, Paul, I've been telling you about these cancer therapy treatments and these cancer areas where patient numbers in terms of those who live rather than those who die is fundamentally changing. Breast cancer has been one of them. Prostate cancer is another one. Melanoma is another one, which of course people are familiar with. And of course, myeloma has been one that we've also got there. There are patients who are alive today who were diagnosed in 1996, 1998. And there have been developments in that space that literally are changing completely the way that people end up living with their disease. Of course, it's not for everybody that ends up like that, but the average mortality or the average life expectancy of the patients with myeloma has significantly changed. And what is it? It's a cancer of the bone marrow, which then, of course, translates to some changes in your blood. So it's a hematological cancer. And yet another major development in the last week or so that came out at Orlando, a conference that was held last week.
What is the treatment landscape then for myeloma?
Yeah, so given that it goes on for so long now, we've got first line, second line, third line, fourth line, fifth, etc. Right? There's so many patients. There are some patients that enter trials these days that have had 8 lines of therapy. But that's, I would say, a good thing. That means we have drugs to treat people every time they fail a previous one. The most exciting recent development was this data that came out of Johnson & Johnson's trial called Majestic 3, which takes a special type of antibody, married it with a well-known accepted drug on the market today called Darzalex, also another J&J drug. And lo and behold, at 36 months post-therapy, 83% of patients were alive. Versus the next big thing, best thing that we've just had, recently added to the armament at about 50%. So the massive shift in survival. I mean, these are things that we don't often see in oncology, but when you see it, you get standing ovations and you get celebration because it makes a huge difference to patients. So that's what we've been seeing recently.
Hey, Sam, here in the United States, the Trump administration has taken a real hard line against some federal funding of universities. And I know a lot of universities are saying that's really hitting their funding for their medical centers, for example, some of the medical research. Are you seeing that? Are you hearing that from the companies? Is the effects, are they being felt yet, or is that something in the future?
No, I would say that type of research funding is something that's going to translate into trouble in 5 to 10 years' time. If indeed it sticks, and if indeed you really end up with people not being able to start a scientific career because they can't get money to do their research. Now, I had a conversation with somebody last Friday who said, actually, it's not as bad as it sounds. It's only some areas that are being cut. The budget hasn't been halved. And then others tell me something different. So let's see how this all pans out in 2026. But if it goes in the bad way that you were just referring to, you're going to end up with fewer scientists in 5 to 10 years' time in US universities, developing these new ideas. And then, of course, where does that all go? China. And they are doing a fantastic job of getting their research funded and pushed. And that's where I think we all, US and Europe, need to watch because you will lose the competitiveness angle.
Right, the talent goes to where there is support for the talent. You're saying that that's a issue that will be more urgent down the road as opposed to right now. So for now, the FDA, the US remains the leader then in coming up with treatments for myeloma and the other diseases that have proven to be really intractable in terms of coming up with solutions.
That's right. That's right. I mean, the US is the market that everybody wants to launch in first because it's a market that rewards innovation. That means you get better prices, there's no central control, and you don't get situations where after your approval, there's yet another body, although that's coming a little bit in the US too, but the draconian ways that people's value of their life is decided based on whether I'm getting enough return for the investment that I'm making in saving somebody, which you get in the UK and you get sometimes in Europe. So these are the sorts of things that there are coming to a degree in the US, but not as draconian as in Europe.
Sam, thanks so much for joining us. Always appreciate getting a few minutes of your time. Sam Viselli, he's the Director of Research for Global Industries, Senior Pharmaceuticals Analyst for Bloomberg Intelligence, joining us from the London office there via Zoom. Boy, you take a look at Sam's out. This dude knows how to take vacation.
He's based in Europe, though.
He's Europe. That's how they do it there. I mean, they know how to do it there. So he's all fired up. So that's the last we're going to see of Sam to the new year, probably. Let's be honest here.
But isn't that the case for most of Wall Street, too, Paul?
Yes. Yeah.
I mean, between now and the end of the year, how much is really going to get done?
Exactly. That's why I thought we'd see some more IPOs here in the first couple of weeks of December than we did maybe. But I'll tell you who's going to be working completely through the holidays besides myself are the bankers and lawyers for this Warner Brothers Discovery deal.
Well, I mean, but it's a long road ahead. It's not like it's going to get done during the next 2 weeks. We're talking, what, 2 years potentially?
We had the head of M&A for Citi in here last week, and he said, yeah, he's already told his team, cancel all your plans. And that's happened to me a million times back in the day. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Monday morning from the Bloomberg Interactive Broker Studio here in Midtown Manhattan. Paul Sweeney and Scarlett Fu with you here on Bloomberg Intelligence. In this second hour of our program, we will be talking to Sri Natarajan. He is Bloomberg News' Wall Street correspondent on McKinsey, the global consultancy. They're plotting thousands of job cuts in their 100-year anniversary because revenue has flatlined for the last 5 years. Stuart Paul of Bloomberg Economics will be joining us to give us a preview of a big jobs report coming up on Tuesday. It's a dated jobs report, but it's one that may, set the scene for 2026. Louis Navellier is Chairman and Chief Investment Officer at Navellier & Associates. He'll be joining us to talk about these markets as we see equities start the week in the red. And Vincent Piazza, Bloomberg Intelligence Senior Equity Research Analyst, will give us his outlook on oil and gas for 2026. First, though, let's go to Charlie Pellet for our Bloomberg Business Flash.
Hi, thank you very much, Scarlett and Paul. Happy Monday, and we are looking at losses. We did see gains in the early going here. Back to work Monday morning. This, by the way, the last full week of trading for 2025. Here's where we stand. The Dow, the S&P, NASDAQ, all in the red right now. S&P lower, down 8 now. Drop there of just about 0.1%. We've got the Dow Jones Industrial Average also declining with the Dow down roughly 0.2% right now, down 74. NASDAQ down 91, drop there of 0.4%. NASDAQ Composite, NASDAQ 100 Index down 0.3%. S&P, though, fluctuating on the eve of the jobs report. Yeah, Jobs Tuesday tomorrow morning. A renewed tech slide and a rout in crypto curbing appetite for riskier assets. Crypto, right now we do have Bitcoin down 1.8%, 86,922 on Bitcoin. Your 10-year, 4.16%. The 2-year, 3.49%. Gold is up $13 the ounce, up 0.3%. West Texas Intermediate crude with a 56 handle now, 56.71 at the end of the year, down 1.3%. Bottom line here, stocks lower. Walter Todd is President and Chief Investment Officer at Greenwood Capital. He was a guest on Bloomberg Intelligence last hour. He told us he is looking ahead to Jay Powell's successor at the Federal Reserve.
I think maybe the bigger thing for fixed income in 2026 is going to be who the new Fed chair is, and we'll get that announcement after the turn of the year. It looks like it may be swinging a little bit more towards Warsh, which I think the market is digesting well. I think rates may be backed up in anticipation of Hassett getting the nod there, so we're seeing a little drawdown in rates.
Walter Todd of Greenwood Capital, again, the 10-year, 4.16%, the 2-year, 3.49%. The two CEOs of Netflix are laying out the company's case for acquiring Warner Brothers Discovery after rival Paramount Skydance went public with a competing hostile offer. That word coming today in a memo to employees. Right now, we do have Netflix shares down by 0.9%. Recapping stocks lower, S&P down by 0.1%, Bitcoin down 1.7%, just below $87,000. For on-demand news, 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. As Charlie was just reporting stocks on the downside here today. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu. We're joined by Bloomberg's Tatiana Darrier. Tatiana, what are you looking at?
Well, kicking it off with iRobot shares, a big move here today, down 73%. The company that makes a robot vacuum cleaners filed for bankruptcy, proposed handling control to its Chinese supplier Shenzhen Robotics. This was somewhat expected as they warned about a potential bankruptcy earlier this month, but the company has been struggling ever since its post-COVID era when shares spiked there. It's hit by supply chain issues as well as cheaper competitors. Also in 2022, they saw a deal from Amazon who made an offer that would have turned the company's fortunes, but it collapsed over a clash with EU competition authorities. So a series of unfortunate events here leading to the downfall of iRobot, and shares are down 73% right now.
All right, Tatiana, what's next?
Next is ServiceNow. The company shares are down 10%. Ticker is NOW. Bloomberg reports the enterprise software company is in advanced talks to buy a cybersecurity startup, Armis, in a deal that may be valued as much as $7 billion and would represent the tech company's largest acquisition to date. It's worth noting that representatives from both companies either declined or did not respond to comments, but analysts here are debating this deal. They see the benefits, however, they are calling the price tag quite pricey.
I mean, a tech analyst calling anything pricey, it's like, come on, are you kidding me? We don't even quote it in multiples of earnings or EBITDA, it's multiples of revenue, and 7 to 8 times revenue. Big deal. All right, one more.
And Costco is the final one. The shares are down 2% after Roth Capital Partners cut the company's shares to sell from neutral. This caught my attention as we rarely see a sell rating on anything these days. And the company has 24 buys and 15 holds. The analyst there saying that despite an earnings beat, he flags several underlying metrics are concerning, like renewal rates fading, paid members slowing, and store traffic decelerating on a year-to-year basis. And this is quite interesting given that we've seen sort of, more value-oriented consumers, but apparently it's also a factor of competition with Sam's Club, BJ's Wholesale also seeing a lot more new business. And they see downside to $769, which would represent quite a big decline, more than 10% from where we're trading currently at $869 a share.
All right, good stuff. Thank you so much, Tatiana Darie, covering the movers for us this morning. Stocks on the Move. Tatiana Darie is a strategist for Markets Live here at Bloomberg News. And for more conversations like this, subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. You know what firm is celebrating 100 years?
What?
McKinsey.
Really?
Yeah, it's
All right.
100 years in business. And of course, they kind of invented the modern consultancy business overall. But what's interesting is, of course, the solutions that they tend to prescribe, streamlining and cutting down staff and consolidating is something that they now need to do to themselves.
Okay.
Sridhar Natarajan is Bloomberg News' chief Wall Street correspondent. He's been writing about this. And Sri, this all comes on the heels of a pretty, I don't want to say disappointing, but lackluster 5 years.
And that's probably the best way to describe it, right? When any company that earns $15 billion a year, you can't really look at their performance and say, wow, they're in terrible shape. But around 2021, McKinsey had revenue at the $15 billion mark. Here we are in 2024, 25. By the time this year ends, we're going to be $16 billion, just a little bit over. So they've operated in this narrow band of $15 billion to $16 billion in annual revenue, which is great. Any other management consulting firm would absolutely love to post numbers like that. For McKinsey, it is a sense that their revenue has flatlined a little bit. And you did mention their 100-year celebrations, right? Which 2026, that is when they will turn 100. So they had this annual partner gathering, which also doubled up as this kickoff for their 100-year festivities. And for those who were there, who listened to Bob Sternfels, the global managing partner at McKinsey, the de facto leader, you could sense some plain-spoken bravado. His words to his partners were, "We will kick some ass as we start our second century." He was asking people, are you in for this mission? And those who say yes, I can assure you good times are ahead. Because it is also an acknowledgement that the last few years have been rocky, not just from its standpoint of its financial health, but you have to think about some of the challenges and the controversies that McKinsey has had to navigate. The opioid scandal, some of the criticism over their work in China and Saudi Arabia, and even back home here in the US with ICE, for instance. These are questions that were asked and stuff that McKinsey has had to answer, and it presented an unwelcome distraction. But the bottom line is for this firm is when it looks at its numbers, it does realize, people won't like hearing this, but at management levels, that's how they talk about it. It realized that there was some bloat, and the message that's percolating through the firm right now is it's time to get leaner.
I was interviewing with McKinsey when I was in business school, and like second round, they asked me to get up on a whiteboard and sketch out kind of like a business flow model. I just turned to them and said, "Thank you, but no thank you," and walked out the door.
That's not for me.
Anytime you bring a whiteboard, I'm out of there. I can't think like an. So I went and traded stocks for a living after that. Sri, why has revenue been flat here? Is there some concern that maybe all this AI spending is taken away from other budgets where maybe I don't need the consulting or?
That's certainly the concern on the forward, perhaps. But just in the last few years, the reality of the industry, and McKinsey in some ways is the flag bearer for the industry, but there are perhaps other major consulting firms that are struggling even more. And the fact is that the demand for traditional consulting services may not be as high as it used to be. Companies and clients are getting cost conscious. When your clients are not able to post great revenue growth, the only other lever that they can pull is expenses, and consulting fees are the first ones thrown out the window, right?
Advertising is the first one, I think.
Advertising, then consulting fees, perhaps.
But is McKinsey's solution so out of the box? I mean, at this point, what McKinsey recommends is kind of dogma in corporate boardrooms. You don't need to hire McKinsey to tell you how to do some of these things.
Look, and I think the way you're framing it is just a little bit more of a polite way of some of the memes that you see out there, right? Which is this idea that all that consulting firms do is prescribe, grow revenue, and cut costs. And in the moment it might be funny, but to some extent it is an oversimplification of what they do, because if you look at the list of clients that they've racked up, we talked about them starting out in 1926, university professor who advised a local meat packer, Armours and Company. From that, what they've grown up to, they are the go-to advisor to blue chip companies, from Coca-Cola and Goldman Sachs to everyone else, and also countries that span the globe. And a lot of these people are repeat clients. So you have to assume that it's not as simple as rote advice that they're doling out, because for these big companies to turn to McKinsey again and again tells you that they see value in most of what they do. There might be some extreme cases on either side. One, it might be some undesirable work, and two, it might just be obvious advice. But for the most part, they're clearly doing something that companies value and countries value.
Speaking of countries, you mentioned China and Saudi Arabia. China wants its companies to continue to bring in consultants, but they just want them to be homegrown consultants.
Right, and that seems to be the push in China, which is a good job relying on all of these Western firms to figure out how you need to modernize and be ready to compete on a global scale. But they're also encouraging them now to turn to homegrown consulting firms. Saudi Arabia is a completely different channel. We have a person at McKinsey who estimated that in the prior decades, so 2014 to 2024, McKinsey earned at least $500 million a year from the kingdom, which is either with companies affiliated with Saudi Arabia or the government itself. But the challenge in Saudi Arabia is also obvious. You've seen some of the recent headlines where they're pulling back on consulting expenses. Some of these pie-in-the-sky projects are not working out as they had hoped for. And again, consulting fees are going away. And Saudi Arabia had become one of McKinsey's most important clients globally. So that is obviously also a place where they don't necessarily see a lot of room for rapid growth.
Yep. All right, Sri, thanks so much for joining us. Sri Nanarajan, Chief Wall Street correspondent, now branching out into consulting, it appears, for Bloomberg
The
News.
big banks, the big consultants.
Yeah.
What else is next for him?
He's got them. It's his kingdom. I mean, the guy's covering everything, pushing everybody else out. We got some economic data coming out. All you have to do is hit ECO Go on the Bloomberg terminal, and it's going to be a busy, busy week if you're an economist, as is our next guest, Stuart Paul, U.S. economist with Bloomberg's Economics. We got some jobs data tomorrow, Stuart. We're going to get some CPI data as well. I guess those are the two headliners of the week. Is this going to be good data, messy data? Is it going to tell us anything?
It's definitely going to be messy data. Let's start with jobs, right? So we're going to get 2 months worth of non-farm payrolls, and we're only going to get 1 month of the unemployment rate. Remember, the jobs report is split into two different halves. You have the household survey, where the Bureau of Labor Statistics calls up people and asks, are you employed? Have you been looking for work? Do you want a job? And we're expecting to see the unemployment rate in November notch up to about 4.5%. If we were to have gotten an October report, it probably would have been even higher, closer to 4.7%. But tomorrow, when we get the jobs report, we're expecting to see a November unemployment rate of 4.5%. On the employment side, when we look at non-farm payrolls, we have the establishment survey, where businesses report how many people are on their payrolls. We're going to get both October and November tomorrow. So in October, we're actually expecting to see a small decline in total headcount during the month of October. And it's not because of the government shutdown. It's because earlier in the year, the Trump administration offered a buyout to a lot of government employees that would take effect in September. And as those folks rolled off of government payrolls, it should drag down October non-farm payrolls by about 10,000 workers total. So we're going to see probably a negative October number, minus 10,000. We do expect to see some increase in November, which will also come out tomorrow. But the November number, we're expecting to see about 130,000 jobs added. So very choppy data. We're seeing about 2.5 employment surveys, 2.5 jobs reports tomorrow. And then later in the week, we're going to get CPI, and we're totally skipping through October. So it's a very confusing data mix, and it's going to be relatively low quality and pretty confusing.
Relatively low quality, yet there are those in the bond market that are counting on this jobs report to set the tone for 2026. Why do you think that is? I mean, is that especially given that it will be messy and, you know, to some extent you wonder whether a lot of these numbers will be revised down the road?
They're definitely going to be revised down the road, especially the employment numbers, the non-farm payrolls number and the unemployment rate. Look, folks are looking at these numbers because we've been holding our breath, waiting for these data for months at this point, since October at this point. So everybody's been holding their breath, and it's some of the last figures that we're going to see before everybody goes away for the holiday. And now we're waiting for the next non-farm payrolls report until, I guess, January 9th. So and that'll be the next major item that comes up. So it does, in a sense, set the tone, but it's just because of the absence of other data and how long we've been waiting for this, not because it's necessarily high-quality data.
What do you think the Fed is focused on most these days?
I think that the Fed is focused on labor market risk. So I think that even though it's going to be low-quality data, it's going to be important if we see the unemployment rate rise to 4.5%. That's higher than the Fed was expecting to end the year. It's higher than the Fed is expecting to end next year. So a 4.5% unemployment rate would really be flashing red lights for the Fed that the labor market is deteriorating. Now, when we look at a broad swath of alternative labor market data, we've built an index to just gauge the balance in the labor market. Right now, we see that we're in about the 25th percentile in terms of labor market strength. We're about 2/3 of a standard deviation weaker than we are on average, the U.S. labor market right now. And so when that starts showing up in the official statistics, particularly in the unemployment rate, the Fed's going to be even more on edge. And that's why we actually think that there's a lot more room to cut next year than the Fed is expecting, with just one cut marked in the December SEP.
Yeah, and bond traders are looking for 2 cuts, right? The first coming somewhere around mid-year, the second coming in October.
That's right. We think that there could be twice as much.
Really?
Yes.
Oh, wow. Stuart Paul, U.S. economist with Bloomberg Economics, giving us a preview to tomorrow's jobs report, which covers the month of November. And, of course, CPI later on this week.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We got the S&P 500 index back in the green right now, up 7, little change. Key takeaway at this hour, back to work Monday ahead of the jobs report, a Tuesday jobs report, but the S&P, as I mentioned, up 0.1%. We've got the Dow down 27, decline there of just under 0.1%. NASDAQ down 15, drop there of 0.1%. Our Mag 7 index pushing higher by 0.6%. The 10-year 4.16%, with the 2-year 3.50%. Spot gold now it is trading just a little bit lower, down under 0.1%, down $2 the ounce, 42.97 there. West Texas Intermediate crude oil down 1.3%, 56.68 a barrel. And the decline for crypto today, we're looking at Bitcoin down 1.6%, just above 87,000 now, 87,040 on Bitcoin. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pello, thank you so much. We appreciate that. We have Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Can we put a bow on 2025, Scarlett, do you think?
I feel like a lot of participants in the market have.
Okay, yeah, exactly. It doesn't feel like there's a lot of energy out there. So maybe it's time to start thinking about 2026. Let's do that with our next guest, Louis Navellier, Chairman and Chief Investment Officer at Navellier and Associates in Manalapan. No, not Manalapan, New Jersey. Manalapan, Florida, which I just
There are
Googled.
multiple Manalapans?
Yeah, everything starts in New Jersey. So you go out to the kids out in Silicon Valley. Menlo Park. Where did that come from? You guys didn't come up with it.
Garden State.
That's New Jersey. It's near New Brunswick. Sand Hill Road. It's like the Wall Street of Silicon Valley.
Yeah.
Where did Sand Hill Road come from? New Jersey, right near New Brunswick. So I take all the tech snobs out there and say, sit back, kids. It all started in the in Princeton area. Louis, talk to us here from Manalapan, Florida here. What's the 2026 outlook?
Looks great. I mean, we just had the strongest sales in 3 years, the strongest earnings in 4 years. We have the biggest earnings surprises in the past 4 years, so that means the analysts are revising their estimates higher now. I do have a criticism. The market is still narrow. It's tight. I got to be in the top 10% of my models. I also noticed, I test my models at the end of each quarterly earnings season. I did notice that a lot of crap rallied last quarter, a lot of short covering. That is usually not a sustainable rally unless they start to revise estimates higher. We're still priced for perfection, so everybody has to be. That's what Oracle and Broadcom just discovered. So, but I feel good. I mean, I think we're going to hit 5% GDP growth. We're 3.6 now. With incredible trade numbers, they're going to revise the GDP higher. Obviously, things are broadening out next year. All the data center companies, their orders are up 20% quarter over quarter, up 50 to 65% year over year. So it should be wonderful. And the Fed now is finally joining the party. And we got at least, I think we need 2 cuts. I think they need to go from restrictive to neutral. And obviously, we'll have a new Fed chairman in May.
Yeah, and right now the bond market is pricing in 2 rate cuts. Stuart Paul of Bloomberg Economics thinks it could be double that in 2026. Louis, you mentioned Oracle and Broadcom and how they realized that there is some reality to realistic expectations to their earnings. What is your take on the AI trade? I mean, is it time to pull back exposure before potential bubble popping, or is it time to double down on this technology?
I would back up the truck. NVIDIA's forecast sales and earnings are still accelerating, and that was before they got the permission to sell chips into China. AI appliers like AppLovie and Palantir are phenomenal results. The data center boom is real. It's unbelievable. And, some people say we won't have enough natural gas to power all this and all, but that's just not true. The natural gas companies can buy a fuel cells from Bloom Energy or buy their own turbines and power their own data centers. That's what Musk is doing with Grok in Memphis. He literally has turbines outside the data centers running off natural gas to power everything. So I'm very excited. I think I just think everybody's got to cheer up. Next year is a political year, so one side will try to throw mud on the other side, and I guess President Trump will pretend he's in a campaign again and run around with his head cut off. But you know, he's got a lot of cheerleaders. He's got Scott Bassett, who does a wonderful job. He's got Kevin Hassard, who I assume is going to be the Fed chairman. I know Jamie called for Mr. Walsh the other day, but Kevin Hassett is the happiest person on the planet. So we've never had a happy Fed chairman. This will be interesting. And Howard Lutnick's a great cheerleader for America. Most commerce secretaries are, you know, but Howard's, you know, I'm surprised he doesn't have pom-poms when he talks, you know, so.
How important is that one big, beautiful bill and impact on the economy in 2026? A lot of folks are calling that out as a real tailwind.
Yeah, when you put money in people's pockets, they spend it. It's as simple as that, you know, and he's still trying to get gas prices down. Obviously, we got, based on the oil and tankers, we're up 24% year over year. So obviously, oil's not going to go up until we get rid of that. It is going up in California because they're losing another refinery, and 20% of California gasoline will be imported from Korea or even farther away. And it's unfortunate California has their own fuel standard, so they just can't get gasoline from other places. So California won't benefit from that, but everybody else in America will.
Yeah, California, arguably the one that needs to benefit the most given how high gas prices are there. Louis, really appreciate your joining us on this Monday morning. Louis Navellier is Chairman and Chief Investment Officer at Navellier and Associates, talking to us about the markets. And of course, we ended with oil prices, so that's where we want to go next. Vincent Piazza is Bloomberg Intelligence's Senior Equity Research Analyst, and he's going to give us an outlook for oil and gas on where things stand in 2026. And Vincent, we know that Louis was saying that crude oil prices will likely, you know, be fairly kind of soft until global demand picks up. What is the outlook, first of all, for demand in 2026?
Well, so when we recently issued our natural gas 2026 outlook, and from our perspective, we are definitely more constructive on natural gas commodity relative to oil, and there are three key drivers for natural gas in 2026. Number one, we have structural demand growth, and that's from LNG exports and also pipeline exports down into Mexico. We have what the other presenter hinted at was AI demand growth. That's also a strong structural growth driver for 2026. The demand side is really quite clear. It's really the production side that is running a little hotter this year versus last year, and that is our biggest risk to our 2026 call. That's the first key driver. The second key driver is relatively robust free cash flow yields as balances tighten. So there is a great deal of cash flow sloshing around for this group. They're trading right now somewhere around 9% free cash flow yield. That gives them a great deal of optionality, and where we think that optionality is going to be targeted, aside from base and supplemental dividends, is really M&A. Natural gas M&A lagged oil M&A. We think that turns in 2026. We saw the first real big hint of that in 2024 and 2025 when Expand Energy was created via the seminal acquisition combination between Chesapeake and Southwestern Energy. That created a Goliath, the largest natural gas operator, natural gas producer, independent producer in the lower 48. We think that'll drive incremental M&A, because the biggest central theme for us in 2026 is concentration via consolidation. We think that continues for the natural gas operators as it did for the oil-centric names in 2025.
All right, I'm looking at WTI crude oil here, 56 and change, and I know from watching season 2 of Landman that they're not happy with that. What are the folks down there in domestic production? What do they do with oil around these prices here?
They don't grow. We think production has peaked. We think you will see a change in sentiment as we see more focus on natural gas relative to oil. What is interesting for the natural gas producers, as you produce less liquids, so less crude, you also produce fewer molecules of what's called associated gas. That's great for the natural gas guys because that means balances tighten. So when you think about relative prices, that's a net benefit for the natural gas producers relative to the oil producers, since associated gas is roughly, call it 1/3 of total production of natural gas. So lower oil, actually good for natural gas.
Which nat gas players are best positioned? I know Bloomberg Intelligence doesn't do buy, hold, sell on individual companies,
Right.
but surely there are
Right.
some that are
Oh,
more
absolutely.
attractive than others.
Yeah, absolutely. So again, on this central theme of concentration via consolidation, Expand has really gone out there and created a dominant player into the central basins, EQT as well. Those are the two key names for 2026, given their size and relative importance in the market, not only in the lower cost basin of Appalachia in the Northeast, but also near seaborne export markets around the Gulf, around Haynesville as well. So Expand, EQT, those are two names that we have focus ideas out for 2026. You can take a look at that on the terminal within the Bloomberg ecosystem.
Nice. What's the OPEC Plus doing these days? How much do we care about those folks if we're a net exporter these days?
They are still the dominant player, the dominant governor of oil markets. They will still drive 2026 supply balances. From the demand side, we think we are past that peak growth demand. Here in the U.S., we pumped out roughly 13.6 million barrels per day. We think we're past the peak there as well. In fact, the other central theme that we talked about for the oil players is really capital discipline. You're going to hear a lot more of that, similar to what we talked about in 2024 and 2025. Investors, what your guys are telling people, Paul and Scarlett, is we don't want to see the production. We don't want to see a higher spending. What we really want to see is that free cash flow coming back to the investor base. All that sunk capital during the initial stage of the growth in shale, we are now at a maturity phase. We want to see those higher dividends. We want to see the base dividends. We want to see supplemental growth in dividends, with buybacks taking a little more of a backseat in order to clean up any equity issuance via M&A market.
Vincent Piazza, Bloomberg Intelligence Senior Equity Research Analyst on oil and gas. Thank you so much for joining us with his 2026 outlook for U.S. nat gas E&Ps. Paul, does Landman talk about OPEC Plus?
No.
Doesn't come up.
No, they're wildcats. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are wavering as bond yields fall in the run-up to tomorrow morning's jobs report. Yes, a Tuesday jobs report. Right now, the S&P 500 index back in the red. We're looking at a loss right now with the S&P 500 index declining. S&P little change to lower, down now by about 0.1%, down 768.19 where we stand on the S&P. And to be sure, close to a record. Dow Industrials down 69, drop there of 0.1%. NASDAQ Composite Index down 78, a decline of 0.3%. While stocks are lower, most stocks lower, the Bloomberg Mag 7 Index is advancing. That index now by about 0.4%. 10-year at 4.17%, the 2-year 3.50%. Gold lower, little change, down 0.1%, 42.93 the ounce. And West Texas Intermediate crude down 1.6%, 56.51 for a barrel of WTI. Bitcoin now at 86,400. Bitcoin down by 2.3%. As we have been reporting, jobs report next up tomorrow morning, 8:30 a.m. Wall Street time. Yelena Sholyetyeva is senior U.S. economist at the Conference Board, and she told us tomorrow morning she'll be focused on the unemployment rate.
So I think payrolls number by itself is less important given all the supply changes in terms of the supply of workers. But the unemployment rate is the key statistic here. And I think that continued increases in the unemployment rate, even if it's like small increases in the next few months, will push the Fed hand.
Yelena Sholyetyeva of the Conference Board interviewed on Bloomberg Surveillance. Yes, we'll have complete coverage of that number as it drops tomorrow morning, 8:30 a.m. on Bloomberg Surveillance. Teradyne shares higher after Goldman Sachs upgraded its recommendation to buy from sell, seeing AI-driven demand uplift for the manufacture of chip testing equipment. And ServiceNow and Adobe downgraded to underweighted. KeyBank, which sees AI tools bringing a bigger hit to both software firms. Recapping, S&P lower by 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pello, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube as well. You know, we love the big take stories. These are really interesting topics. They are deeply researched, deeply sourced, and get a lot of resources, and they are just awesome. And a lot of cool graphics for people like me who likes graphics. This one's a good one. A shadowy global network to help Trump make millions in meme coins. I can't follow all of the places and exposure that President Trump and his family has in the crypto space, but I know meme coins is certainly one of them. So let's check in with the author. Zeke Fox, investigative reporter for Bloomberg News, joins us live here in our Bloomberg Interactive Broker Studio. Meme coins, President Trump and his family, what's the story?
Yeah, so during his first term, just a couple years ago, Trump was calling crypto a scam. But as he prepared to take office this time, he and his family started 2 big crypto ventures. And for this story, I went deep on kind of the silliest one, which is the Trump and Melania meme coins.
I forgot about that one. Okay.
Yeah, so this was on the eve of inauguration. The president and then his wife both announced they were creating new cryptocurrencies that didn't do anything at all. And these are like transparently useless. It's kind of like a gambling game. And at the time, this was really hot in crypto. So many people dived in that on paper, for just a second, the Trump meme coin, the Trump family had $50 billion of holdings of this meme coin. But this is a crypto world where things can go poof overnight. The best estimates we found from Chainalysis and Bubble Maps, 2 crypto research firms, were that the Trump family made about $350 million of real profit on these meme coins.
Wow. Who helped them market these coins? Who helped them, presumably profit off of that? That's the gist of your story. And was it a difficult question to answer?
Yeah, like on the one hand, the whole thing sort of happened in the open, and it felt like there was we sort of knew what happened. On the other hand, as I tried to dive in and figure out who was behind this, it was really tough. You'd think that people might be proud to say that they'd helped the president with an important business venture, but really nobody was talking. The trail took us in a very convoluted way, but it ended up with a guy who uses an icon of a cartoon cat wearing an astronaut suit on Twitter.
Okay.
He goes only by Meow, and he runs a crypto exchange, or he was the co-founder of a crypto exchange called Meteora that was actually home to a ton of these giant meme coin launches. And all of them, or most of them, seem to follow this pattern where they'd go up a lot on hype when they got announced and then soon crash. And we were trying to figure out, you know, who knew what when. And the trail took us to Istanbul, to Singapore. You got to read the story to see how close we got.
So, is the Trump meme coin still in existence?
Yeah, these things like never really die, but there's no excitement around it anymore. The price is down about 90% from its peak.
Where do I find the price?
You know, their CoinMarketCap is a pretty big crypto tracking site. But one funny thing we found in reporting this was talking to meme coin traders. A lot of them said that Trump actually killed this boom. Like for a while, we were all having a lot of fun trading these meme coins, but the Trumps made so much money off theirs that the gamblers in the casino were like, you know what, we've emptied our pockets. We're done with this. Bring on prediction markets. We need something different to gamble on.
So are meme coins, they've peaked already? They've died? Or, I mean, they're still there, but no one's making money off of them the way they used to.
Yeah, it's a little bit like if you remember the NFT bubble, the digital crypto art. For a minute, it's hot, and people are making good money. They're telling their friends. And then at some point, people just... it crashes and people move on. So a lot of the same people who were in on NFTs got in on meme coins. And while this was running, it was a great business. We talked to one 22-year-old who started one of the biggest meme coin creation and trading apps. His company, which just had a few employees, generated $1 billion during this meme coin bubble. But now a lot of the people who are excited about meme coins have moved on to prediction markets, where the Trump family has its own interests as well.
Yeah, Don Jr., right, has some pretty big stakes, or has a pretty key role in some of the companies.
Yeah, he's an advisor to both Kalshi and Polymarket, the two big prediction markets. And then the Trump family's social media platform, Truth Social, has announced plans to create its own prediction market. But it's kind of a pattern where the Trump family has these business interests in this kind of gray area market, and then the Trump administration is creating rules that are legalizing these markets and helping make them grow.
Has President Trump or his family or his administration commented on your story or about the meme coin part of it?
So the press secretary got back to us, not really getting into the specifics, but just saying, hey, the Trump family would never engage in conflicts of interest, but not really addressing how they manage having interests in both the business side and being in charge of drafting the rules.
And I guess no one cares anymore?
I'd like to think that people still care, but you know, when it came, normally you have, like, let's say this was the stock market and somebody created like a penny stock that went up, you know, 1,000x and crashed. Right? Yeah, somebody would be diving in, they'd be digging through people's messages, they've been trying to figure out what happened. Meme coins, a few weeks after Trump was elected, the SEC put out a statement that basically said, not our business. Okay. Nobody has stepped up to look into these yet.
All right, very good.
There's the answer to your question, Paul.
Yeah, there's the answer to my question. I think maybe the definitive report is your article here. Zeke Fox, investigative reporter for Bloomberg News, joining us here in our Bloomberg Interactive Brokers studio. Again, you can read this big take story on the Bloomberg terminal and at bloomberg.com/big take. So you can read Zeke's article as well as all the other big take stuff. And again, every day they come out with just blockbuster stories, really well sourced as well. We appreciate that. S&P down 12. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube, so check us out there. I'm looking at the 10-year yield down a little bit here. We're down at 4.17% here. Looks like the Fed is in a rate-cutting mode. That should benefit a number of industries, including the housing market as well. So let's check in on that. Drew Redding, he's the home builder analyst for Bloomberg Intelligence. Drew, what's your 2026 outlook for the home builder segment there, the folks that are out there building the homes? Will lower interest rates, will that help their business?
So we actually think that 2026 is going to be another challenging year from a fundamental perspective for the builders. If you think about the weakness that we've had in demand over the last several quarters, it leaves much of the group coming into the year with backlogs that are down anywhere from 10 to 40%. And that's ultimately what translates into revenue over the next, call it 3 to 9 months. In addition, I think you're going to see further pricing pressure as builders look to adjust prices to meet market demand. So we're going to have further base price reductions. And I think builders are going to have to continue to lean on incentives because it's something that home shoppers have become accustomed to. And, they're looking for deals when they're out there in the market. So, slow top line growth. And I think that incentive dynamic is also going to continue to pressure gross margins as we get into next year. On the positive side, we do have lower rates. So I do think that orders can grow next year. We're looking at a 6.25 rate, call it right now. Last year, we're almost 100 basis points higher heading into the spring. So lower rates and community count growth could support orders, but I think that revenue and margins are going to be down this year.
What's the relationship historically, Drew, between new housing and existing home sales?
So the new home market is historically about 15% of overall housing transactions. So a much smaller piece of the market. They've performed vastly differently over the last couple of years. If you look at the existing home market, we've been bumping along a 4 million annualized run rate of home sales for about 3 years now, and that's about 20% below normalized levels. So there's been a lot of pressure because the mortgage rate lock-in effect, affordability. We have seen an improvement in demand in the resale market as rates have come down. We're looking at purchase applications, which is the most high-frequency data point that we have. So we have seen some improvement, and we think, looking into 2026, you could see growth in the resale market anywhere from 5 to 10%, call it. But keep in mind, that's off a historically low level.
Has the tariffs impacted the new home building market? I'm thinking lumber and all the other materials used in building a home. Has that had an impact on the profitability?
Yeah, good question. To this point, it really hasn't. We've heard from a number of builders who haven't seen much of a cost increase in 2025. I think you could see as you get into 2026 that become more of a problem. We did an analysis that looked at all the tariffs that have come through in it, and it shows that there could be a $10,000 cost increase per home as it relates to tariffs. Now, when you think about who's likely to feel that the most, it probably won't be the large single-family production builders. They've got a lot of scale, they've got a lot of leverage, and they've had success in pushing back against their suppliers. I think you're more likely to see the pinch among smaller private home builders who just don't have that scale and ability to push back. So to this point, it hasn't had a big impact, but I think that's something you need to watch as we look into next year.
Are they still building like crazy down there in Florida and Texas and Tennessee and those kinds of states?
Yeah, that's a good question. I mean, during the pandemic, that's where a lot of people were flocking to. There was a lot of construction down there. If you look at inventory levels now in the South, they're actually at the highest level on record. Wow. So that's where we're seeing a lot of the weakness in the new home market. There's so much inventory. Builders have had to get increasingly aggressive on prices, to move inventory. A lot of incentives in the market, a lot of base price reductions. So that's really where we've seen the weakness. And if you contrast that to some of the stronger markets, it's really a tale of a couple of regions. You have the Midwest and the Northeast, which tend not to be boom markets. We didn't see the same type of inventory growth there, and you're seeing a lot more price stability. On the other hand, you mentioned the South, but you also have the West, where there was a lot of inventory growth, and we're seeing similar pricing pressure.
So is there still a housing shortage in this country? And if so, how does it right itself?
Yeah, another good question, and one that's frequently debated. Just to take a step back, you'll hear estimates of anywhere to 1 million to a 5 million unit housing shortage. But I think it's a more complex answer in that the shortage, so-called shortage, is probably more at lower price points. So there's a mismatch between where there's theoretically demand, which would be at lower price points, and what's available out there in the market. So it's really affordability problem that's holding things back. Now, how do we get? I mean, the government has talked about all sorts of things in order to boost production and help builders to build more homes at reasonable prices. Whether it's dangling carrots in front of local municipalities to get them to reduce their regulations. Whether it's trying to knock down the price of building materials. There's a lot of different things, but I don't really think that there's necessarily any one single silver bullet that's going to solve this problem. I think at the end of the day, you have home prices that are up, more than 50% since 2019. And I think we need to let kind of the basic laws of supply and demand kind of take course in order to right that.
Right. All right, Drew, thanks so much. Appreciate it. Drew Redding, home building analyst for Bloomberg Intelligence. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment, with the S&P down 9 points, the Dow off 100, and the NASDAQ off 80 points. More coming up. This is Bloomberg.
I'm Steve Kathan. New developments in the deaths of Hollywood director and actor Rob Reiner and his wife, Michelle. CBS's Jonathan Vigliotti reports one of the couple's sons is held.
CBS News has confirmed Nick Reiner is now in police custody. The 32-year-old was booked early this morning around 5 a.m. What exactly transpired in the household behind me and Nick Reiner's role in it at this hour is still unclear. The LAPD very early on into this investigation declared it a homicide investigation. Beyond that, though, they have remained very tight-lipped. TMZ is reporting, and CBS News has confirmed through one source that it was the daughter of the parents that discovered their bodies yesterday.
I'm Stacey Lynn at the White House. President Trump posted on Truth Social about the tragedy, suggesting that the famous Hollywood director and actor's political views contributed to their deaths. Without giving any evidence, he wrote the two reportedly died, quote, due to the anger he caused others with his Trump derangement syndrome. Reiner was a very outspoken critic of the president.
In Massachusetts, Brian Walsh has been found guilty of murdering his wife, who's never been found since disappearing almost 3 years ago. Correspondent Jared Hill is in Rhode Island covering the manhunt for the shooter at Brown University, where 2 people were killed over the weekend.
What we know at this point is that they're saying there isn't a ton of video evidence in or around the school where this happened, and so that's why they're asking for the public to come forward with anything that they might have that could help figure out who this person is and where they might be. Just yesterday, one of the officials said that they're not sure if this person is in the city of Providence, if they are in the state of Rhode Island, where they are at all.
Australia's Prime Minister vows new gun control after the deadly mass shooting targeting a Hanukkah celebration. Vanessa Miller was there and during the chaos lost contact with her 3-year-old daughter, who was not harmed.
I was screaming out, my baby, my baby, my baby is there, my baby Gigi is there, my baby Gigi. Everyone's like, stop screaming, he's going to get us, he's going to hear us, and I don't care, I've got nothing to lose, I've got to go, I've got to go, I've got to go.
4 alleged members of an extremist group suspected of planning bombing attacks in Southern California have been arrested. CBS's Jim Krasula.
The 4 were taken into custody in a desert valley east of Los Angeles last week. Investigators say they were preparing to test improvised explosive devices for planned bombings. They are said to be members of an offshoot of a pro-Palestinian group. The 4 allegedly plotted to set off a series of bombings on New Year's Eve and target ICE agents and vehicles.
And checking Wall Street, the Dow is down 104 points. The S&P is down 9. This is CBS News.
a new record for a Christmas kiss.
I should be playing in the winter snow, but I'ma be under the mistletoe.
1,435 couples made like Justin Bieber to set a new world record. They kissed for 5 seconds underneath the national mistletoe in Washington, D.C. to notch a spot in the Guinness books. That breaks the old record set by 480 couples who locked lips under the holiday shrub at an Anheuser-Busch-hosted event in St. Louis in 2019. The downtown D.C. Business Improvement District organized the new record breaker 30 feet below a 10-foot sphere of greens, blooms, ribbons, and a jingle bell. Deborah Rodriguez, CBS News.
Merriam-Webster's word of the year is slop. Nowadays, the meaning has expanded to include digital content of low quality that's produced in quantity by means of artificial intelligence. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Heading for the cliff. With only 5 working days to go, welcome to the Monday edition as lawmakers return to Washington with a last-ditch effort in the House this week to keep healthcare premiums from rising. And we'll get the latest when we talk to Nathan Dean at Bloomberg Intelligence. He's also tracking pot stocks. And as President Zelensky gives ground on joining NATO, we'll look at Ukraine peace talks underway now, day 2 in Berlin with our political panel. It's all after a look at Wall Street. Let's start there now with Charlie Pellet. He's got the read on the markets and the Monday trade from World Headquarters in New York. Charlie?
Hi, thank you very much, Joe Matthew. And here's what's going on. We are looking at a down day right now for the Dow, the S&P, NASDAQ. Red on the screen, back to work Monday. And guess what? This is the last full week of trading, before the new year. Christmas next week. S&P right now down 8, drop there of just about 0.1%. Your Dow Industrials down 0.2%, down 80 points now. NASDAQ lower by 75 for the NASDAQ Composite Index, down now by about 0.3%. Stocks have been wavering. We did see gains earlier in the session. Bonds rose as Wall Street gears up for key economic data that will help shape the Fed rate outlook. Of course, we got a jobs Tuesday tomorrow morning, 8:30 a.m. when the number drops. And yes, even though it's November data, complete reaction right here on Bloomberg Radio. 10-year, 4.18% with a 2-year, 3.51%. Gold is down $5 the ounce, down 0.1%. Spot gold, $42.94 the ounce. West Texas Intermediate crude, $56.61 a barrel, down now by 1.4%. And Bitcoin down 2.5%. 86,313 on Bitcoin. So next up, as I mentioned, the jobs report, 8:30 a.m. Wall Street time. Kate Moore is Chief Investment Officer at Citi Wealth. She was the guest this morning on surveillance.
You know, we're in an environment where people have had a good risk-on year, and they're starting to get a little bit antsy about their overall positions. I would classify sentiment as kind of tepid at the moment, and you've seen this in terms of some of the rotations happening in the market in this final month of the trading year.
Kate Moore of Citi Wealth interviewed on surveillance. Confidence among U.S. home builders edged up in December as builders continued to deploy sales incentives to motivate potential buyers. Lennar shares, case in point, they're trading lower, down 0.2%. Toll Brothers, the luxury home builder, up 1.2%. KB Home down by 0.9%. Recapping stocks lower. S&P down now by 0.1%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, thank you so much. Good to see Charlie Pellet. Always reassuring to hear the voice of Wall Street and the New York subway here. Welcome to the Monday edition of Balance of Power. I hope you had a great weekend. I know it was probably cold if you were anywhere near the Amtrak corridor in Washington, D.C., although it's even cold down south, right? This is a tough moment here as we count down to the holidays and the cliff. We've got a lot to cover here on Bloomberg Radio, satellite radio, channel 121. Are you already on the way home? You can stream us live on YouTube by searching Bloomberg Business News Live and watch us on Bloomberg Originals on your Bloomberg TV. I'll get to the podcast eventually. So here we are with 5 working days to go. We're going to spend A chunk of time this hour talking about what Congress might, or, well, I guess what everyone says won't be able to do to keep your healthcare premiums from going through the roof a couple of weeks from now. It's the 15th of December. We have till the 31st to figure it out, but it's not really like that. There are 5 working days left for lawmakers to figure out a plan here, and we are going to see likely some votes in the House this week. We'll get there with Nathan Dean as we make our way through the hour a little bit later from now. Looking at the president's schedule today, we might see him, we might not. He's certainly been busy on Truth Social, but there is a 3 o'clock event in the Oval Office as he participates in what they're calling a Mexican border defense medal presentation. Right now, that could open to press, and if it does, expect a lot of headlines because the president has potentially much to make news on here. He's got a couple of Christmas receptions this evening, having taken to Truth Social earlier to talk about the killings of Rob Reiner and his wife, knowing that there has now been an arrest in that story. We're going to talk about that in a moment with Miles Miller, who's, of course, focused as well on the mass shooting at Brown University. I'll tell you what, this is a tough day in the news department here. And, you know, we try to be a little bit different at Bloomberg. As we talk policy on this program, we try to talk to investors about where they meet in the middle here between Washington and Wall Street, but sometimes we're stopped down by tragedy, certainly when the commander-in-chief gets involved, and that has been the case here. You saw Kash Patel and other authorities in Providence, my old haunt of College Hill in Providence, Rhode Island. And of course, the president was weighing in as well, as they apparently jumped the gun on a suspect here. A manhunt for the shooter who killed 2 students at Brown University is now in its 3rd day. Authorities released a person of interest earlier, and we heard from the mayor of Providence, Rhode Island, Brett Smiley, last evening about this. Listen.
Shortly, we will be releasing the person of interest who had been detained earlier today, and the Attorney General can speak a little bit about the rationale for that, but we want to inform the community that that individual will shortly be released from Providence Police.
So we're back to the drawing board and have been now with day 3 upon us. Miles Miller is covering this for us as Bloomberg's senior national security reporter. Miles, where are they looking and what comes next?
Right. Right now, they're focused on piecing through who the suspect is and what steps he took to get to the campus, and also how he made an effort to leave the campus. What we know right now about the investigation is that they're going to be doing an investigation into any forensics they could have found in that building where he opened fire on students, or the suspect, I should say, opened fire on students, or on any of the shell casings left behind. And then they're going to be doing sort of a really detailed look at what path he took to leave campus. What we know is that what led them to that suspect who had been released was a tip into the FBI tip line that said, here's a person who, had weapons in a hotel room. They interview him and realize this is not the person. What this has done is complicated matters because they had put all their efforts into that one person, and now they have to take those efforts away and start focusing on, okay, what are the pieces we didn't look at thus far? But this definitely complicates the matter. It bears striking resemblance to what happened in the case of the person who shot Charlie Kirk in Utah, right? They zero in on a suspect immediately. In that case, put a person's name out and then had to backtrack. So this is the second time that the FBI has had an issue like this. And again, who was out front? The FBI director out front talking about a suspect being captured within 24 hours.
Well, yeah, you point us to it. And of course, Donald Trump was listening to his FBI director, Miles, and there were 2 posts on the 13th. One said, I have been briefed on the shooting that took place at Brown University in Rhode Island. The FBI is on the scene. The suspect is in custody. That was at what time? 1744. About 15 minutes later, Donald Trump, the Brown University police reversed their previous statement. The suspect is not in custody. Is he throwing Brown police under the bus here? Was it not Patel who was behind this?
Right, and it also relates to what kind of information they're getting real time, right? FBI Boston told me that they were involved in the investigation almost immediately. FBI Boston has jurisdiction over Rhode Island as well. and you start to think, what information is being given to the president and to the director, and what resources are they actually surging up there? I'm dealing with sources in the marshal's office, and they were there as part of the apprehension of that suspect, but something felt off. As I was speaking to some of these law enforcement officers, something felt off about this apprehension, so much so that folks were being hands off. People who would usually want to take credit for being part of an apprehension, saying, listen, this was the FBI, this was Providence Police, we're going to leave it with them. So that was sort of an indication that maybe, something wasn't tip-top there.
Boy. What's going to happen next in terms of briefings, Miles, in this investigation? I'm assuming that they're going to want to stay in front of cameras and microphones until this person's found.
Right. I mean, and they've tried to be as transparent as possible. Every time I'd reach out to Providence Police Department, they'd say, we're going to have a press conference literally in 5 minutes. The mayor's going to speak about this. We had the Rhode Island Attorney General come out last night and say, we released this person because, there's not enough probable cause to hold them. And there's nothing linking this person directly to what happened. Usually, you do not see that level of transparency, and so we've reached out to get more of the background of just how this all came about. And this could be as simple as someone went into that hotel room, saw that there were weapons there, and called in and said, hey, connecting weapons and what happened, and putting two and two together, and that could have led to what happened there. But it's highly unusual.
I started by talking about the doom scroll this morning, Miles. It's palpable. We've got the situation in Australia, of course, here on the first day of Hanukkah. We've also got a very busy FBI. Pam Bondi says that they just foiled a planned New Year's Eve bombing campaign in Southern California. What do we know about it?
Yeah, so just that story we broke on the terminal earlier today. Pro-Palestinian group is what sort of the way that they are terming it, anti-government group. What we learned is that they were planning, allegedly, to attack places in Southern California around New Year's, and if that's not sort of alarming enough, they also plan to target ICE agents and vehicles. This group is called Turtle Island Liberation Front, a radical pro-Palestinian and anti-law enforcement group, as well as an anti-government offshoot. What was most alarming to law enforcement was that they were doing detonation of explosive material practice in the Lucerne Valley, and that is what tipped off law enforcement. They start doing the work on it, figure out that there's a person in New Orleans who's connected with it as well. We're told that there's a nexus to Massachusetts, and that there were some arrests that were supposed to be made there as well. This was just announced in the last hour in Los Angeles, but it really gets at what they say is what the president has wanted: investigations into what he finds as radical extremism, but it's mainly what they say is on the left. That is what the first assistant U.S. attorney said today, is that this is exactly what the president called for and what they want.
Wow. Miles, thank you. He's got his hands full today. Miles Miller, our national security reporter here at Bloomberg. It's great to have you back with us, Miles. The president also posting about the murder of Rob Reiner and his wife in a truly remarkable way that we'll talk about later on in the broadcast. I'm Joe Matthew in Washington. Nathan Dean joins us next as we turn to Capitol Hill and your healthcare premiums. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got stocks wavering, bonds rose as Wall Street gears up for a key economic report tomorrow morning, the jobs report, and that will help shape the Fed rate outlook. Here's where we stand ahead of the report right now. Stocks did open higher, moving lower now, down 11, wavering. Right now we've got the S&P down 0.1%, Dow Industrials down 111, down 0.2%, NASDAQ Composite Index down 93 for NASDAQ, a decline of 0.4%. Interestingly, on a down day for tech, on a down day for much of the market, the Bloomberg Mag 7 Index is higher by 0.2%. The 10-year at 4.18%, the 2-year 3.51%. Spot gold down under 0.1%, 42.96 the ounce, and West Texas Intermediate crude oil down 1.4%, 56.62 a barrel on WTI. Bitcoin down 2.5% now, 86,282 on Bitcoin. iRobot shares are plunging. The stock is down 72%. iRobot has failed for bankruptcy and proposed handing over control to its main China supplier. The company's common stock will be wiped out under the proposed Chapter 11 plan, which will allow iRobot to remain as a going concern. iRobot shares down now by 72%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Back we go to Washington, and once again, your host here is Joe Matthew.
All right, Charlie, we thank you. Charlie Pellet in New York. We'll have more in just about 20 minutes on the Monday trade, which has seen pot stocks lose the hot sauce, and we're going to talk to Nathan about that in just a moment, because look at this. Here we are, last full work week, or the last work week period of the year for Congress. And you're not surprised to hear that. The problem is the to-do list remains quite long if you care about health care premiums and the rest. So we're going to talk about Nathan here, talk to Nathan about all of this coming up with our eyes on new research from Bloomberg Intelligence that pulls us into the farm aid debate as well. This was not the most productive Congress of all time if you haven't been keeping track on your home game. Just last week, Speaker Mike Johnson talked about the need to address health care reform, the expiring subsidies at the end of the year, and Democrats call for more of the COVID-era enhanced subsidies that are just about to go off a cliff. Listen.
When the Democrats talk about health care affordability, okay, this catchphrase that they are talking about one thing and one thing only. They are talking about continuing handouts to big insurance companies. They have no ideas, they have no desire to fix the broken system they created. They just want to subsidize it. And subsidy is a big word. It means they're taking taxpayer dollars and funding a broken system.
Is subsidy a big word? I don't know. If you have a terminal, maybe. Nathan's with us to pull us back from the ledge. It's not a branded fleece today, but it is a quarter zip nonetheless. It's really cold out.
Yeah, my fingers are killing me.
I mean, forget the house, getting out of bed today is the hard part if you're anywhere between Washington and New York.
And we have football practice tonight, so we're going out there.
Do you really?
Yep.
It should be made indoors, sir.
Oh, the 9-year-olds, they love it. They're
America's dad says, get out there and do some laps. He's, of course, Bloomberg Intelligence senior U.S. policy analyst, and we actually have a lot to cover today with 5 days left. So fly out is Friday, I presume. So there's your 5 days. And you read any of the tip sheets, Nathan, you read the smart analysis, you listen to Rick and Jeannie on this program or any of the columnists at Bloomberg Opinion, and they all say it's too late, we're going off a cliff. But there is going to be some important votes that take place in the House this week. It could, and of course, one of them depends on a discharge petition. Could any of them keep this from happening?
Well, you notice how over the weekend the definition of cliff changed, yeah, I think so, because some of the remarks from the Republican lawmakers over the weekend started talking about January 15th, and that's the date when open enrollment ends. Okay. And they started talking about January 31st. That's when the next, funding bill has to get decided upon. So it's almost like this recognition that nothing's going to pass this week, and the number one plan is to do something so that we can get out of town. And so I think what happens here is you're going to see a series of votes. None of it really has chance of passage. My colleague Dwayne Wright continues to use the words like long odds and skeptical, because at the end of the day, the Republicans have a lot of different ideas, from just extensions to also, just widespread changes to Obamacare. And at the end of the day, the only person that's going to be able to get the Republicans on board is President Trump, and he's not involved in this debate. So I think we're just going to go through the motions, and then you'll see a little bit of this again, I think, in January. But when Congress comes back in January, it's all about the funding bill that has to keep us open through January or past January 31st.
And then at that point, do we presume that there will be something that looks like the discharge petition, maybe extends Obamacare subsidies for a year, puts on new eligibility requirements, and the rest deals with pharmacy benefits managers? Would that all happen then? And what about the month that would be lost? Is it retroactive?
To be determined. I mean, obviously, I think what happens here is that this can go out in a variety of different scenarios. I mean, some of this discharge petition talk also includes languages that Democrats aren't exactly on board with. If you talk to Minority Leader Hakeem Jeffries, he even just said over the weekend that this is not, some of these ideas coming from the Republican Party don't really fix the underlying issue with the subsidies. So again, we'll have to see how January plays out. But at the end of the day, this is a really interesting point from the political science perspective. There's always been talk of it's easier to put subsidies and benefits on, harder to take them off. Well, it sounds like we're going over the cliff, and so we're going to have to see politically how things play out in January, because we got an election in November, and a lot of people are going to be paying attention to that.
Boy, amazing to think that we're talking about this with regard to a discharge petition. Is that the only way that gets to the floor in the meantime this week, if they get the signatures? Because the Speaker Johnson has said he would allow a vote. Maybe it's in the form of an amendment, but that's all bound up in politics as well.
Absolutely. I mean, there's a variety of different ways this can go, but at the end of the day, Speaker Johnson doesn't have a caucus that's united. And when you don't have a caucus that's united, you're going to have a fraction different ideas. You're going to have policymakers saying different things. And so I think this week is about the motion from the moderate Republicans to come out there and say, look, we're trying to extend these subsidies. But then you have conservative Republicans saying, look, I campaigned on the fact that we were going to end government spending, and this is one of the ways we do it. Both sides feel politically advantageous again, and that's one of those things where it's just
the most dangerous thing we get in Washington.
Exactly.
So enrollment ends on the 15th of January. That's the new cliff? Is that what you said?
That's what some people were saying.
That's actually really smart for everybody to know here. There is a deal, though, to give, or there was, this Fitzpatrick-Higgins bill a vote as an amendment. Is that off the table?
I don't think anything's off the table at this point. We have to see politically how it plays out. But even if you get this, and I know Representative Roy was sort of hinting that he was not on board with this idea over the weekend. So, Speaker Johnson has to look at his caucus and has to say, look, I have a group that wants to extend. I want a group that doesn't want to extend. When I don't have that type of unity, the best thing is to do nothing. And so I think when Speaker Johnson looks at the situation here, none of the solutions that Dwayne's been looking at, that our team's been looking at, none of the solutions here lead to a solution by the end of this week.
You're not running odds on this, are you? Okay. On to Farm Aid. This is remarkable, and I haven't seen or heard this anywhere because it's straight off of Nathan's desk. Trump's Farm Aid plan to bring relief, but not likely for long. We talked about this $12 billion. Some call it a bailout. You call it an aid package. You get in trouble on your own with that. The fact of the matter is, this number is woefully inadequate. The president said he was making the farmers rich again. Is that not true?
This is a Band-Aid. This is a Band-Aid solution because the farming industry has, high production costs, low crop prices, and one of our biggest trade partners, China, isn't buying soybeans. But let's take this $11 billion, because it's $11 billion for 20 commodities, $1 billion in reserve for specialty crops and sugar. So let's look at that $11 billion. Now, corn is just one of those 20 commodities, and we did some back-of-the-envelope math. You can go to the USDA website. It's $93 per loss per acre in 2025 anticipated, and there's 98 million acres out there. You do that math, and it's $9 billion. So if corn alone is just one of 20, and they're looking at a $9 billion loss, this $11 billion aid is going to help the farmers in the short term in terms of seed, capital expenditures related to fertilizer. And that's why when you look at our note, definitely look at the fertilizer companies, because I think a lot of this money is going to go directly to fertilizer. But that's why President Trump said in the same breath that John Deere and these other tractor manufacturers need to lower their costs. We had our industrials call first thing this morning, and our tractors analyst said, ain't happening.
Not going to happen. So we're talking about a new package in the new year?
I think you're going to see more debate. I mean, the House Republicans on the Ag Committee, a couple of them floated up to $50 billion. And just last year, at the tail end of 2024, Congress authorized $10 billion in additional payments directly to farmers. So whether it's part of this light farm bill, which I actually don't think it's going to have much chance of passage, or part of this spending debate, you are, I think, very likely going to see more discussions of additional farm aid in 2026.
Boy, that's big. That's going to be big for lawmakers who join us from the Midwest. and the other big farming states. I got to ask you about the pot stocks because, boy, this looks different than it did on Friday. There was a report here that the president was set to reschedule cannabis, having promised to do so as early as today, would sign the document. Nathan, pot stocks, hot sauce, went through the roof. Today, there's a little paranoia in the old cannabis investing community. MJ is down. The ETF is down 5%. MSOS, the U.S. cannabis ETF, is down almost 3%. Investors feeling like they were had again. What's going on here?
So I think a lot of the concern here is that when is this order coming out? If you look at President Trump's public schedule today, there's no ceremony like there was for the AI.
Yeah.
So a lot of the marijuana investors have been calling this morning saying, is he actually going to sign this? Now, what we're telling our folks is that when this order comes out, if it comes out, President Trump doesn't have the authority to unilaterally say, go forth and reschedule. He can order the Department of Justice and the DEA to move forward with reschedulation. And this process started under the Biden administration, and they're about 60, 70% of the way through at the moment.
Okay.
So if they really wanted to push fast, they could get this done in the beginning of next year. The concern, though, from the marijuana community, though, is that even though President Trump has said he's going to do this, you know, he's made statements in the past saying, I'm going to do something, and then slow-locked the process. So even though we have the optimism, and we haven't seen that decline that you usually see with the hot sauce spiciness of these marijuana equities, we haven't seen that yet. So there's still optimism this gets done.
Okay.
And our view is that you should use as your base scenario that this gets done, because presidents normally don't put out orders and then saying, I want you to do this, and then walk it back or not do it.
Right.
But again, he needs to actually put that order out, because until he does, we're just in this unclear, situation.
So this is a paranoid optimism.
Well, there's
cannabis
a lot of retail sentiment in these stocks. I mean, you have the marijuana equities themselves, and this really goes towards the mom and pop equities as opposed to the publicly traded ones. But if you take into account that a lot of the Canadian equities are also up 30, 40%.
They have nothing to do with
this. Really doesn't apply to them. And so there's a lot of retail sentiment here, and so a lot of people are just trading off of retail sentiment.
If he does sign this, say it happens this week, it's, at one point, I think the other network said that was today. Maybe it's this week. Your point is they've got 30% of this review left. What are they reviewing? Are they going through old arrest records here? Are they taking breaks at 420? What's
so there were
involved
over
in the
14,000 comment letters on this. And so they have to go through every single one. And there was a portion where they were supposed to have a public hearing. And this hearing was going to be in front of an administrative judge. They were going to bring testimony. They were going to do all that. Now, President Trump can order the DOJ to essentially skip that hearing. And I think they'd still be okay. But they still have to go through this process, because from the Administrative Procedures Act perspective, if they were to really push forward, and let's just say that President Trump says, I declare it rescheduled, and they implement that, there's going to be a lawsuit on this. And if the lawsuit comes back and says you don't have the authority to do that, you broke the APA, it slows the system down even more. So just in order from their perspective to make sure that there's no more bumps on the road, they'll probably have to restart that process.
So just like the tariffs, it goes to court and we just wait.
Exactly.
In a state of paranoia. That's the readout from Nathan Dean at Bloomberg Intelligence. They are heading lower here, not by a lot. To your point, this isn't off another cliff when it comes to cannabis, so just hang on to your doobies. Look for Nathan's work on the terminal and online. I'm Joe Matthew in Washington. We'll assemble our panel next. Rick and Jeannie on the way in here, only on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We kick off the final full trading week of 2025 with losses for the U.S. equity market. Most stocks trading lower now with the Dow, the S&P, NASDAQ. They're all in the red. Bonds rose as Wall Street gears up for key economic data that will help shape the Fed's rate outlook. The S&P right now down 8, down 0.1%. The Dow is down 88, drop there of 0.2%. The NASDAQ Composite Index down 80. For NASDAQ, a decline of 0.3%. The Bloomberg Mag 7 Index, though, is advancing today, up now by 0.3%. 10 years currently yielding 4.18%, with the 2-year 3.50% ahead of the jobs report tomorrow morning. Gold up 0.1%, 43.03 the ounce. West Texas Intermediate crude oil down 1.2%, 56.71 a barrel. And Bitcoin down now by 3.1%, 85,716 on Bitcoin. Keith Lerner is Chief Market Strategist at Truist Advisory Services. He says he does not see, he says he is positive tech longer term, but short term, he's not seeing much of a catalyst.
You know, we just went through earnings season. People are focused on, obviously, Oracle. NVIDIA comes out with some news about some more chip selling to China. It's not moving it. So I think it's just maybe a digestion phase. And I think, you know, next year at some point, maybe that's 3 months or 6 months from now, we'll see money rotate back into it.
Keith Lerner of Truist. Teradyne shares higher after Goldman Sachs upgraded its recommendation to buy from sell. Teradyne up now by 1.3%. ServiceNow and Adobe have been downgraded to underweight at KeyBank, which sees AI tools bringing a bigger hit to both software firms. Right now, ServiceNow is plunging by 10.8%, Adobe down by 1.3%. Recapping, stocks are lower. S&P right now down 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your host is Joe Matthew.
Okay, Charlie, many thanks. Charlie will have more on Wall Street at the top of the hour. As we welcome our global television audience to the program, thanks for being with us here on the Monday edition. I hope you had a good weekend and you're not shivering somewhere along the Amtrak corridor, because it is bitter cold as lawmakers return to town and the peace process continues involving Ukraine. A good friend of mine said this morning, you know, it's colder in Ukraine than it is here. Remembering that Vladimir Putin is very skilled and experienced at using cold as a weapon. As we enter the winter season, that may be in the back of President Zelensky's mind, or the front, as peace talks enter day 2 in Berlin. And I'll tell you, a little bit later on in the program, at the top of our next hour, we're going to be joined by Heather Conley from the American Enterprise Institute, and we'll take her pulse on everything that developed over the course of the weekend, because it has been a story of concessions for President Zelensky. And now one of the big ones, giving up Ukraine's bid to join NATO in return for security guarantees. Enter Steve Witkoff and Jared Kushner once again, back on a plane. We were asking last weekend, is it possible Trump, and it looked like he wasn't going to go, could he send his lieutenants to Berlin to take part in these talks? The word from the Oval was no, not without some sort of guarantee or a deal in advance, but sure enough, the president's son-in-law and his chief envoy, Steve Witkoff, are indeed as taking part in a second day of negotiations with Volodymyr Zelensky in the German capital. And it's where we start our conversation with our political panel. Rick Davis and Jeannie Shanzano have been watching this march to peace, frequently favoring the Russian side here, and they're with us now, a Bloomberg Politics contributor. Rick Davis, Republican strategist, partner at Stone Court Capital, and Jeannie Shanzano, our Democratic analyst, democracy visiting fellow at Harvard Kennedy School's Ash Center. Welcome to you both. First, it was Zelensky accepting the idea of maybe freezing borders where they are, Rick. Then he said he was prepared to accept presidential elections, which is something that the President Trump, in this case, had been asking for, now giving up the bid to join NATO. Are we at a point where it's just a matter of when and not how we get to peace in Ukraine?
I'm not sure I'm exactly that enthusiastic for peace at this stage. Remember, these are all news items coming out of Berlin between the EU and Zelensky and the U.S. The Russians aren't involved in this discussion at all. And the Russians put out a statement this morning that said that the territorial concessions are a must, that we're not putting up with anything that isn't, our deal. And the territorial concessions really aren't easy for the Ukrainians because their borders are meshed in their constitution. As you point out, Zelensky had offered to have a referendum, but part of the referendum is we got to have a ceasefire. Russia doesn't want to agree to a ceasefire because then they can reconstitute on the Ukrainian side their armed forces. I mean, each one of these deals has a caveat, and this caveat with, not joining NATO is a bilateral agreement with the U.S. saying you'll give me kind of Article 5 type protection, and a bilateral agreement with the Europeans to do the same. So it isn't great for Ukraine. They got to go shopping if the Russians come across the border again. But it certainly, tries to stem the issue of joining NATO.
The president was hoping for a Christmas peace deal, Jeannie. Should he be more or less optimistic about that idea?
I don't think much has changed. I have to say I agree with Rick on this. I am not feeling, I've heard some reports where we're hearing a lot of optimism. I am not feeling as optimistic. One of the unconfirmed reports is that the U.S. delegation is still pushing, and this is just one example, Ukraine to give up the eastern Donbass, where they have defensive lines and are reluctant to give it up. After everything, and you gave the list, Joe, of things they had said that they are willing to negotiate on, from holding elections to, foregoing joining NATO. The reality is we're hearing the one side of Ukraine's willingness to give up so many things, to concede so much, and nothing from Russia except for today saying, we will still take the Donbass region by force if it is not given to us. So I'm not so certain that we're going to be facing imminent peace here. And the reality is, why are we seeing Ukraine give up so much? Because they are losing on the battlefield. And it is a really difficult situation for them. They are conscripting people over the age of 40, sending them to the front lines with absolutely no training. They're outmaneuvered and outmanned, not just in terms of the number of people they have, but also in terms of things now like firepower. So that's why they're forced to concede. And their reliance, of course, is on Europe, and their reliance is on the U.S. And the U.S. has been very clear under Donald Trump that they are sort of turning this whole thing over to Europe. So I am not feeling as optimistic as some people are that we are on the brink of a peace here.
Yeah, well, it doesn't sound like either of you are feeling the optimism of Steve Witkoff today or the president of Finland, Rick. How about Alexander Stubb on X? We're probably closer to a peace agreement than we have been at any time during these 4 years. What's he responding to?
Well, I think that's actually a good line, right? It doesn't mean he's close to a peace agreement. He's just further along than he's been since the war started. And that may be true. That is, I would concede that the more they talk, the more they come up with some of these parameters. More they talk, the more they come up with some of these ideas around, how to bridge the gap between the Russians and the Ukrainians. But at the end of the day, you're dealing with a counterparty in Vladimir Putin who is not honest. He's not honorable. He's cut peace deals in the past that he's thrown in the garbage. He's running a horrific campaign of annihilation with his own soldiers, not to mention what he's doing with the Ukrainian civilians. So it's really hard to imagine a scenario that they get peace without giving everything that Vladimir Putin wants to Russia. And I don't see anybody at the position now of saying yes to that deal.
Jeannie, has Vladimir Putin made a single concession as the invading force in this war? Have we seen anything that looks like a concession in these talks?
If you sort of wave your hand before your eyes, this whole idea of, well, we'd be open to them joining the EU, but of course, the EU is not a security coalition. It is an economic coalition. So that hardly does anything to protect Ukraine from another potential Russian invasion in the future. And, this is not just about the Ukraine. It is about Europe, and it is about the United States relationship with Europe. I was struck in that Politico interview Donald Trump did the other day. When he was asked about Europe, he said things like, European nations are decaying, they are weak. And of course, this is reflected by some of the commentary we've heard from people in the administration and Donald Trump since he took office. Then you also look at this national security document they put out last week, and it is got a lot of very, very harsh things to say about Europe, much less so about Russia. So I think Donald Trump would like nothing more than to turn his focus to the Western Hemisphere, particularly the South America, Latin America, allow Russia to control its area, Asia to control its area, and make nice with deals he can make with Vladimir Putin. He is far less committed to this sort of old style European relationship we've long had, at least since World War II. And so I think it is very problematic for Europe, and they are being sidelined. They met 5 hours yesterday and 3 hours today, the U.S. and Ukraine. Who wasn't there? European leaders who have just arrived in Berlin now and may not even get a face-to-face with the U.S.
Rick, do you think that Donald Trump's interest in economic ties, normalizing economic ties and investment with Russia is enough for him to not lose interest and patience here? When things aren't going well, he tends to say, well, you know what, then you guys fight it out and we'll just walk away. And at some point that might happen, unless, of course, there's the idea of doing business with Moscow. What do you think?
Yeah, I think the twin pillars are that Russia is an immense and vast country with very few people and lots of natural resources. And I think Donald Trump sees the opportunity there. Two, I think he thinks that the only route at this stage to getting a Nobel Peace Prize is through Kyiv. And so he's divided, right? How do I get my Peace Prize and tackle all these incredible resources that might be available to me in a deal with Russia? So it's a conflict for him. And I do agree. We've seen him lose interest in this a couple of times in the course of 1 year. And when he loses interest, then there's no interest at all, because it's pretty clear the Europeans on their own can't conceive of and implement a peace plan. So I do think that's what's got everybody worried, is that it comes a point in time where the United States says, you know what, had it, can't really get either side to move the way we want them to. I've invested a lot of time in my efforts to do it. So I'm just going to walk away and let you guys, bang each other's heads in. And of course, that violates the number one thing that he says all the time about being a peacemaking president, is that people are killing themselves, and he doesn't want that to happen. So it's really hard to see the future under Donald Trump when it comes to something like this big geopolitical fight.
Even though we've got hundreds of millions of dollars in Ukraine assistance money in the NDAA, right? Jeannie, if that gets through, the United States is going to have a pretty long road ahead with regard to this war.
Yeah, they will. I mean, you focus just on Donald Trump and the Trump administration. Of course, their interest is no longer giving money. They would, be willing to certainly have Europe pay for anything they hand over. They don't want to hand over that money. And that's very much in keeping with what the president has said very vocally. I mean, I can't stress enough, I don't think we have seen a time in recent American history when relations between the U.S. president and the European leaders have been as fraught as they are. Publicly, they will at least sometimes say nice things about each other, but privately, there is no love lost between these folks. And, you listen to Macron, I was listening to him just the other day, and he's saying things like, oh, we don't want to deal with this plan Trump has. And, we have something else in store, and Europe, the United States, and Ukraine can beat Russia. And you feel like shaking them by the shoulders and say, but President Macron, Donald Trump has checked out of this entire endeavor with you. This is now Europe and Ukraine, and Europe's economy is not what it was in 2022 to move forward like this. So I think the European leaders have a tough time ahead until and unless the United States gets a new leader with a very different view on this war.
Our panel will be back in hour 2. Jeannie Shanzano and Rick Davis. Not mincing words about Ukraine. In our next hour, we'll have much more to talk about the healthcare cliff, including our conversation with Republican Congressman Troy Downing of Montana. He'll be part of our conversation, and I hope you will be as well. Stay with us right here on Bloomberg. Hour 2 of Balance of Power is on the way.
From Washington, D.C., this is Balance of Power with Joe Matthew.
Congress braces for the cliff. Welcome to the Monday edition as lawmakers return to Washington with all of 5 working days to keep Obamacare premiums from rising at the end of the year. And we're going to get the latest straight ahead, a report live from Capitol Hill from Bloomberg's Eric Wasson with insights this hour from Republican Congressman Troy Downing of Montana. And as President Zelensky gives ground on joining NATO, we're going to look more closely at peace talks in their second day in Berlin when we join Heather Conley from the American Enterprise Institute. Insights as well from our political panel, and it's all after a look at Wall Street. Let's get to the Monday trade first with Charlie Pellet at World Headquarters in New York. Hey, Charlie.
Thank you very much, Joe Matthew. We've got a jobs report coming up tomorrow morning. Right now, we've got stocks trading lower ahead of that key piece of data with the Dow, the S&P, NASDAQ, they're all in the red. S&P right now down 13. That is a drop of just about 0.2%. The Dow lower by 104 points. Dow Industrials down 0.2%. NASDAQ is down 109. The NASDAQ Composite Index down 0.5%. The Bloomberg Mag 7 Index up now by 0.2%. The 10-year ahead of the employment data tomorrow morning, 4.17%, with the 2-year currently yielding 3.50%. Gold up $4 the ounce, 43.04 now, up 0.1%. Silver up 2.5%, 63.48 on silver, while West Texas Intermediate crude down 1.4%, 56.61 on WTI, and a retreat for Bitcoin down 3.2%, 85,000 now, 660 on Bitcoin. Confidence among American home builders edged up in December as builders continued to deploy sales incentives to motivate the buyers. Among home building names today, we're looking at KB Home, trading down by 0.8%. Toll Brothers, the luxury home builder, up 0.9%, and Lennar lower now by 0.1%. Again, recapping, stocks lower, S&P 500 index down 0.2%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. Balance of Power continues now. Back we go to Washington. Once again, your host, here is Joe Matthew.
All right, Charlie, thank you. Live from New York, Charlie Pellet will have more on the markets coming up in about 20 minutes' time here on Balance of Power as we connect the dots between Washington and Wall Street together once again. Thank you for joining us here on the Monday edition on Bloomberg TV and radio, with a very short schedule left on Capitol Hill. And that's where we're going to start our conversation as we prepare to look abroad here on peace talks involving Ukraine as well. We'll do that with Heather Conley in just a moment. She's with us in studio today from the American Enterprise Institute. Only 5 working days left this year, though, if you're a member of Congress. And, of course, there's something that's being called a cliff at the end of this month. That's when Obamacare, enhanced Obamacare subsidies put in place during COVID are set to expire. The very matter that led to the longest shutdown in government history has still not been resolved. They are set to expire at the end of this month. And if you talk to anybody who knows what's happening in Washington, they will tell you we're going over the cliff. That will not, however, stop lawmakers from taking a couple of swings at the ball. There will be voting this week. More realistic voting when it comes to the NDAA, the National Defense Authorization Act. It's passed the House already, and all 3,000 pages are set to pass the Senate at some point this week. Senate will also clear a package of about 100 nominees and might do some individual voting on some of the other nominations coming from the Trump White House. It's what's happening in the House of Representatives that's going to be interesting here, because remember, Speaker Johnson promised to vote on a Republican health care package. It emerged on Friday night as we were all heading home for a very chilly weekend. There may also be a separate vote on a bipartisan plan that would help to extend the Obamacare subsidies. Speaker Johnson speaking about this at the end of last week. Listen.
When the Democrats talk about health care affordability, okay, this catchphrase that they are talking about one thing and one thing only. They are talking about continuing handouts to big insurance companies. They have no ideas, they have no desire to fix the broken system they created. They just want to subsidize it. And subsidy is a big word. It means they're taking taxpayer dollars and funding a broken system.
I guess subsidy is a big word, even here at Bloomberg. At least the weight that it carries. Ask Eric Wasson. He's been covering this on the daily since before the government shut down, having had the same conversation every day. And without a solution in sight, we bring him in now. Bloomberg congressional reporter live from Capitol Hill. Eric, is there any chance at lawmakers saving this, or the cliff is the cliff and we're going over it?
Right. I don't think we'll see Obamacare subsidies extended before the end of the year. There's still a small chance I'm monitoring that something comes together in January. What we're watching is House moderate Republicans who are trying to get this amendment vote on their sort of bipartisan plan to extend Obamacare either 1 or 2 years, depending on the version that we see. We have yet to see that version. If they don't get a vote, if that vote fails, there's still the option for them to sign on to a discharge petition. This is a way of forcing a vote on the House floor put forward by Democrats. Democrats only need a handful of signatories, and then that can start a clock where we come back in January and see a vote. Now, as you noticed already, people will have seen their Obamacare premiums go up, but there's a chance that, that same bill could extend the open enrollment period. You'll still see people drop off or lose their insurance, but there is potentially a chance. But, the Senate is going to look to go out of town on Thursday. This runway is already greased for them to leave, and as you mentioned, the national defense bill is on the docket. So I just don't see this. My bet would be that it's a pretty sure bet it will not be extended before the end of the year.
Now, this is what the end of the year looks like on Capitol Hill. Eric, not a lot, it seems, will get done here, but I'm compelled by what you just mentioned, because if this Republican plan in the House does not pass with the support of moderates, will the moderates then turn to that Democratic discharge petition? It's got 214 signatures on it, Eric. It wouldn't take that many to force this to the floor.
That's right. And the discharge petitions have really gained steam. This is a very rare, it's an affront to the authority of the Speaker, but we've seen them really gain steam here in the House in the last couple of months. That's what, forced this vote basically on the Epstein file release. We're facing a Friday deadline to see all of those Epstein files. There are other discharge petitions active on stopping members from trading stocks, for example. One actually succeeded in protecting federal worker union rights, and the House passed that bill on an overwhelming basis. It's just kind of sitting in the Senate, but still is a very symbolic move and affront to the Speaker. So there's a chance that that could actually happen, and Democrats would be able to get a vote on that in January.
Just curious about war powers, Eric, while you're with us. We talked last week with Jim McGovern. He's got a War Powers Act that's supposed to ripen this week. Now we see Senator Ruben Gallego offering a war powers resolution, all with their eyes, of course, on what's happening in Venezuela. Are any of these going anywhere?
I think the real deciding factor there will be if we get a land invasion. Trump has many times said that there's going to be land activity in Venezuela, potentially even Colombia or somewhere. If that happens, Schumer is ready to launch a real effort to do a war powers raiding in the president. I think it would get some support. I think there's not a lot of appetite in either party for a land war in Venezuela. We'll see if the president can make his case. But interestingly, the NDAA, the National Defense Bill, does repeal authorizations that have lingered since the Iraq War and before that have been used to justify these sorts of activities. So that would sort of create an interesting legal limbo for anyone going in. The NDAA is a very interesting bill. There's an outbound investment provision in there that really affects U.S. investors trying to invest into China. It expands to Russia, other countries. When this bill, which is likely going to pass before the end of the week in the Senate, comes into law, there's a different landscape for those investors, as well as some changes to pharmaceutical supply chains. The Biosecure Act is in there. So this is something that, normally just think about it in terms of defense contractors, but this will be an important bill for the wider investor community if this gets into law.
Well, that's really important, and it never gets enough coverage. Eric, Friday's it, right? We're going to hear a lot of references to fly-out day and jet fumes this week. Everybody's gone on Friday no matter what happens with these bills.
That's what I'm thinking. The House added Friday as a vote day when they were getting under heavy criticism from their own party for keeping away from D.C. for 8 weeks. They may even leave before Friday if things are looking too tumultuous for the Speaker. We'll see.
I'm so not surprised to hear that. Eric, thank you. I hope that means your weekend starts earlier, too. Eric Wasson, I don't, by the way, think it works that way. Bloomberg congressional reporter. There's your live update. So we're starting this week. We got 5 days without exactly knowing what in the world is going to happen. Yet everyone seems to know that everything we just talked about is going to fail. So 2025 in Washington. By the way, that NDAA, the National Defense Authorization Act, has $400 million in it, earmarked for Ukraine. No one's talking about that either. But there would be some at least tacit support, whether that comes in the form of intelligence or military support coming from the United States, even with this passing here today and peace talks underway that we want to talk about now with Heather Conley. This was day 2 in Berlin, right? President Zelensky at the table, Jared Kushner, the president's son-in-law, Special Envoy Steve Witkoff, trying to advance the ball here on what the president would love to call a Christmas peace deal. Not a lot of people think that will happen, but there has been a bit more optimism surrounding this most recent stage than we have heard recently. Heather Connolly is non-resident senior fellow at the American Enterprise Institute, former deputy assistant secretary of state for the Bureau of European and Eurasian Affairs. Heather, it's great to have you back as part of our conversation on Bloomberg. Pretty remarkable headlines coming out of Berlin. Now, President Zelensky says, I'll give up on the quest to join NATO as well. We haven't seen really a single concession by the Russian sides. Would something like this, though, get the gears turning toward peace?
Well, Joe, I think you're right that we are seeing real progress coming out of these 2 days of talks in Berlin. There have been Ukrainian concessions, but I would put them in quotation marks.
Okay.
NATO membership was something that was always going to be a very long-term prospect.
Sure.
But what the Ukrainians are asking for is NATO-like Article 5 security guarantees. And that is one of the main sticking points for these conversations. What security guarantees can the United States and Europe give to Ukraine when Russia violates this peace deal? That, and of course, territorial concessions. Will the Ukrainians approve of turning over land that they currently defend in the Donbass? Those are really the 2 key sticking points.
And I guess 3 when you add NATO. So let's pick 100%. Through them. To your point, NATO is an ambition. That was not something that was about to happen and wouldn't be unlocked by a peace deal. So let's focus on the other 2 here, because I guess Zelensky is kind of warming up to the idea of maybe joining the EU, if not NATO. But without NATO, there's still an Article 5 type of guarantee here that's being talked about. And that came as well from Witkoff and Kushner, right? This wasn't just Zelensky putting this forward. The United States suggested this without the involvement of Europe, but it would require European troops, would it not?
Yeah, I mean, I think there certainly the U.S. would have to have those security guarantees. There's some rumors coming out of Berlin that the administration would submit these security guarantees for Senate ratification, almost like a treaty, like we would do to amend the NATO treaty. That would be important. But yes, Europe has to be part of this as well. And the Ukrainians have negotiated bilateral security guarantees with those countries. But the question, Joe, is when they're tested, will we apply military power against Russian forces, again, when they violate this peace deal? And that is the question mark.
I think that was framed as in the event of a sustained attack in the initial language we saw. So a cruise missile into an apartment building wouldn't qualify.
Right. But again, the sustainment may be through hybrid activities, meaning that they would seize the territory. It wouldn't be through military means, but they would do it through hybrid warfare. That wouldn't trigger it. So huge question marks.
All right. Well, let's talk territory then, because you freeze the lines on the Donbass, and I think Zelensky suggested maybe that he puts this to a vote, right? Let's actually have the people who live there vote on this. I'm guessing that based on his history of behavior, Vladimir Putin wouldn't care either way, would he?
Yeah, but this is where I actually do think Vladimir Putin does care, because it's now in the Russian constitution that these 4 Ukrainian territories are Russian.
So that's the motherland, he says.
Exactly, and this is the restoration of Russia's historic lands. But this would be Ukraine giving up territory it currently defends, and this territory is part of its so-called fortress belt, which is its defensive line. So without those lines, Ukraine is going to have a very hard time being able to reinforce its military across its border. So in some ways, it would render it in part defenseless.
This is why we were talking about a potential demilitarized zone in that area, right? Is that a more realistic approach?
Well, again, it gets back to the who protects this demilitarized zone. Again, it's important to remember, we've been to this movie before when the first annexation and incursion into Ukraine, there was an OSC monitoring force, and that ceasefire was violated repeatedly, even though it was monitored. And this is where, again, Russian hybrid tactics really were trying to change the status on the ground.
Really interesting. So we've talked through some of the particulars that are at the table here, and I guess they have concluded. This was a 3-hour session today in Berlin. It was about 5 hours yesterday. I'm assuming everybody flies home now, and President Zelensky sure would love an invitation here to the U.S., but we've still left the Europeans out of this conversation as well. The Russians haven't given much in the way of encouraging remarks about this, so Are we just spinning our wheels until everyone's in the same room?
Well, I think the Europeans are feeling better. The fact
Yeah.
that these conversations were held in Berlin and that they actually were at the table. Now, the incredible visual is the U.S. is on one side, Europe and the Ukrainians on the other side, that we are negotiating with our European partners.
Who would've thought?
I think, yeah, exactly. I think this plan now, whatever comes out, is going to have to be briefed to the Russians. I assume that Special Envoy Witkoff has already been keeping the Russians pretty well informed. They may not accept some of these changes, and you're absolutely right. If the Ukrainian government does decide to make some territorial concessions, have to change their constitution to remove NATO, you're talking about a referendum, you're talking about an election that President Zelensky did just say over the weekend that potentially could happen in 60 to 90 days after a peace deal. So it could be a lot of changes, or we could be quite stalled.
Is there a single Russian concession that you could see coming out of this?
No.
Well, my God, how do you find peace in that world?
So you cave, you capitulate to the Russian position, and that it's absolutely
But
brutal.
is that sustainable if you're
No.
framed as capitulating?
It's not sustainable. It's not
You're ready
sustainable.
to fight another war.
In Ukraine, it's not sustainable in Europe. It's not sustainable for the United States and our security interests. This is why the British head of MI6 just came out with a devastating speech saying we're already in war with Russia. The hybrid activity, NATO Secretary General Rutte last week said in 5 years there will be war. So you hear us preparing for this, yet we're talking about appeasing the aggressor. It is extraordinary. It does feel like 1938.
Well, that's a heck of a statement here. Will it feel like 1938 for the next 3 years and 2 months? To what extent is the administration keeping this Russian dream alive?
So it is.
Or maybe a Putin dream is a better way to put
Well,
it.
again, this is where last week's national security strategy did not articulate who our adversaries are. Russia, China, North Korea, Iran. It spoke about a focus on the Western Hemisphere. It talked about securing economic and strategic stability. We are closing our eyes to this. And if, in fact, the United States provides security guarantees, we are inserting ourselves in this. So this is a moment for clarity of knowing who the aggressor is, who is challenging the United States and our European partners, and preparing for potential conflict.
Just a minute to go here, Heather. What is China learning as it watches the way we work with Ukraine, keeping Taiwan in mind?
I think it is learning that we will appease for some sort of magical economic stability, that you have, you don't have that stability. It is emboldening those who believe that they can snatch territory, and that if there's economic disturbance, that they will negotiate and get that stability. It's a terrible message to America's adversaries.
Boy, it really is. Is that because you think that Donald Trump is more interested in normalizing economic ties with Russia? When you talk about that economic stability, imaginary or not, how does he find it here?
Well, I think what is elusive is that there is no momentary deal that will stick. And I think this is what the White House is learning with all the deals that have been negotiated. They're starting to fall apart because it's not just that moment. It's creating the structure to deter aggression, to be strong, and send a clear message to our adversaries. We are strong with our allies and partners. Don't violate international law.
This is a very delicate moment that we're in, Heather. I'm really glad that you could join us to talk about it once again. That's Heather Connolly from the American Enterprise Institute. Last time she joined us, we said we need to get her back, and this is why. I'm Joe Matthew in Washington. We'll keep the bead on the effort to find peace in Ukraine as we wait for a readout from the White House. We've not seen one on an official piece of paper or on Truth Social, and that might emerge a bit later today. Republican Congressman Troy Downing of Montana joins us next as we turn back to healthcare on Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are in the red with the Dow, the S&P, NASDAQ all declining ahead of the jobs report tomorrow morning. S&P right now down 15, drop there of 0.2%. Dow Industrials also down now by 0.2%. We've got NASDAQ down by 0.5%. 10-year at 4.17%. Gold little changed, up under 0.1% right now. Spot gold 43.02 the ounce. West Texas Intermediate crude oil down 1.6%. 63.56 right now at 56.51 a barrel on WTI. Crude West Texas Intermediate down 1.6%, and Bitcoin slumping now by 3.1%. Bitcoin at 85,760. Just getting word that General Motors has cut a deal with Apple to bring the Apple Music app into Chevrolet and Cadillac models beginning today. Recapping S&P down 0.2%. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thanks so much. Charlie Pellet will have more on the markets in about 20 minutes' time. Here on the Monday edition of Balance of Power on Bloomberg TV and radio, we thank you for joining us here with big questions about what could be accomplished this week on Capitol Hill with 5 working days left. Yeah, we're almost there at the end of the year. In fact, it's just a couple of weeks until the enhanced Obamacare subsidies from the COVID era are going to expire. And we've been talking about this on the daily. It looks like there could be some really interesting maneuvers on Capitol Hill directed toward your health care in the coming days, whether it's through discharge petition or otherwise. We're going to get down to some voting. As we mentioned, the NDAA in the Senate, that was likely just in the next couple of days, and that'll pass. That's the must-pass bill. Healthcare is another matter. And glad to be joined by Troy Downing, the Republican congressman from Montana. 2nd District is with us here in studio today on Bloomberg TV and radio. It's kind of you to come by, and I appreciate it very much because there are a lot of questions about what's going to get done here. And you probably have some of these questions, too. Yeah. It could be the Republican-led bill that was released late last week will get a vote. There also could be other votes, though, in terms of a discharge petition. There was another extension to the ACA that at one point was promised to bring to a floor vote. Now it might not happen. Do you have a clear view of what this week will look like?
Well, here's the thing with those discharge positions. Yeah. Actually, let's just take a step back on these enhanced premium tax credits, because a lot of the rhetoric that we see on social media from headlines from people pushing back is we have to do something or premiums are going up. Premiums already went up. The open enrollment period is over. I mean, that's already baked in. For those who don't understand how this works, the payers, the insurance companies, they file with their states months before the open enrollment period. It gets approved. It gets filed with CMS, the Center for Medicare and Medicaid Services, and then comes the open enrollment period where you pick your policy for the next policy year starting January 1st. That's over. And so this whole argument about if we don't do something by the 31st, then suddenly premiums are going to go up. Well, I'm going to tell you, if the enhanced premium tax credits, if the Obamacare tax credits expire, rates have gone up. If they get extended, rates have gone up. It's the same thing no matter what. But here's the thing the folks aren't talking about is the chaos.
So they wouldn't, just to be clear before you go on, they wouldn't come back down through some sort of retroactive language and legislation?
Well, so let's just think about what would have to happen mechanically.
Yes.
Is first of all, you'd have to have the payers, the insurance companies, refile their rates.
Okay, yes,
so let's say we get into that, by February. So those get reviewed, those get filed. So then you have to have another open enrollment period. And that's going to create confusion in the marketplace because people who pay a portion of their small group or large group through their employers are going to think, well, hey, I'm going to get a discount too. But no, this only affects the individual market, so it's a small percentage. So then you have to have an open enrollment period. Let's say that's March or April or whenever they can do that. So then do you make it ex post facto going back to January 1st? Do you have it going forward? But it creates confusion in the market. And I'm not exactly sure how we would deal with that mechanically, but then let's look at what happens if we just extend the tax credits. Let's say we extend them for 2 years. Well, then everybody refiles next spring. We have another open enrollment period, November, December, and that goes into the 2027 policy year, which will probably still be a little bit of an increase because here's one thing that the Republicans and the Democrats all agree on right now is ACA, the Affordable Care Act, Obamacare has been a complete failure, and rates have gone up independent of these tax credits. They're going up no matter what because the cost of health care has gone up. And what's happened is the cost of health care goes up, of course the cost of health insurance goes up.
Yes.
And when that happens, people start coming off and they find alternatives. Either they go uninsured or they find an alternative like a health sharing ministry or some other thing. And it's not the healthy people. I mean, it's not the sick people that come off, it's the healthy people. So the younger, healthier people come off, and that creates this phenomenon called adverse selection. So then you've concentrated the risk, losses go higher, and the next premium year, premiums go higher. And that creates
so the
this
cycle,
whole cycle.
is brutal. And
yeah.
our audience should know you were state auditor
Yes.
overseeing
So
this
I
very
regulated
matter in the
insurance
state
for-
of Montana.
yes.
So you have a unique understanding of all of this stuff. KFF says the expiration would more than double on average what people are paying annually. President Trump would say, keying off of what you just described, then so send people the money instead of the insurance companies. But don't people lose power by having essentially an individual barter with this massive insurance company? How does that keep premiums
Well,
down?
first of all, let's just correct the record on one thing. The actual rates that have gone up in just the individual market, so just a small fraction of the overall market, on average, well, in Montana, on average, is about 22%. And the enhanced premium tax credit, the Obamacare tax bracket, that's single digits of that. So it does have an effect, but the rates are going up with or without that. So first of all, just make sure that people understand that. And then in terms of the healthcare savings accounts that the president's talking about, personally, I think there's meat on the bone there.
But they're not going to be in this bill?
They're not going to be in this bill, unfortunately, but this is something that we need
That's like the Bill Cassidy plan is something that you would warm up to.
Well, I think there's meat on the bone here for a very simple reason. One of the issues that we have is we've created so much distance between the doctor and the patient. There's so much in between there. And what an HSA does is you've got a finite amount of money for paying for your out-of-pocket expenses, for your medical expenses, and it can only be used for that. And so now you're saying, I've got $5,000 in there or however much that money is. And you're talking to your doctor and you're saying, well, how much does this test cost? Well, do I really need that? Or the other thing is right now, nobody is incentivized to look for actual pricing. So if I talk to Dr. 1 and I say, this is going to cost, $500 and Dr. 2 says $1,000, it starts to put that in there because the problem right now is somebody else is going to pay for it. So there's no incentive for somebody to look at what the actual cost they're being charged is because you know that your insurance company is going to pay it.
And that would be the individual doing that
So
job.
the HSA,
right?
with the HSA, it puts more power, if we start to expand that, it puts more power into the patient in having that conversation with their doctor and actually asking, because now it affects them directly, asking what the prices are, what the tests should be, what the expenses of the, so it brings that in. I just think about, when I was growing up, lived in a single income family, worked in a grocery store, so not a family of high means. And when I'd come out of the doctor, my mom would go up to the front desk and she'd get out her checkbook and write a check. And that's how we did it because there was that doctor-patient relationship. And I think we've come so far away from that and put so much money into the system that we've seen the underlying care, costs of health care going up. Economics 101, you put money into a system, things get more expensive, and we've seen that, and that creates that vicious cycle that we talked about with adverse selection.
Well, and, a conversation like this gives somebody a popsicle headache because it's complicated stuff.
It
and they're
is.
trying to figure out, well, what part of this policy is going to help me?
And that's what makes it hard politically because it is hard to explain.
because you have to communicate this stuff.
It is hard to explain.
So let's say, all right, so the messaging system breaks down here, and we're looking at a government funding deadline at the end of January. I'm not even going to ask you. Are you worried?
I think, when we had the shutdown, that 43-day shutdown, it was horrible. Nobody wins. Everybody, well, which side won? Did the Republicans win?
We have short memories, Congressman.
Nobody wins in a shutdown. But here's one thing that I will say is at least on my side of the aisle, the Republican conference really stuck together and said, okay, we're not going to negotiate this craziness. They're bringing in all these red herring when this is really a simple, short-term extension of current policy so that we get through the appropriations process.
Is the scar tissue from that experience enough to keep us from doing it again?
I can be hopeful. I really think it is. I think that's going to come into play when I know that the resolve on the Republican side is pretty strong, and I think that the Democrats learn that that is not a winning prospect. So I'm hoping that calmer heads come to the table and prevail, and we start to get more of these appropriations bills through. So obviously, we just had the National Defense Authorization Act, so that's going to the Senate. Hopefully, that moves through. So we're slowly ticking away at these. We'd all be happier if it went faster, but the frustrating thing for me is that when these appropriations bills come out of committee, you got the four corners. They start out bipartisan. It came out of committee with the ranking member and the chair, both the Senate and the House side. So you've already got a bipartisan spending bill. And it's just frustrating that we can't all rally around this. Get back, as Speaker Johnson says, the muscle memory of actually appropriating and going through that process rather than continuing CRs and omnibus spending bills. And I think there's a huge desire to get back to that, and I am so hopeful that we can get back to that. And it may not be this cycle, maybe the next cycle, but soon, because the American people want that. The people that voted us into office want that. We all want to get back to that and get back to actually doing our job of regular order.
Well, when we get to regular order, come back. We'll do a special together. Congressman,
exactly. I would love that.
You back with us. It's Troy Downing, Republican from Montana, on a very important week here on Capitol Hill. We thank you, Congressman, for the insights as we assemble our political panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano join us now with their insights on everything we just talked about, and it's hard to get away from the healthcare story, so we'll start right there. Rick, Republicans have a very interesting looking schedule here in the House over the course of the week. Will we see voting on all the various forms of legislation that we just talked about, and will this come down to a discharge petition?
Well, if it comes down to a discharge petition, it just depends upon which discharge petition they're going to carry, because all of these are slightly different, including the House bills. I mean, part of the biggest problem we have is the Republican Party has not focused on a solution set that they can get on board with as a party. And so we have 4 different bills right now in the House of Representatives to fix the system, right? And yet none of them are a comprehensive fix. And I think the congressman was right saying, look, there are huge advantages to HSAs, but they don't really fix the whole problem. And so are you going to tinker with it and try to make it a little bit better while at the same time tightening your belt on things like these subsidies? I'd be surprised, because Congress by nature doesn't like to tighten its belt. It is a spending machine. It hasn't gotten smaller. Government has gotten bigger with this Republican Congress. And so the fact that they're going to pass something that actually makes it smaller would be, I think, great, but unlikely.
So we're going over the cliff, Jeannie, is what it sounds like. And based on what the congressman just said, don't wait around for a life raft. Is that how you see it?
Yeah, I believe he said we've already gone off the cliff. It's too late. There's nothing that can be done. The costs are going up. You know, there's so many stunning things about this, but I would say one of the most stunning things is that affordability is the biggest issue domestically right now. Donald Trump is talking over the weekend in an interview where he's saying he may lose, Republicans may lose the House next year, and yet they are doing nothing about health care because the president would have to lead that charge, and he's absolutely AWOL.
Incredible stuff. Jeannie Shanzano and Rick Davis. We're like Thelma and Louise. We're going off the cliff together. We'll have more with our panel coming up in the late edition of Balance of Power. That starts at 5 p.m. Eastern. I'm Joe Matthew in Washington. Stay with us. It's only here on Bloomberg TV and radio.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're all in the red right now ahead of the jobs report tomorrow morning. Right now, the S&P is down 0.3%, lower by 19 at 68.07. Dow Industrials down 143. On the Dow, a decline there of 0.3%, while NASDAQ is down 131 points. The NASDAQ Composite Index down 0.6%. But interestingly, on a down day for much of the market, the Bloomberg Mag 7 index is holding on to a gain right now of 0.1%. The 10-year, 4.18%, with the 2-year currently yielding 3.50%. Gold up $9 the ounce. Spot gold, 43.09 the ounce, up by about 0.2%. Silver up 2.6%, 63.58 the ounce. West Texas Intermediate crude oil down 1.7%. WTI 56.44 a barrel. And Bitcoin now at 85,645, down by 3.2%. The two CEOs of Netflix are laying out the company's case for acquiring Warner Brothers Discovery after rival Paramount Skydance went public with a competing hostile offer. Now, in a letter to employees today, Greg Peters and Ted Sarandos moved to quell industry concerns about job losses and the end of theatrical releases. Right now, we do have shares of Netflix down 1.5%, Warner Brothers Discovery down 0.8%, Paramount Skydance up 0.8%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, we thank you, and we're going to stick with Wall Street and keep the beat on the markets here in the last full trading week of the year. We've spent the balance of the program talking about uncertainty around policy here in Washington, and well, that's not new if you ever join us here on Bloomberg TV and radio around this time every day. But we are finally going to start filling in the blanks when it comes to economic data here. Not a lot of earnings to look at. We've got a couple of big ones like FedEx and Nike, Micron, a couple of days from now, but big for economic news. And we're going to start catching up on some of the missing data with jobs reports. We've got retail and inflation all on the calendar this week. And then, of course, well, there's Santa Claus. Where's the end-of-year melt-up here? Did Charlie miss something? I heard about a lot of things going down. So we thought we would spend a little bit of time with Christine Aquino to get a sense of what to expect over the course of this week. Because by the time we get to Friday, yeah, there are going to be some trading days left. But the smart people like Christine are going to be gone. They're on their way to grandma's house, and it's going to be light trading, super light, quiet, low volume days. Christine, it's great to see you. She's the managing editor for Bloomberg Markets Live blog. And we've got a lot of news to digest in the days ahead, don't we?
Absolutely, Joe. And let me just correct you and say that I will be around for the rest of the year, barring the holidays.
Wait a minute. Don't they know who you are? All right, that means you're coming on the show next week, and we'll meet you then.
But yes, absolutely. I think how you described it is very much on point, Joe. I mean, there's a lot of questions still over what the state of the U.S. economy is, given that a lot of investors were really in the dark during the dearth of data over the government shutdown. And as you say, they're now starting to fill in the blanks, right? And I think, you know, what we're seeing this week is just a little bit of a pause from the recent moves that we've seen, which actually has turned more optimistic for both the stock and bond market as of late. But now we're kind of seeing those gains pause because, yeah, investors are wanting to confirm what we have seen in alternative data sources for the labor market, for instance, right? Is that softness actually going to be backed by the official non-farm payrolls data that we're going to get tomorrow, in addition to all the other tier one data points this week? And so it makes a lot of sense for investors to kind of just take a little bit of money off the table, maybe, you know, sell the rumor, buy the fact once that we get that confirmation, or negate that some of the alternative data sources. But yeah, you do seem to have a lot of investors staying the sidelines, at least for this week.
Wow. So are we robbed the whole end-of-year melt-up that so many analysts were predicting, all the year-end factors that come into play with portfolio managers trying to dump their losers and catch up with the winners? Did we front-load all the good stuff this year?
Well, Joe, I mean, I think if you zoom out to, say, for instance, the year-to-date chart of the S&P 500, I mean, that is still massively up this year, especially from the lows in early April. And, you know, we're still a whisker away from that new record high that we hit in late October. And so I think stepping back, it's still a positive equities year, certainly a positive positive year for fixed income as well. And so I think, maybe that melt up may have already been underway, or we're in the midst of it. But it seems like, a lot of that, as you say, may have been front loaded early in December. I started hearing about the Santa rally the day after Thanksgiving. And so, I think maybe investors got a little overexcited, but I think overall, investors are probably comfortably booking year-to-date gains for both equities and the fixed income market here.
Well, we're hard to please around here, and we get bored, Christine. The last couple of weeks, though, have been kind of tough with the unwinding of the AI trade, but we do have to remind everybody that there are actually a lot of stocks going up, right? That's why the S&P 500 is sitting right where it is. We're going to be joined by John Bozzella in just a moment. GM, all-time high today. That's a pretty good example.
Yeah, absolutely, Joe. And I'm just looking at the groups that are leading the S&P 500 today. Very interesting, right? So there's a lot of cars, cable, hotels, tobacco, and, you have semiconductor equipment there as well. And so I think this is kind of testament to, yes, we're taking a little bit of a breather in terms of index gains today. But when you look at kind of the movers, the leaders and losers there, it is very encouraging to see that there's more breadth in this market. And I think that's why investors aren't necessarily panicking just because we're down today. I think they're taking heart in the fact that, okay, like the gains seem to be more evenly distributed beyond the tech sector. And that speaks to a little bit of a alleviation of the worries over the AI bubble.
Well, let's get some of this data under our belt, some of these earnings that I mentioned. We'll see where we are by the end of the week. Christine, we're going to compare notes with you. You're locked in now. She's going nowhere for the holidays. Like me, Christine Aquino. Thank you so much. Managing editor, Bloomberg Markets Live blog. Charlie will have more on the Monday trade coming up at 2 p.m. I mentioned shares of GM. That has been a hot stock recently. Ford's been doing pretty good. They all have been. Thanks in part to this program rolled out by the president that we talked about back. It was the 2nd of December, I believe. The administration undoing Biden-era fuel efficiency standards, which it blames on driving up the cost of new cars. We carried that event when the president announced it earlier this month. Listen.
My administration has taken historic action to lower costs for American consumers, protect American auto jobs, and make buying a car much more affordable for countless American families and also safer. Now, under the new rules being issued by Secretary Duffy, the Department of Transportation will rescind the Biden fuel economy prices. In other words, we're bringing automobiles back and the manufacturing of automobiles back into this country.
Remembering they topped out, right? $50,000. The price of a car in this country hit $50,000 on average for the first time ever in September, which means no car for a lot of Americans. What does this mean for the companies as well, though? Remember, we talked last time, I believe we talked to John Bozzella. It was about the many changes that they were being asked to make because of the tariff regime and the complications when it comes to manufacturing cross-border with Mexico and Canada. Now another change, but this one seems to be going over a little easier. John Bozzella is president and CEO of the Alliance for Automotive Innovation, where the story changes every day lately, John. It's great to see you. Welcome back.
Great to be back, Joe. Thank you.
The car makers were in the room for this one, though, which reminds us that they were pretty happy with this news. Is it just as easy to downscale when it comes to emissions like this as it was to put all of these changes in effect to begin with?
Yeah, that's a really good question you're asking. It's a great place to start because what manufacturers want more than anything else is a degree of certainty and clarity about what the rules are going to be. This is a long lead time, high asset business, right? So these companies are planning model years out, 28, 29, model year 2030. And so you got to have consistency, clarity, and some degree, of stability here. But what we did see, and you saw this in the clip you just played of the president, this is really kind of a return to the roots of what this corporate average fuel economy program really was. It was established in the 1970s to reduce our dependence on foreign oil. Its focus has always been on increasing the efficiency of gasoline-powered cars and trucks. And so that's where the Trump administration is starting with this program, and it's a good place to start.
It's interesting. It was inspired by dependency on oil from other nations, not climate, which it is more typically associated with.
Yeah, it's exactly right. Now, it really isn't a climate measure. There are other regulations that are associated with climate and auto emissions related to the climate. But this is really about fuel economy, but also, here's a word Congress uses, economic practicability. What you and I would say is affordability. So that's what the Trump administration is leaning in on here. They're saying, look, the days when you could make assumptions of very, very high levels of electric vehicles being sold into the fleet and then setting CAFE standards based on that idea that there are going to be a lot of electric vehicles in the fleet, that's illegal. Congress said you can't do that. And so the Trump administration is just trying to reset the baseline, follow the law, and go forward.
So I guess the two big questions that we all have are, number one, how will this impact the price of a car? Do we see that number come back below $50,000? In what period of time? But also, what types of changes, what kind of retooling do these automakers need to do to crank out what I guess is a slightly more old-fashioned kind of car?
Yeah, I think we should be careful with the idea of old-fashioned.
Okay,
right?
Sure
and I'll tell you why. I think really the previous standards were really overly ambitious, to say the least. They were unachievable. The assumptions that went into them, the levels of electric vehicles that we thought the market would demand, the amount of charging infrastructure that people felt would be available to customers, it just isn't there. And so having a reset and a reevaluation of these programs makes sense. Now, that doesn't mean that there will not be electric vehicles in the future, or plug-in hybrids or hybrid technology.
Do you make an ICE car differently, though, because of this change?
There's always improvements, even in ICE technologies. But what I think you'll see is much more hybridization across the fleet, right? And so today, if you look at the market, the numbers of gasoline-powered vehicles are going down and the numbers of hybrid vehicles are going up. And so I think you'll see more of that.
You were in, I think, Japan with President Trump, and I know you're a world traveler, because he was pointing to Japan when it came to the tiny cars post. And I want you to explain it to me. This was, I believe, the 5th of December. I've just approved tiny cars, he says, to be built in America. These cars of the very near future are inexpensive, safe, fuel efficient, and quite simply amazing. He said, start building them now. Are we talking about like the Pope Mobile? This is the Fiat. What did he see in Japan with you?
Here's what he saw, and I saw them too, and I was there at around the same time. What he saw was these very, very small cars that are really built to get down these narrow alley type roads.
Are we not allowed to make them here, or we just don't?
Oh no, I think we are. Okay. I think it's a matter of what customers demand, and if customers demand small cars, you'll see small cars. We certainly saw Stellantis produce the Fiat 500 and sell it in the United States. We've seen other small cars. It really comes down, in my view, to what the customer demands. Now, is the Department of Transportation right to look at whether there are regulatory barriers? Yes, but let's be very clear. No one is ever going to sacrifice safety to bring vehicles into the marketplace. And so as long as safety's first and foremost, if customers want them, they'll get them.
Does that help to bring the average cost of a car down?
It could.
These would be much cheaper, right?
It could. By the way, when you look at that $50,000, so when we hit that target, we also were experiencing a very high level of electric vehicle sales. Okay. Right. This was at the very end of the tax credit.
So that will naturally come down.
Yes. Right. So you're going to see, if you're already seeing the average transaction price down a little bit as relatively more expensive EVs are sold in smaller volumes. But I do think this affordability question is something we have to continue to look at. And I do think there's a role for policy to support affordability as well.
There's also the matter of culture, right? American culture. I keep hearing this, and you go outside right now, we'll look up and down I Street. Americans like big cars. I mean, how do we rationalize the tiny car thing with what I see every time I get on the road?
I think you're exactly right about that. This is a market that values large cars. It's also a market that values what a car marketing person might call a richer mix, higher trim levels, more technology, more stuff in the vehicle. That's what consumers demand in this market. I think, though, that when you get a little bit more of the deregulatory actions in place, you will see some affordability, but there are larger questions related to purchasing, questions related to supply chain, questions related to tariffs. It isn't simple it's overly simplistic to suggest that it just needs a little bit of deregulation and then the vehicles become more affordable. It's more complex.
Your industry has become so complicated. There's no doubt about it. How many people pick the car based on the infotainment system? You've got to have a percentage on that, right? It's got to be a huge. It's like buying the wine based on the label. It happens every day, right?
You know, I think it does, but I'll tell you what. In China, it happens more in China than it happens here.
They want the bells and the whistles.
Well, they want the.
John Bozzella, I'm sorry, we're out of time.
Fantastic, Joe. Thank
The
you.
Alliance for Automotive Innovation. He's the expert. I'm Joe Matthew. This is Bloomberg.
Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody across Bloomberg platforms. Carol Masser, Tim Stenivek, and wait, did I walk in the wrong door?
No, this is the right place. Same show, new home.
You know, we did one of those like makeover shows and like over the weekend, paint, everything. This is where we are.
Well, here we are.
Yeah, same, like different background, but same stuff.
And you're stuck with us still.
You're still stuck with us, so sorry, but continue to send in the messages on the Bloomberg. Very good Monday afternoon, everybody. December 15th, the last full trading week of 2025, which is kind of amazing considering what a year it's been. We're not quite done. And this is going to be a week where we are going to get a lot of economic data points.
Yeah, it's going to be the backdrop of our program today. We are going across assets. We see stocks, bonds, and the dollar wavering. Investors prepping for more info on the U.S. economy. We're going to have more from Charlie in just a minute.
Yeah, looking forward to that, folks. And so this hour, what we were thinking is we've got to focus on all of those economic releases to come, Tim, this week. Inflation, we've got jobs. We're going to have a Jobs Tuesday. It's usually a Jobs Friday. You know, everything has been turned upside down because of the government shutdown. So we're going to get into what those data points might reveal about future Fed policy.
Also, the pursuit of Warner Brothers Discovery. Netflix
Not
making
done yet.
its case.
Not done yet.
The co-CEOs of that company out with a letter that says, hey, Hollywood, don't worry, all is good.
Yeah, okay. That always gets me worried when people
We
say,
love
"Don't
movie
worry."
theaters.
Yeah, exactly. All right, we're going to talk about that. Speaking of that expected deal, we are waiting to see if it closes in 2025, whether it carries over into the new year. But we're going to get into what has been a very, very busy M&A deal globally. So we'll talk about that among our most read stories on the Bloomberg.
Well, in the Northeast, it's very cold outside, and that just adds to the demand for grids. That's part of what we're going to be talking about. Is that why?
Yeah.
Okay. Well, we're inside, though.
I know.
Inside. Sally Librera is going to join us. She's president of National Grid New York. So also talking about grid resilience and AI demand.
Yeah, I'm curious about the spend, the build, and how they keep up with all of the power demand and whether or not they can build it all out fast enough. All right, let's get to the trade. We're pretty much hovering near our lows of the session when it comes to the equity trade. For an update on the session this Monday, let's turn things over to Charlie Pellet.
Thank you very much. Happy Monday to you both. Certainly feeling the chill on Wall Street today. With the Dow, the S&P, NASDAQ, they're all in the red right now. Interestingly, though, down day for much of the equity market. Our Bloomberg Mag 7 index is holding on to a gain, up by 0.4%. But bottom line here, equities lower. Little changed on NASDAQ, on the S&P 500 index, down 0.1%, lower by 6 at 68.20. We've got NASDAQ down 77 for the NASDAQ Composite Index, down 0.3%, while the Dow Industrials are down 92 now, a drop there of 0.2%. 10-year currently yielding 4.17%, with a 2-year 3.50%. Gold is up 0.4%, 43.14 the ounce on the precious metal. West Texas Intermediate crude down 1.5%, 56.67 for a barrel of WTI, and Bitcoin now down 2.3%, 86,432 on Bitcoin. The two CEOs of Netflix are laying out the company's case for acquiring Warner Brothers Discovery after rival Paramount Skydance went public with a competing hostile offer. Now, in a letter to employees today, Greg Peters and Ted Sarandos moved to quell industry concerns about job losses and the end of theatrical releases. Paramount Skydance shares today, they're up 0.7%. Warner Brothers Discovery down 0.9%. Netflix down 1.3%. And yes, we'll have a whole lot more of this story coming up right here on Bloomberg Business Week Daily. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Coming to you from News Studios, I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, the big debate in the U.S. Treasury market over the extent of Federal Reserve interest rate cuts ahead is about to heat up, Tim. We've got a string of pivotal economic data releases, and it starts tomorrow with a bunch of reports on the labor market.
Yeah, it'll go a long way in filling the void created by the U.S. government shutdown. Delayed announcements of monthly employment and inflation figures, and then early January brings in more key jobs data. We've got with us Michael McKee, Bloomberg TV and Radio International Economics and Policy Correspondent. He joins us here in the Bloomberg Business Week studio. Also here, Megan Robson, head of U.S. credit strategy for BNP Paribas. She's going to jump in with us in just a minute. Jobs Tuesday. We don't usually say that. We usually say Jobs Friday.
Usually say Friday. We haven't said that in a long time.
But are we getting a complete picture?
No, we're not. We're getting a partial picture, and it is also an old picture, so it isn't clear exactly how much difference it will make. I will defer to the smarter person to my left in terms of what the bond market is going to do about this. But you have to realize we're not going to get half of the October. We're getting October and November, but not half of the October report. We're not going to get the household survey, so we don't get the unemployment rate, which is what matters to the Fed. And we don't know in the October report how many of the actual categories in the establishment survey we're going to get either, because a lot of that comes in electronically, and some of it they have to call and get it, and whether they were able to call and get it or not, we don't know, which means for November, we're going to have a number for how many jobs were created, but compared to what? Is that compared to September, or is that compared to October and November? I mean, it's going to take a little while to figure all of this out. We also have one other big complication, and that is the federal workers. They were furloughed in October, so depending on when they were off the job and how many were off the job, they will count as not being employed. And then the Doge workers, the people who were fired or who took early resignations and had a severance, that severance ran out on September 30th, so that they would fall off as well. So we could have like a big negative number, but you drop the federal workers out and it's slightly positive. And I think that's kind of what people are looking at with this 50,000 consensus in the survey.
All right, wait a minute. So we're not happy when we're not getting data, and then we're not happy when we're getting kind of weird data, right? I mean, Megan, is there anything to it? Come on in on the conversation. Is there any value in this for you?
I think that the market does want to see some employment data. So I think it's good that we're starting to, even if it's backfilled and will be noisy, I think it's good to have that data. I think investors are also starting to think about 4Q earnings. And typically you just have GDP in other economic data that gives you a sense of how earnings will come in. So I think it will be a little bit of a relief to get past some of this data and see where it comes in.
Mike, if you're Fed Chair Jay Powell or a voting member of the FOMC, are you like, why couldn't we have gotten this data last week? but would it have changed any of the way that people on the committee voted?
We don't know. If we get a big surprise one way or another, it might have. The reason they couldn't is the Fed meeting was very early, and they extended the survey period for November to be able to get as much as they could, because they not only got started late, but they had Thanksgiving in the middle of it. So they weren't able to change it or get it in time for the Fed meeting. But I think what you'll see is Fed officials, they'll give us a feel for how they think about what it's telling them about the economy, but they're really going to wait for the December numbers, which we'll get on January 9th if we don't have another government shutdown, and that will be more of the basis on which they'll make a decision for the end of January meeting, although also with the CPI numbers we're going to get on Thursday.
Right. And I wonder if they're more important. We did know that Fed Chair Jay Powell, you guys know this, that he did say there's pressure on both the labor and inflation mandates on the Federal Reserve, and he talked about this being challenging. When it comes to inflation, Stephen Myron, the Fed governor recently appointed by President Trump, he shared his view once again on U.S. inflation. He spoke earlier today at Columbia. Here's what he had to say, guys. There was a large bout of inflation that resulted in an increase in prices after the pandemic. While American families are still rightly distraught with that experience and unhappy with affordability, prices are now once again stable, albeit at higher levels. Policy should reflect that. Megan, Mike, you both smile. Is he right, Megan?
So we at BNP, we're actually forecasting inflation to accelerate a bit into 2026. We think there still will be pressure on goods inflation.
Because of tariffs or because of?
Yeah, based on tariffs and some of the delayed impact of goods. So we have inflation target around 3%. And so we do think there also will be some bumpiness in the labor market, potentially, as Mike highlighted for the January report. So we think we get one more cut next year, but that inflation will prevent the Fed from really extending a cutting cycle beyond that.
It's pretty much a universal view that we're going to see inflation accelerate because of tariffs into 2026. There's some question about when that falls off. Jay Powell said 6 to 9 months it could be that we see this. But the interesting thing about what Stephen Myron said, and remember he's there to give Donald Trump's viewpoint, was that inflation has stabilized, albeit at higher levels. Well, wait a minute. That's what you're supposed to bring down.
So then there's inflation.
But that brings up a good point, and that's about the Fed's 2% target and whether or not that's actually a realistic thing right now. What do you think, Megan?
I think that
given the environment that we're in,
I think it's going to take. I mean, look at their forecast. I think it's going to take some time for the Fed to get to the actual 2% target. And it does seem like, although they're looking at both sides of the mandate, Powell does still seem like he's biased towards the unemployment side of things. So if anything, we would likely get more cuts based on that posture.
Mike, will CPI help us out here in terms of giving us some more good information on inflation?
I don't think it'll give us a specific amount of information, unless it's a surprise, as I say, that will change Fed feelings, because I think they have a pretty good feel for where we are within a certain range. But the thing that is going to get people is, when do we have a feel for what unemployment is going to do versus inflation? And that's what you need to have, is the comparison, because right now they're betting on unemployment being worse. They're looking at the SOM rule, basically, and saying when unemployment starts to accelerate, it goes up fast. If it doesn't do that, but inflation doesn't come down, then they're going to flip their mandate and start worrying about inflation more.
You guys have been watching the Fed for a long time. What does, if both of them are challenged, what are they going to be most, let's say jobs gets better, but inflation gets, like, which one is more important, I guess, was what I'm guessing, in terms of the mandate. I'm not laying it out well. But, I mean, does one of them matter?
They don't want to say one matters more than the other. But what their official strategy is you look at the one that is farthest away from the goal that will be the hardest to bring back to where you want them to be.
Right.
And right now they think that's going to be unemployment, because they had been making progress on inflation until we got the tariffs and things started to turn around there. But there's another argument that there are some embedded inflation problems in the numbers that are not related to tariffs. And that's what they're going to have to be able to tease out here and figure out. I was thinking when Megan was talking, since 2015, roughly, when they started putting out these summary of economic projections, 2% has always been their goal. But every year they move it 2 years out. Right now, we're not going to see 2% until 2027. Well, last year it wasn't going to be till 2026, and the year before that it wasn't going to be till 2025. So can they hit it? That's an interesting question.
2 years from now, maybe.
2 years from now.
2 years from, and 2 years from.
Well, the Fed does 2 years.
Year.
Donald Trump does 2 weeks, you know.
Well, Megan, on the dual mandate, what Carol was getting at, and this seems to be the core tension between different members of the FOMC. Which one is the priority in your view? What needs to get under control?
So we think they will protect what they will do, not necessarily what they should do. We do think they will protect the labor market. And so we think they are biased towards more cuts. I think that's partially why you're seeing asset prices so elevated.
At the risk of inflation.
At the risk of inflation, because you have the Fed at your back. You know, if unemployment, we do see a nonlinear sort of rise in the labor unemployment numbers like we did over the summer, the Fed is there to really cut. For now, we haven't seen inflation rising to any degree like we did outside of the pandemic. So I think that is lower on the priority list for now.
All right. So I want to ask you, Megan, I want to stay with you for a moment in terms of the credit markets and what we're seeing. It seems like we had a little bit of stress earlier this year, right, in terms of some of the regionals, some of the, kind of subprime auto lenders and so on and so forth. What are you seeing right now?
So I think the debate right now is really around, are we seeing a transition from deleveraging to releveraging? And for most of 2025 through third quarter, we still really saw corporates very disciplined, not much borrowing, higher rates really impacted debt issuances. And then that sort of started to change in third quarter with the hyperscalers and just really chunky M&A deals in the expected pipeline. So for next year, we do think there will be a pickup in supply and an end to the quote unquote bond scarcity story, but we're still forecasting less supply than consensus. We think that rates are still elevated and they will dissuade some sectors outside of the known, utilities, hyperscalers from really borrowing too much. So I think that's the key story, especially in the investment grade markets.
We talk a lot about the K-shaped economy, and that's kind of been like, the backdrop of our conversations over the last few months. You note the credit market is K-shaped. What do you mean by that?
So K-shaped, I think it means a couple things. You have some sectors where you're really seeing CapEx expectations surge, and that they're expecting growth, and you're seeing borrowing on the back of that.
Technology.
So technology is a great example. I think utilities is another example. CapEx has increased 20%.
Related to the tech spend.
Related to the
We're
tech
going to
spend.
talk about like the New York power spend really a little bit later on this hour.
But on the other side, you have sectors much more tied to the consumer. They're growing much more slowly, and they're much more cautious about adding leverage. So we do think that there's a dichotomy there, and so overall credit can perform well. And part of it is you're not seeing that real animal spirits in a lot of the market.
Mike, when you think about the economy and moving into a new year, I mean, it's hard to believe all the kind of twists and turns we had this year, but what are the major risks to the economy next year?
Well, it's interesting because the president is touting, and some economists are writing into their forecast the idea that people are going to get bigger tax increases, tax refunds this year because of the president's tax cuts, and then they're talking about some sort of bonus checks. That's probably not going to happen. But the offset to that is the whole thing with the Obamacare premiums, because if you're going to get $1,500 back on your taxes, but you're going to have to pay $2,000 or $3,000 a month, that's not going to go very far.
Right.
So we don't really know what's going to happen, and I think the overhang of all this is confidence. I've said this many times before. Recessions are when confidence falls, and so it depends on how people are going to be feeling, which is kind of the tension you see coming out of Washington. Is the Republicans are saying to the president, get out there and tell people how wonderful it is, and then people, when they hear him, say, no, not so much. And so the Democrats are going to be piling on that side and the Republicans on this side, and we'll just have to see how people feel as the year goes on and all these things come at them.
Yeah, Megan, on that, the way that people feel obviously has an impact on the way that they spend, on the way that they think about the economy. How are you looking at that going into 2026?
I think for credit investors, there are some places you can position for some of the weakness and strengths that we're seeing on the consumer side. In the high yield market, we like mortgage servicers and originators. We think as rates continue to fall down and you have exposure to more medium, upper income consumers, that sector can perform well next year. And then on the other side of the coin, sectors that are exposed to not only lower income, but also that middle tier that's starting to show weakness, we think are places you might want to avoid. So leisure, out-of-home entertainment, places like bowling alleys, movie theaters in the high-yield market have really struggled more, and that's places we'd be more cautious on.
You're going to say you were just at a bowling alley.
No, I did bike by a bowling alley over the weekend, but I did not go inside. We hear from the cruise operators that everything is awesome.
Super rosy, super rosy. You sound more cautious.
I think on the cruise lines are interesting because they do a lot of their revenue is pre-booked, so they could be booked for all of 2026, and so there is this sort of lagged impact on weakness that we haven't seen on the cruise lines. But to your point, we've seen cruise lines has been an area we've liked. We've seen upgrades, and they've done a great job deleveraging their balance sheets.
Mike, 20 seconds. John Williams, the president of the New York Fed, said monetary policy now well positioned for 2026. When he talks, it's important, right?
Well, when he talks, he kind of gives you an idea of where the chair is, because he's the vice chairman of the Open Market Committee, which by tradition never dissents. But we already know that because that's exactly what Powell said. So they're out delivering a unified message now.
Team, all aboard. All right, we got to leave it there. Michael McKee, international economics and policy correspondent here at Bloomberg, and of course, Megan Robson, head of U.S. credit strategy at BNP Paribas. This is Bloomberg.
Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're all in the red. Russell 2000 index also declining, down 0.6%. The Bloomberg Mag 7 index so higher, up by about 0.3%. But equity markets lower right now. First trading day of the new week. Last full week for 2025. The S&P down 11 right now, 68.15 where we stand, down 0.2%. Dow Industrials also down 0.2%. The NASDAQ Composite Index down 103 now, down by about 0.5%. 10-year at 4.18% with a 2-year 3.50%. Gold is up $13 the ounce, 43.12 up 0.3%. West Texas Intermediate crude down 1%, 56.85 a barrel, and Bitcoin is at 86,200 now. Bitcoin down 2.5%. PME, that is a Dutch pension fund, has severed ties with BlackRock based on an assessment that the world's largest money manager no longer acts in its best interests on issues such as climate risk. BlackRock shares, they're down now by 0.4%. Recapping, S&P lower by 10, down 0.2%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got to Charlie. Carol Master, Tim Stanovic, live here on Bloomberg Week Daily. We'll get back to Charlie in just a moment. Hey, 3 names that we keep watching: Netflix, Paramount, Skydance, and Warner Brothers. In terms of the acquisition, the pursuit, if you will, of Warner Brothers. Right now, Warner Brothers just down by 0.8%. Netflix is down, Tim, 1.2%, and Paramount Skydance just up about 0.75 percentage point.
Well, Netflix co-CEOs Greg Peters and Ted Sarandos, they're trying to reassure employee concerns about the company's bid for much of Warner Brothers Discovery, reiterating that there's no business overlap and therefore won't be any studio closures. And, you know, they're like, actually, we like movie theaters and we think there's a place for movie theaters.
Yeah, like just some reassurance, right, out there. Just remember, we've got Netflix's $82.7 billion bid for Warner Brothers. It's a big one. The streaming and studio businesses was agreed to by the Warner Brothers board. Then you had Paramount Skydance come in, and they swooped in with a hostile $108 billion bid for the entire company. We've been following this saga. So we want to see where we are, because we did see Netflix's co-CEOs come out and try to maybe calm everybody down. Bloomberg News senior editor and entertainment team leader Chris Palmieri has been on this story, so we head out to the West Coast. Chris, it feels almost a little quiet today after last week's actions and felt like nonstop activity around Warner Brothers Discovery. What's the latest? What's new?
Well, you can be assured it's going to get a little louder later in the week. So today, Netflix comes out and is trying to reassure both employees and Hollywood about their intentions. They're still going to release the Warner Brothers movies in theaters, and they're saying basically to their employees, "Don't worry, we don't have a studio like Warner Brothers, and so that we're not going to be firing people en masse like say Paramount might." That was the implication there. But Paramount has reiterated its offers. Warner Brothers has 10 days as of last Monday to respond. So everyone anticipates, including Paramount, Warner Brothers to come out and say, we're sticking with Netflix, in which case the ball will be back in Paramount's camp to increase their offer more to try to lure Warner Brothers away from Netflix.
Chris, I'm going to ask you a very general question, and it's going to require you to paint with somewhat of a broad brush, but in general, how does Hollywood view Netflix? And is there a suitor for Warner Brothers Discovery that in general people in Hollywood would rather have?
Not another suitor, no. I think that generally Hollywood would be fine with Warner Brothers continuing to remain an independent studio, and there wouldn't be all those mass firings and changes in strategy.
The so-called synergies that we've heard about.
Yeah, I mean, Paramount has said the number could be $6 billion. Now, a lot of that's likely coming from the cable networks that Paramount's acquiring of Warner Brothers, but still a staggering number, twice what Netflix is projecting. So yeah, I think Hollywood in general would prefer this, another studio hiring them and greenlighting new movies and all of that thing, rather than Netflix or Paramount.
All right, so is this it? Is there anybody else who could come in? Is there any other configurations that we might get out over this? Because I don't know. It just feels like
there's still, I spoke to Mario Gabelli last week. He still held out hope that Amazon or Apple would come in and make a giant bid at some point.
Done.
But
yeah. Not Bob Iger or anything?
Definitely not Disney.
Okay.
Would it fit with those more tech-focused companies, Chris, or would it have an easier regulatory path?
Really hard to say. There certainly would be pushback about big tech company increasing its strength in any way. But neither of those companies, Apple or Amazon, has a studio like Warner Brothers, this beautiful lot in Burbank, and so you could argue that it would be a good fit for one of them.
Hey, the Paramount deal, though, all the financing is there for it. I mean, we've been talking about the hit that Oracle has taken and what that does to the wealth of Larry Ellison, right, who was supposedly backstopping it. So is there any concern that if indeed Paramount, Skydance is the winning bid, that everything's there?
There is concern. We've been hearing from the Warner Brothers side that was one of the issues with rejecting Paramount, that they didn't feel the money was there. And of course, Paramount is saying the opposite. They've fully backstopped by the Ellison family.
How badly does Netflix want this?
Well, that's a question a lot of people have been asking, but I think you have to take the letter today from the co-CEOs at face value and they're still in the game.
It's because shareholders haven't been that supportive of Netflix's bid. I mean, we've seen shares down significantly since Netflix got in on this bidding process, Chris. Like, they're not convinced that this is necessarily a good fit.
Absolutely. I mean, they lost tens of billions of dollars of market value in it, and the closer Netflix gets to doing a deal, the more the stock seems to fall. If you look at the track record, I've sort of joked that Warner Brothers is like the King Tut's tomb of movie studios. Anybody that acquires it is cursed. And from AOL to AT&T to Discovery, those mergers haven't worked. So there's certainly reason to concern for either bidder.
Hey, we'd be remiss. One last question, Chris. Obviously, everybody thinking about Rob Reiner and his wife found dead at his home yesterday, stab wounds, according to sources close to the family. And we know his son, Nick Reiner, or their son, was arrested by the LA Police Department. I mean, our thoughts obviously go out to their family and friends, and it's shocking, the story. Just curious what you are hearing in and around the LA community.
Just shock, really. I was at a party last night when the first reports came out, and just amazement. I mean, you forget when you look at his biography of all the wonderful movies and TV shows he was associated with. They're really just such a part of our popular culture for 40 years now. The whole family, with his father, Carl Reiner, in that as well. So it's just a great tragedy.
All right, we're going to leave it on that note. Hey, Chris, thank you so much. Really appreciate it. Chris Palmieri, out there in our LA bureau for Bloomberg News, senior editor and entertainment team leader here at Bloomberg News.
Well, on Hollywood, we wait for an expected deal involving Warner Brothers to wrap up. We are curious, though, whether it will end up in the M&A league tables for 2025 or for 2026, Carol, which brings us to one of the most read stories on the Bloomberg terminal.
I love this story. It's about how the deal makers are heading into the final weeks of 2025 on that $100 billion cliffhanger that is the pursuit of Warner Brothers. Let's get more on the year in global M&A. Michelle Davis is in the house. She is Bloomberg News senior M&A reporter. First up, before we touch on the Warner Brothers pursuit, good year for global deal makers. Like, finally, right?
Pretty good, yeah. One of the best ever, arguably. And bankers have been saying, if it hadn't been for Liberation Day, it may have been the best one ever. Second best of all time, actually.
How big of a speed bumper, hiccup, was so-called Liberation Day?
It was, in the sense that deals were put on pause for 6 to 8 weeks.
I mean, do you remember that where all the IPOs that were set to be priced were put on pause for that? Like, every day there'd be like, hey, this company's put their IPO on hold, this company's, but then they all came back.
They did. And so we saw volumes at $4.5 trillion. It's all setting up for 2026 to maybe even exceed the record year that we saw in 2021. But folks that we talk to are always quick to remind us that, while everything does seem to be setting up for a really great 2026, 2021, the last record year, was a little different because we had rock bottom interest rates. And so that really propelled, private equity. That's the one leg of the stool that we haven't seen come back yet. Of course, everyone's predicting that, private equity buyers will come back in 2026, but who knows?
I think what's fascinating, Michelle, is just the kind of deals that were done. You've got railroad, you've got mining, you've got video games, and of course you have technology. I mean, we saw a lot of deals happening in a lot of different spaces and some good-sized deals.
Yeah, so the strength has really spanned sectors. It's been broad-based, and what's been interesting has been the size of the deals. So this has been a record year for deals over $30 billion. So it's the return of the mega deal. Over the last couple of years, we didn't really see anything above that $30 billion figure. This year we have like more than 10 that exceeded $30 billion.
What's the theme that defines the deals? Because I look at the graphic that we just had up, and I'm reminded that a lot of the companies that have shed assets, those assets have been bought up at pretty sizable stakes. And that's kind of where we are, at least in the business cycle right now, where these companies are saying to themselves, you know, separate is actually better. There's more shareholder value there.
I think the other theme that we've seen a lot of is companies are really shooting for the moon. They see a really clear and maybe easier regulatory environment than they have had for at least 4 years. And so they're all doing these dream deals that they'd put on the shelf. And, you know, they're just, again, shooting for the moon. They're, you know, contemplating deals that we haven't ever thought could happen, like railroad sector. Who thought there would be more to do there?
Right.
But, you know, they announced a deal. The Warner Brothers situation is another great example. And of course, you know, already one of those Warner Brothers deals, Netflix Warner Brothers, that will be in the league table for 2025 because they signed a deal. Whether Paramount,
I was curious about that.
Whether Paramount upends that deal, you know, is another story. And that only means that if that happens, we could see an even bigger deal value at the end of, you know, when this finally gets set in history.
Before we go, you know, Michelle, I think about the role of the White House this year. Go back to Liberation Day, April, upending the markets, volatility, and so on and so forth, that really made a lot of corporate boardrooms nervous about maybe pulling the trigger. Having said that, then we kind of got back to where people calmed down, but you also had the White House taking positions in various companies. That was part of this, right?
Yeah, that's been a really big theme this year has been, you know, the White House's involvement in deals earlier, from not only, you know, taking a stake in Intel earlier this year to, you know, the president making comments about whose hands he would like to see Warner Brothers ultimately end up in.
The AI side of this, I mean, a lot of the big deals were as a result of AI investments or money from these companies. How does that theme continue into 2026?
So it's part of why we've seen such a big pickup in TMT, but a lot of the AI deals haven't been, you know, what you'd think of as traditional M&A. They're like announcements about, you know, JVs or that sort of thing that don't necessarily reflect in the numbers. But the one thing about AI that's interesting when we think about next year is it came up as a swing factor that could cause all of this to end, in that, you know, if next year, for whatever reason, investors get spooked about AI and get worried that maybe there aren't as many use cases for it as previously thought, that could be something that causes, you know, the stock market to come down and then maybe impacts overall sentiment among CEOs.
Kind of the good, the bad, and the unknown, right, of AI. That kind of continues. Michelle, thanks. Michelle Davis, Senior M&A Reporter at Bloomberg News, joining us right here in studio. We mentioned AI. We're going to talk about the AI build when we come back, the electric grid power needed to keep it all going. We're going to talk to the head of one New York utility in the middle of it all. I'm looking forward to this, right?
I'm looking forward to it as well. I love talking power.
Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They are all declining right now. The Mag 7 index is advancing. That index up by 0.2%, but the S&P, keeping it all in context, it is down 0.2%. The Dow Industrial is down 0.2% as well. NASDAQ is down 0.5. The 10-year 4.18%, with the 2-year currently yielding 3.50%. Gold up 0.2%, 43.10 the ounce, and West Texas Intermediate crude oil WTI down 1.3%, 56.70 for a barrel of WTI. Bitcoin, meanwhile, down 2.5%. Bitcoin 86,231. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Tim Stanovic live here at Bloomberg headquarters in New York City. You found this and you pointed out in our planning call, it was a report in the Albany Times-Union, and they said over the weekend, National Grid and other utilities are spending billions of dollars to prep New York's electric grid for a generational shift, and it includes things like all of those AI data centers that are being built in the state and across the country, really.
Yeah, the paper went on to note that New York utilities are spending that much money to modernize the grid for those facilities. Their investments for New Yorkers, many of whom are already struggling with utility costs, are going to have to pay for that in the coming years. But the idea is that we're prepping it for the future.
Exactly, exactly. But so how uncomfortable as the build out happens and the stress on the grid continues. Let's see what our next guest has to say. We've been looking forward to this. Sally Librera is President, National Grid New York. It's a subsidiary of the publicly held electricity, nat gas, and clean energy utility, National Grid PLC, serving millions in New York and Massachusetts. National Grid ADRs trade in the U.S. They've got about a $75 billion market cap. They're up more than 27% year to date. So nice to have you here. How are you?
Great to be here. Thanks, Carol and Tim, for having me.
Well, it's great to have you here. How would you describe power demand today and how that demand is growing, surging? Use whatever word makes sense so that we understand what's the current situation.
Sure. So at National Grid in New York, we serve more than 4 million customers, and we deliver natural gas and electricity to those customers, and our focus is on doing it safely, reliably, and affordably. But the reality is there is increasing demand for energy across the entire state. And we serve through upstate, we serve in Long Island, and we also serve in New York City. And it's our job to deliver that energy, to meet that energy demand where, when, and how folks need it.
How would you quantify that demand, though? Give us some idea, because we're talking nonstop about deals of AI data centers, whether it's New York or elsewhere. Give us an idea. How stressed is the situation?
So we work with our New York Independent System Operator, the NISO.
Yeah.
And NISO manages what we call the large load queue. So it's essentially the companies that have indicated wanting to hook into the New York grid that have large power needs. And they estimate that the cumulative power need across those companies that are essentially in line to connect sometime over the next 5 or so years is about 10 gigawatts of energy. And so just to give you some context, at our peak in New York, we demand about 3 times that across the entire state. And another really important point is that 1 year ago, that queue was 1/3 the size. It literally tripled in just 1 year.
All data centers?
No, not all data centers.
What is it then? Because it does seem like for many years, we thought that power demand across the country would actually stay relatively flat. And it did stay relatively flat. But just in recent years, we've seen so much of an uptick in demand. What are you seeing on your grids?
Well, there definitely is the impact of data centers, but New York is also very attractive to manufacturing, and large-scale manufacturing, particularly some of the modern manufacturing we see around semiconductors and computer components. It's very energy intensive, and companies with big power needs are drawn to New York. And we are working to make sure that they have the power that they need, not just today, but well into the future.
So it's interesting, right? Because we think about this White House, right? And encouraging investment from foreign companies to build here. I mean, I guess, that's the good thing, right? We want to see other companies investing into the United States, but there's a power grab on that too, right? As a result of that, in order to meet that.
Well,
potentially.
I think it is important to note that even if we weren't at this unique moment in time with rapidly increasing demand for power, we still have a grid in New York, and this is true across many places in the country. We have a grid that needs investment. We have assets that are close to 100 years old. on our grid.
Right, Tim? Like, how many people? Like, why? If it's 100 years old, why 20 years ago? Right?
Why didn't we make the investment then?
Yeah.
We've been
politics. I'm guessing part of it.
That was a long pause.
Please, you answer the question.
Trying to understand because it's important.
We have been very careful about balancing the bill impacts which customers bear with the investments that we make in our infrastructure. And even today, where we look at assets that are 70, 80, 100 years old, we're very strategic and pinpointed about which of those assets, which of those parts of infrastructure we replace, because we want to keep customer bills low. So we look for those opportunities where we can do multiple things with an investment, where we can replace an aging asset with something that's more modern and something that can carry more energy, something that can unlock more energy that our generators have to connect into the grid, and something that's going to be more resilient to storms and better leverage technology so it's cheaper to maintain.
Does more resilient to storms mean burying power lines? Is that the way to do it?
In some cases, we do that, but it's also the type of infrastructure that we put up. We are replacing in places sometimes wooden poles with steel poles, just much stronger infrastructure.
Well, and I think about how do you balance all of that? Like affordability, as you know, has become quite the word that we are hearing a lot, certainly in the political environment. So how do you keep your investors happy and the grid reliable without rising bills that make your customers furious and invite regulatory and political pushback? I mean, that is a hard mandate.
It is a difficult balance, and it's one that we navigate every single day. We do it through a number of avenues. We certainly work closely with our customers to help them manage costs, and we do that through a variety of bill assistance programs and energy efficiency programs and rebates. And we have consumer advocates whose job it is to specifically work with folks in communities to help them manage their costs. We also, as I mentioned before, are very careful about where and how we invest in assets, and we make sure that if we're investing in an asset, that we're going to get more power from investing in that asset, that we're going to get more resiliency, and that we're going to get more efficiency from investing in that asset.
The president has been outspoken about his disdain for certain renewables, especially wind power. Your investment in renewables or sourcing energy from renewables, has that changed under this administration?
Well, we certainly support the all-of-the-above energy approach, and are pleased with the most recent version of the State Energy Report that's just come out today that leans into an all-of-the-above approach. Given the rate at which demand for energy is increasing, we need to be utilizing all of those opportunities, from renewables to natural gas to nuclear, to make sure that
is that more difficult if the federal government is not supportive of certain renewables?
We are working on the infrastructure to move power from point A to point B. So while we support projects like, say, the Nessie pipeline, that's a supply project. It's not our project, but we support it because we know how critical it is to the downstate community and how reliant New York City and Long Island are on natural gas, and how thin that reserve margin is, and their demand for energy is growing as well. So we support Nessie for those reasons. The other side of our business is about building transmission. It's about building the highway over which the power moves. So the sourcing as to where it's coming from isn't a national grid decision. We work with generators of all kinds.
Bottom line, though, does this potentially, as you guys are very careful about when you invest so that power prices don't go up, but are there going to be moments where prices are just going to go up just because of the environment, and it's hard to kind of predict everything? And forgive me, just got about 30 seconds.
There are moments, and now is one of those moments where customers are seeing increases on their bills, and that's for a number of reasons, but primarily it's to be investing in infrastructure that is necessary. Those investments are necessary to make sure that folks continue to have the safe and reliable energy that they need.
And those investments include renewables, green, all of it.
Well, we're investing in the ability to unlock those energy sources and be able to bring them onto the grid and move them at a greater frequency.
Okay. We could go another 60 minutes. So hopefully you will come back soon. Really appreciate it. Sally,
Thank you for having me.
Sally LeBur, she's president of the National Grid New York, joining us right here in studio.
Hey, coming up next, stocks on the move. And speaking of indices on the move, the S&P 500 down 0.2%, the Dow down 0.2%, the NASDAQ, though, the underperformer, that's down 0.5 percentage point. This is Bloomberg Business Week Daily.